Well, Air France, AIG, Lufthansa, all raised to equal weight over at Barclays. Chrissy, you can take us to the open.
We are buzzing with anticipation this morning because, of course, we are ready for the opening trade across Europe. As Lizzie and Val both set us up very kindly, we are now seeing, of course, perhaps, or setting ourselves up, I should say, for some pain when it comes to that Swiss market. But the rest of the market should be in green on the screen, at least when it comes to the futures picture. The FTSE kind of 100 kind of waffling at the moment, only higher by 0.1%. A similar story when it comes to the stock 600 as well. So green on the screen there, but I'm not sure we're going to see the same kind of momentum in the open that we saw in the futures sector. IBEX right out of the gates higher by 0.4%. We're going to still wait for a couple of minutes for the SMI and, of course, for the DAX, which I'm surprised is open this early. It usually takes about 3 minutes, which I think tells you just how low the volume and liquidity is. It is officially August at the end of the day. The SMI, I think, may take some time, confident at least in that call, Val.
Let's take a look at the sectors as we are just a few moments into the opening trade. We do have 5 sectors in the red, the remaining 14 in the green so far. Travel and leisure is at the top. As Lizzie had mentioned, we're keeping an eye on some airline stocks. This morning, we are seeing airline stocks power the Euro Stoxx 600 stronger this morning. To the downside, though, we do have healthcare, only the 3rd worst performing sector this morning. We're still waiting for some of those Swiss names to open, but it does look like we do have Roche on the downside, down 2% so far in the first moments of trade.
Yeah, so Roche down more than 2%, Novartis down 1.1%, Nestle nearly 1%, Richemont 2.5% lower, Swatch 3.4% lower, and ABB down 2.5%. So the pain opening up for Switzerland there. You mentioned the airlines, Val. You've got Air France up 3.33%, IAG up 1.6%, Deutsche Lufthansa up 1.8%. So that upgrade benefiting those as things stand. And then when you look across the overall picture now, as we can see, yeah, you've got about half of sectors in positive territory, and it's really just the Swiss market that we're waiting for at this point, Chrissy.
But I think we're going to get a pretty decent indication, at least from some of the names that you had highlighted there, just how much pain we are due from an index perspective as well. But I think what's also interesting is how much is really priced in here. Remember, Novo Nordisk, for example, took a massive beating on Friday as well. So the rebound here is about 1.5%. BP seeing some green on the screen ahead of their earnings tomorrow. We'll have an exclusive interview with their CEO there as well. So light volume, light liquidity, but just a little bit of a catch-up trade in this market, which I have to say makes things just a little bit easier to interpret.
And now we have it, Swiss market opening down 1.8%.
So less than the futures actually indicated. We'll see if it continues to spiral there as well, or if it continues to rebound. Lots going on when it comes to the market's picture.
All right, joining us now is Benedict Lowe, equity derivative strategist for Europe at BNP Paribas Markets 360. Thank you for joining us this morning. I think we have to start on the question on payrolls. Did the revisions on Friday change any of your big macro views?
I think it made the questions of the Fed cut in September even more pregnant than it was before. So in our view at BNP, we still think that the Fed will remain on hold in September, as we expect the CPI data and the data on the inflation side to start to show some pressure coming from higher prices. And we don't think the Fed will be able to cut in September. But on the market perspective, we've seen that now the market is pricing in 21 BP rate cut for September. So there's room for disappointment, we think, in terms of what's pricing for September.
And then I guess the other key theme for us this morning is the market reaction to the 39% tariff rate on Swiss exports to the U.S. Does that worry you in terms of maybe Donald Trump setting up some negotiation tactic ahead of the pharmaceutical sector tariffs that we're waiting for?
Yeah, I would say it was a huge disappointment. When we were hearing the conversation and the negotiation with Switzerland and the U.S., it seemed like they were going in the right direction, that Switzerland executives were expecting some good news to come out of the tariff, and I think it really came in as a shock. Now, the reality for the Swiss equity market is that a lot of negative news was already in the price, and this is probably why the market reaction this morning is quite negative, but not overly extended on the downside. The reality is that the Swiss market is the index that was lagging versus overall equity index since Liberation Day. So I think a lot of negative news was already on the price.
So is it because it's already priced in, or is it because there's optimism that 39% is a level that's going to come down?
Probably both. I think there's expectation or hope at least that we will be able to bring that rate lower, maybe closer to what we have for the European Union in terms of the rates in terms of tariff. But also I think the market was already pricing in very negative news for the Swiss market, and I think the reaction as a whole on the dark side will have to be more cautious just in terms of positioning. The healthcare sector has lagged quite a lot. Companies in Switzerland have announced that they were doing some huge investment in the U.S., that they're relocating some of their manufacturing over there. So I think the signal was quite positive from them, and then we're one of the reasons why we're not seeing such huge move on the downside this morning.
And just going back to payrolls, we saw Sell America back again on Friday, but not necessarily by Europe. If Sell America continues, does it benefit Europe?
Yeah, I think what we had on Friday is a double whammy for Europe of the tariff news, where the market was already down around 1.8%, and then the poor data out of the payroll. The U.S. situation is a bit more tricky because you can be in a situation where bad news is good news, in the sense that the Fed will have to come save the day if the data gets too negative. And I think there's been a bit of a pause in this sell the U.S. exceptionalist trade as a whole, where basically the market is expecting some positive signal to come from Europe. We've seen that the earnings season has not delivered any positive news out of Europe, so I think people are kind of waiting on the sideline, not to be too early on that trade.
When it comes to kind of the moment in the sun that Europe has had in the last 6 months or so, there's a big question here of how much of that fund flow is basically getting reversed a little bit, even to the United States, even just kind of removing it from a tactical perspective. Do you see that when it comes to the fourth quarter, do we see Europe outperforming the States or the States outperforming Europe?
Yeah, as you mentioned, it's definitely slowed over the past few months. Now, the hope for Europe is that in the end of the year, we're going to start to see the effect of the capex super cycle coming from the German fiscal stimulus. And that is really the hope for Europe, that we're going to get that growth picking up, that cyclical recovery that we've been waiting on for so many months and even years, and that would be a clear positive signal for stocks. Now we need to see it in the numbers, as the market is kind of being quite patient and not ready to be the first one in and get burned.
When it comes to not being the first one in, what drives kind of the investment case right now? Is it ultimately what's not getting touched by tariffs? Is it who's maybe cutting rates the fastest to give that little bit of a tailwind? Is it still economic growth when the whole world seems to be slowing at the moment? What is the driving catalyst here to make a bull case?
Yeah, I think the bull case is probably we need to wait for the end of the earnings season for the market to digest that it's not been actually really great for Europe, and then to focus on what's coming up in the Q3 and Q4 quarter. As we mentioned, the German economy is going to front load a lot of their fiscal spending, and that should start to show into the numbers. We should start to see optimism from companies picking up, and I think they're probably waiting for basically some real signs from the economy. They're just getting a bit fed up with just like hopes, and they're actually waiting for some signs that the economy is picking up to kind of go back into the bull case for European stocks.
Benedict, given your position as an equity derivative strategist, we had this jump in the VIX on Friday. It went above 20. How does that play in to your calls on perhaps how you use volatility in order to position for some of these trades? Is this something you would want to sell into?
Yeah. So on Friday, we had obviously a sharp move lower in spot market, and as a result, we had the VIX and the VSTOXX, the European indices, that went back above 20. So decent move. Now, the reality is that the vol move was actually quite contained compared to the spot move. I would characterize what happened on Friday more as a sell-off in spot market than as an overall overreaction in vol market. This is very different from what we had in August 24, when we had basically a vol meltdown, whereas here I think positioning was much lighter into it. I think people knew that this week was going to be a very heavy week in terms of macro, but also in terms of tariff. So I think people were a lot more hedged, and there was a lot more surprise from investors from those huge moves, and hence the lower vol reaction we had on Friday.
But given that there's so much left to settle when it comes to tariffs, how much do you expect that volatility to settle down in the second half?
It's probably going to take a while, especially as we're not starting from very elevated level. As you mentioned, we're back above 20, but we're not at 30s level. It's basically slightly above the realized vol that we've been in, so it's not too costly to hold on at the moment. So we're probably going to have to wait for the market to digest the economic news for the vol to be able to come down from those levels.
How much of the currency picture matters here? I'm putting my Guy Johnson hat on right now. We are expecting, I think it's fair to say, some currency swings when it comes to reallocating. How much of that is driving the earnings case, the investment case in Europe?
Yeah, so I think that is one of the big reasons why the U.S. earnings season has been so much better than for Europe. We've had this huge move over the past quarter of a weaker dollar, and that has been really a tailwind for U.S. companies, especially for the tech that are heavy exporters and have benefited from this weaker currency. Whereas in Europe, we are an exporting region, and we've suffered from that. Now, we've seen over the past week or so, the euro has started to weaken. We've had this huge move higher on Friday back, but we're starting still at kind of more reasonable level. That should be easier for European stocks basically to digest and for them to perform in.
All right, Benedict Flo, pleasure to have you, equity derivative strategist for Europe at BNP Paribas Markets 360, digesting some of these the market drivers for us on this Monday morning. We thank you so much. Let's get a quick check on the core six. I think I have a pretty decent idea of how these are going to perform, but of course we're going to see some pretty decent moves in, I think, the tech exposed names here, shockingly. ASML, Schneider Electric, higher by almost 1% this morning. Novo Nordisk actually pairing some of the initial move that we saw at the open, and now higher by only 0.7%. Nestle, also only down 0.4%. We were waiting for that Swiss read-through to come through into Nestle shares. I think Val mentioned about 15% of the Swiss market is just Nestle. Not that big of a downside move when it comes to that number. We'll see how it all shakes out. That is your core six. Let's go check on some of the other individual stocks on the move with Chloe Melly. Chloe.
Good morning. So as expected, across that those Swiss shares, we are in the red. So Novartis, Roche in the pharmaceutical sector, Richemont in the watchmaking luxury sector, and then Lindt in the chocolate making sector. The moves it's all down, but it's not maybe as down as we perhaps expected. Maybe on that expectation that things might not be as bad. We also have ABB and Logitech also down. So ABB in that industrial sector and Logitech in that software sector. Moving on to UK lenders. So UK lenders are actually up this morning. Close Brothers is up by as much as 22% this morning on the back of that UK Supreme Court ruling that ruled in their favour and means they're now on the hook for lower compensation than originally expected. So we have got quite good moves this morning across that sector. And then finally, in the airline sector, all three of those airlines, Air France, IAG and Lufthansa, got upgraded at Barclays from underweight to equal weight after quite good earnings over this past earnings season, and that is driving the stocks up, especially Air France were up almost 6% this morning, so quite good news for that airline sector.
All right, Chloe Melly from our equities team walking us through some of those early movers. We're going to display some other parts of this market. It's not all bad news when it comes to these numbers. But I'm curious if it's just a Monday feeling, an August Monday feeling. We have plenty of earnings that kick off throughout the rest of the week.
Yeah, but I guess overall, we're walking in this morning and the equity market just doesn't seem as bad as feared. We are bouncing from the move on Friday. The move in the Swiss market doesn't seem as bad as we were worried about. And then we have this big jump when it comes to these UK lenders as well after the Supreme Court ruling when it comes to those car insurance fines.
Yeah, what a whopping great move when it comes to Close Brothers, more than 20% higher. They must be particularly more affected by the FCA ruling than Lloyds Banking Group, only up 5.8%. We're going to dive into those Swiss markets more in the next part of the programme. They're reacting to Trump's tariffs, of course, and demands for Big Pharma to cut their price of their drugs. We'll dive into that sector next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Earnings season is here.
The focus is on the European earnings space.
A busy week of corporate earnings. We're going to be deeply into a lot of these earnings stories. Bloomberg is first to break the numbers.
Santander, Caixa, Soc Gen,
Deutsche Bank, HSBC, BBVA.
A slew of bank earnings already out.
With the smartest insights.
There's an earnings revolution going on.
Markets are going to be driven more by earnings.
It looks like the worst is behind us.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back to the opening trade. We're 16 minutes into today's session, seeing some green on the screen there, although I feel like we're off our highs when it comes to the stock 600, only higher by 0.1% now. The DAX, though, remains your outperformer, higher by 0.6%. Enough with the green on the screen. Let's talk about where the pain trade is, and that, of course, is going to be Swiss pharma stocks reacting to Trump's shock announcement of a 39% export tariff on the country and demands to slash the price of drugs sold in the United States. There's a lot going on here, a lot of different variables. We've got the perfect person to help us digest it. Ashley Furlong, our healthcare, biotech, and pharma reporter, joins us around the table. So we are seeing Swiss pharmaceuticals react to the partially, I feel like it's the tariff sentiment that's hitting Swiss stocks altogether, but also the drug pricing story from Friday as well. Just walk us through how these drug makers have responded, how much room to maneuver they actually have.
So firstly, there's a lot of uncertainty still for Swiss pharma companies. So the 39% is not actually going to hit them immediately. They sort of have a short stay of execution in some ways. But at the same time, they know that they need to move manufacturing to the US to sort of appease Trump, as that's been very sort of central for him. And also Swiss pharma stocks are, well, the Swiss pharmaceuticals are one of the key reasons for this massive trade deficit between Switzerland and the EU. So they know that they're going to have to come to the table with something good there. And obviously the most favored nation drug pricing threat is also hitting the Swiss pharmaceutical companies today.
Talk to us about the most favored nation drug pricing, because I think obviously this is something Trump tried to do in his first term, but he struggled with it. What changes now? How can he get it through now?
So last time it was stopped by the courts on a technicality around not sort of discussing it sufficiently with all the players. So potentially he knows he needs to do that now. He knows he needs to go to drug makers and talk to them before it's implemented. it still could be prevented by the courts. And drug makers are very keen to negotiate. So they've already come up with proposals around direct-to-patient drug pricing. And that's something that they're very keen to do because that sort of cuts out the middleman, which drug makers would love to do and Trump would love to do. So there might be some wins for pharmaceutical companies there.
I mean, do they even have the headroom to cut the price of drugs?
It depends on what actually is the ultimate, what ultimately is cut. So if it's just Medicaid, for example, which is, sort of one insurance program for Americans, that might be manageable. If it's across the board, it won't be. But Trump is saying we want Europeans to pay more and we want Americans to pay less. So ultimately he's saying, I don't want your profits to be slashed. I want you to get more money from the Europeans. So we have to see how that all plays out.
But what about kind of moving some of their exposure to other parts of the world? This was something that was floated with the likes of AstraZeneca, for example, which I don't think have commented on this particular dynamic. But at the time when they were facing pressure from some of the supply chain issues extending into China, there was a question of, do you just recalibrate where your consumer base is? Can drug makers do that in Europe?
Potentially, but it will ultimately mean that patients are hit, that patients don't get the drugs that they need. And pharmaceutical companies are they want to bring their drugs to the most patients possible. So, there'll be a lot of pressure also from governments in Europe to ensure that that doesn't happen. But there is that threat, and pharmaceutical companies have been open that, if they're forced to raise prices in Europe, in an unsustainable way, they just won't launch that drug in Europe. So that means that then, patients in Europe just won't get these new innovative medicines that they need.
All right, Ashley Furlong, walking us through those dynamics in the pharmaceutical sector. We thank you so much. Let's go from pharmas to cars, Lizzie.
Yeah, indeed. BMW going all in on its new electric vehicle offering, with the company's future riding on it, really. That's the subject of today's Big Take, with the German car maker's flagship factory set to produce nothing but EVs by 2027. The CEO has been speaking exclusively to our very own Tom McKenzie about the launch, its business in China, and how the investment is going to shape the future of the company as his tenure comes to an end.
Well, we're not waiting for the Neue Klasse, which hits the market in China in the second half of 26. So shortly after we launch it here in Europe. We're not waiting until that car is launched over there, because a lot of capabilities, especially on the digital side, you will already see currently in the cars. So we will see fairly stable volumes, maybe a little bit less than last year, but China is already stabilizing for us. And then, of course, that will give an additional growth momentum in China when this car launches the car. So we will be fairly stable this year, and by the end of next year, we will see some growth there. We're very sure, especially because this is also a symbol of the renewal of BMW, a completely new user experience, which is quite unique also in China,
In China, the competition is intense, particularly when it comes to the software and it comes to the technology. You have companies like Xiaomi coming out with the SU7, priced at about $40,000. Some have described it as a Ferrari at $40,000. What gives you the confidence you can compete in China?
Past, current, and future competencies we have. When you look how strong BMW is as a brand, and what you mentioned, the turn down in the industry, this was also partially intended by us, because we were retracting from markets which were not profitable, simply as that. And as everyone knows, there are market segments where you cannot be profitable, and we ask ourselves, growth itself does not have a value in itself. If it's not profitable, we retract. And what we see in the marketplace is various things. High technological advance, and we will give that answer with that car, that we're absolutely competitive in every market, including China. But we are not staying in a market which is not profitable for us. And how that will develop, how prices will develop this year and next year, this has to be seen. And we already see this year stabilizing prices, and that this is partially an extremely unhealthy competition, that everyone knows that,
And you have not been involved in that price-cutting competition in China. BMW has not been part of that, but you have been supporting your dealership network. Does that support continue?
You're always part of a market, but we have not been continuous specific markets and where it was not profitable. At the same time, we're reconsolidating our dealer network. That's happening at the same time to what is happening in the market. And by the second half of this year, we will be through with that. We have less dealers. We have more larger dealers. We have more profitable dealers. We have more experienced dealers. So that is happening at the same time. Why is that necessary? We have been growing by leaps and bounds in China for the last 15 years. And I think maybe it's even a good thing to take a break and consolidate our business. And that is what's happening right now.
Does that consolidation mean reduced workforce, reduced headcount in China, like some of your competitors, some other automakers have cut headcount? Is that something you're doing or planning to do in China?
We also do that. If you have less market volume, of course you adapt to that. The main thing is you have less but larger dealers, which means more profitable dealers, more efficiency.
So that was Bloomberg's Tom McKenzie speaking to the CEO of BMW. Those shares not doing very much this morning at all, as is the rest of the auto space. Middle of the road when it comes to the sectoral basket, only up 0.1%. But it's green across the screen, Chrissy, when it comes to European equities this morning. This relief, perhaps, maybe the expectation, actually, that the Fed is going to cut.
Yeah, it could be certainly a reaction function to Friday's kind of data deluge as well. There are a couple other things that are worth hitting here. I mean, we just heard the BMW CEO there talking about China. We are still waiting on trade deal negotiations between the United States and China. So Jameson Greer, the U.S. trade representative over the weekend, saying we're halfway there on one component.
Yeah, I remember reading that line halfway there, and I was thinking, is that bullish or bearish? Is that better than the market expected? Obviously, the big deal with China, it's going to be probably the biggest trade deal that Trump's going to sign out of all of these that he's focused on right now. But halfway there, is that better than you expected or not, Curdy?
Does a meeting with Xi take you all the way to 100%? I don't know.
Well, I feel like going into the conversation to Stockholm and certainly in London prior has just been, as long as you're talking, it's a good thing. So at that point, 50% is, I guess, helpful in that we are halfway there, is meant to be a positive thing. But again, we're only halfway there on one issue. There's still IP, there's still supply chains, there's still currency manipulation. There's so many other allegations that have been made from Washington that are still certainly on the table, and rare earths is just simply one of them.
And so many other European capitals to tour on all of these many talks. All the cities in the world that are affected, of course, by these US-China talks. Exactly. Coming up on the programme, we're going to dive back into the Swiss market reaction to Trump's tariff hit, that 39% level. We're going to be speaking to Mark Heifler, the Chief Investment Officer over at UBS Global Wealth Management. That conversation next. This is Bloomberg.
Applications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the fourth quarter. We think the Middle East have deep capital sources. It has strong logistics for trade, and it is a strong center for investment. And we are seeing increasingly the global GDP is increasingly becoming overweight in Asia and Middle East. So that linkage with the middle income segments growing in India and China, they will provide a very strong market.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back. This is the opening trade. We're 30 minutes into the cash equity trading session in Europe. We are seeing some decent bounce from Friday's trade. Euro Stoxx 600 is up 0.2%. Some outperformance in the DAX, but the SMI over in Switzerland has to take into account that weak payrolls print on Friday, the tariff threat of 39%, and the drug pricing threat. This market was closed on Friday, so it's on a back foot, down 1.5%. One of the key underperformers across Europe this morning. What are the single stocks, Critty, that we're having our eye on?
Yeah, it's interesting. It's August. It's the first real week of August, which means that nobody except us is working. And that really shows up in some of the volume here, down about 12% versus 100-day average, when that kind of feels like a little bit of autopilot to the upside. 433 stocks higher, 152 stocks on their lows. But digging deep underneath the surface, these are the ones that are hitting their 52-week highs. We've got Lloyd's, of course, is going to likely be talking a little bit and reacting perhaps to that Supreme Court story. How about 6.5%? Swisscom is also higher by about over 2%. Italgas also winning, I should say, a series of upgrades from Wall Street. Italgas higher by about 0.9%. When you look at the downside, though, a little bit of a different story. We have Diageo and ITX, which are, of course, 2 key stocks that we're keeping our eye on. But Nestle, I thought, was interesting because, of course, it is reacting to what we're seeing in the Swiss market, down about 0.4%. That's what's going on in the markets. Lizzie, tell us what else we need to know.
Well, this morning, Critty, you're looking at oil prices fluctuating really after OPEC Plus agreed to another major output increase, stoking concerns about global oversupply as countries wrestle with the impact of the US import tariffs. You've also got Novo Nordisk's recent struggles generating concern that the pharma giant could become a drag on the broader Danish economy. The company's market value shrinking by almost $100 billion last week after it cut its profit outlook. It had, of course, cited intensifying competition and copycat drugs over in the US. Elsewhere, we're also watching Wall Street banks losing ground in Europe as President Trump's tariffs continue to spook clients. According to data compiled by us, companies are diversifying their banking relationships away from American banks, and that move seen as a boon for Europe's leading lenders, which, of course, have been actively vying to win that extra business. Val.
All right, well, let's kick off this markets chat. Joining us now is Mark Heffley, the Chief Investment Officer at UBS Global Wealth Management. Thanks for joining the show this morning, Mark. Take us through your surprise to Friday's payroll number.
Well, I'm not sure that we're that surprised. About a week ago, I put out a piece about it being a little too quiet out there, recognizing that a lot of the tariff noise and other factors hadn't quite come through the data, but was likely to start showing up. And I think, you know, contextualizing the tariffs, the employment, what's going on in consumer spending is all part of this, a little bit of a surprise that we've had.
And carry on that conversation. When it comes to surprises, we also had this surprise 39% tariff on Switzerland. We're seeing that kind of market reaction right now. Are you reading much into that, or is Trump just setting up some further negotiation when it comes to pharmaceutical tariffs?
Well, I think you hit on the key point, which is that they had always said that there were going to be sectoral tariffs to come, and pharma was clearly part of that. And of course, Switzerland plays a major role in that, so that wasn't set. I think, it was our national holiday here in Switzerland on Friday. The firework and other celebrations were tempered by the high rate. I do think there's a hope that there can be some sort of renegotiation before August 7th.
Marcus Creedy in London, and can you just talk to us a little bit about the actual impacts of the tariffs themselves? I think we're waiting for it to show up in pricing, in terms of price hikes, in terms of margin compression. We haven't really seen that kind of pain trade when it comes to like the corporate earnings yet. Do you have a timeline on when it may be more apparent that there is a painful impact here?
Yeah, we think it's going to start to show up now. So what happens, around, say, the September Fed meeting is going to be increasingly closely watched. What's going on with jobs versus what's going on with tariffs, and how much the Fed is willing to look at a tariff bump as a one-off, something that Powell has talked about. So, it's likely to be more volatile after a very strong July. Ultimately, we do think that the tariffs settle in around 15%, which is very high compared to history, but probably not enough to send the U.S. economy into a recession. And we think that, there are some positives out there, such as the continued CapEx in AI, and some of the One Big Beautiful Bill tax cuts are going to start to flow through to some consumers later in the year, or in the beginning of next year. So we see the market moving higher by the middle of next year, but it could be a little choppy in here as the data you described starts to come through.
Well, Mark, you talk a little bit about CapEx despite some of the tariff threats as well, and it feels like that's most abundantly clear when it comes to the tech story. You mentioned AI as well. At what point can CapEx continue to be spent, basically, by the other 493 members of the S&P 500? It feels like they're still spending perhaps a little bit of cash remnant from issuance during COVID, for example. How long can that spending spree last?
Well, certainly now as we start to come through earnings, we're going to get a better sense of that from executives. But I think it's a really interesting point to raise in the sense that we have some of these companies where, the earnings are still good, the CapEx investment is still very strong, and yet we see some slowing in the broader economy. And is this setting up a dichotomy where the data we look at and what the Fed looks at is not creating the right picture anymore? So that's one of the things we're looking at in the fall. In other words, if you look at just the speculation in the markets, you could say that the Fed should be raising rates. But of course, if you look at the macro data in the economy, we think the Fed should be cutting rates. So that's getting to be an interesting setup that you're highlighting.
Okay. Just some of the reaction on Friday was that you saw, Sell America coming back. Mark, good morning. It's Lizzie here in London. And actually, where you've seen investors, retail investors piling into European stocks, some are comparing that to the meme stock frenzy. I wonder if you're concerned at all about froth when it comes to those investors buying European defense stocks.
Well, I think that there's many cross currents. When we look at professional investors, they've been heavily invested in the United States with full allocations, and absolutely some of them are looking at, being over allocated and looking for other places to go. They are having difficulty diversifying away from the U.S. given the growth profiles of a lot of U.S. companies. For our clients, we looked at their investments more extensively, and the home bias is much stronger for many retail investors. And I think that they have less diversification that they need to do away from the dollar. Nevertheless, all the things that we've seen, some of the things that you've been discussing on air about data or the Fed and things, none of that is building the confidence that we need in the U.S. dollar, and at the margin, people are looking abroad. I think that buying into what the government is spending money on over time tends to be a strong way of investing. But you're right that in the near term, given what's happened with, if you look at the European defense sector, ETFs and things, especially in dollar terms, they have run a lot right now.
Okay, and I also just want to pick up on Val's point about Swiss tariffs, right? If you've got 39% at the moment, and if that sticks and the EU's got 15%, how much of a competitive disadvantage is that for Swiss businesses? Can you quantify it?
Well, I don't think we can quantify it at this time, as the different Swiss companies sort through this. But, I think the broader issue is that policies for many years within Europe have contributed to a situation where Europe is kind of the field upon which U.S. and Chinese power politics are being played out. And unfortunately, yes, Switzerland has been caught up at that at the moment.
Mark, let's pivot back to the U.S. economy. Given Friday's payroll surprise, the fact we're now pricing in a Fed cut in September, do you think that kind of ruins the bull case for the dollar? A lot of people talking about before that the dollar was going to keep supported because the Fed wasn't going to cut interest rates or was going to hold off cutting on interest rates. What's your view on FX here?
Yeah, we think that the dollar is likely to move lower, obviously not in a straight line, but we would look for trades that can help diversify away from the dollar. And should the geopolitical noise increase, that could include further moves into gold from here. And it is something our clients are asking us about around the world.
Mark, do valuations matter in this environment, whether it comes to gold, whether it comes to equities at the moment? Are valuations what people are really taking into account right now?
I think it's a great question and something we look at very carefully. In many ways, valuations are elevated, and if you look at the speculative stocks, they've really taken quite a run here. I think that, over the longer term, valuations do matter. One of the things that we're trying to watch very closely in this period to get a better sense of how this is going to shake out is how that flow through from, say, consumer spending and jobs into the large companies like, in the internet space that ultimately, in some ways, rely on the consumer to fund this large CapEx expenditure, how that continues and how investors respond to that CapEx investment in AI right now, because that is driving so much of, we think, both the speculation and the strength in the markets. But the other side of what you're pointing out is that there are lots of stocks around the world where valuations are much more attractive. And that's one of the reasons we like Chinese tech right here, which can have some of the strong growth dynamics and strong margins, but still at much lower valuations, say, to U.S. tech.
Okay, so another way to diversify. Just finally, Mark, going back to that dollar weakness story, if it persists, how well can European equities weather it? Because already we've seen, a mixed earnings season here in Europe compared to the US.
Well, we're very selective on European equities because the U.S. story of tariffs against China really set up, and Europe set up a dynamic where Europe is not only having trouble getting goods into the United States, but it is potentially in greater competition with China to sell in their own market and to sell their goods around the world. And so that's why we think you still have to be selective on Europe in this current environment.
All right, Mark Heafler, Chief Investment Officer over at UBS Global Wealth Management. Really great to have you with us on the programme this morning, Mark. We thank you so much. Coming up, shares of UK lenders moving higher this morning after the industry won a major reprieve in a pivotal UK car finance case. We're going to break down the moves next. This is Bloomberg.
single best investment opportunity you see in the world, regardless of industry or geography. Why? And again, how are you making it available to your clients?
I think there's no question AI is going to impact everything we do. The opportunity to take great companies and use AI is going to transform. Also, the issue of jobs. What do we do with jobs? Because there's no question, you look at things that are customer service oriented, and the AI is so much more efficient. As we look at across all these different opportunities, what we really like is data centers in the U.S. And, the one thing that we know is that AI is just going to create this enormous demand for data and this even growing opportunity for cloud computing. So for us, owning data centers for 20, 30, 50 years, we're going to have a limitation on power in the U.S. There's no question over the next 20 years, the technology will change for chips. It'll become more competitive, and NVIDIA may not be the only major provider. So I think you're going to have a big technology refresh over the next 20 years. But the one thing we know is you're going to need data centers, you're going to need power, you're going to need cooling to support all this growth in the cloud. So we look at them as long-term bonds.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. We're 46 minutes into today's session, and it's mostly green across the screen here in Europe, except for Switzerland. But banks at the top of the sectoral basket, up 1.3%. And that is coming back largely to the UK lenders, the likes of Lloyds Banking Group and Close Brothers and Barclays, all jumping after the industry won a major reprieve in a pivotal UK car finance case before the country's top court. Joining us now for more is Bloomberg's markets editor, Sam Unstead. Sam, why the disparity between Close and Lloyds here? Close up 20%, Lloyds up 7.6%. It must be to do with how they're affected by this ruling.
Yeah, so Lloyds is the largest car finance lender in the country, but Lloyds is also a very big bank. Close Brothers, much smaller, and they've had a pretty rough year. Last year, their shares fell by 70%, mostly because of this car finance probe. A much larger proportion of their loan book was in car finance, so they took a much heavier hit. Lloyds, though, if you look at Lloyds over the sort of last year, 18 months or so, since the probe sort of really started to take hold, they have also underperformed NatWest, Barclays, which again have slightly smaller exposures to the car finance market. There were questions, particularly as people were talking about the real worst case scenario of this, that Lloyds' dividend could come into question. I think today takes away a lot of those concerns.
How do some of these banks then now operate moving forward?
I think for Lloyds in particular, this was a big overhang for really their whole operation. And like I say, the dividend, that is a major part of the investment story for all UK banks. Any questions that were being asked about that are, very significant for them. The worst case scenario for this, when it was initially being talked about, was £30 billion overall. This is now looking like it's going to be closer to £9 billion, so not nothing. And probably the provisions will have to rise very slightly, but for Lloyds in particular, it's not material. So what I think you're likely to see is that gap in performance between NatWest and Barclays, and then Lloyds, which has been a bit weaker, start to close.
But in terms of what they're going to use this cash money that they set aside for, could they increase their dividends? And could Barclays, announce a share buyback? Is this a catalyst for that?
I think probably not. Certainly not in the short term, because although the provisions are much lower overall, they will still need to take slightly extra provisions. So Lloyds this morning, they said it's not material, but how much they put by so far is still probably not quite going to cover it, but it's not going to cover it to the same extent. If it had been at £30 billion, then the question would have been asked much harder. But I think now it just removes effectively a sort of major overhang for all of those lenders.
Yeah, and the uncertainty of the Supreme Court ruling, I guess, has been nailed down. Thanks for joining us. That was Sam Unstead, our markets editor, on the recent Supreme Court ruling on car finance. Kriti?
Now let's go from the banking sector to the oil sector, if we can. Oil fluctuating after OPEC Plus agreed to another major output increase, stoking concerns about global oversupply. And yet, feels like oil hasn't moved a whole lot. Bloomberg's Anthony DiPaolo is here to explain. Anthony, let's just rewind for a second. Walk us through OPEC Plus's thinking here. Is this the last increase we're likely to see?
Good morning, Kriti. Yeah, as you say, oil has been holding up. It was still green when I left my desk to come up here and get on set and talk to you guys. But in fact, exactly that next move going forward is what is the question for OPEC, because they have just completed unwinding a segment of cuts that 8 countries of the OPEC Plus group made on a voluntary basis. There are other levels of cuts still to come. So there's still production that OPEC and OPEC Plus is keeping off the market that they will eventually want to bring on. So they've got a plan in place that would see a lot of that output staying restricted until the end of next year. So the question is really, are they going to bring those increases forward as well, above schedule, or are they going to have to cool their jets a little bit as we get into the autumn? What has been the surprise really has been the fact that the oil market has been holding up so well as OPEC has brought on this production, sped up the pace at which they're bringing on those barrels, and really completed that rollback of that initial round of cuts by September. So we're having a lot of oil coming back on the market, 2.2 million barrels a day by the end of September. So that's a lot of oil coming back into the market, and prices have still really held up. And that's because we've seen a lot of demand in the summer, transport demand as people are driving, so we're seeing gasoline and diesel, as people are flying on vacations, jet fuel. So that has really supported refineries, which are the purchasers of this oil, kept their margins high, allowed them to keep buying more oil. And we haven't seen oil building up in storage yet. So these are really the things that OPEC Plus watches to decide whether to bring more oil back into the market. There are clouds on the horizon. A lot of the analysts are forecasting lower prices by the end of the year. So we're going to see how that takes place, whether those prices do cool.
I mean, we have to factor in the geopolitics as well, Anthony. Good morning, it's Lizzie here. I mean, now we look ahead to Friday. You could see Trump imposing these sanctions on Russian oil to, ramp up the pressure on Moscow over peace in Ukraine. Surely that would drive up oil prices, which is the opposite of what Donald Trump wants.
Good morning, Lizzie. Yeah, well, that's been a kind of a countervailing factor throughout this bit of OPEC Plus increases. We've had the increases bringing back oil production, which should bring the price down, and we've had that geopolitical premium on the other side that's been supporting prices. Now, if Russia is significantly sanctioned, or there are secondary tariffs put on buyers of Russian oil, and that proceeds to take some oil off of the market, that would have that impact of driving prices up. But there are a lot of ways to get around those sanctions, and we've seen Russian crude, Russian tankers, Russian vessels, the consumers as well, kind of figuring out ways to get around that, as we've seen with Iran, which is another country that's under sanctions. So the question there will be, how strong are the measures, the sanctions or the tariffs or whatever status they take? How strong are those in being able to keep the Russian barrels off the market, and how much the market thinks that those barrels will come out? OPEC has not said what they're going to do post-September, whether they're going to continue unrolling the cuts that remain in place. They do still have production restricted, so will they unroll that? Or will they, even if the market weakens, need to take some oil off the market? So OPEC's got its options, and the market is still going to be looking for what is the real impact on Russian barrels of those decisions from the U.S. administration, Lizzie.
Okay, so we look ahead to Friday. Bloomberg's Anthony DiPaolo out of Dubai. We thank you so much for that analysis. And Val, we've got so much on the docket apart from that coming up this week.
Yeah, we do. It's not only economic data, but we also get a lot of earnings from around the globe. On Tuesday, it does kick us off with economic data. We get U.S. ISM services. This follows off a weak ISM manufacturing last Friday. And then we have earnings ahead on Wednesday, Disney and Uber. We also have Toyota earnings over in Japan as well. The BOE decision, probably the biggest macro one on the calendar this week on Thursday. Friday, also we get the the Canada employment report. But one thing that was hard to maybe nail down a date for, which probably could shift the markets the most out of any of these, is Trump's potential pick to the Federal Reserve Board of Governors. Now that Adriana Kugler has handed in her resignation, that could be something that could really shift the markets this week if it is an outside candidate, maybe someone we're not familiar with, but that's going to be something the market's going to be waiting for after Trump has basically said it's going to come in the next couple of days.
Yeah, really surprising turn of events that I feel like we've kind of set the stage for over the last couple of months or so, but this is really putting the idea of actually having cuts baked into this market turn into and manifest into a reality. I believe we have 2 cuts priced in for the end of the year. We are 4-5 months out now.
Yeah, I just can't wait to hear from Jay Powell after that labour market data on Friday. I wonder when that commentary is going to come. But, you know, whoever this replacement is, we'll be looking to them for the direction of the Fed possibly coming up in the future. I'm watching the BOE. I do wonder whether they're going to drop the language around the gradual rate path. And the vote split also in focus, of course. If it's a 3-way vote split, just how confusing is that to the market when you have got these conflicting signals? That would be why there's a vote split. But how is the market meant to read that sort of communication?
But it's funny to now draw the parallels between what the Bank of England is dealing with in the UK to what the Fed is dealing with the U.S. when we have a deterioration in the labor market on both sides of the Atlantic, and inflation, at least forward inflation in the U.S., still causing some concern, and in the UK, current inflation also still causing some concern.
Yeah, it's fascinating. I was reading some analysis from Mark Zandi, who's the chief economist over at Moody's. He's quite negative and can be quite negative on the U.S. economy, but he was just kind of listing out the really rough data points that we've started to see, from PPI to the ISM to now the jobs report to some of even the ADP private numbers as well. You were starting to see some of these cracks emerge in the economy, and the labor data was the last kind of standing foothold that you had. The other might just be that the inflation data is still kind of elevated relative to where you need to be.
It'll be very interesting to see if people upgrade or downgrade their inflation forecast based on the fact that the labor market is weakening, correct? Right? You don't have this excess demand from consumers to pay for elevated costs from tariffs if they're frankly losing their jobs and don't have that kind of income. So I'm very interested to see if anyone changed their call on year-end inflation for the U.S.
Yeah, we haven't even really talked much about what I think the rest of our week at least is going to be dominated by, and that is the earnings story. Tomorrow, BP, Diageo are both going to report. You know, Diageo's just had that leadership change. They're also dealing with the tariff impact on several different fronts. BP, of course, heading that oil story as well. We're excited to speak to BP. Exclusive interview tomorrow in the opening trade. We've got Glencore as well, Commerce Bank. We're excited to speak to the executives there as well. Siemens, Rheinmetall, and Maersk. By Friday, these earnings interview will give you a pretty decent chance to understand where we are at. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Swiss stocks in the red as the market reopens after a holiday. Exporters, they're facing a 39% tariff from the United States. And a big U.S. jobs miss and revision, boosting those rate cut expectations as President Donald Trump looks to announce a new Fed governor and jobs data statistician all in the coming days. Plus, one eye on oil as prices lose a little bit of momentum. OPEC Plus adding barrels into a market already facing renewed demand worries. Let's get a quick check on the cross-asset story here at about the 10-year yield. We're still digesting perhaps that payrolls number and a series of weak data from last week. 4.24 on that 10-year yield. Weakness in the euro this morning as well, although it doesn't feel like the dollar's bounce back is that prevalent today, at least against that currency pair. 115 on euro dollar. The Swissy sees a little bit of weakness. A weak CPI, a stronger CPI print, but those export tariffs certainly weighing on that market. And of course, Brent crude unchanged at the moment, but a 69 handled there. Let's take a quick look at the European markets map and how the equity story is starting to shake up, because you are going to see green on the screen across the board, except for one tiny pain point. And that, of course, is Switzerland, down about 1%. Really not as bad of a market reaction as perhaps the market was bracing for. Lots to digest. Let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, standing in for Francine Lacqua. There's a lot to digest in this market picture. We have a lot of weak data from last week. We're now starting to talk about a change of guard over at the Federal Reserve as well. How do you price that all into a market that's still kind of keeping up, or catching up, I should say, to the tariff picture? Seema Shah, Chief Global Strategist over at Principal Asset Management, joins the program first thing this morning. Seema, pleasure to have you. Walk us through that narrative here. I think it took everyone by surprise, that economic resilience story of the United States in one quick data print feels like it didn't exist to the same extent that we thought it did. What do you make of the revisions number from Friday?
Thanks for having me on. It was a real shock, I think, to see those numbers. And I think over the weekend, I think there's been a lot of digestion. And then remembering that the key thing here is also that there is a labour supply dynamic at play too, which could mean that, a lot of the drop in payrolls that we've seen is not necessarily just down to labour demand, but a lot of it is labour supply in play as well. So it is a really, really conflicting, confusing picture, I think, at the moment. We've already seen that through a lot of the economic data over the last couple of months, and now it's spreading to labour market data. So I think for the Fed, although it's certainly a clearer picture of weakness than maybe certainly Powell had anticipated last Wednesday, but I don't think it's that clear still, because, we still have to wait to see what happens to inflation. And of course, there's the next employment report. So I think still a lot to be seen at this point in time.
When it comes to how the Federal Reserve maybe processes it, reacts to it, how do you price in some of the volatility that may be coming from the changing of the guard at the Federal Reserve?
Right, and I think this has this whole another dynamic of what is to come. From our perspective for next year, we are anticipating more rate cuts. The timing of that is going to be difficult because, of course, it depends who's going to come into play, when they're going to come into play, and then also how vocal they are. If they are who's going to be very vocal, trying to lead the market in a more dovish stance, well, then I think the market is going to react. The bond yields is going to move down, even as maybe central bank rates don't move down so quickly. So I think there's still, as I said, there's a lot of conflicting signals at the moment. From a market perspective, we're trying to look through all of that noise, trying to say, well, what are we going to expect a year from now? Where is the economy going to be? Where are rates going to be? We do think rates are going to be lower. Not significantly, though, partly because we still do believe a picture of general economic robustness. So weakness that need to come into play, but we're not looking at recession. So there's kind of 4 rate cuts that I think the market has been pricing in until Friday. That, to us, looks about correct.
So still strength is what I'm hearing from you, at least in the next 12 months or so. Where does the tariff picture ultimately fall into that?
I think the tariffs are clearly going to have an impact. And I think that's been one of the things that the market has been tripped up by in the last few months is that, well, actually, you haven't seen the economic data respond. You haven't really seen the inflation data respond. So I think the market had some complacency leaking in. Now, with a lot of the uncertainty, at least some of it being cleared up on Friday, we can now start to think about how does the macro picture respond. There will be some impact. Someone is going to have to pay for these tariffs. It's either going to be the U.S. consumer or US business, most likely. And then you start to see some slowdown coming down the way. But again, we don't think it's going to be as severe as what was being priced in back after Liberation Day. So for us, it's about a 1.6% hit to growth. That is very specific, and I think that almost exaggerates how clear it's going to be. But certainly some downward impact on growth down the line.
All right, Seema, hold that thought. I want to bring in our reporter out of Zurich, who, of course, is monitoring one impact of this tariff picture. Of course, we're seeing Swiss stocks really pricing in the pain that Switzerland is at least anticipating is going to kick in August 7th. A 39% export tariff rate, one of the highest in the world at the moment. Our Swiss bureau chief, Jan-Henrik Forster, is all over this story. Jan, can you just walk us through, for our global audience, the dynamic between the United States and Switzerland right now?
So on Liberation Day, when Trump announced the U.S. tariffs, people were surprised that they were so high for Switzerland. It was 31% at the time. Since the Swiss government has given the impression that the relationship with the White House is actually quite good and negotiations are going very well. The Swiss were saying, look, we're going to invest more in the United States. We are a big employer anyway. We are a big investor in R&D. And apparently Trump didn't really care too much about this. He was mainly pointing out the trade deficit, the big surplus. Switzerland is a big exporter. And that really, in the end, the conclusion was that the relationship wasn't as good as the Swiss thought it was. So now we had this tariff announcement on the Swiss National Day, 39%, which is by far the highest of all Western economies. And certainly higher than the European Union, the other trade bloc here in Europe, or the main trade bloc. And yeah, that was a big surprise. Now, market reaction today in Switzerland is muted. Negotiations might be continuing until the end of the week, so there's still a bit of hope that the Swiss can hammer out some concessions. One is, for instance, importing liquid gas from the States. That would be one thing. And then there's also the pharma industry, which is pledging investments into the United States. So there's still a bit of hope, I guess. And then really the other aspect is that Swiss companies are very good at defending margins, right? We've seen that. The companies here constantly deal with a strong currency. So I guess it's also the market reaction is also a bit of a realistic reflection of what people are used to here in Switzerland.
Jan-Henrik Forster there in Zurich, walking us through some of those dynamics that we've got to keep our eye on. He also, and I'm sure is monitoring very, very closely the fact that one of the key kind of complaints that Donald Trump has against the Swiss is the fact that their rates are at zero. And they have actually been talking about moving the currency as well, intervening when it comes to the Swiss franc. And we get that right. Still with us, Seema Shah, Chief Global Strategist over at Principal Asset Management. Jan-Henrik used a key word there, negotiation. There is a sentiment that even at 15% or potentially 39% or whatever the number is that is applied to these rates, as long as you have clarity on what the number is, it is actually a good outcome and that the volatility is worse. Does that apply to all figures?
Well, Well, look, I think one of the key things that's been weighing on markets to some extent is the fact that there hasn't been a lack of certainty on where tariffs are going to end up. So at least knowing something of where it's heading is good news. I don't think this is the end of the road, though. Certainly, we're expecting continued negotiations even this week. And then looking beyond that, we've still got the legal challenges to be cleared up. We also think that there's going to be increasing pivot towards sectoral tariffs, which I think is going to be really key for Switzerland, given the focus on pharmaceuticals. So, you know, I think the lack of, at least the clearing up of some uncertainty is positive. But when you're looking at a tariff of 39%, I think you prefer to have a bit more uncertainty, knowing that there's a potential for it to come down.
Absolutely. Talk to us a little bit how this shows up in the currency space, though, because there has been this long narrative for about, at least since Liberation Day, but certainly for 6 months now, that you want to be structurally underweight the U.S., or at least structurally neutral towards the U.S. Does that still apply in a recessionary scenario?
Well, so historically, we've always seen that the US dollar has strengthened in that kind of environment, especially if it's a global recession. Now, what we've seen actually in the last couple of weeks is those concerns around the dollar, the weakening, has started to subside. Concerns that, you know, maybe there's going to be further criticism of various institutions has started to subside, and that's been almost putting a kind of a floor under the US dollar. I think that's going to continue. I think what we're likely to see now is that as we get into the last couple of months of the year, we start to, you know, maybe see some of the other countries weakening further. You could see the dollar stabilize. I wouldn't expect any strength at this point, but certainly it does seem like that downward path in the dollar is mostly played out.
There is a question, though, of if it's mostly played out, then what kind of tactical reversal do we kind of see? Who benefits, or who I say who loses from that? If you see a reversal in the dollar, for example, who does that come at the expense of?
Yeah, we've had a couple of concerns about the euro area. I mean, look, it's done incredibly well this year. We do think that it's been justified. But at this point, again, similar to what we've seen for the US dollar, a lot of that good news is played out for Europe. So on the other side of US dollar stabilization, it might be that you start to see euro weakness, a little bit of euro weakness. And actually, if anything, I think that could be really good news for the euro economy. We've seen so far from this earnings season that the strength of the euro has been weighing on a lot of companies. So there's always going to be a balance for any currency when it's in terms of the good news for the country. And I think for the euro, we're probably hitting a point where actually a lot of people would welcome a bit of weakness.
In terms of the pound, how do you think about the UK and exposure to the UK, whether it's the pound, gilts, even the FTSE 100? Where does the UK fall into that global allocation?
Yeah, it's been an interesting story for the UK because it's going back and forth. There's been so many concerns from a domestic side. Sorry.
No, don't worry about it.
But at the same time, there has been, I think, continued concerns over what happens to the fiscal picture, what happens to inflation, where the Bank of England is going to go. The UK has benefited, on the other hand, from just being a bit of a defensive play, a country which has not fallen in the kind of the line of sight for President Trump. It's got a fairly good tariff deal. So, you know, I think the UK has benefited as companies are trying to look, or investors are trying to look for where is stabilization, where is defense. But overall, from a macro picture, we have a fairly negative view over a 5-year period.
So I'm having a little bit of deja vu from the first Trump administration, where we weren't really talking about trade deals with as much focus on Europe, the UK, Switzerland, Latin America. It was really all about the US and China at the end of the day. And I'm curious, with those ongoing negotiations, is that the next kind of pivot point when it comes to global allocation, that ultimately you have to wait for the nitty-gritty that comes out of the two largest economies in the world?
I think that is key, but again, you know, we are expecting that we've finalized that part for China. It's going to be that focus on sectors. Which are the sectors which China is going to be most exposed to? What is going to happen to the semis? So I think there is something to play for. With China, actually, the key thing that we're looking out for is how are policymakers going to intervene? Do they continue to see weakness, which prompts them to believe that actually there is a strong case for some kind of intervention? But overall, we're actually feeling more confident on the idea of investing in China going forward. And as a result, actually all of Asia, parts of emerging markets looking a lot more attractive for us in the last couple of months.
All right, Seema Shah, Chief Global Strategist over at Principal Asset Management, taking us on a tour around the world. We thank you so much. I want to bring it right back to kind of where we started the conversation, though, around how we should be interpreting monetary policy in this environment. President Donald Trump saying he will announce a new Federal Reserve governor and a new jobs data statistician in the coming days.
You know, I have a couple of people in mind I'll be announcing somebody for the filling of the person that left. A woman left, as you know, who was I guess a Biden appointment, either Biden or Obama, but I think a Biden appointment. And she left early, and I think she left because she agreed with me on interest rates, and yet they were on the other side of the ballpark, right? So I'll be announcing that probably over the next couple of days.
Now, Trump has faced criticism for his relentless attacks on the Fed and for firing the Bureau of Labor Statistics chief after data showed weak jobs growth. Bloomberg's Valerie Teitel has been following the story for days now. Val, how do you make sense of these movements?
It was some of the steepest revisions that we've seen from the BLS when it came to the non-farm payroll report on Friday. Going all the way back to 1979, we've not seen as steep downward revisions in these payroll figures outside of recessions, which are notoriously very hard to collect data in. But it puts the 3-month run rate for NFP at 35K, which is the weakest jobs market that we've had since the pandemic. The May and June figures revised down into the teens, Critty. Some very steep revisions. This led to a huge repricing in front end. We saw the biggest move in 2-year yields that we've seen in over a year on Friday, dropping around some 28 basis points in the session, as now the market has it went in at some point on Friday to price that Fed cut in September with more certainty. Now that odds are hovering around 85%. We also, it was a very busy Friday. We also had the announcement of the Fed Governor Adriana Kugler resigning. Now remember, this was a candidate that did not vote in the meeting on Wednesday that had those 2 dissents. She resigned on Friday after the weak payroll print. So a lot of curious, I guess, conclusions about the timing of her stepping down, but it does leave that seat open, wide open for President Trump to fill, hopefully maybe even before that September meeting, for him to have some sort of influence on the Fed's next decision. Critty.
Something we're watching very, very closely. Bloomberg's Valerie Teitel walking us through the dynamics over in Washington. We thank you so much. Coming up on the program, OPEC Plus closes a 2-year chapter in its oil strategy with the last in a series of bumper output hikes. We're going to dive into the details next. Stick with us. This is Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Versace in Tehran, and this is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance. Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. A Bank of England rate cut is back on the cards this month after a pause in June in a divided vote. And markets will be listening to Governor Andrew Bailey for clues on the path ahead as the UK economy cools and uncertainty lingers.
Interest rates are not on autopilot. They cannot be.
Tune into Bloomberg for live coverage of the BOE decision and press conference. It all starts Thursday at 12:30 p.m. on Bloomberg. Context changes everything.
Oil prices fluctuating after OPEC Plus agreed to another major output increase, stoking concerns about global oversupply as countries wrestle with the impact of U.S. import tariffs. We're seeing Brent crude trading at about $69.50 a barrel. Joining us for more on this Middle East energy markets reporter Anthony DiPaolo, all over this story. Anthony, just walk us through the details of this OPEC Plus decision.
Yeah, good morning, Kriti. Basically, OPEC Plus had a select group of the countries there, 8 of them, had taken off voluntarily about 2.2 million barrels a day of production. And what they're doing is they're unwinding those cuts now. They're bringing that oil back into the market. That won't bring all the OPEC Plus oil back to the market because there are still cuts in place. That will be the next phase of what they need to decide on. But what they're doing right now is by September, they're going to have unwound that first round of voluntary cuts. Again, that's 2.2 million barrels that they're bringing back to the market. And that's a lot faster than they had initially planned to do. They initially planned to take a full year more before they brought that oil back to the market. But OPEC has assessed a couple things. They've assessed that the market is strong enough to take all that oil back into the market. Plus, I think they've decided that they want to have market share. They don't want to give up that market share to those other non-OPEC Plus countries that are continuing to produce and increase production and put more barrels into the market. They want to get some of that market share back for themselves, even if it means slightly lower prices. They're also taking the temperature of the room and saying that Donald Trump wants lower prices, thinking that prices are going to go that way anyway, so they might as well get some more barrels out there and get a political win from giving Trump what he wants. Of course, prices are not as low as the president might want. They're around about $70 a barrel today. And so one of the surprises is that prices really have held up in the face of this added supply coming to market. And that's because we've seen really strong demand through the summer from gasoline, from diesel, from jet fuel as people travel around. The clouds that are kind of on the horizon, though, are of the prospect of declining demand as we get into the winter months. So as we get into that summer peak, a little bit less demand. As that oil comes to market, maybe we get some buildup and some lower prices. So that's the risk that the market is looking at, Kriti.
Well, Anthony, you talked a little about it from a supply perspective. Talk to us from a demand perspective. Why is oil not lower in the face of some of the deteriorating economic data that we've seen? It's been a major theme here that perhaps the cracks from the tariff war have actually started to show up on the surface. Oil doesn't seem to be budging in the eyes of, or in the face of, I should say, weaker payrolls, deteriorating manufacturing data, when he traditionally has been sensitive to that in the past.
Yeah, it seems like a lot of that data is waiting to see, really waiting to project what those results are. And the market is also waiting to see how the data is going to reflect what's happening. So we haven't really seen what people thought might be the worst impacts of tariffs, of a trade war. So as those deadlines as well have been pushed back until the tariffs have been implemented, and we've got different signals coming about what they're going to be, what products they're going to be on, what the levels are going to be. The market hasn't really decided yet, and we haven't seen the full impact of those in the data yet. So that is perhaps kind of a lagging result that we're going to see going forward. And it could be that we do see negative information just as all that oil hits the market and just as that demand starts to get out of this peak from the summer. But right now, demand is really going strong, records every year, and that's the signal to the refiners. Margins are great, and that's the signal to OPEC to keep producing. So that's what we're seeing, Kriti.
All right, Bloomberg's Anthony DiPaolo in Dubai giving us an update when it comes to the oil picture and OPEC Plus's role in it. We thank you so much. I want to stick with the same theme with a slightly different angle. Indian Prime Minister Narendra Modi is striking a defiant tone in the face of President Trump's 25% tariff rate. He's urging citizens to buy locally made goods while New Delhi continues to buy Russian oil. Joining us now is Tony Halpin, who leads our Russian economy and government coverage. Tony, just walk us through this dynamic between India, Russia, and the United States. We know that India buys Russian oil at a much more discounted rate. It's a historical kind of geopolitical tie that's been there for decades. But walk us through the impact of where a secondary tariff or a secondary sanction, as Donald Trump has threatened, might show up.
Yes, good morning. As you've noted, India has really capitalized on the diversion of Russian oil flows away from Europe. It's now the biggest importer of seaborne Russian crude in the world, and its own consumption has gone up from almost nothing before the war to about a third of imports from Russia now. So it's very unlikely that India would simply buckle under to a demand from Trump to simply stop purchasing Russian oil, which is the drive behind his threat of secondary sanctions. The idea from Trump is that Russia will have its sources of financing for this war cut off if they can somehow reduce the amount of oil that Russia can sell abroad. And countries like India and China in particular are big purchasers of Russian oil. But as you've noted, Modi's striking a fairly defiant tone. Trump slapped 25% tariff rates on India. So India doesn't really have much incentive to do Trump a favor on the war in Ukraine. And currently, because of the long-standing ties with Russia, it's much more willing, I think, to continue buying Russian oil.
Well, Tony, walk us through all of that in the context of the fact that Steve Witkoff is due to be in Russia this week, the U.S. Special Envoy. Of course, it follows just days after there was a fairly rough exchange between Dmitry Medvedev and Donald Trump himself in talking about things like nuclear submarines. Is that a good thing that Steve Witkoff is going to be in Russia for his 5th visit?
Yes, I mean, Putin has met Witkoff on each of the previous 4 occasions, so I think the expectation there is that he will see Witkoff again this week. It will be a surprise if he doesn't, and that will tell us something about the state of current US-Russia relations and the relationship between Putin and Trump personally. But the fact that it's taken almost a week since Trump announced this visit for Witkoff to arrive in Moscow sort of underlines the sense, I think, that the US isn't really expecting to gain any concessions from Putin ahead of Friday's deadline. And I think the Kremlin itself is waiting to see what Trump will do once they reach that Friday deadline. So I think probably the Witkoff visit will be as much to try and gauge the temperature with Putin, to try and understand where they might move forward once this deadline has passed and once the US has imposed these tariffs. But I don't think there's a great deal of expectation that Putin's going to make concessions to Witkoff, and he certainly hasn't in any of the previous visits.
All right, Bloomberg's Tony Halpin setting us up nicely for a big story that we're going to be monitoring this week. We thank you so much. I want to bring one more story to your attention. UN Secretary General Antonio Guterres planning to slash more than $700 million in spending and overhaul the United Nations as the United States pulls back its support. Guterres' plan calls for 20% cuts in expenditures and employment, and about 3,000 jobs would be lost as a result. President Trump has suspended funding and pulled out of several UN bodies. A broader review is expected to lead to further cuts. Now, coming up on the program, we're going to switch gears a little bit. Greek commodities firm Metlen begins trading on the London Stock Exchange today in a rare glimmer of hope for markets right here in the heart of the UK. We speak to the company's CEO about the listing, the thinking behind the move from the Athens Stock Exchange, and perhaps why he didn't pick any of the other exchanges that may be vying for his business. There's a lot to digest this morning. We're going to dive into all of it with that exclusive interview, as well as some moves from the market. Stick with us. This is Bloomberg.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that? in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, and these are your top stories. Swiss stocks falling as the market reopens after a holiday. Exporters facing a 39% tariff from the United States. And a big U.S. jobs miss and revision boosts rate cut expectations as President Trump looks to announce a new Fed governor and jobs data statistician in the coming days. Plus, oil prices lose momentum as OPEC Plus adds barrels into a market facing renewed demand worries. We're going to dive into the details. Now, Canadian Prime Minister Mark Carney and U.S. President Donald Trump are expected to talk over the next few days after the two governments failed to reach a deal before the August 1st tariff deadline. U.S. Trade Representative Jameson Greer noted that while talks are continuing with Canada, the administration views tariff rates as largely non-negotiable.
I'm not concerned that it's going to complicate things with Canada. Our view is the president is trying to fix the terms of trade with Canada, and if there's a way to a deal, we'll find it, and if it's not, we'll have the tariff levels that we have.
Our very own trade czar Brendan Murray joins the program this morning. Brendan, what do we make of this? I thought there were no extensions. I thought there were no negotiations, and now there are.
Well, it seems that heading into this August 7th, this new deadline that we're looking at, that some countries think that there's still time to get a deal. For all the deals that we had announced last week, we still don't have one with China. The one with Mexico was postponed for 90 days, and Canada is still in limbo as well. So those are the three biggest U.S. trading partners where things are still uncertain. And, of course, the European Union, their deal was written down on two separate fact sheets. So there's some there's a lack of clarity there about how the two sides will come together into one formalized statement, some sort of executive order or something that lays out exactly what the arrangement is going to be going forward.
So you named Canada, Mexico. We know that China is, of course, in the background as well. Those are your three largest trading partners for the United States. What is the U.S.'s beef with Switzerland right now? We got a 39% tariff rate. You're seeing the Swiss markets reopen this morning and have a pretty dire reaction. Walk us through the trade dynamics between those two countries.
Well, as we've reported over the past couple of days, there was a call with President Trump at the 11th hour on Thursday that did not go well. And the president decided to go with this number, seemingly out of random, the 39%, to drive home this message that he wants deals that will benefit the United States, and that didn't meet the threshold from the Swiss in this case, apparently. And so he's hitting Switzerland with these very damaging tariffs. Switzerland's a big pharmaceutical exporter to the U.S. They export Nespresso coffee pods. So you could see how this can hit a cross section of the U.S. economy and the Swiss economy with these very high tariffs that he's threatening to impose.
It's fascinating. The trade story just goes on and on and on. Brendan Murray is here to keep us apprised of all of that. We thank you so much for that update. Of course, as the tariff volatility, it feels like subsides and then restarts. There's been a lot of questions about how stocks IPO, trade in these markets, whether you even want exposure to the public story. Well, there's one company that has made a very interesting choice we're going to dive into. Greek industrial company Metlin Energy and Metals has started trading in its London-listed stock today. Now, the company says it will retain a secondary listing in Athens. Metlin's listing is a welcome sight for the London Stock Exchange, which has been shrinking in recent years amid frequent takeovers and a few new listings and plenty of geopolitical volatility. Joining me now is the chairman of Metlin, Chief Executive Evangelos Mytilineos, joins me here. Pleasure to have you. Thank you so much for coming to join me. We have so many questions about this decision to move from the Athens Stock Exchange to London. I know you have that secondary listing there as well. Just walk us through why you chose London.
Well, in the last more than 10 years, the international footprint of the company has grown steadily. We are now present in 42 countries, and we have decided that time was right to move to a bigger exchange. And for us, determined to stay in Europe, we thought London was the best option. And we are happy that London is going to make a comeback, and we are going to be part of it.
Well, we know that Euronext has been looking to consolidate and grow bigger and bigger. They just looked at buying the Athens Stock Exchange as one example as well. I'm curious, why not pursue a European capital or a continental European capital like Paris or Frankfurt?
That's a very interesting question. If you look back a little bit, the city has been through rough times after Brexit, no doubt. And Frankfurt, Milan, Paris, Amsterdam, they have tried to take a big chunk out of the city business. But in the end, city never lost the primacy in the financial markets. Therefore, although it was the most difficult stock exchange to get in the first place, our decision was for London.
You've said in previous comments that Metlin plans to take advantage of rules that might allow euro-denominated stocks to join the FTSE 100. If that change weren't in the works, would you have still picked this part of the world?
That's a very interesting part of the whole scheme. When we decided to enter the LSE, we didn't know that there would be changes in the laws and regulations, and you could trade in euro or dollars. Now that is the case the last 4 or 5 months, and we are the first company to trade in euros. At the same time, we have seen a rapprochement between the UK and the European Union, the most after Brexit. This is ongoing now, we can see it. And I'm happy that a European Union company, is listing in the UK and is listing in euros. So it's a step in that direction, and that makes me very happy.
Certainly a positive one. I think makes a lot of people who are excited about London very, very happy as well. Let's talk a little bit about your business specifically, if we can. We're talking a lot about geopolitical volatility today. We're talking about trade deals. We're talking about tariffs as well. We know the U.S. has raised tariffs on aluminum to the tune of about 50%. Are you seeing an impact on your business?
Look, we're a big exporter of aluminum, but we have to consider that the U.S. is a big importer of aluminum. Therefore, for us, that makes no change, because the Americans will have to buy the same amount of aluminum that they used to buy before the tariff increase. the ones who will have to pay will be the American consumers.
And you're able to pass on those costs? You don't feel margin pressure for yourself?
No, we don't.
Talk to us a little bit then about how you're operating in the rest of the world then. If there is this idea of the U.S. has this massive consumption of aluminum or is trying to import them, would you look to broaden your exposure to other places in the world?
Well, there's no doubt that the trade flows are going to be seriously affected by the decisions of President Trump for the tariffs. But how the end game is going to be, we have to wait and see. I'm far from certain that we are going to have a nice end game, and especially for Europe, where the chance to have a good agreement was lost. We made a bad agreement in Europe, and especially I want to underline the fact that we have, according to the agreement, to invest $600 billion in the next 3 or 5 years, whatever, and buy energy, $700 billion. Even if Europe could absorb this amount of energy, the U.S. does not have $700 billion worth of energy to sell to Europe. So probably this is an initial agreement, and we may see significant changes to the final text.
You say it's not a very good agreement. Talk to us about that 15% number. The criticism of that is that at least it provides clarity to European businesses. Do you feel like it provides clarity?
It does provide clarity because it's 15%. But I remind you that before that, it was 0%. So Donald Trump, who is a great negotiator, said I could raise it up to 30%, and then he said for 15, and Europeans say, oh, yeah, great, it's 15. No. It was 0, and it's 15. And the Europeans, they cannot retaliate. It's part of the agreement.
Talk to us a little bit about another place that Europeans are spending quite a bit of money on right now, and that is the defense ramp up in this continent. How is Metlin looking to get more involved in the defense sector?
In our metallurgy sector, we have been in the defense business for more than 25 years. We have a long experience. We have very close connections with all big German and U.S. primary manufacturers, and we intend to expand this business. We have already 3 plants in Greece. We are building another 2 as we speak. So this is part of our goals going forward.
All right. Evangelist Waitlist, Chairman and CEO of Metlin Energy and Metals, joining us around the table this morning. We thank you so much for your time. I want to stick with the industrial sector. BMW going all in on its new electrical vehicle offering with the company's future riding on it. Now, the German car maker's flagship factory set to produce nothing but EVs by 2027. The CEO has been speaking exclusively to our very own Tom McKenzie about the launch, its competition with Tesla, and how the investment will shape the future of the company as his tenure comes to an end.
We're 109 years old, and it's by far the biggest single investment into one architecture we've ever done. And it kind of developed. We started with an electric car, and we said, well, it's also about digital, it's about connectivity, it's about a global approach. And then it kind of developed, and the whole company said, this is a great idea. And because everyone kind of wanted to contribute to that product, it kind of became a self-fulfilling prophecy to start that, and everyone said, this is the right time, and the right investment, and the right approach. And then the investment is almost an outcome of that approach. But our investments already peaked last year, with more than 10 billion euros into that platform. We're coming down now, and we are absolutely sure with the first responses we get from the capabilities of the car that this will be a very profitable future for BMW.
The iX3, deliveries in the first quarter of 2026.
Yes.
In terms of volumes, what would be a success for you by the end of next year?
That the market share which we gained together with the brother of this car, there's also the current X3, which is a combustion engine car and a plug-in car. And this brother or sister car, that we will have increased market share when they're together on a global scale. That's our target, and that's more than a wish.
What are the vulnerabilities of Tesla and your Chinese competitors right now?
I mean, when you drive the car, if you measure the car, if you see what this car can do, this will be the benchmark of the industry. You know, this will be the benchmark of the industry.
On Tesla specifically, we've seen their sales plummet in Europe, in Germany, double-digit drops, in France, double-digit drops. You can take market share. You will be taking market share from Tesla. How much market share do you expect to be taking from them?
You know, when you bring the newest technology into the market, you have the first mover advantage because you cannot bring every year a new car. So when you launch a car, you have the first mover advantage. So when this car is being launched in terms of charging speed, in terms of range, in terms of energy usage of the car, it will only use 15 kilowatt hours per 100 kilometers. I mean, this is the absolute benchmark in that industry. And we will use that first mover advantage at that point in time to say, well, there is a car brand, namely BMW, who can build superior electric cars. And the rest of the market has to answer. We think we have a very strong brand. We have a very high quality recognition in the market. Yeah. And from the first car we built, this will be BMW quality. And that is not only a first mover advantage, this is an advantage to every who is new in this industry.
To be clear, you think the pendulum swings back from Tesla to BMW. We did a survey in 2019, 5,000 drivers. A lot of them were swapping out BMWs for Tesla Model 3s. Right. The pendulum now swings back to BMW.
Well, this is already happening in 25. I mean, in Europe, we sell more electric cars than the competitor. This is already starting before this car is even launched. So when this car is being launched, that momentum will even be accelerated because you already see it with the previous technology.
Tom McKenzie there speaking to the BMW CEO, Oliver Zipse. Now, Bloomberg has learned that Indian energy company Adani Group is exploring a tie-up with Chinese EV giant BYD. Sources saying the deal would allow the corporation to manufacture lithium-ion batteries in India. The move would extend Adani's push into clean energy, which is already India's largest renewable power producer. Now, coming up on the program, the Swiss stock market sinking today after Donald Trump's surprise announcement that the country will receive 39% tariffs on exports. A little bit of a catch-up story over in Zurich. We're going to dive into it. Stick with us. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
The UK's Financial Conduct Authority is to consult on a redress scheme for motor finance customers that were missold car loans, which it estimates could cost lenders at least £9 billion. Now, the announcement comes after the UK's top court handed a big boost to banks on Friday, reducing the worst-case amount they would need to pay out in compensation. We're joined now by the FCA CEO, Nikhil Rathi, joining me right here on set. Thank you so much for your time this morning. Can you just walk us through the math here? The £9 billion to £18 billion estimate, how did you get to that number?
We've acted within 48 hours of the Supreme Court passing their judgment on Friday, which gives clarity around the law, particularly around the criteria that should be used to decide what an unfair relationship is between a lender and the consumer who buys a car. We now need to take that and, as we consult on our redress scheme, figure out which agreements are inside that scheme, what the methodology is going to be for calculating compensation, what the interest rate is, and what the take-up is likely to be. When you consult on a scheme which potentially affects millions of people, there's necessarily at this early stage going to be a range. We wanted to give a ballpark for what we did, the minimum we think it would be, so the market could understand where we are. Now, that will obviously get refined as we do this work in the next couple of months. There will be operational costs, something like this, which affects potentially millions of people. It will inevitably, in terms of operational costs, cost several billion pounds. Then you have to think about what the potential compensation levels could be, which we'll be working through in the next couple of months.
Well, talk to us about how and which firms end up paying for the compensation ultimately. Who does it fall upon?
The scheme we're looking at is a lender-driven scheme, and we've been working with around 41 lenders to understand the scale of the issue. They cover around 90% of the motor finance market in the United Kingdom. There were 25.6 million agreements on motor finance between 2007 and 2020, of which around 14.5 were so-called discretionary commissions, where the dealer could adjust the interest rate based on the level of commission they had. And there were also some agreements that may be unfair, the Supreme Court said, where there were fixed commissions or non-discretionary commissions. So it's a wide range of the market. Each firm will need to estimate for themselves what the impact will be, because they all had different practices here, and some of them will have more agreements that were potentially breaking the law or breaking our rules, and therefore will need to compensate as compared to others, and practices changed over time as well.
In terms of, break down those lenders a little bit further from us. You mentioned over 25.6 contracts, a million contracts. Walk us through how much of that, in your perspective, is non-bank institutions versus your traditional banks.
So I don't have that data to hand, but what I'd say is that you have some banks who are very active in this market, and you'll have seen some of the market statements this morning, some large banks, some medium-sized banks. In the new car market, often the motor manufacturers will be dealing with what they call captive lenders, so their own lending businesses, and they are often the vehicle through which lending is given for new cars. And then you do have some other smaller lenders as well that might deal with niche parts of the market. This is an enormous market. It's the second biggest consumer credit market in the UK, so there's a very wide range of players. When we consult in October, we'll put out a lot more detail around the institutions affected and the different types of contract we're dealing with.
Well, let's talk about another player in this conversation. That, of course, is the UK government itself. There has been concern when regulatory authorities kind of ultimately clash with the UK government's commitment to invest, commitment to growth in the UK. Are you concerned about that clash with this particular situation?
We've said all along that as we think about a redress scheme, we want to make sure there's a healthy, competitive, functioning motor finance market in the future. 2 million consumers a year rely on motor finance to buy a car, and we're confident we can put a redress scheme in place which continues to ensure that market functions. But we also have a consumer protection objective and a market integrity objective. And the Supreme Court has now ruled. And if the law has been broken and our rules have been broken, as we believe has been the case in many agreements, there needs to be appropriate consequences and appropriate compensation for those consumers who've lost out so that they have trust in the market as well. And we think we can achieve both.
Well, talk to us about that compensation or those payouts as well. How many consumers are we talking about? What kind of timeline, what kind of payout can we expect?
We're going to have to work through the numbers. I gave you the numbers of the overall agreements, but not all of those will qualify. We've also said we're going to consult on a de minimis threshold, which is where there's very small amounts of commission. They may not be included in our scheme. We would like industry to cooperate with us now. The Supreme Court has ruled. We'd like to work closely with industry so that we can get on and design the operation of the scheme promptly over the next few months so that payouts can start next year. That gives consumers the certainty they want, but it also gives firms the certainty that they and their investors have been asking for. So my message to industry would be now, work with us. Don't try and argue over every technical point because it will just slow things down. Let's get this up and running and operationalized and get the certainty we're all after.
All right. The FCA CEO, Nick O'Rati, joining us this morning on a crucial historic morning when it comes to that motor lending case. We thank you so much. I want to go to another major story in the transportation space. I think we can loop it all under. More than 3,000 Boeing defense workers have gone on strike for the first time since 1996 after rejecting a 20% pay rise. I want to bring in Bloomberg's Danny Lee, who's been covering the story for us. Danny, walk us through the implications for Boeing when it comes to this strike.
Yeah, Critty, good morning. So this strike is now a little under 4 hours in, affecting defense machinists, unionized defense machinists in St. Louis, Missouri. And it's the first time, as you said, they've gone on strike since 1996. And the last time the workers went on strike was for 99 days. It's not so clear this time what kind of resolve the workers will have, but this does indeed affect and a little bit Boeing in the near term, particularly the Defense Space and Security Unit, which it falls under, which has been struggling for some time now, and particularly it is an important part of Boeing's business that generates around a third of all of its total revenue, and in the past 3 years has amassed operating losses to the tune of $11 billion. So how did we get here? It's indeed the workers, the union workers, which rejected a 20% pay increase that would have lifted pay to around $103,000 a year from $75,000. This vote was struck down twice by the unionized workers because of contention around pensions and overtime, amongst other things. So there's a bit of a frustration for Boeing, but when you look at how important the unionized workers are, they do play a key role in building the F-15 jet and the T-7 training jet and building munitions and missiles.
All right, Danny Lee, giving us a little bit of an update on that Boeing strike. We thank you so much, walking us through that crucial component as well. We feel like we get a lot of strikes from Boeing. We'll see how much of this change this makes, and of course, how it shows up in the pre-market. In the meantime, we've talked about these futures here because we are counting down now to the U.S. Open as well. And remember, there is some green on the screen when it comes to the futures picture on both sides of the Atlantic. We're going to put Switzerland off to the side for just one moment in terms of the underperformance you're seeing there. They're playing a little bit of catch up to all the bad news coming from Friday when it comes to the payrolls report, the risk sentiment, the tariffs, et cetera. But right now, a little bit of a rebound story for the S&P, higher by 0.6%. You are seeing outperformance in the NASDAQ, so a slightly defensive tilt when it comes to the futures picture. In the meantime, when you look at European indices, though, it's a similar story, green on the screen, but not seeing as much buying with that same margin, unless you look very specifically at the DAX. And that's really the one driving the trade this morning, higher by 1.3%. Overall, the FTSE kind of lagging here, only up 0.5%, but certainly one we're going to keep an eye on. We are keeping a very, very close eye on the Swiss market, down about 0.5%. Pain when it comes to the Swiss market, digesting 39% of exports, the 17 companies that got the letters from Donald Trump, and of course, the payrolls report from Friday. That does it for the Pulse. Bloomberg Brief is up next. Stick with us. This is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Why is Baltimore so important to you? It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime, and now Baltimore is having among the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Stock future is bouncing back as investors bet on Fed rate cuts following a cooler than expected jobs report. President Trump says he'll announce a new Fed governor and a new chief for the Bureau of Labor Statistics. And U.S. Trade Rep Jemison Greer says Washington and Beijing are, quote, halfway there on rare earth flows. So let's take a look at where we stand futures-wise, because it looks like we might be in for a bounce back. Eddie Ardeni calling Friday Freaky Friday, and you all know why. The S&P 500 was down 1.6%, the NASDAQ 100 was down 2%, and yields plummeted. It looks, though, like we might be in for a better session this Monday. There's lots to look forward to, perhaps even more Fed rate cuts. That's what it's all about at the moment, September 17th. Do we get a cut? Do we get even potentially a 50 basis point cut like some in the market anticipate? Let's have a look at those yields, because we are coming back from Friday's drop, but not by that much. You see the 2-year yield up about 3.5 basis points right now. It is early going. And the 10-year yield up just less than 3 basis points. Don't forget that 10-year yield dropped nearly 30 basis points on Friday. So that's where all the action is going to be at today. We will be taking a look at what the market is anticipating. After all, there are some out there, including Ed Yardeni, who still see no interest rate cuts this year because they think consumer price inflation is going to see a boost in the coming data points. I do want to point to oil as well, of course, OPEC Plus. Putting in those extra barrels, it is putting a little softness into the oil market, but not by that much. WTI down about 1%. So let's get to some individual stocks to watch now. And Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with Boeing. There's been some news about the St. Louis factory having some strikes. We're seeing Boeing on the back foot, down nearly 0.5%. Now, note that this St. Louis the strike that's happening in St. Louis is a lot smaller than what happened over in Seattle earlier this year. So that's probably the reason why for the tempered stock move this morning. Let's move on to companies reporting today. The big one being Palantir. This is the data company, the software company that's highly leveraged to the defense space. We're already seeing some optimism, Bonnie, baked into the stock before these earnings. The earnings are happening after the bell later tonight, but the stock is already running up 2% so far in the pre-market. Lastly, I want to talk about some M&A moves. M&A news for those taking helicopters out to the Hamptons. Bonnie, Blade is under some speculation of an acquisition by Joby Aviation. That stock is jumping 20% in the pre-market trade. Bonnie.
Yes, I did notice that, Valerie. I have not been a client, at least so far anyway. Thank you for that. That's Valerie Teitel there in London. And in this hour, Lizzie Galbraith of Aberdeen joins to discuss President Trump's tariff playbook, and Skylar Montgomery Koning of Barclays joins on her dollar outlook. Now, most of President Trump's new tariffs will take effect later this week, right after midnight, August 7th. Aberdeen's Lizzie Galbraith writes this, quote, "We expect that the stagflationary effects of tariffs on the domestic U.S. economy will begin to build from here, presenting a challenging outlook for the Fed. We expect core inflation to increase over the rest of the year." And Lizzie joins us now. She's political economist at Aberdeen. And thanks so much for joining, Lizzie. Lizzie, does your base case hold regardless of what kind of tariffs we see on, for example, China?
So our base case incorporates an assumption of tariffs of around 40% on China, all things being said and done. And actually this 40% transshipment tariff that we're starting to see crop up after Trump's announcements last week reinforces our assumption that that's where the eventual level will settle. Now, US-China negotiations are ongoing, so there is, of course, some uncertainty there. And we do operate on a scenario basis for this. So we do have this 40% base case, but we do acknowledge that there are risks skewed both ways, both given the constantly fluctuating nature of US-China relations, but also the critical minerals leverage that the Chinese appear to hold over the US economy at this stage does give it more leverage than some other countries have had in their negotiations with the US. And that could pull tariffs lower eventually as well. But for now, we stick with our 40% assumption.
Lizzie, 40% is a whopping tariff. What does that do to U.S. inflation, for example?
So we are expecting that US core goods inflation in particular will continue to creep up over the rest of this year. We're expecting it to become more material over the autumn and winter months. We, of course, have seen that impact delayed somewhat relative to our previous expectations, as we've seen tariff levels fluctuate so much and quite a lot of front running of good purchases delay that impact. But it does create a bit of a tricky combination for the Fed, particularly when you see it in combination with what appears to be a slowing jobs market as well, now that we've had that Friday payrolls report as well. Now, we're not expecting sort of runaway inflation. We do think that the risks here are relatively contained, but nonetheless, we are expecting upward movement in goods inflation over the rest of this year. And that is, of course, something that the Fed has been very clear that it is taking into account when it's thinking about its decision-making over the course of this year and into next as well.
Right, and this could very well present a big conundrum for the Fed at its next meeting. It does have, roughly 6 weeks till that September 17th decision has to be made. Nevertheless, we're not going to get that much more inflation data between now and then. What does the Fed do in this situation when the market clearly thinks, 4 out of 5 participants at the moment clearly think there's going to be at least one rate cut in September?
Yeah, it is, as you said, a very, very tricky proposition for the Fed. You're not necessarily going to have, all of the data that they would necessarily want to be able to make a decision like this. And Powell has indicated that, he is potentially more of in the camp of, let's wait and see. Let's try and understand how the changes in US policymaking are affecting the economy. But nonetheless, there is still pressure building for a cut in September as well. And we do think that jobs report that we got on Friday does make a September cut more likely. We have been in the camp of thinking that December has been more likely up until that point, because it would allow the Fed to have a better understanding of how all these different policies are affecting the US economy in greater detail. But it is that picture is somewhat shifting as a result of the jobs picture moving as well.
Lizzie, we're seeing many carve-outs. So, our Sean Donnan has written about this. There's about $1 trillion worth of goods that have been carved out with exemptions from these tariffs. Are you considering that at all in your playbook, in your base case, and what it might mean for inflation? Could it be material?
Yeah, one of the things that we think is going to be a core picture, part of the tariffs picture, is that it is somewhat constantly shifting. We're not necessarily getting to a point where we can say, okay, tariffs are now done, everything's stable. You are getting a bit of a shifting picture constantly, whether it's through sectoral tariffs being added, and therefore the tariff rate on some sectors potentially moving upward over time. And also, we're expecting more trade deals to come through that potentially lower the tariff rate for some of the currently affected economies. And of course, additional carve-outs could also be agreed over time as well. So we are expecting it to continue to fluctuate, even as we start to see a bit of a landing zone where we can understand the sort of the rough contours of where certain countries are likely to end up. But that doesn't necessarily mean that tariffs are going to be done and completely embedded on a totally stable level from the 7th. So that does mean that you do potentially get some shifts going forward, particularly for some sectors where we think that tariffs are still coming down the track, like pharma. Now, we know that the EU have got potentially a bit of a preferential deal there on some pharma tariffs, but we don't necessarily know the full picture for the rest of the world, and that could be a really important one when we're considering the overall outlook from here, as well as potential additional tariffs levied. We know that some extra inquiries are being conducted by the US trade representative at the moment. That could still result in a shifting picture over the rest of this year.
And Lizzie, just briefly, if you see tariffs being a considerable headwind to US growth over the next 2 years, there is, in your opinion, perhaps an offset. We might have to wait, but by 2026, 2027, there will be a support to growth. Can you give us just a little more detail on that?
So what we are saying is that for some affected economies like the Eurozone, as an example, they're currently, we are expecting a hit to growth as a result of the tariffs that they're going to be levied with from the end of this week over 2026, 25, 26, sorry. But because we're also expecting in the Eurozone increased defence and infrastructure spending to start coming through as part of the changes to the Eurozone's fiscal rules and as part of the increased defence commitments that they've made through the NATO summit over the summer, we are expecting that actually we're going to see some support to growth as that money starts to move through from government commitments into the real economy from 2027. So we think there is support coming that will, over the more medium term, help offset some of these immediate impacts that we're seeing on the trade side.
All right, Lizzie, thank you so much for joining us this morning. That is Lizzie Galbraith of Aberdeen. Now to top stories trending on the terminal this morning. Swiss stocks getting hit today, nearly erasing gains for the year. That's on fears President Trump's 39% export tariff will dent profits there. Switzerland, known for its luxury watches, rich chocolates, and banking giants, of course, is one of the US's biggest trade partners. More than 3,000 Boeing defense workers are on strike, walking off their jobs around midnight. The workers rejected a modified contract offer, which would have raised wages by 20% and boosted retirement contributions. Union members built fighter aircraft such as F-15s. BMW is taking on Tesla and is going all in on its new electric vehicle offering. The German carmaker's flagship factory is set to produce nothing but EVs by 2027. It's staging a swift rollout of 40 new or updated models with high-performance computers. Coming up, Kugler exits. President Trump prepares to name replacements for the Fed governor and the fired jobs data chief in the coming days. More on that next. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Couple of people in mind. I'll be announcing somebody for the filling of the person that left. A woman left, as you know, who was I guess a Biden appointment, either Biden or Obama, but I think a Biden appointment. And she left early, and I think she left because she agreed with me on interest rates, and yet they were on the other side of the ballpark, right? So I'll be announcing that probably over the next couple of days.
The exit of Fed Governor Adriana Kugler handing President Trump a sooner-than-expected opportunity to appoint someone who more closely aligns with his preference for lower interest rates. Joining us now from Washington is Bloomberg's Kasia Klimashinska. Kasia, a very interesting development. Does this mean that the heat might come off Fed Chair Powell for a little bit if the president is, more focused on appointing a new governor?
Good morning. Thank you for having me. So indeed, even as President Trump has only one event on his schedule for today, this is lunch with Vice President J.D. Vance, but he will be very busy thinking about two nominations, the one that you mentioned, of a new Fed governor after Adriana Kugler announced unexpectedly that she will resign sooner than expected. Her term was about to expire in January, so I'm sure President Trump already had an eye on this possible vacancy coming up, but now he will have to announce the replacement sooner. And also because the term of the chair of the Fed, Jerome Powell, expires in May, President Trump might announce somebody now who will first get on the board and then eventually become the chairman.
So who should we be expecting to be in the mix? The same names that we've been hearing as a potential new Fed chair?
Indeed. So there are two Kevins, right? Kevin Hassett, who is now at the White House. He's advising President Trump. He's very much aligned with Trump. Several times he expressed his concern and his support for interest rates being cut. There's also Kevin Walsh, who used to be on the Fed. And there is also Treasury Secretary Scott Bessent.
Kasia, moving to the data statistician chief, how can President Trump have an impact on that bureau by appointing somebody closer to him?
Yes, so that's perhaps an even more surprising story. After we had relatively weak job data on Friday, President Trump announced on Truth Social that he's firing the head of this agency and he will pick a new one. We had a note from JP Morgan economist Michael Ferroli just yesterday saying that this is a very important development, that markets should perhaps pay even more attention to that than the Fed, that this agency being politicized is a serious concern. It might have impact not only on the economic data, but also on financial markets, given that BLS is producing a lot of data that is impacting the trading of dozens of assets every day. For example, inflation-linked treasuries are linked to CPI, which is one of the data sets that this agency is responsible for.
It's going to be some interesting days ahead. Kasia, thank you so much. That's Bloomberg's Kasia Klimashinska in Washington. Meanwhile, the trade talks persist with China.
They really focused on rare earth magnets and minerals. China has put a global control on the world. And so for the United States, we're focused on making sure that the flow of magnets from China to the United States and the adjacent supply chain can flow as freely as it did before the control. And I'd say we're about halfway there.
Joining us now is Brendan Murray, who leads our global trade coverage. So it seems to be all about the magnets right now, Brendan. How many more do we need? If we're halfway there, what does that even really mean?
Yeah, he didn't put any numbers on the halfway there comment, but we do know that there's a deadline coming up here in the near term. August 12th is when the current ceasefire truce between China and the U.S. and the very high tariffs that they had on each other just a few months ago. And they came out of the meeting in Stockholm a week ago saying there were just some small technical details to work through, but here we are a week later, and if those were so small and insignificant, why aren't they resolved by now, and why haven't they extended that truce? So there'll be a lot of focus on the White House today and in the days ahead this week to try to understand what are the sticking points, if there are any, and why can't they get this, as Treasury Secretary Scott Bessent has said, maybe a 3-month postponement, kick this can down the road into November or so. Why haven't they gotten there? The other short-term deadline we're looking at is August 7th. That's this Thursday, when those tariffs that President Trump announced on Friday take effect for most major trading nations. There's some thinking that perhaps there are still a deal to be done for a country like Taiwan or perhaps Switzerland, which got hit with 39%. So there could be some furious deal making going on in D.C. Over the next couple of days.
For sure. And then the other question is that it seems that the heat is being turned up with the relationship with India. Indian Prime Minister Modi urging the nation to buy local goods in the face of U.S. tariff threats. What kind of a response should we expect from President Trump on that?
Well, President Trump, likes to escalate so he can de-escalate. So this is just the latest in a series of shots that each leader has fired across the other's bow. It's you could see a point at which they disagree so much and the rhetoric gets so heated that President Trump takes the temperature down. But I think what you're seeing from India is what we're seeing from South Africa. It's what we're seeing from Brazil. It's these countries are saying, look, if you're going to treat us like this, then we're just going to take our business elsewhere. We're going to look for other markets to do business with. I think that's one of the key things to look for in the weeks ahead is to what extent countries can try to step back from the U.S. market and diversify their supply chains elsewhere around the world.
Yeah, you mentioned South Africa, Brendan. It's actually stated and is looking for new relationships. This is going to change ties, particularly with global South countries. What else do we know about where South Africa might be able to boost its ties and replace some of those relationships that it had with the United States?
Well, there's the continent-wide free trade across Africa. So there are some thoughts that there could be some diversification there. But countries like South Africa and others that are in the BRICS are really trying to formalize some of these relationships, understanding that the U.S. is trying to sever a lot of them. So it's still, that's the big bet. President Trump thinks that they can't live without the U.S. economy. That's the leverage he has over them. And so they're gonna be weighing up some difficult decisions if those tariffs take effect as President Trump has implemented for August 7th and starts to reshape trading flows around the world.
As you say, just 3 days away. Brendan, thank you so much. That is Bloomberg's Brendan Murray there in London. Coming up, Texas Democrats flee the state to block a redrawn congressional map. More on this and a look at what else is making headlines in your front page news. That's next. This is Bloomberg.
I think with the new world reorder, it means that there will be regional clusters of excellence. There will be regional clusters of great companies. And so it's okay to be number 2, because you could be number 2 in every single region and still command that premium. Because today we talk about AI, we talk about data, we talk about processes that's going to be very specific to industries, specific to countries, specific to regional challenges that needs to be built and addressed. And therefore, the good of it is that now it's not just going for that one company and overpaying for that company until the returns goes to 0. It's actually about finding regional champions, which could also be huge category leaders for us as funds as well. And I think it's actually good for the world to have multiple pots of excellence that can be localized to its own needs.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, a Wall Street Journal exclusive on how China is choking supply of critical minerals to Western defense companies. China supplies around 90% of the world's rare earths and dominates the production of many other critical minerals. Next up, on the Washington Post, Texas Democratic lawmakers are fleeing the state to block a Republican redistricting push backed by President Trump. The walkout will leave the state legislature short of the minimum number of lawmakers required to hold votes. And on the New York Times, U.S. and Israeli officials float the idea of a, quote, all-or-nothing Gaza deal. With Israel-Hamas talks now at an impasse, American and Israeli officials appear to be sharply changing their tone by pushing for a comprehensive deal. Let's get a check on the markets now. We do appear to be looking at a positive day. We've had positive sessions across Asia and into the European session. Right now, S&P future is pointing to a gain of 0.7%. That's, of course, after the index dropped 1.6% on Friday. The Bloomberg Dollar Index relatively stable, fractionally lower. The 10-year yield bouncing back by less than 3 basis points. That plummet of 16 basis points on Friday, really something to watch. Of course, the 2-year yield was down 28 basis points, and that is up only around 4 basis points right now. Coming up, we're going to discuss currencies with Skylar Montgomery Koning of Barclays. This is Bloomberg.
Estava sitiada.
Isso eu começo, eu não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Stock futures bouncing back as investors bet on Fed rate cuts following a cooler than expected jobs report. President Trump says he'll announce a new Fed governor and a new chief for the Bureau of Labor Statistics. And U.S. Trade Rep Jameson Greer says Washington and Beijing are, quote, halfway there on rare earth flows. Let's take a look at those markets as we inch ever closer to the open. Look at that green on the screen for S&P futures, NASDAQ 100 futures, and Russell 2000 futures. That's, of course, after a blood-red day on Friday. Ed Yardeni calling it Freaky Friday. In fact, it was that bad. The S&P was down, well, 1.6%. Let's not maybe get too carried away. The NASDAQ 100 was down 2%. But we haven't seen those kinds of declines in quite some time. If we take a look at bonds, the reaction is a little bit more muted today. We're up just less than 3 basis points on that 2-year yield, which dropped, remember, almost 30 basis points on Friday. So we'll see how that moves today. Obviously, repricing of Fed rate cut expectations built in here, but they're not being repriced today. We still have to, of course, see who the next Fed governor to replace Adriana Kugler is going to be. Also, what's going to happen with the Bureau of Labor Statistics. All of that to come this week. Let's get to some stocks to watch now, though. We'll go to London and Valerie Teitel. Valerie.
Good morning, Ivani. Let's start with Boeing. There's word that the trade union at their St. Louis factory is going on strike. Those shares are on a back foot, down less than 0.5% this morning. The St. Louis factory makes their F-15s. It's focused on defense production, but the trade union there is one of the smaller ones at Boeing, hence the tempered decline in the pre-market. Let's move on to earnings. It's a quiet day-ish this week for earnings. We do have a big one after the bell. That's Palantir, and we're also seeing some positivity baked into this stock already in the pre-market trade, up 2.2%. This is the data software firm that is tied mostly to the defense industry. They report after the bell, the biggest stock in the S&P 500 to report today. Lastly, some M&A activity. It is Monday. There is some chat that Joby Aviation is looking at a potential acquisition of Blade. The shares of Blade up some 19%. I think most in Wall Street might be familiar with Blade as they charter many helicopters out to the Hamptons. Bonnie.
Yes, indeed, Valerie. The summer isn't over yet. You never know. That's Valerie Teitel there in London. Barclays FX strategist Skylar Montgomery Koenig writes this. The dollar bearish view is a narrative around the end of U.S. exceptionalism, but that narrative has failed to show up in flows or data. It's a fascinating take, and she joins us now in studio. Skylar, you say that this bearish dollar narrative is not showing up in the flows or data, but we have had a significant drop to the dollar. Are you saying that that drop is now perhaps complete?
I think what we see maybe is a little bit different in the near term versus the long term. So in the near term, Friday's data was pretty unambiguously negative. I think the market processed that well. We added on top of that the resignation of a Fed chair. So you now have questions around who's going to become, sorry, not the Fed chair, the resignation of a Fed governor. So you now have questions around who will be the next Fed chair, as well as the issues that you have around the BLS. So in the near term, certainly I think you can look at tactical shorts in the dollar. I think longer term, though, we have one data print. Yes, the revisions were also negative, but it may be exaggerating the weakness that you see in the U.S. economy. Elsewhere, we haven't seen a lot of that weakness. So if you look at other labor market data, say layoffs, so claims or openings, those are still holding up at very strong levels. And at the same time, what we heard from the Fed last week was that it's both the supply and the demand of labor that matter, and those are coming down together. So they're really watching the unemployment rate. So it feels like it's a bit premature to price in almost 3 cuts this year for the Fed when you don't really know where that unemployment rate will go. We think it will only rise modestly. And at the same time, inflation is likely to rise quite a lot. And so we still only expect 1 Fed cut this year.
Yeah, Ed Yardeni doesn't even expect any. He says none and done still for pretty much the same reasons. What are the flows showing if they're not showing that U.S. exceptionalism is over? Is it that, there's still a lot of optimism about the U.S. economy and about, the fact that the dollar is the reserve currency to the world? Or is it just that, people don't know yet?
I think the issue isn't so much around optimism. I think it's mostly that there's not a great alternative. And so there was all this excitement in the first quarter of the year around Europe and that they get more fiscal. You haven't had fiscal really spread out beyond Germany. These other economies haven't decided to take on that loosening of the fiscal rule as a way to boost their economy because they're worried about their debt load. And so what you've seen instead is, this flow out of the U.S. into other regions that was expected just hasn't happened. You haven't seen broad flows out of U.S. equities. You haven't seen broad flows out of U.S. fixed income, and you're unlikely to see those flows if the data keeps holding up, right? Because it means that U.S. tech in particular is holding up the equity market there, but also U.S. earnings generally can outperform still, and it means that if the Fed stays where it is, U.S. yields are still relatively attractive.
So to phrase it in trade terms, because everything has to be phrased in trade terms, we're seeing ties broken, new ties being formed, efforts at new ties and so on the trade front. But you're saying when it comes to currencies, we're not really seeing the same types of relationship changes.
I think we had initially on Liberation Day seen a very large relationship change in terms of Liberation Day was taken pretty unambiguously as negative for the dollar. I think there are 2 big reasons for that. The first is there was a question over whether or not the U.S. administration was prioritizing U.S. growth. If you had such a negative U.S. growth policy come out, and then the second bit was around the U.S. was starting a trade war with the rest of the world. The expectation was the rest of the world would retaliate, and that would hurt U.S. growth much more than elsewhere because all U.S. imports would be affected versus Europe. It's just their exports to the U.S. that are impacted. What we've seen instead, though, is that these economies are willing to accept relatively high levels of U.S. tariff rates without retaliation. They're also much more open economies. The U.S. is the most closed economy within G10, and so a trade war that slows down global growth is more negative for them than it is for the U.S. And so we've now flipped to much more of a normal correlation, I would say, where when you had the European trade deal, it wasn't seen as a positive for Europe, it was seen as a negative for Europe and a positive for the dollar.
So in Barclays' view, what are the currencies that we should stay long and relative to what? I mean, so is the euro going to suffer now?
Yeah, I think the euro certainly has really benefited as a dollar liquidity play. So there's not a lot going for it from a fundamental perspective for growth next year. And this year it is quite weak because you're coming from a place of stagnation, and the negatives from growth from tariffs far outweigh any kind of fiscal impulse you could get that's more positive. I think, though, other currencies to look for are something like the yen. So there's a big fiscal premium baked in there now. That's maybe not as justified. You also kind of see a decay factor with those premiums. They've gotten a trade deal. That trade deal meant that we raised our growth and inflation forecasts. That's also fed into the Bank of Japan inflation forecasts, which are significantly higher. You are actually seeing inflation that's being driven by wages rather than kind of more transitory one-off factors. And so that should allow the Bank of Japan to hike in relatively soon. So we expect the next hike now in October. And that means the Bank of Japan is hiking as the rest of DM is easing. And that's very supportive for a currency, especially one that's a safe haven.
So then should we expect renewed appetite for the carry trade again? And are we back to where we were?
I don't know so much on the carry trade. I think the carry trade makes me a little bit nervous because you need 3 fundamental things, right? You need interest rate differentials, you need positive risk sentiment, and you need low volatility. Some places you do have interest rate differentials that are significant enough, but that gap is certainly closing with a lot of G10s easing. And I think the issue really is whether you get that rise in volatility or risk sentiment coming off because, yes, we're excited that tariff rates aren't as bad as they could have been, but the market's also looking for the Fed to be supportive this year. And as we saw on Friday, if you get poor data, then that's not great. And also if you get the Fed not cutting as much as the market expects, it creates some wobbles as well.
Now, do we get a lot of volatility, Scott? Right now the DXY is at 98.79. We're talking about, 115.71 versus the euro. Do we see, big movements there? Many big figures, for example, for the euro?
Yeah, I think for euro-dollar in particular, we do have some near-term weakness. So 117 for euro-dollar is what we're looking at near-term. But then further out into 2026, we have this kind of gradual fall to 113. And I would say here as well, what you've seen is that you've had a lot of front-loaded weakness, right, in the dollar. So the first half of the year, you saw quite a lot of that priced in, and you saw more negatives priced in than positives, as in it was an asymmetric reaction function, where, for example, something like fiscal, which could be seen as positive because it boosts growth in 2026, was taken as a negative because Section 899, which isn't even in there anymore. And so that means that even to kind of get more to a fair value level, you'd expect some kind of dollar appreciation, where even post the move we had in yields on Friday, fair value on something like terminal expectations is closer to 112.
Whoa, 112 all the way down from 115. Skylar, thank you so much. We'll be chatting with you again before all of that happens, no doubt. That is Skylar Montgomery-Koning of Barclays. And now to other top stories trending on the terminal this morning. Swiss stocks are getting hit today, nearly erasing gains for the year. That's on fears President Trump's 39% export tariff will dent corporate profits. Switzerland, known for its luxury watches, rich chocolates and banking giants, of course, is one of the US's biggest trade partners. Berkshire Hathaway shares are lower pre-market after reporting that it took a $3.8 billion impairment on its Kraft Heinz stake. It reported a $344 billion cash pile for the second quarter. That's the first time in 3 years that the war chest has shrunk. Just a little bit. BP says it made its biggest discovery in 25 years. It found a 500-meter column of oil and gas in deep waters off Brazil. The discovery is a boon for the UK oil major as it seeks a turnaround after years of underperformance. Coming up, President Trump prepares to name replacements for Fed Governor Adriana Kugler and the chief of the Labor Statistics Bureau. More on all that next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
couple of people in mind. I'll be announcing somebody for the filling of the person that left. A woman left, as you know, who is I guess a Biden appointment, either Biden or Obama, but I think a Biden appointment. And she left early, and I think she left because she agreed with me on interest rates, and yet they were on the other side of the ballpark, right? So I'll be announcing that probably over the next couple of days.
Fed Governor Adriana Kugler's resignation giving President Trump an open spot for an appointee of his choosing faster than anticipated. Joining us now from Washington is Bloomberg's Kasia Klimaszinska. So Kasia, we were all focused on the Fed chair, but now perhaps we should be focused on a different seat. Will it take the pressure off Fed Chair Powell, at least for a few months, if President Trump gets to nominate somebody to be governor?
Good morning. Indeed, finally, President Trump has a chance to make his mark on the Fed in his second term. He has been criticizing the Federal Reserve since he became the president, since he returned to the White House, attacking especially Fed Chair Jerome Powell personally for not cutting interest rates fast enough. Now, Chair Powell's term doesn't expire until May, but now with this resignation from Adriana Kugler, President Trump has a chance to pick somebody new, add them to the board, and perhaps later promote them to the Fed chair in May.
Now, Kasia, the data statistician that might be appointed by President Trump, how much can he influence the collection of statistics by, putting in somebody that's closer to his interests?
Indeed, that's a great question. That's an even more interesting, more surprising story. On Friday, we had those relatively weak numbers about the U.S. job market, and as a result, President Trump went to Truth Social and he said he's asking to fire the head of this agency and he will pick somebody new. That's obviously a shock. This agency, BLS, is considered a gold standard, highly regarded here in the U.S. and around the world for putting out reliable, fast, accurate numbers. Now, a lot of people, economists, former heads of this agency say that this one change should not impact much, that the army of statisticians and economists that work there, that they will continue to produce reliable numbers that are really crucial for financial markets around the world.
I think that is certainly the hope, at least. And then let's move to trade, because we had, high hopes for Stockholm, but now we have the USTR, Jameson Greer, saying U.S.-China talks are, quote, about halfway there on rare earths. What does that mean for overall talks with China?
Indeed, so we are still waiting for President Trump's decision on that. Remember, last week on Thursday, the White House unveiled this huge list of new tariffs for all the trading partners around the world, except for China, and that's because those talks between the U.S. and China are ongoing. Last week, Treasury Secretary Scott Bessent and U.S. Trade Representative Jameson Greer met with their Chinese counterparts in Stockholm, as you mentioned, and then the Chinese side came out and announced kind of a success, saying that this tariff thaw or truce has been extended. But then Treasury Secretary Scott Bessent and Jameson Greer said that the decision has yet to be made by President Trump, and we are still waiting for this announcement. But those comments from Jameson Greer yesterday were very interesting, very insightful. He kind of said that the U.S. and China are halfway there, implying that the magnets are not flowing fast enough to the U.S. So the U.S. wants magnets or rare earths from China to be able to produce home appliance, missiles, a lot of products, and it looks like they are not satisfied with the supply yet.
All right, Kasia, thank you so much. That is Bloomberg's Kasia Klimaszinska in Washington, D.C. Let's turn to oil now. Prices taking a little dip this morning as investors assess the decision from OPEC Plus's production hike and the possibility that the group may now pause increases. Joining us from Dubai is Bloomberg's Anthony De Paula. So, Anthony, as I say, we're seeing just a little softness there in an oil market that's already pretty saturated. Why not more, given that we're seeing quite a lot of barrels come back to market now?
Yeah, good morning, Vani. Oil is pretty stable. We are into the red now. We were in green here in Dubai this morning, but we're still around that $70 mark, which isn't bad for oil. And really, it's not a decline that would indicate 500,000 barrels of new production coming online from OPEC. These decisions were forecast by the group, so there was some reporting from Bloomberg this weekend that they did expect to go ahead with that. And coming out of the last meeting, A month ago, when OPEC made a similar increase for August, the decision this weekend was for September volumes, it seemed pretty much likely that they were going to go ahead for the second straight month of that same size increase. But what we're seeing is a really market that's really benefiting from high demand. So we've seen a lot of good summer demand from transport, so transport fuels like gasoline, diesel, because people are driving around going on to their vacations, and also jet fuel, again, as people fly and go to different destinations. So we've seen that demand really holding up over the summer months, and that's kind of been the surprise, that we haven't seen demand waning. We haven't seen the oil mark crumpling a little bit more under the weight of this added OPEC plus supply, which is kind of what you would expect. But as we get that supply coming on in August, coming on in September, we may be going into those more shoulder months as demand wanes kind of into the third and fourth quarter, Vani.
For sure, and OPEC Plus seems to be keeping its cards close to its chest on what it's thinking for a next decision, Anthony. I mean, is it possible that it could continue to add more barrels back? Are the likes of Saudi hurting financially? Would they need that?
Yeah, I mean, for sure they could continue to keep adding things back, because OPEC Plus at this point is cuts upon cuts upon cuts. So what they've done now is rolled back one group of voluntary cuts that a group of 8 countries made. There are other levels of cuts that OPEC still has to reverse as well, too. So if they see the market continuing in this strong fashion, they could add some more oil to the market. OPEC is looking at the benefit of gaining some market share. A lower price will also hurt some of their competitors. However, OPEC has tried to play that game before, and they weren't able to price competitors like U.S. shale out of the market. The U.S. shale producers bounced back and are still a major player in the market. But OPEC is looking to gain back some market share. They could add back some more. They could even take some more off of the market if we see that weakening through the end of the year, Vani.
Anthony, thank you so much. That is Bloomberg's Anthony De Paola there in Dubai. And one stock we're keeping an eye on, Boeing, down about 0.5% now in the pre-market. More than 3,000 of the firm's defense workers are set to go on strike. In fact, they're on strike this last almost 6 hours now. That's since 1996 has there not been a strike like this. They rejected a 20% pay rise, among other things. Boeing says it's ready for the strike with contingency plans in effect. For more, Bloomberg's managing editor for space and aviation, Benedict Kamel, joins us now. Benny, what is the appetite among union members for a strike? We did see the last time, back in 96, a 99-day strike. Could it go even as close to that long this time?
Well, it looks as if this time they are really willing to go to a strike. In fact, as you said, they have. And it was a bit of a surprise. We came into this a week ago. There were preliminary conversations between management and the unions. And then we thought that they might use the week that just ended to get over that hump. And that clearly has not happened. So we are now in a strike scenario, first time in almost 3 decades. Whether it'll go to the 99 days that we had last time is anyone's guess. I would probably think that they will get to an agreement sooner rather than later. Boeing can probably afford a little bit more patience here, because this is a business that is much smaller than the one that went on strike late last year. People will remember that the civil aviation business that went on strike last year. That was more than 30,000 people, and that really ground those operations to a complete halt. So that's not quite as dramatic this time. So Boeing might be a little bit more casual about it now and might feel that they have the cards in their hand. So we'll have to see how the next rounds go. We don't know yet when they will join them, the workers and management. So it'll probably happen sometime this week, but at this point, the status is that the workers have walked off and they're on strike right now.
Yeah, CEO Kelly Ortberg saying we're looking at about 1/10 the size of last year's civil business strike. And so obviously, you know, that would be the company line anyway, right, to play it down a little bit. But I am curious, they manufacture the F-15 in this department, the T-7 training jets, missiles, munitions. Will there be any pressure put on the company to get this sorted fast?
Yes, I think the longer this drags on, the more pressure will build. This is a playbook that we saw on the civil side last year as well. At some point, you will get a mediator coming in. At some point, you will see the government come in and look at what they can do to facilitate things. This is a less visible part of the business. They make fighter jets, they make training jets, components for some civil products, but it's not as visible as the civil aircraft that we all use on a daily basis, and therefore it won't have as dramatic a ripple effect across the entire company. As you said, Kelly Ortberg, who really walked into that strike last year, he is a little bit more casual about it,
Yes.
so this week will probably bring some movement.
All right, Benny, thank you so much. That is Bloomberg's Benedict Kamel there in Berlin. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Now, for a look at what's ahead this week, we get PMI and trade balance data coming on Tuesday. Earnings continuing apace with AMD reporting Tuesday, Disney, Uber, and Lyft on Wednesday. And a Bank of England rate decision comes on Thursday. I do have to say we have to get through Monday's trading session before we get to all of that, though, and it's going to be a fascinating one. If you look at S&P futures, we're seeing a big bounce back from those big declines Friday. It was a 1.6% drop, don't forget, for the S&P. However, we're not seeing quite the same repricing in the bond market. Will the bond market tell us what the Fed's going to do in September today? We'll see. That's it for Bloomberg Brief. Surveillance is ahead. This is Bloomberg.
nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were gonna probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is gonna get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
When you look at the labor market data, there's certainly some stuff to be concerned about.
The inflation data are also going to be pretty elevated in the next couple of prints, so it makes it a really tough backdrop for the Fed.
I think the bar for them to cut has actually increased in the last few months.
I do think it's time for the Fed to really be pivoting to why are you waiting, as opposed to the well, we can wait.
The Fed put is still there to come in and sort of save the day, if you will.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City for our audience worldwide, good morning. This is Bloomberg Surveillance. Alongside Danny Berger, I'm Anne-Marie Hordern. Jonathan Farrow and Lisa Abramowitz are off today. We're coming into the week with stocks looking to bounce back after Friday's post-payroll sell-off. The weaker-than-expected data and large downward revisions prompting the president to fire the head of the Bureau of Labor Statistics. Plus, Fed Governor Adriana Kugler resigns, giving President Trump an opportunity to shape the Fed earlier than expected. The president said he'll name names this week.
They'll be announcing somebody for the filling of the person that left, but I think a Biden appointment. And she left early, and I think she left because she agreed with me on interest rates. We'll be announcing a new statistician sometime over the next 3 or 4 days. We had no confidence. I mean, the numbers were ridiculous.
Meanwhile, the fresh tariff rates announced last week go into effect Thursday as some countries are still hoping for deals. Danny, good morning. A fresh dose of uncertainty this Monday morning.
Oh, it's going to be such a quiet week, Anne-Marie. It's uncertainty, and kind of the absurdity of it is that we were just at all-time highs on stocks at this point last week. Instead, what we have now is the data is starting to look weaker, both jobs, and by the way, ISM was really weak last week too. Credibility at the Fed being eroded once again, credibility of the data being eroded once again, and tariff pressures reigniting, all of that happening with stock valuations near all-time highs. As Lori Calvasine of RBC says, angst has returned for this market.
Oh, then you have other people like Mike Wilson of Morgan Stanley this morning. Investors should be buying of this potential stock pullbacks. We're buyers of this dip. Friday may all we get to the downside for now, and they still see Liberation Day as the major and durable low for equities.
Well, also part of the problem is on an index level, tech is still doing really well. We learned that from earnings. Banks are still doing really well. What happens when some of the more cyclical type industries start to hurt? What happens when you start to get the P&Gs of the world flag that consumers aren't spending as much across the income spectrum? At any point, does that even read through to the indexes? It's something that's really difficult to grapple with, and why you can have two different views of where we go.
And what happens when the market is starting to worry about confidence with this idea that you can just fire the head of an independent agency? Kevin Hassett over the weekend, the president's top economist. What we need is a fresh set
of eyes over at the BLS. The president wants his own people there so that we see the numbers, they're more transparent and more reliable. Neil Dutta, though, says, don't shoot the messenger.
This is often the case with Trump, that he identifies a real problem. We know that this is a problem. The data is getting more difficult considering response rates have gone down and just their funding has gone down. The problem is that he identifies the wrong cause and thus makes it political and undermines confidence. You could say around the edges, does this not at least argue for higher risk premium in U.S. assets?
Well, when it comes to futures this morning, Danny, they're bouncing back from those lows that we saw on Friday. No drama, as Jonathan would say, as I sit in his seat this morning. S&P 500 futures up 0.6%. Mike Wilson, I keep going back to this. This really feels like the tone of the market, at least for this morning, even though we have that uncertainty, saying investors should be buying of any potential stock pullbacks. Coming up this morning, Ed Yardeni of Yardeni Research with stocks rebounding. Terry Haynes of Pangea Policy with President Trump reshaping the Fed and the Bureau of Labor Statistics. And Michael Gapin of Morgan Stanley as a softer payrolls report fuels rate cut expectations. We begin this hour with stocks looking to bounce back after a weak payrolls report fueled rate cut expectations. Ed Yardeni of Yardeni Research writing, traders might be starting to take profits before going on their August vacations. They might also be betting that September could be a weak month for stocks. Ed joins us now. Ed, let's start with the growth picture and just your reaction to Friday's labor market data, especially those massive downwards revisions. For you right now, is it a cause of concern?
Not really, not the way the market took a dive, and I'm happy to see that the market may very well rebound today. The reality is we did have a lot of uncertainty during May and June when we had these big downward revisions. Honestly, it seems to me the downward revisions actually make more sense, given that if I was an employer during May and June, I wouldn't have fired anybody, but I wouldn't have hired anybody, given all the uncertainty unleashed by what I call Trump's tariff turmoil. And so, yeah, all in all, those numbers didn't surprise me all that much, with the benefit of hindsight, obviously. And then, of course, we did see that the labor supply, the labor force, has been kind of flattened down since the beginning of the year. So this is a combination of weakness in demand related, that may be temporarily related to the turmoil on tariffs that should, I think, abate over the next few months. And at the same time, we may actually have a shortage of workers.
Well, the president didn't like the jobs number on Friday, and he fired the head of the Bureau of Labor Statistics. Do you think that undercuts market confidence?
Well, this is a very bad situation. The president, in my opinion, shouldn't have done that. I agree with what your colleague Danny just said, and that is he should be throwing more money at the Bureau of Labor Statistics so that he can do a better job sampling workers and the unemployed to see what's really going on here. Firing the commissioner does raise some questions of the confidence that people are going to have in the data, especially if he puts in a loyalist as a statistician, which he's likely to do.
So what do you do then, Ed? If you get a loyalist put in as a top statistician there, do we still trade on the data? Do you take it more skeptically? Do you use private measures more? How will it change how you interpret labor market data?
Well, yeah, I think right now there's a lot of skepticism about the labor market data, the employment data, I should say, because of what you mentioned before, the fact that response rates have gone down. And look, the economy moves a lot faster these days, and I'm not sure the statistical techniques that the BLS has move as rapidly. So I would throw more money at them rather than become partisan about it. So all I'm saying is the data was already suspect for other reasons, and we've all of us economist types have looked at all the employment data, both private and public. So I think nothing dramatically changes in terms of the way the markets look at data.
Even so, Ed, nothing dramatically changes, but Friday did demonstrate a vulnerability in the market with that huge move in the front end. You could even say what happened with copper prices demonstrated a vulnerability. Given that we've had this slow melt up to the summer, you're still bullish, Ed, but are you concerned about some of these short-term blips that traders aren't properly hedged for?
Well, you quoted me saying that a lot of traders, a lot of investors are going on vacation. They certainly don't want to be exposed to the volatility of the market, at least not from a trading perspective. So I think we're going to see a lot of that kind of activity slow down. I think it already has slowed down. Maybe it started that on Friday, as some people said, you know what, I'll be taking vacation for the next week, 2 weeks. Let me just close my books here. And then, of course, there is a seasonality issue. Septembers have a tendency to be weak months. So I wouldn't be surprised if this market just kind of chops around here in August and September, and maybe we make some sort of low or bottom in October for a year-end rally.
Good luck to anyone who's trying to take a vacation with all these headlines coming out. Ed, also this week we have this new deadline when it comes to the tariff rates on Thursday. Do you think the market is ready to basically put the trade war behind them?
I think the markets would love to put the trade war behind them, and I really thought that by now the president would really be in the same camp, because he's going to start focusing on the midterm elections next year. He does love to talk at these large conventions, these large rallies in sports stadiums, and he's going to need to do that in order to shore up his Republican Party during the midterm elections. And he's got to really start to focus on just saying what has been accomplished and avoid doing things that might backfire on the midterms. I think the other issue, of course, is the courts are probably about to rule that he doesn't really have the legal authority to do what he's been doing. I don't know if it's going to go all the way up to the Supreme Court. The appeals court has 11 judges, and if all 11 of them rule that way, which is possible, the Supreme Court may not take it up. So we may be entering even a more volatile period with regards to what's going on here on the tariff side.
But you don't expect the tariffs to go away, do you? Because there are other tools they can use to enact them.
There are other tools, but they're not as quick or efficient as the emergency act that he called upon, that the courts may rule. He just doesn't have the power to declare an emergency when there doesn't seem to be an emergency. Again, I think he and the administration may conclude that it's time to downplay the whole thing and move on.
What does that mean for corporate America, Ed? Some of these companies are just starting to wrap their heads around what it means for them. Or you have the likes of Amazon last week who said, we just don't know what's going to happen moving forward. Yeah. Is there enough clarity after Friday for corporations to move forward with things like spending and hiring plans?
I think we have to see what the courts rule and how the administration responds to that. The reality is, if we just take it at face value that the president wants to basically achieve a 15% tariff across the board on everybody and raise something like $400 or $500 billion, well, the corporate income tax raises about $600 billion. In effect, the tariffs are a tax, and they're a direct tax on importers, businesses. And so it is a negative for corporate profitability. And again, we've heard some bad news out of GM and Ford anticipating this, but other companies say we just don't know enough to really figure out what this is going to cost us. So that's still a known unknown.
But it's still a little bit more clarity in terms of the bottom line rate for tariffs. Yeah. We do have a weakening jobs report on Friday. Do you think the Fed is in position to cut in September?
Well, the market certainly thought so on Friday. Maybe today there'll be a change of opinion. I think on Friday we got the probability of a rate cut, according to the CME FedWatch tracking tool, going up to a 90% probability. Then over the weekend, that actually simmered down by the end of Friday down to 80%. I wouldn't be surprised if there is no rate cut on September, because we still have a batch of data up ahead here, particularly on the inflation front. We are seeing that the tariffs are having an impact on inflation. A lot of people saying, well, it's not there, but the reality is, if you look at durable goods inflation, durable goods prices typically fall. That's what they did before the pandemic. Then they had that inflation spike, but then they came right back and started falling again, and now they're rising again, mostly because of the tariffs.
Ed, thanks so much for your time this morning. It's a great point. Ed Yardeni of Yardeni Research. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anand. Hey, Yahira.
Good morning, Anne-Marie. President Trump is set to announce a new Federal Reserve governor and Bureau of Labor Statistics head in the coming days. He told reporters he has a couple of people in mind to replace Fed Governor Adriana Kugler. His pick might be in the running to fill Fed Chair Jay Powell's spot when his term ends in May. Meanwhile, on the trade front, President Trump and Prime Minister Mark Carney are expected to talk over the coming days after the two countries failed to reach a trade deal before the August 1st deadline. Canada's minister in charge of U.S. trade said he thinks there is opportunity to strike a deal that would bring down some tariffs. And staying on the trade front, Swiss stocks dropped after traders there had their first opportunity to react to President Trump unexpectedly slapping a 39% tariff on all imports from the country. The new tariff announced last week leaves Switzerland with one of the steepest levies in the world. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. We'll hear from Yahira again in 30 minutes. Up next, awaiting President Trump's picks.
So we'll see what happens. But we just found out that I have a open spot on the Federal Reserve Board. I'm very happy about that.
Terry Haynes of Pangea Policy joins us next. You're watching Bloomberg Surveillance.
Is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Good Monday morning. A lot of uncertainty into this market. As the president said, we're going to get new names when it comes to the head of the labor statistics that he fired on Friday, that commissioner, and also a fresh seat open at the Fed now that he has a chance to put a new person in there, something that we know the administration is very excited about. What we have in futures this morning, bouncing back from Friday's low. Ed Yardeni, we just caught up with, said that market reaction Friday was overdone. We're going to see a lot of seasonal volatility. And Mike Wilson said investors should be buyers of any potential equity pullbacks. Under surveillance this morning, awaiting President Trump's picks.
We'll be announcing a new statistician sometime over the next 3 or 4 days. We had no confidence. I mean, the numbers were ridiculous, what she announced, but that was just one negative number. All of the numbers seem to be great. We'll see what happens. But we just found out that I have a open spot on the Federal Reserve Board. I'm very happy about that.
Here's the latest. President Donald Trump sharing plans to name new appointees to both the Federal Reserve and the Bureau of Labor Statistics following the resignation of Fed Governor Adriana Kugler and the firing of BLS Commissioner. Joining us now, Bloomberg's Mike Shepard. Mike, what's the reaction in Washington from the flurry of news we got Friday?
Well, in a word, Anne-Marie, you could size it up as dismay. Even from some Republican lawmakers, we heard from Republican Senators Cynthia Loomis and Tom Tillis that they were concerned by this. And Cynthia Loomis even went so far as to say, look, if the president doesn't like the numbers he's getting on jobs, it's not the statistician's fault. And it comes, Anne-Marie, at this time as we are seeing, or at least beginning to see signs that the president's tariff policies are beginning to have an effect on the economy. We're seeing flickers of inflation in key consumer categories, and then we had the Friday jobs report and the revisions that moved the president to the point that he ousted the head of the BLS, Erica McIntyre, who was appointed by President Joe Biden, but was widely hailed as somebody who was nonpartisan and was committed to the data. And her predecessor, William Beach, who was appointed by Donald Trump during the president's first term, even stepped forward to defend her over the weekend. He said that the move risked undermining BLS and the credibility of the agency and the work it does. And he also said there was no grounds for it. At the same time, though, he said that there were a lot of committed and dedicated civil servants at BLS who will continue to do their jobs and do so free of political influence. So it will be interesting to see how whoever the president decides to put into this job will interact with that part of the bureaucracy, and whether those people who are producing the data and the numbers will bend to the new head of the BLS as well.
Mike, thanks so much for that. Bloomberg's Mike Shepard out of Washington. Can you continue the conversation? Joining us now is Terry Haynes of Pangea Policy. Terry, you're right. Over the weekend, Trump now accelerates reshaping the Fed like he did the Supreme Court. But when it comes to this Kugler seat, does he go for the person he wants to be the new Fed chair, or does he just put someone in there that he was planning to for that extra seat he likely would have at the Fed?
Good morning, Adrienne, Danny. The bottom line, I think, is that Trump sees the opportunity to reshape the Fed now in a way that he didn't before. He's now got the Kugler seat in his pocket, which he didn't. He'll make a decision on that, but he's also got the Powell seat coming up in summer, and he's even got a potential vice chair coming up before the end of his term. So I think he's going to try to figure out ways to push the narrative and reshape things in the way that the Supreme Court got reshaped by a few different picks. Now, whether he uses the Kugler pick to put the shadow chair in or not, I think depends on a couple of things. One, two different Trump instincts, both of which we've seen demonstrated. One is making the biggest splash and the biggest push possible. The other instinct is, you know what, I'm going to make a smaller splash, cement my initial counterweight here, and let the battle go on among potential chair candidates for a little while longer.
Can we play out the former scenario, Terry? If we get an appointee who is very obviously political, what is the strength of the institution of the Federal Reserve to try to fight back against that? And to what degree might it see some bends?
Well, I think there's two sets here. One is kind of Venn diagram style sets. One is kind of the political and malleable, and the other set is candidates that are best for markets and best for Fed independence. I think you get a confluence of those sets to some extent, but that's going to take a lot of input both from Congress and I think crucially markets who are going to say, look, what we need here is we need somebody with a lot of gravitas and a lot of ability to frankly burnish the Fed's credentials, burnish the Fed's independence and ability to keep making these decisions. So that's one reason I think why it may take a while. It's easier to put the political loyalist in if you're in the Kugler seat, very much as Kugler was, I think, with Biden, if you're going for kind of a lesser normal governor type.
Unless, Terry, we get a recess from Congress that allows Trump to make a quicker appointment to the Federal Reserve because of those recess nominations. Do you think that could happen?
I think that's possible. I think Congress, the Senate particularly, would counsel very strongly against that. The Senate, think about the broader context here. The Senate is in a situation now where it's trying to push through as many Trump appointees as possible, getting a lot of pushback from Democrats who, long ago decided that they're going to have to deny Trump as many nominees as possible, and maybe even go shut the government down or push back on spending this fall and winter. In the middle of all that, I think the last thing Trump should want to do is play into that, and he'll certainly be counseled by Senate leadership that way.
Terry, who's in pole position right now that you would bet the president to appoint in the Fed seat?
I think that if I'm not going to take any public position or private position for that matter. Seriously,
Well, just name a few names.
I will. I want to be clear about that. I'm not expressing a personal preference, but I think that the Trump battering the Fed, Trump doing what he did at the BLS, have a number of fallouts. One bit of that fallout is that since the BLS matter and him battering Powell undermine his own credibility on the economy to some extent, it has to be corrected by candidates that have more gravitas. So what I took from the weekend was that candidates like Kevin Warsh and David Malpass, I think, gain a little bit in that. And I think somebody who lost a little bit over the weekend was Kevin Hassett, and that's out of his control. But, he had to go on television on Sunday and defend the BLS business. And that only reminds people that right now he's a Trump staffer, and that may not be the look that the Senate wants to put in the Fed position.
How challenging is the Senate confirmation going to be for the Fed?
Well, the conventional wisdom will be, well, the Senate's a rubber stamp. They'll do whatever Trump wants. I think that's not true. I think the Senate is there's a lot goes on behind the scenes. People have gotten used to trading public barbs and having public strategies go on, and people forget that there's an awful lot that happens privately. The private counsel will be. Look, we need to get somebody who is in the Fed position who Republicans are united on, because Democrats certainly, by and large, are not going to vote for that person, number one. Number two, it's going to have to be somebody that enhances Fed stature. And anybody that thinks the Senate's a rubber stamp, any Senate, has only to go back to Sarah Bloom Raskin a few years ago to remember that Democratic Senate stopped a Biden vice chair nominee cold.
Terry, thanks so much for that. Terry Haynes of Pangea Policy. Danny, the point Terry really makes, though, is that the Kugler seat is now so much more important. It's not just a regular seat anymore.
Does it become something of a shadow Fed chair that we get in? Does it also mean that Powell stays on or resigns early? Just how many appointments will Trump be getting over the next of his presidency? Just how much is he going to be able to remake the composition of the FOMC?
Yeah, it's going to be one we're going to be watching very closely, especially as the president said we might get a potential nominee name this week. Coming up on the program, Sonia Martin of DZ Bank with President Trump's new tariffs set to take effect on Thursday. Plus, Yahaira will be back with us for your morning movers. Tesla gaining this morning as a new incentive for Elon Musk. You're watching Bloomberg Surveillance.
you've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more. Right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Good morning. Welcome to Bloomberg Surveillance. Almost 6:30 here in New York City. John and Lisa are off today. I'm Anne-Marie Verdern alongside Danny Berger. What we see in markets this morning, futures rebounding after Friday's low. Of course, that low was induced by the weaker than expected labor report and the massive downward revisions. Of course, fresh uncertainty given the fact that the president then fired the head of the Bureau of Labor Statistics. He said we will get a new nominee name this week. Also, some uncertainty, potentially the opening up a seat at the FOMC with the early resignation of Fed Governor Adriana Kugler. We are now 3 hours away from the cash open. Let's get your morning movers. But Yahira, hey Yahira, good morning.
Hi, Anne-Marie. We start with some possible M&A news capitalizing on the need for data centers. Take a look at CommScope Holdings. Shares are soaring up 41%. On the Wall Street Journal reporting that Amphenol is nearing a deal to buy its broadband and cable unit for around $10.5 billion, including debt. The move underscores booming demand for data centers, which rely heavily on fiber optic cables, key parts of this CommScope unit that Amphenol is looking to buy. Meanwhile, take a look at shares of Tesla. You mentioned this one. They are up 2% on some headlines that just crossed. The board has approved a new interim award of 96 million restricted shares to Elon Musk as a way to incentivize the CEO. And the board also saying that retaining Elon Musk is more important than ever before. And it's a clear signal from the board that they want Musk locked in after all those political distractions and at a time when they need him most, with fierce competition over EVs and slowing sales over at Tesla. And the Sydney Sweeney drama continues, but this time the stock is getting a bid. It is up 4% as the company says that it's standing by its campaign featuring the actress, which of course drew criticism by some over what they perceived as racial undertones. But remember, this also was a stock that was caught up in the retail trade frenzy, so there might be a little bit of that going on today. Anne-Marie?
Yahira, thanks so much. You know, the company coming out and says it is and always was about jeans. But the president says he likes the ad now because apparently she's Sydney Sweeney's a registered Republican.
Poor Sydney Sweeney becoming a political figure. I'm sure she and American Eagle want to put this behind it, although they've given it a little bit more life by going in on this. I mean, just leave it alone. Let it dissipate. I'm tired of it. Let's stop talking about it.
Well, the stock is up more than 4% this morning, so they must feel like they've done something right. On our radar this morning, President Trump will announce a new Federal Reserve governor and BLS chief in the coming days. The Fed replacement might be in the running to fill Fed Chair Jay Powell's spot when his term ends in May. This is why it's so interesting. As Terry Haynes was saying, this is not just now a regular governor's seat. Potentially, this could be the shadow Fed chair.
I also wonder if they can convince anybody to come in and join the FOMC unless they are given that promise that you will be the Fed chair at some point. Not to mention Michael McKee writing into us saying it would be impossible to make a recess appointment. So for the Fed, you'd have this really long, drawn-out process. Isn't it advantageous for Trump then to just have the person that he he wants to become the next chair. So does that mean you get a shadow Fed chair coming onto the board? And is it someone who's blatantly political or someone who's just more dovish? All of that will make a really big difference to as what the composition of the Fed will be, and maybe how long Federal Reserve Chair Powell stays on for his governorship, whether he leaves before 2028.
And if he taps someone, like Breitbart's talking about the fact that Neil Dutta, potentially someone they could tap, then you know they're thinking elsewhere for the Fed chair, maybe like a Christopher Waller.
Well, we know Trump has also been concentrating more on the board. On Friday, we were talking about, the Truth Social post saying that the FOMC, the committee, should come together and try to overrule Powell. So maybe he sees this as an opportunity to completely reshape the FOMC. If he gets 2 more people, that means a total of 4 appointees that he will have on the Federal Reserve. It is more of a stranglehold over the Fed and where their policy goes from here.
Regime change, that's what we're looking at. Elsewhere in Washington, U.S. Trade Representative Jameson Greer saying the U.S. and China are, quote, halfway there on a rare earths deal. His comments coming as the trade truce between the two countries is set to expire, Danny, on August 12th.
Halfway there, and it's clear that this is the sticking point. It is clear that this is somewhere that China has such an upper hand. Part of the problem with this, too, and it makes it more difficult for the U.S., if you were to say, okay, maybe this is less of a problem if we can look at supply chains elsewhere. Where else has critical earth minerals? It is places like Brazil, it's places like India, places that just got slapped with very high tariff rates. So this makes the talks all the more contentious, and again, gives China a really big playing card coming into this deadline.
Massive negotiating chip, and it's one of the reasons why potentially you could speculate they put those H20 NVIDIA chips back on the table. The Treasury Secretary told us it was part of the mosaic of the trade talks. Front page this morning of the Wall Street Journal says China is limiting the flow of critical minerals to Western defense manufacturers with these ongoing discussions, and says one drone parts manufacturer is saying that supplies for U.S. military was forced to delay orders by as long as 2 months while it searched for these non-Chinese source of magnets. The problem is, to your point, China has about 90% of this market.
And this is coming at a time when military spending is being upped, not just here in the United States, but in Europe and throughout the world. What happens if China starts to choke the supply of the rare earth minerals that are necessary for doing that?
Speaking of rare earths, let's stay in the commodity space. Oil prices slipping this morning after OPEC agreed to another output boost in September, stoking concerns about a global oversupply as the U.S.-led trade war weighs on economic growth and energy consumption. So it was just a 14-minute meeting, so very short for OPEC standards, and I've had a lot of time with OPEC meetings. Sometimes they go days or weeks. What happens next is going to be interesting.
You are so right, because at the moment, oil's weaker this morning, but only by 1.5%. The things holding it up is that there is still demand. We are still traveling. Everybody got in their car over the summer traveling somewhere. Everyone is still flying, so jet fuel is still in high demand. What happens when that ends? What happens when the summer is over and some of that ebbs? That's just the demand side. What happens on the supply side? Are we going to see stricter restrictions, more tariffs, more sanctions for people who use Russian oil? It is a quickly changing picture, which means that this OPEC meeting, it might be more than 14 minutes in the future.
And that's a great point to bring up, because the president said over the weekend, if Putin does not come to the table for his self-imposed 10-day truce, which is this Friday, there could be sanctions, more sanctions when it comes to Russia. So everyone's squarely focused on what that means for the oil market. Turning to foreign exchange now, the euro recovering from recent pressure as President Trump's 15% tariff on most exports from the EU is set to take effect Thursday. Sonia Martin of DZ Bank writes, the correction in euro dollar has run its course fundamentally. There is still one major risk factor at play: the large overhang of the speculative long positions that could spell trouble in the very short term. Sonia joins us now. Sonia, just explain that. Where do you see euro dollar going if we have this speculative long still baked into the market?
Good morning. Yes, in fact, one of the big problems that we have seen recently is that we have built this massive overhang of speculative long positions. It started around April, so with Liberation Day, that's when it really kicked off. I estimate that the average entry level of these positions is probably around 110, 112. So right now, you could say that they're still quite comfortably in the plus. But obviously, there is a risk that if euro-dollar starts to edge lower again, that these investors will lose confidence. And we're looking right now at about 125,000 contracts. That is a quite significant amount. And what could happen, obviously, is, as I said, if euro-dollar does pull back for whatever reasons, then these investors will start to liquidate at least some of their positions, and that could accelerate the move. And I think the critical question would be, at what levels do fundamental investors who might feel very well, or very rightly, I think, that maybe levels around 114 are good buying opportunities, when will they come in and pick up the slack?
Sonia, we have a 15% tariff rate when it comes to the European Union, but who's to say that's going to last Trump's entire term? Is there potentially concern when it comes to the currency pair that we could even see higher rates or those sectoral tariffs hitting the currency?
Yes. I mean, the market reaction last week to the trade deal announcement was very clear. The euro lost quite a lot of value on Monday in the early part of the week. And this was because of that concern. So obviously we have 15% now. You could argue that that's better than the 30% we fear we might get. But what the market is looking at is the fact that we have now capitulated in front of Trump. So we have given in. I think that's the interpretation. And I think the concern is indeed that in doing so, we've basically provided him with the door. We've opened the door to more tariffs, and that if he feels like it in a few months' time, 6 months' time, who knows, that we might be hit with higher tariffs. And I think that's what the market reaction was all about, not so much about the actual tariff, where 15% obviously isn't great. It's going to dampen somewhat the outlook for Europe, in particular the export-strong nations. But it's not a complete disaster yet. But I think the yet is what people are worried about.
Well, the drivers from the start of the week to the end of the week felt completely different, Sonia, because by Friday, you had a rally in euro dollar with the dollar's worst day since around Liberation Day in early April. How do you understand what the drivers are, and what is a bigger risk? Is it the weakening data that forces the Fed to cut, or is it an undermining of confidence in both the Federal Reserve and the data in the U.S.?
Well, I mean, both risk factors are currently obviously at play. But if you ask me what the bigger risk is, then I would have to say the latter. I mean, weak data is one thing, and the Fed could react by cutting rates. And, a lot of people have been playing the risk of a U.S. slowdown, potential recession. That's not entirely new. But I think longer term, when you look at the dollar and confidence in the dollar, the much bigger risk factor has got to be an undermining of confidence in the Fed. And I mean, you discussed it on the program just before. I mean, Trump now has an opening. He can appoint someone there or try to appoint someone there who might also then act as sort of a shadow Fed chief until Powell leaves, and they might, be put in a position to replace him. That's going to make the Fed's job harder. Definitely it's going to make Jerome Powell's job a lot harder. And I think that in combination, of course, with the firing of the head of the Bureau of Labor Statistics, it all just goes to undermine sentiment vis-a-vis the US dollar.
Sonia, if that hadn't have happened, we would have been debating just the actual weakness of the data itself, not the confidence in it. If we can do that, are the employment trends worrying enough that we're likely to get a cut from the Fed regardless of where inflation comes in the next month's data?
Well, I think the problem with the labor market data is, it obviously has been generally more solid than people feared it would be. And I think now it was a major disappointment. The big thing that we're all waiting for when we look at the US economy is when the big impact of the tariffs will hit the inflation rate and consumption, and therefore also eventually the labor market. I mean, you remember a few months ago, everyone was talking about Trump's session. A lot of these forecasts have been revised since, but there's still a lot happening in the pipelines. I mean, these price increases through the tariffs will have to find their way into the economy, and that can happen in only two ways. Either it ends up being paid by the U.S. consumer, or it ends up being swallowed by the companies. And both outcomes are not good news for the U.S. So that is going to happen. The question is just when. And I think that, we're starting to see some weakness in the data. The U.S. surprise index that Bloomberg publishes has been in negative for a while now. So it's coming, but I think the timing is much more difficult. But it does mean the Fed will have room to cut rates further.
Sonia, thanks so much for that this morning. Sonia Martin of DZ Bank. Let's get you an update on stories we're watching elsewhere with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, Anne-Marie. Boeing workers at its defense plants in St. Louis are striking for the first time in nearly 3 decades. Thousands of machinists walked off the job after union members rejected the company's contract offer that would have raised wages 20% and boosted retirement contributions. Boeing saying it implemented a contingency plan to support its customers. Meanwhile, I mentioned this one earlier, Tesla shares are rising 2.3% after the company announced a massive payout to CEO Elon Musk. Musk awarded 96 million shares of restricted stock worth over $23 billion based on the last closing share price. Tesla's board described the decision as a good faith payment, saying retaining Musk is more important than ever before. And Texas Democratic lawmakers have left the state in an effort to stop Republicans from redrawing congressional maps. That leaves the state legislature short of the minimum number of lawmakers needed for votes. Texas Governor Greg Abbott has reportedly threatened to attempt to remove the lawmakers if they don't return today. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. Up next, September on the table.
The big picture, though, I think, is you can cut the rate. You can get 100 basis points off this interest rate and still be above where inflation is tracking. Would I get that rate down to something and then see where you are? Yes, I think that's a possibility.
Up next, Michael Gapin of Morgan Stanley joins us. Don't want to miss that conversation. You're watching Bloomberg Surveillance.
You missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. Futures this morning clawing back some of the losses we saw last week after the weaker than expected labor data. S&P 500 futures up 0.6%. Markets now really starting to bake in this chance of Federal Reserve interest rate cut happening in September. Before the labor market data was at a 40% chance. Right after it, it shot up to 90%. So that hope, maybe bad news is good news in terms of that. Under surveillance this morning, as I just said, September on the table.
Economy's in pretty good shape, and I think that's really fair. I think there's some impact from inflation and productivity that's going to pull it down with a little bit of an uptick for tariffs. The big picture, though, I think, is you can cut the rate. You can get 100 basis points off this interest rate and still be above where inflation is tracking. Would I get that rate down to something and then see where you are? Yes, I think that's a possibility.
Here's the latest. Rising unemployment and slowing job growth is boosting investor hopes that the Fed will intervene with a rate cut. Michael Gapin of Morgan Stanley writing, Chair Powell emphasized the unemployment rate, but the slower payroll pace keeps downside risks elevated and a September cut on the table. Michael joins us now. A lot of distractions coming out of Washington. I want to talk to you actually about the data. What did you make of those revisions on Friday?
So I think they now reveal a picture of an economy where job growth slowed much more dramatically over the summer. And the fact that it happened in May and June came right on the heels of the Liberation Day tariff announcements. And we heard from the corporate sector that, wow, this is a big change. We don't quite know what to do. It's making planning hard. So I think seeing employment growth slowing down rapidly kind of fits that narrative. So I think it paints a picture where labor demand came off pretty quickly. And what's key then is about at least some resolution to that story. Where's trade policy uncertainty going forward? We thought recession risk was elevated going in anyway. We've all been talking about if you want to reshape global trade, you're going to have to risk downside. So I'm not sure that this report materially changed our view on that right now. But I think it's clear that the economy is adjusting to a period of higher tariffs. Either the consumer will eat it or corporates will. And if the latter does, look for a much weaker labor market.
With certainty, though, on a number of trading partners now, and base case 10%, most countries 15%, can companies go out and now hire?
I think they have to be selective. I think the clarity we've gotten, at least what market participants will tell you and corporates will say is, well, we think kind of the maximum tariff, the ceiling is lower. Okay, fine, the ceiling might be lower, but I think where this lands is still uncertain. So I think the difficulty in planning remains, and I think firms in general, outside of maybe AI investment, are cautious in what they're doing. So I still think it's right to believe things are getting delayed, capital spending plans and hiring decisions. So we would expect kind of continued modest rates of employment growth into year end, something around what we saw in the July report itself. 50, 75,000 jobs a month is probably where we are for the time being.
Well, even before Trump came out and fired the BLS head, there was a real shock to how large the revisions were.
Yes.
And Michael, there very well could be a conversation that we should be having about how you treat monthly data, given just the difficulties in making accurate, real-time economic data that comes in. When you look at one-off reports, and we can put to the side of who the BLS chief is at the moment,
Sure.
Do you need to be looking at aggregate data? Can you really make decisions on 1 month of data? And what does that mean for the Fed as they try to decide what to do in September?
Well, the typical economist response to this is, yes, you do want to look at 3-month moving averages or something even longer, because with COVID and the massive shocks that we've seen to the economy, the flows are different. The behavior of hiring and firing is different. So the signal from any 1 month of data has gone down. So you want to smooth through that. Does it still mean you can make accurate policy decisions? Yes. I just think you downplay 1 month of data and look at a longer trend. We did dig into those revisions. You mentioned they're large. They were the largest downward revision since 1979 outside of COVID. So it was about 4 to 5 times the normal move, right? So a massive outlier on that front. In and of itself, that doesn't really change recession probabilities. If you put that into your probability models, the July number matters more than what the revisions say. So we would say, should it really change your view on the labor market? Probably not.
Well, there started to be people, Rick Reeder of BlackRock among them, as well as Steve Englander of Standard Chartered, who say that should the next month come in weak again, should we get revisions again, it could put a 50 basis point cut on the table for the Fed. Do you see any validity to that? Is that a possibility?
Well, so if you think it tells you the labor market has cracked, and either we get, I think you need negative payroll numbers to get a 50 basis point cut in September. So would a 50, and if you got a positive payroll growth in August, but other downward revisions that showed May was negative, well, does that justify a 50? So I think you probably need something like minus 50, minus 100 to get them cutting in September in that magnitude. So it would have to be a signal that the recession's here. The tariff rate's already too high. We just didn't know it. Now we know it. 50 basis point cuts historically are about recessions.
What about a 25 basis point cut? What do you need to see in the next jobs report?
I think you need to see the unemployment rate moving higher, right? So Powell was very clear in the July press conference, a lot of noise in the data, but immigration's having an important effect on the labor market. It means labor supply is falling about in line with labor demand. So, you hearken back to the 1992 Carville line. It's the economy stupid. In this case, the Fed chair is saying there's a lot of data out there, but it's the unemployment rate. That'll tell us whether slack is being created or not. So I would say on balance, if the unemployment rate's moving higher and they think it will keep moving higher, then that's your scenario for getting a 25 basis point rate cut in September. And as Rick Reeder said, maybe getting policy closer to neutral and reevaluating as things go. Otherwise, if the unemployment rate stays at 4.2, but it's inflation that's moving higher, then the Fed can skip September and stay on hold.
A lot of noise surrounding this labor report because after it, the president decided to fire the head of the BLS. Does that undermine market confidence in your view?
I think it fits a pattern where U.S. country risk is rising, right? So you go back to trying to reshape a global trade narrative and tariffs coming much faster, much higher than people thought originally. Concerns about the independence of the Fed and the validity of the data, it all aligns in a way that suggests your country risk premium is higher. That's tended to manifest itself most in the dollar, but doesn't have to stay there, could show up in other places.
If we do get a blatantly political appointment to the BLS, how would you and the team at Morgan Stanley start to approach the data releases from them? Would it change what you do and how you interpret them?
Initially, I would say no, because there is still a career staff there and the processes are in place. So I think it would be, and the concern would be about gradual erosion in the quality of U.S. data. So I would say no, not initially, but it's something we would be watching over time.
Neil Dutta called it the gold standard in terms of the world, how the U.S. collects data and the U.S. jobs report. Could more be done, though? Do you feel like you're not getting enough data to really understand where we are right now in the dynamics of the economy?
Well, I'm an economist, so I'm going to say yes. But I do believe that. If, there's been a narrative recently that, there's been a lot of negativity thrown on federal government workers and what they do for the economy. But the idea of producing high quality, visible data that tell you then how to manage the economy has a lot of value to it. We probably don't put enough resources into understanding where employment and inflation is every month, right? You think of, well, the household survey every month, there's a pool of about 60,000 people that we're sampling. Why only 60? Mm-hmm. Right? Yes, 126,000 or so establishments that we get payroll data from, that's a lot, but why not more? Shouldn't we get a higher quality signal from the data? We're probably underinvesting in it, even though, as you say, U.S. data is the gold standard, and it is what allows us to make better policy.
So it sounds like you want to make the BLS great again. Michael Gafin of Morgan Stanley, thank you so much for joining us this Monday morning. Coming up on the program, Barbara Doran of BD8 Capital, Henrietta Trey's of Veda Partners, and the NYSE President Lynn Martin, Michelle Meyer of MasterCard's Economics Institute. You're watching Bloomberg Surveillance.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view of Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to
continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Right now, the market is becoming more desensitized to tariffs.
We haven't really seen the pushback we thought we might from some of our trading partners, which goes to show just how broken the global trading system was to begin with.
We're not big fans of tariffs.
If you have perpetual negotiations, uncertainty prevails.
We're all holding our breath to wait and see how bad the trade disruptions will be on the real economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning from New York City for audience worldwide. I'm Anne-Marie Hordern alongside Danny Berger. Jonathan and Lisa are off today. Danny, what a difference a weekend makes. We have stock futures rebounding from Friday's low after that weaker than expected labor market data. Another big week ahead. Earnings in full swing. We're going to get more data that potentially is going to really try to help us understand what is going on in this economy. At the same time, what is not on that board, and potentially the most important thing the market cares about right now, is what the president said last night, heading back to Washington, D.C. from the weekend, saying, one, he's going to have the names for a new Fed seat for Adriana Kugler stepping down and resigning, and also a new name for the head of the BLS.
We would be having such a different conversation this morning had it not been for the firing of the BLS chief, had it not been for Adriana Kugler to be stepping down. The problem is that those are conversations that are still worth having. Did the labor market data show that real cracks are appearing, and this is a Fed that is behind or close to being behind on cutting? Are these earnings that are starting to show that consumers might be exhibiting some weakness? Have the tariffs really settled out? These are some big existential questions. Instead, it's a market that necessarily has to be distracted on things like credibility of the data and independence of the Fed.
Yeah, and credibility of not just the data, but also, is it going to be politicized now if the president wants to put a new head of the BLS in there? And we heard from Kevin Hassett over the weekend. He said that they want their own person in there so they could believe the data. Michael Gapin, though, of Morgan Stanley, was basically outlining that this is par for the course what they were hearing from corporate America. There was so much uncertainty about where the tariff rates were going to lie that basically it was paralysis on the hiring and firing front.
There's so much irony in all of this because the numbers were bad partially and in large part because of policy. By the way, the government hiring numbers were really poor. Wasn't that the whole point? Neil Dutta talked about this. Isn't that what the Trump administration was trying to do? And by the way, part of the reason the BLS has been struggling to collect data, yes, its response rate's going down, but it's their lack of funding. So in some ways, the Trump administration very much hoisted by their own petard. How much of a difference will putting a new chief in really make? Does it just turn around and make things worse?
Potentially. We'll have to see. This morning, though, not worse, better when it comes to equity futures. They are up this morning. S&P 500 up 0.5%. Eurodollar at 115. And treasuries, 10-year yield 4.2. We saw yields really take leg lower last week following the weaker than expected labor market data. Coming up this hour, Barbara Duran of BD8 Capital as the S&P 500 looks to snap a 4-day losing streak. Henrietta Trays of Veda Partners on an opening for a new Fed governor, and the NYSE President Lynn Martin on weathering market volatility. We begin this hour with stocks gaining following their worst weekly performance in over 2 months. Barbara Duran of BD8 Capital writing, "It may be time to take a breather and let the market settle down. Worst case fears may need to be incorporated into the market before investors are willing to step back in." Barbara joins us now for more. Some wise words this morning after the Friday and the weekend we just had. So now is at a time that you actually maybe want to step aside until we get September, more data in August, and September deciding what the Fed is going to do?
Yeah, I think so. I mean, there was going to be some catalyst for a pullback here. You had the market at 23 times earnings. You've had a 30% rebound since the April 7th low. And you've got, I think, a little bit of froth showing up in terms of the meme stocks. You look at the IPO for Figma on Thursday, which was up 250%. And something that I haven't seen discussed too much yet, but margin debt is back to where it was at levels pre-2000 and 2007. And of course, we know the bear markets that followed after that. So I think there's some concern right here where we are, but people want to be invested in this market. And so we'll see after Friday. I really thought we could swish around here. It looks like the futures are going to open here, because I think once you've had time to look at these numbers, jobless claims are still supportive. The unemployment rate's been between 4.1 and 4.2% the last 6 months. And and those are leading indicators. And until we see some signs there, you know, the BLS numbers, I mean, the revisions are extreme, but it's not unheard of. I mean, last year in August, 2024, they revised downward by over 800,000 jobs, and that was under the Biden administration. So it's really a function of their rolling methodology. You know, the first month, then a revision, the second month, third month, the final, and because it's all about response rates from the companies that they're surveying. So, you know, it looks like we'll see today. We know what happens.
And it's probably a good thing to get revisions because it means that we've made the data all that more accurate. But Barbara, you lined out some of the concerns. Some other people would take those concerns, as Michael Hartnett of Bank of America does, and say, it's a bubble starting to form. Would you go so far as to say that?
There is some fraud, as I mentioned, in terms of when you see the meme stocks in an IPO up 250% and the margin debt, we could be heading into that territory. But again, this is when you've had such a fast rebound and where valuations are, you do have to be cautious. And this is where you start to take some money off the table in terms of your stocks. I mean, I'm still fully invested. I'm going to remain fully invested. But you do have to have some risk management. That means taking profits in some names.
It's also been confusing to understand the earnings picture because you have tech doing so well. You haven't even you have some of the consumer names too, all the credit card companies saying spending looks robust. But then you have people like P&G who say consumers are more value-oriented. They're a little bit more cautious. PayPal saying tariff-sensitive areas are more cautious too. How have you interpreted what corporate America has told us so far?
Well, Danny, I think you're absolutely right. There is a bifurcation going on. The AI play is alive and well, and you saw that last week, with the Meta dramatic increase in earnings and the response of the stock, and Microsoft as well. And as you just mentioned, the credit card companies, the travel companies, even Booking.com, they're all seeing not only just current consumer strength, but they're looking ahead and saying, we see it looks fine. And so there's been very little cracks in the consumer spending. And the lower income, yes, they're feeling the pressure. And that's where I think the P&Gs of the world, you know, they are passing along the pricing. And we will see, I think, more of that. Companies, as you said earlier, you know, Anne-Marie, are on hold, waiting to see how all of this settles out. So pricing has not really kicked in. Companies are like, we don't know what our costs are going to be. Although Ford last week said could be $2 billion, and GM similar. So I think it really is, we're still playing out the tariff impact, and we're going to start to see that over the next month or two.
Well, this week, on Thursday, that's when the new date is set for these new tariff rates to take effect. In that sense, could we put this story behind us, and the second half of the year, potentially we're going to get more clarity from corporate America?
Well, I think it's an interesting question, because it looked like coming into this Friday news, the markets had been assuming tariffs are pretty stable. And they're still, in a way, they are. Instead of being sort of 14, 15% average that people are assuming, it's now up to 17, 18%. So that will cost companies, that will cost the consumer. And that, again, when those rates kick in, it'll be another month or two before you see it. But from the previous tariffs, we are going to start to see it. And we've got CPI and PPI numbers, 2 sets coming out before the Fed meets again in September. So we'll see, because that's obviously right now what's going on. The Fed, does this really change their view? Labor looks like it's softening. You're not seeing it in the leading indicators, as I mentioned earlier, jobless claims, et cetera. So, and they're still having to keep a close eye, this balance of jobs versus inflation.
After April 2nd, the market reaction was one that pushed Trump to back off on the worst of his intentions. We've seen him not back off this time around, and it is a market that is selling off, but it's resulted in a Trump blame game of Powell. Are there any more checks left when it comes to market reaction on the president, or does it just result on things like firing the BLS chief and remaking the Fed?
Yeah, it's a good question, because the market has, you know, assumed that it is a lot of bark and not bite. And so that's what you've seen, the market making new highs. And even today, looks like the market is going to have a good day, you know, assuming that, okay, the tariffs are out of the way, the jobs, you know, numbers are not great, but we also understand that we haven't seen the canary in the coal mine, which would be jobless claims, et cetera. So no, I don't think there's a good check in the market here until you start to see it. Earnings right now are coming in. They were, when we went into this quarter, as we know, the last quarter, first quarter, was 13.5+%. And because of April and the tariffs, some companies withdrew guidance, but a lot cut their numbers. So we came into this quarter at a 4.9% overall estimate for S&P 500 numbers. Right now, 2/3 of companies have reported. 80 to 83% are beating those numbers, and right now the blended rate is 10.3%. So it's double what was anticipated coming in. So right now, as long as earnings are holding up, so it's going to take another quarter. We're going to have to wait till the next quarter earnings to see what the bite is. And I think we have a pretty good guess, though, the companies that will be hurt, and you're seeing it already in the durable goods numbers. Inflation is creeping up there. And that's what we got to see. What is more dangerous? You know, the jobs are slowing down, and what we've seen is not mass layoffs. It's been a slow easing of the labor market. And of course, immigration, we don't know the impact there. That's still going on. And then construction and ag being the most affected there. So I just think, you know, the Fed, I think, has been correct to wait and see, you know, how the balance, you know, shifts. And again, we're just going to have to wait for more numbers.
Even though it's been this slow churn of a little bit of weakness in the labor market, it was still a bond market that was caught by utter surprise when you had a drop of 27 basis points on the front end, the most in more than 2 years. Did that incident show us that bonds can act as a hedge, or was it just a mismatch in positioning?
I mean, you're right about the bonds can show us the way. And certainly that was, you know, a month or two ago when the long bond was shooting up. And people were like, oh, my God, the bond vigilantes are back, and that's going to check things. And that can happen, you know, and that will happen, you know, if things do get too extreme one way or the other. Right now, you know, the bond market was reacting, I think, in normal fashion to the news on Friday. So right now, I don't think it's going to, you know, rein anybody in.
Or more of a hedge just in a portfolio.
Yeah, oh, definitely in a portfolio. Yeah, because you've still got high rates there. And so enough to counter sort of even some of the dividend-paying stocks that it's attractive to still be invested in fixed income.
The bond market was reacting to the data. Is anything in the market right now reacting to the policy implications, the fact that the president didn't like the jobs number and decided he wants to fire the head of the BLS?
Yeah, I mean, I think that's a longer-term impact question, because I think for me, it's in conjunction with the attack on Powell and the independence, by definition, of the Fed. and also the BLS blaming the head of that for, and in my view, politicizing that, by accusing the head of that of manipulating the numbers, which, every credible person out there coming out over the weekend is saying, no, they're not manipulated. You may want to broaden it, as your guest just before this said, in terms of maybe more than 121,000 companies and maybe some way to speed up the collection so we don't have these revisions. But basically, I think that, this calls into question by foreign investors and others about the credibility of the U.S., whether, and we saw this fright a few months ago, the dollar and people, are they leaving in U.S. exceptionalism? I don't think so. All the evidence has been they're still buying bonds and they're still, buying the dollar. But on the margin, people are trying to move away. And I don't think this is helpful to attack the credibility of the Fed, and the BLS.
Barbara, thank you so much for your time this morning. Barbara Duran of BD8 Capital Partners. Danny, it's what Michael Gabin was saying. This all just means more of a risk premium to the U.S. when you're investing.
And it comes at a dangerous time because our deficits are ballooning. If you get that undermining of both the Fed governor and the FOMC and at the same time the BLS, what does that mean for trying to fund? What does that mean for the long end? Can you really get the rally? To Barbara's point, there's already been a question of how many foreigners are willing to come into the U.S. Does that just further undermine it?
All right, let's get you an update on stories elsewhere watching this morning. Your Bloomberg Brief with Yahira. Hey, Yahira.
Hi, Anne-Marie. President Trump is set to announce a new Federal Reserve governor and Bureau of Labor Statistics head in the coming days. He told reporters he has a couple of people in mind to replace Fed Governor Adriana Kugler. His pick might be in the running to fill Fed Chair Jay Powell's spot when his term ends in May. Meanwhile, BMW is hitting back at Tesla with longer-range EVs. The German car maker is rolling out 40 new or updated models with high-performance computers and new design cues under a new lineup called New Class. CEO Oliver Zipse says the company's lineup will show that BMW can build superior electric cars, and the rest of the market will have to answer. And Indian Prime Minister Modi struck a defiant tone after President Trump imposed a 25% tariff on the country, urging the nation to buy local goods. Modi also insisting the country would continue to buy Russian oil, with the government describing the India-Russia relationship as steady and time-tested. The White House has threatened more action if India continues to purchase that oil. That's your Bloomberg Brief. Anne-Marie?
Yahara, thank you so much. Up next, getting a fresh set of eyes on the data.
Does the administration have any evidence that it was rigged, as the president said?
There have been a bunch of patterns that could make people wonder, and I think the most important thing for people to know is that it's the president's highest priority that the data be trusted.
And Kevin Hassett says that's why they want their own person at the BLS. Henrietta Trey's of Veda Partners joins us next. Her input on this story. You're watching Bloomberg Surveillance.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Good morning. Welcome to Bloomberg Surveillance. I'm Amber Hordern alongside Danny Berger. Futures this morning rebounding after Friday's swift sell-off following the weaker-than-expected labor market report. On top of that, the massive downward revisions, but the market now baking in potentially 2 Fed rate cuts. So maybe bad news is good news before year end. Under surveillance morning, getting a fresh eyes on the data.
Does the administration have any evidence that it was rigged, as the president said?
There have been a bunch of patterns that could make people wonder, and I think the most important thing for people to know is that it's the president's highest priority that the data be trusted and that people get to the bottom of why these revisions are so unreliable. What we need is a fresh set of eyes over the BLS. The president wants his own people there so that when we see the numbers, they're more transparent and more reliable.
Here's the latest. President Donald Trump is set to fill new vacancies on both the Federal Reserve and the Bureau of Labor Statistics following the resignation of the Fed Governor, Adriana Kugler, and also the firing of the BLS Commissioner. Joining us now is Bloomberg's Mike Shepard from Washington, D.C. Mike, I want to pick up that line from Kevin Hassett. The president wants his own people there so that we see the numbers. They're more transparent and more reliable. Is now the BLS Commissioner going to be a political job?
Well, Donald Trump is certainly trying to shape it that way, in much the way that he has also tried to shape and influence selections, for example, at the Justice Department, and as well as his upcoming pick for the new Federal Reserve vacancy, the one created by Adriana Kugler's departure there. Now, Anne-Marie, what this does is it sets up a challenge to the political independence of an agency that had long been viewed as outside the political fray. The Bureau of Labor Statistics had never been seen as an entity or an institution with government that was subject to sort of the usual political give and take. It was a bipartisan vote, 86-9, that approved Erica McIntyre for the job during the Biden administration. And current Vice President J.D. Vance, then a U.S. Senator, even voted in favor of her. Yet we are seeing Kevin Hassett raising questions about the credibility of the work of BLS under McIntyre and insisting that the president wants to put his own team in there. Hassett also insisted, though, that the president is not going to look across the data generated by the government and simply fire anyone who crosses his view of what the economy is at the moment. We're going to get a test of that, though. Later this month, we're going to see the personal consumption expenditure index from the Commerce Department. So what will happen there at the Bureau of Economic Analysis? If the numbers come in hot, if we see a higher level when it comes to inflation, this is a gauge that the Fed watches very closely to determine whether to cut interest rates. Does the president try to look for making changes there as well? So it does raise questions about the credibility and independence, as Barbara Duran just raised and mentioned in the previous segment, talking about how these institutions have previously been seen as independent from any sort of political interference. And that sort of independence is something that Wall Street has valued. It's come to look to these numbers as independent, as reached on a survey basis. Yes, there may be some ways to improve it, but it doesn't fall into the category of something that needs to be addressed as a political problem, Anne-Marie.
And Neil Dutta calling it the gold standard. Bloomberg's Mike Shepard, thank you so much for joining us. Let's continue the conversation now. Henrietta Trays of Veda Partners. Henrietta, what do you think? Do you think the firing of the BLS commissioner and the president saying he's going to name someone new this week undermines the credibility of the data?
Well, I think what's happened here is that the president has lost sight of the fact that the BLS is on his side. They're here to help. They are effectively his eyes and ears when he makes policy decisions. So if, for example, you want to raise the domestic tariff rate from 2% to 18%, then the BLS is here to tell you that disrupting trans-Pacific trade and creating so much uncertainty that businesses don't know how to operate, there will in fact only be $35,000 jobs created over 3 consecutive months. You will shed 116,000 manufacturing jobs as you tax inputs. So the BLS is informing him in real time about what happens when you institute your policies. And the president has a couple options. You can either course correct, adjust your priors. You can say these casualties are worth the price of the trade war, or I guess apparently option C, which is fire the commissioner. And so that's where we are right now. And it's not a good look for the administration and not something that the economists universe or Wall Street is going to take sitting down as we're seeing right now.
It's not a good look for the administration, Henrietta, but how impactful is it when it comes to the Bureau of Labor Statistics? How strong is the institution itself from any political sway if we do get an outright political appointee to head it?
You know, I've gotten this question a lot from investors over the weekend. The continuity that we're going to have is probably going to be with us for at least the next 3 months based on my calculations of the calendar. So right now, as you know, the Senate has gone into recess. They are not technically on the kind of recess, though, that allows for the president to just appoint somebody either at the Fed or to replace the BLS commissioner. So what we're going to have instead is the acting commissioner who's already held that role twice before over the last decade. And so investors should have some confidence in a continuity of the data through, I would imagine, at least October. We're going to spend September working through continued nominations, but probably also deal with government funding fights and things along those lines. And probably the Fed chair is going to be, the Fed nomination is going to be pulled forward ahead of BLS. So I would say BLS data and a new commissioner is probably a late October, November time horizon. And that's the stability that investors can count on for the time being.
What happens after that, though, Henrietta?
Yeah, after that, then we are in to see who he's going to nominate. And at that point, what is the administration trusting the numbers on? I mean, the staff, the 2,000 folks working at BLS have been there for a very long time. They are very diligent. It's going to be really difficult to manipulate the data. And I think, 141 years or whatever in existence is going to hopefully maintain them as the gold standard. But it's tricky from here.
Henrietta, let's talk about the open seat now that the president has to fill at the Fed. How are you viewing who he potentially is going to put in that chair?
I agree with conventional wisdom. One of the Kevins or Secretary Bessent. I mean, I think Secretary Bessent is very intimately involved in the trade negotiations at this point, and things with China, I think, especially require an expanded cabinet, and disruption will only increase the perception amongst our trade partners that they don't know who the chief negotiator is. At this point, we have Secretary Lutnick, Secretary Bessent, USTR Greer, and also Marco Rubio in a lot of those instances, and specifically with China. So I think continuity there for the trade negotiations probably prohibits him from putting Secretary Bessent in. But that's my best guess. And this is, of course, the parlor game and all the lunchrooms around Wall Street right now.
So your best guess is that it's not going to be Bessent, but what about the other names? Do you think the president is viewing this as someone he wants to be chair? So basically setting up the Kugler seat earlier now as a shadow Fed chair, or is it going to be potentially a regular normal appointee as a governor?
I think shadow Fed chair is going to be the immediate perception, and the expectation is that that seniority is going to elevate them when the time comes and Powell leaves. But I want to be mindful that the administration and the president in particular really likes the parlor game of who will and who won't be in a position of seniority and who he'd rather, sort of put the thumb on the scales for to be Fed chair. So I imagine it will look a lot like this is the next candidate to be chair in his desires, but there'll probably still be speculation as we go into May about who might supersede that person, especially if there are unsatisfactory conclusions drawn by whoever he nominates in the near term.
Henrietta, thanks so much for your time this morning. Henrietta Trey's of Veda Partners. And Danny, this gets more complicated, of course, because they don't know yet if Powell is stepping down from his seat. Yes, his chairmanship at the Fed will be over, but he doesn't lose his seat until 2028.
Right. Well, if they put someone who's conventional, does that mean Powell feels he can step back? And does that mean Trump gets another appointee and the FOMC is remade in his image?
Coming up in the program, NYSE President Lynn Martin as IPO activity ramps up on Wall Street. Plus, Yahaira will be back with us with your morning movers as Wayfair sees its best quarter since the pandemic. That stock up more than 10% this morning. This is Bloomberg Surveillance.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning, 7:30 here in New York City. I'm Anne-Marie Hordern. Futures this morning bouncing back after Friday's low and sell-off. Given the weaker expected labor market data and really those downward revisions, now what you see an annualized monthly jobs report basically at 35,000 just per a month. Lots of concerns, but this means that traders are now pricing in about 90% chance that the Fed will cut rates in September, and that is what is fueling this market this morning. We do have a number of individuals like Yed Yardeni joining us earlier saying the market reaction on Friday was overdone, lots of seasonal volatility. Of course, there's one more jobs report before the Fed meets in September. We are 2 hours away from the cash open. Let's get you an update on your morning movers as well with Yahira. Hey, Yahira.
Hi, Anne-Marie. We start with Wayfair. The company just reported results and shares are absolutely soaring up 11%. This is because the online furniture company completely blew past analyst estimates, posting its best quarter since the pandemic when everyone and their mom was buying furniture. Revenue in the second quarter handily beat, reaching nearly $3.3 billion, and earnings were more than double what analysts were expecting. Meanwhile, we have some more potential M&A news, this time in air travel. We are seeing shares of Blade up 16% on our reporting that Joby Aviation is exploring a deal to buy the helicopter ride company, which, as we know, flies New Yorkers to JFK and the Hamptons. And the reason Joby is interested is this is a company developing electric air taxis, and a built-in market would be ideal as it looks to start commercial flights next year. And we're taking a look at Spotify shares. They are also rising up 4% after announcing it's raising prices for premium subscriptions in several markets around the world. But good news for us here in the U.S., this does not affect us. But this pop in shares comes after the stock had its worst one-day drop in 2 years last week when it reported a surprise loss due to rising employee costs. So investors obviously cheering this move since it could mean it could help margins moving forward. Anne-Marie?
Thanks so much, Yahira. Danny, I'm stuck on Blade. Do you blade or do you drive to the Hamptons?
I drive, or I take a bus, or I take the Long Island Railroad. I'm all about public transportation, Anne-Marie.
Okay. All right.
Don't take Blade.
Good to know. On our radar this morning, President Trump set to name 2 new appointees, one to the Federal Reserve and the Bureau of Labor Statistics. Fed Governor Adriana Kugler resigning from her role last week. And then, of course, on Friday, Trump fired the BLS commissioner after the week payrolls print.
It is very much so a circumstance of Trump firing the messenger. That is what we got. As Neil Dutta says, it's not just about the data and the message behind it. He needs actual data to move in his favor. It can't just be vibes, but as is often the case, Trump did identify a real problem. Now, the cause of which he said is wrong and that it was manipulated, but it is a real problem with the data we've been getting. Response rates have been falling. Funding for these government institutions have also been falling. So ironically, the solution isn't to dismantle it and put someone new in. It's to give them more money. It's to allow them to work harder and put in the resources that would allow the data to get better.
To have better data collection. Also, the other irony of this is that weak report means that potentially he's going to get what he has been truthing about every single day for the past few months, which is a rate cut, potentially as soon as September.
It's what he wanted. And by the way, they wanted jobs to fall because they wanted to slim down the federal government. That's literally what we saw in the data. So on both those two fronts, it's something that you'd think Trump should welcome. But again, instead, firing the messenger.
Also happening in Washington, officials in Canada are optimistic a new trade deal could be reached with the United States after President Trump hiked Canada's tariffs rate to 35%. One official saying Prime Minister Mark Carney and Trump are expected to talk in the coming days.
I go back, though, to what USTR's Jamieson Greer said to us on Friday, saying that some countries are trying to manifest a deal last minute, but saying ultimately we have to do what's right for America. It's a split screen between what we're hearing from some of the American trading partners and the Americans negotiating this themselves. Will Trump actually reach an agreement with Carney? One thing we have seen work, though, are the two leaders coming together and meeting. It's very similar with what we got in Mexico. It took Trump sitting down with the Mexican president. Could that work this time? Although it has been a Mark Carney who was literally elected saying he'd take a tough line with Trump.
What's also interesting when it comes to Canada is the fine print. If you are a company that has USMCA compliant products, guess what? You don't have that 35% tariff. And guess what? That's about 90% of the products coming into the United States.
So maybe Carney can take a harder line. Still, there are parts of their economy that would feel the pain of that 35%. So you see this rushing of Canada and many other countries at this point, let's be very clear, to try to get something done before the deadline.
Also happening, workers at Boeing's defense division are striking for the first time in nearly 3 decades after union members rejected the company's latest contract offer. More than 3,000 employees walked off the job after voting down a deal that would have raised wages by 20%. And Danny, you see Boeing is a little bit softer this morning in the pre-market.
Look, it's not a great look for Kelly Ortberg because it recalls to times past, specifically last fall when they had a strike. But just to be clear, this one is way smaller in magnitude. It's something like 2,300 workers that are going to be walking off. Last time around, it was 33,000. So that had a really huge impact. And we even heard from Kelly Ortberg on Boeing's call, getting ready for this, saying, listen, we can get through this. It's different this time. It's not going to halt things, for example, like their 737 MAX production, which it did last time. So it seems a company that has more of an upper hand in negotiations.
All right, we want to turn back to the markets now. IPOs are making a comeback this summer with the latest Figma share surging more than 250% in its debut last week. So excited for this conversation. Joining us now is NYSE President Lynn Martin. Lynn, good morning. Thanks for joining us.
Thanks for having me.
So you told John, Lisa, and myself in May that you saw, quote, unprecedented levels of volume following the April 2nd Liberation Day. Yeah. But for the IPO landscape, you were optimistic, but the timeline was shifted out. Where are we now in that timeline and that pipeline?
Well, I think as a result of the successful deals we've been able to bring to market, really starting in that end of May timeframe, but most manifestly over the last 2 weeks when we had 7 IPOs, I think it's fair to say that the markets are open for IPOs.
Are markets open for all IPOs, though? Do we still need to be selective among those that are being brought in? And they need to be tech companies, for example, or can we start to see some of the smaller mid-caps come back, too?
Yeah, we've seen a variety of sizes and companies across different sectors come to market in the last few months. Tech, in particular, has, as you point out, had a great reception in the market. You know, in the last 2 weeks, we saw Nielsen IQ, we saw McGraw-Hill, we saw Figma, as you just had the screen up, and then a couple months ago we saw Circle come to market, also Hinge Health and Mountain. So some really tech-led companies, but mostly pretty much all sectors the market's ready for.
It is a bit of a split screen, though, Lynn, because you start to have some IPOs coming back.
Yep.
And at the same time, you have these private equity players coming up with liquidity solutions that just allows companies to be private for longer, be it secondary funds, be it perpetual capital. And their argument is companies just don't want to be public, and we're giving the option not to be. Longer term, does that hinder IPOs?
Well, I think what it means is that the companies that come to market are better companies. You look at the companies that have come to market, it's not the first time that they've been in the news about an IPO. Look at Circle, for example. They were talking about going public back in 2021. When they came to market, though, they're a better company. They have a more refined strategy, a more refined P&L, a story for the investors that generates a tremendous amount of excitement. And I think what you're seeing with the reception of the companies that have come to market is that pent-up demand in the public markets, that pent-up excitement in the public markets for new issues to come to market. It's something that I talk with long-only investors, something I talk with retail about, how they really want to see these new names, these growth companies come to market to add to their portfolio.
That pent-up demand, was it being held back because of regulation in Washington?
It was really being held back because of volatility and uncertainty in markets. There have been a variety of events that have occurred over the last three and a half years, wars, geopolitical uncertainty that have fueled that volatility. Now that there is more certainty around the geopolitical landscape, more certainty around the market and the trajectory of the market. That's why you're seeing these companies finally come to market.
How is the change in regulatory leadership, though? The SEC regulates the NYSE. How has that potentially changed your business going forward?
We're very optimistic. We had a great relationship with the past administration and the past SEC, but we're very excited about...
Paul Atkins, though, is very different than Gary Gensler.
He is, and we've had a long relationship with Paul Atkins. This isn't Paul Atkins' first time in the SEC, and we had a very productive working relationship with him. We've already had a very productive working relationship in the short time that he's been chair, and a lot of the modifications that he's looking to make, I think, are going to benefit the public markets.
So we have a moment where public market volatility has started to ebb, but even so, you have the rebirth of meme stocks. And you have these weird things happening where you have Open Door, for example, on one day can account for 10% of all equity trading volume. What do you make of just the health of these markets at this moment as some of that starts to bubble up?
I think the markets are incredibly healthy. I mean, our markets are the envy of the world, the breadth, the depth, the liquidity, the trade certainty. Any one day, though, there could be excitement about a different name. I think what you're seeing is a lot of the pent-up demand looking for the new issues and new things to trade.
It's very different, though, than 2021, where those retail investors had all the money to go. So when you look at that, you're like, okay, this is just a temporary phenomenon, or do we just need to get used to single names, getting this wind sweep of various excitement built up online, and that's just the new normal we live in?
I really can't speak to what's driving a stock on any given day. Certainly, the social media and the conversation around stocks overall, I think, is actually a good thing. It means that people aren't interested in investing. They're interested in adding to their portfolio. They're also interested in diversifying their portfolio.
Speaking of diversification, on Thursday, AT&T says they're going to have this dual listing in the NYSE in Texas. What's the business like in Texas?
Yeah, well, we're very supportive of all of the changes that Governor Abbott has rolled out in the state of Texas to really foster that pro-growth environment. Since we announced NYSE Texas and launched the exchange, which was the end of March this year, we've added 20 new listings to the exchange. So we're very optimistic and grateful for Governor Abbott for really leading the way on pro-business atmosphere.
Do you see more money leaving New York, though?
I don't really, I don't know. I don't think so. I think New York's always going to be an important epicenter for markets. But I think it's interesting, the pro-business moves, and then ultimately what the pro-business moves in Texas will lead to on the federal level, more than anything.
Lynn, thanks so much for your time this
morning. Thanks for having me.
Great insight. NYSE President Lynn Martin. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief at Yahira. Hey, Yahira.
Hi, Anne-Marie. Brazilian President Lula da Silva said that he's open to trade talks with President Trump on one condition: his country must be treated as an equal to the U.S. Lula said he wants to negotiate on equal terms and will support Brazilian companies telling the U.S., when you're ready to negotiate, our proposals are on the table. Meanwhile, we're reporting that the Adani Group is looking at a tie-up with Chinese EV giant BYD. It would allow the Adani Group to manufacture batteries in India and further a push into clean energy. That's according to people familiar with the matter, as the company denies it's exploring a collaboration. And Delta is trying to calm blowback after the company said it's been testing an AI tool that could help set up to 20% of its domestic fares. The airline faced sharp criticism from consumers and lawmakers on concerns that AI will set personalized ticket prices based on passenger data it collects. Delta said it has not used AI to set personalized prices. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. Up next, the consumer hangs on.
If you look at consumer spending so far in the first 6 months of this year, we're running just below zero. So we're kind of in this really low growth world right now that we've been expecting.
Michelle Meyer of the MasterCard Economics Institute joins us next. You're watching Bloomberg Surveillance.
With the new world reorder, it means that there will be regional clusters of excellence. It will be regional clusters of great companies. And so it's okay to be number two, because you could be number two in every single region and still command that premium. Because today we talk about AI, we talk about data, we talk about processes that's going to be very specific to industries, specific to countries, specific to regional challenges that needs to be built and addressed. And therefore, the good of it is that now it's not just going for that one company and overpaying for that company until the returns goes to zero. It's actually about finding regional champions, which could also be huge category leaders for us as funds as well. And I think it's actually good for the world to have multiple pots of excellence that can be localized to its own needs.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Victor, Idaho, and this is Bloomberg.
Good morning. Welcome to Bloomberg Surveillance. Markets this morning bouncing back from Friday's low after the weaker than expected jobs data and the massive revisions for the prior 2 months. S&P futures are up nearly 0.6%. Mike Wilson of Morgan Stanley this morning putting out a note. Investors should be buyers of potential stock pullbacks. He says we're buyers of dips, and Friday may be the downside for now. And they see Liberation Day, that April 2nd, big tariff chart Liberation Day. The president coming out in the Rose Garden said that was a major and durable low for equities. Under surveillance this morning, the consumer hanging in.
We're just kind of decelerating into a lower run rate of jobs, which of course translates into a lower run rate of GDP, right? If you look at consumer spending so far in the first 6 months of this year, we're running just below zero, right? Real consumer spending, which is obviously correlated to GDP. So we're kind of in this really low growth world right now that we've been expecting.
Here's the latest. U.S. consumer sentiment rising to a 5-month high in July, despite consumer spending showing signs of strain. Michelle Meyer of MasterCard Economics Institute writing, consumers are the heartbeat of the economy and they are resilient. Michelle joins us now. So you say they're resilient. What kind of cracks, Michelle? And good morning. Thanks for joining us. Do you think the economy is seeing right now when it comes to the consumer?
Well, I think it goes back to what we learned over the last few days on Friday with the jobs report, that clearly there has been an uncertainty impacting the economy that has mattered for companies when they think about the labor demand numbers. So the slowdown in job creation within the May and the June report looking distinctly different than we thought it was in real time shows that some of that uncertainty mattered, that there probably was some pausing in terms of the pace of job creation. But importantly, there's very little evidence of firing happening, whether you look at the jobless claims numbers or you look at the JOLT survey. And I think for consumers, what that results in is a labor market that is still supportive, right? An unemployment rate of 4.2%, wage growth that is still running above underlying inflation, even with some of the tariff inflation impulses starting to move in. So consumers are managing this, I think, quite remarkably.
And things like sales and the earnings we've seen look really strong.
Yeah.
But Andrew Lapthorne over at SocGen noted that 2/3 of the companies in the S&P reported declining profit margins. In other words, for now, the companies are eating the higher costs. If they turn around and start to raise costs, will the consumer still be resilient?
Well, I think it's happening, and it's happening slowly, and this is important to keep in mind, which is that I think relative to the initial expectations and the fear of tariffs was that it was going to impact the economy immediately, and all of a sudden consumers wouldn't be able to get items or they wouldn't be able to afford certain goods. And the reality is that it's happening slowly. It's moving into the economy. It's starting more on the supplier side than the companies. And into consumers. And if you look at the last inflation report, it's starting to show in certain categories. A lot of the durable goods, discretionary goods, whether you're looking at appliances or auto tires or even into apparel, it's starting to show up. So I would argue that consumers are already starting to face some of those higher prices. It's happening gradually and it's happening uneven, which means that consumers still have some choices in terms of how to navigate this and move around some of these price shocks.
In terms of the unevenness, it's also interesting to look and see what the hottest parts of this economy are. And it's hard to argue it's anything but tech and AI.
Yes.
But these are the very companies that are firing on a headline level and only hiring at the top echelons where you get the most pay. When you look at that trend, do you see what you're talking about in the unevenness? Does it start to get exacerbated by some of these tech moves?
Well, I think the fact that you're seeing all this investment focused on technology is actually a really positive secular trend that hopefully could help get us through some of this cyclical adjustment that's happening as a result of tariffs. But yes, to your point, what it also does is it creates a lot of wealth in the economy. So if you look at the equity market, we'll see what results today, but the trend has clearly been very positive, notwithstanding Friday. And therefore, that's positive wealth gains, and those positive wealth gains will filter into consumer spending amongst the cohort that can realize those gains, that can invest and can see that wealth creation.
That's the upper echelons of society. Correct. Do you feel like we're going into a K-shaped economy, or are we just already in one?
You know, that's been a conversation that's been on and off for the past several years. And I think the reality is that there's always an unevenness about any business cycle. And I think when you consider the start of this cycle coming out of the pandemic, it was certainly one that was much more driven by lower income consumers than we have seen in recent history because of the amount of stimulus that pumped in, because of the movement in the labor market, red hot labor market, very strong wage growth. And that has shifted over the last 2 years or so, where lower income consumers aren't seeing that same wave of stimulus clearly. And wage growth has slowed a bit more for that population than for others. And the balance sheet is just frankly not going to be as supportive.
We have a viewer writing in, loving to get your thoughts on real PCE turning negative in the first 6 months of 2025. They say it's the first time we've seen that since 2010, excluding, of course, the pandemic.
Well, real PC turning negative, I think we can debate, but certainly there's been a slowdown in measures of real PC if you look at the GDP reports in Q1 and Q2. And that reflects what we were just talking about in terms of higher prices, right? The consumer has already started to see some of those price increases, and what that does, it means that real spending starts to slow. We saw it during the pandemic inflationary burst. The nominal economy was running at extraordinarily high levels, and the real economy was much, much slower because consumers and companies had to absorb those higher prices. So when you have a price shock, today is a lot more muted than it was during the post-pandemic period. But the real economy has to moderate in order to absorb some of those inflation gains.
Michelle, you look at a lot of alternative data sources.
Yeah.
And right now we're in a moment where we're starting to question the official data we're getting, not least of which if we do get an appointment at the BLS, which is blatantly political. If that does happen, would you be prepared to lean in to those alternative data sources? Does it change the inputs that you use to see where we go from here?
Well, I am a big, big advocate of many different data sources. At the MasterCard Economics Institute, we're sitting on one of the most amazing ones, which is understanding the consumer in real time by looking at consumer payments. So, yes, I think it's extremely important to rely on many, many different sources and forms of data. The great thing about, as being an economist here in the U.S., is that we have very long time series of data coming out of the government, which has been an extraordinary support for us in terms of how we think about modeling the economy. But the economy is dynamic, the economy is shifting, and therefore I think you have to be really mindful of using a variety of different data sources. So trying to see, really that pulse of the consumer in particular and how consumers are evolving their spending trends has been a critical impact for us, and I think a real distinguishing factor.
With the president, though, firing the head of the BLS, do you still put credibility in the jobs report going forward?
I think you do. I mean, look, I think there's a huge staff of economists at the BLS that are doing their job.
The commissioner doesn't really even touch the data until the very end.
And they've been doing their job for decades. And I think that's hard to shift overnight. But, they're contending with the fact that the response rate has been declining for surveys across all different types of government data. And that's a challenge. So I think continuing to adapt, continuing to find new methodologies, new innovative ways to gather data will be really important.
Michelle Meyer, thank you so much for your time this morning. Of course, Michelle Meyer of the MasterCard Economics Institute. And Danny, that's what every economist we've heard this morning say. Michael Gapin, just fund it more. Neil Dutta, it's the gold standard, but why don't you just put some more money to it so you have better, accurate jobs reports?
But I also think what Michelle was saying underscores that there are other pieces of data. So if Trump wants to do something that looks a little bit like manipulation of the data, this is a private sector that will step in. We're not going to just completely have made up numbers. I think other people out there are willing to look and find out what the real underlying economy is. So in that way, again, to what Neil Dutta said on Friday when this happened, the Trump administration can't just go off of vibes. It needs a real economy to participate. So you can't just change the data and hope the rest of the market won't notice.
Also, the irony of all this, it needs that jobs data to weaken to get the Fed cut that the president has been pushing Jay Powell for.
Yeah, exactly. This should be a good thing. And by the way, weaken the dollar too, which apparently the Trump administration also wants.
Yes, exactly. All right, one more hour of Bloomberg surveillance coming up for you. Venue Krishna of Barclays, former New York Fed President Bill Dudley with a new opinion piece out this morning, Robert Socken of Citi, and Noel Dixon of State Street. You're watching Bloomberg Surveillance.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
When you look at the labor market data, there's certainly some stuff to be concerned about.
The inflation data are also going to be pretty elevated in the next couple of prints, so it makes it a really tough backdrop for the Fed.
I think the bar for them to cut has actually increased in the last few months.
I do think it's time for the Fed to really be pivoting to why are you waiting, as opposed to the well, we can wait.
The Fed put is still there to come in and sort of save the day, if you will.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City for our audience worldwide, good morning. This is Bloomberg Surveillance. I'm Anne-Marie Hordern alongside Danny Berger. John and Lisa are off today. Supposed to be a sleepy August, but it's anything but. This morning we do have stocks bouncing back after Friday's weaker than expected payrolls report. Danny, those downward revisions at the moment, the market seems to be taking it in stride because it means they're focused on September, and we could potentially get a Fed rate cut in September. Also this week, the president said we will have a new name. He's going to name the name when we have that Kugler, surprise Fed governor, Adriana Kugler, resignation Friday afternoon.
But has all of this just put on full display the vulnerabilities of both this equity and this bond market? That bond market move was stunning on Friday. By the way, all of July we climbed higher by 24 basis points, completely undoing that on day one of August, down 27 basis points. It was a huge move in bonds. We had a huge move in copper earlier in the week. Have we built up a lot of positioning as we trade at very rich valuations that make us vulnerable to it at a time when the data is starting to weaken, Fed independence is being questioned, data credibility is being questioned, question. And oh, by the way, tariffs, those are still starting to bite with more force.
And this week, it's going to be still a huge trade week. On Thursday, those tariff rates come into effect, and some countries are still trying to, I think as Jameson Greer told us on Friday, manifest trade deals before Thursday. But I think most important this Monday, given the fact that the president said he's going to name names, last night we're going to get a new potential name on the Fed. Potentially we're going to get that before the September meeting, and he's going to appoint someone new at the BLS. This is what Kevin Hassett had to say over the weekend. We need a fresh pair of eyes over the BLS. The president wants his own people there so that we see the numbers. They're more transparent and more reliable. Most people say, though, this actually just undercuts their credibility.
It does undercut their credibility, and it's a real question to when that actually starts. How resilient is this as an institution that can keep chugging along and keep giving us the data, even if you get a blatant political appointment? We were talking to Henrietta Trey's of Veda Partners earlier, who said the first couple of months will be okay, the institution is all right. But what happens after that is a real question, and it could mean a higher risk premium attached to U.S. assets. What does that mean as debt spending really ramps up? Are we going to be able to fund the twin deficits at a lower cost if you are concerned about credibility of the data and your willingness, if you're a foreigner, to come around and buy U.S. assets?
And that's what Michael Gapin said. Basically, there's going to be this risk premium when you want to look at the United States. Maybe it's exceptional with an asterisk. All right, let's check in on the markets this morning. You do have futures slightly higher after Friday's sell-off. Euro-dollar at 115. Potentially it can go even lower given the fact that we do have this new 15% tariff rate regime in place for the European Union. Danny was talking about what was going on in the yield space. 10-year yield this morning, 4.2%. Treasury yields saw their biggest weekly decline since early April on Friday. Coming up this program, Venu Krishna of Barclays with stocks bouncing back as traders add to rate cut bets. Former New York Fed President Bill Dudley on why the Fed will be, quote, just fine, and Noel Dixon of State Street on navigating choppiness ahead. We begin this hour, though, with stocks gaining on optimism over Fed rate cut at the Fed's next meeting in September. Venu Krishna of Barclays writing, we continue to favor U.S. equities versus the rest of the world. We are confident peak trade uncertainty has passed. And Venu joins us now. Okay, so peak trade uncertainty maybe has passed, but what about just other uncertainty? The fact that the president on Friday didn't like the jobs report and decided to fire the BLS commissioner.
Well, I think those are the kind of uncertainties we'll have to learn to live for the next 3.5 years. And I think to some extent, I think the risk is something we were talking earlier, is that, have we become too desensitized to some of these, changes in policy, or, are we politicizing some functions or key aspects of the economy? But if you take a step back, in aggregate, the macro data has been quite resilient. The consumer, there's some bifurcation, for example, in the economy, but it's holding in okay. And the unemployment rate is still, by historical standards, relatively low, right? So the aggregate picture is not as bad as some of the near-term gyrations.
You prefer the U.S., but is there now more of a premium to invest in America?
There is, right? And that shows most evidently in the rates market, where the term premium has increased, over the last 6 months. And that has to do a lot with finally the market paying a lot more attention to deficits and things like that, and the level of policy uncertainty in the U.S. In equity markets, actually, the risk premium has been quite low. It's been low for quite some time. And that has to do with the dynamism of the underlying economy of corporate America. And I think the biggest boost to that has been coming from technology. And we are in a very critical phase right now, where two mega trends in technology are coming together. One is the transition in cloud, and second is AI on top of that. So that's what's been driving the equity markets. And we would argue that a lot of people are saying it's rich. It's not rich. I think it's fully valued. It was really cheap during the post-Liberation Day sell-off. But now, compared to the underlying fundamentals, I think it's reasonable, even though there are pockets where you need to pay attention.
Well, it gets back to this thing that you're saying, that in aggregate, things look healthy. But underneath the surface, there are concerns. If you look at earnings, for example, for consumer companies and materials, they're down on the year slightly, but they are down on the year. At what point does that create a problem for the overall market? Or as long as tech is booming, I can ignore those sectors and buy on an aggregate basis?
I think there's a two-part answer to that. One is you do need tech to keep delivering. And what's interesting on tech, at least big tech, is that the street has been on a consistent basis wrong or in other words, has been underestimating their earnings power. And luckily for us, they have been delivering into their multiples on a steady basis. And their multiples, by the way, have been generally trending down in the last 2 years. So we have a good problem over there. The rest of the market, I would agree with you, because that is where we are still not certain, because the post-COVID effects are now coming in. Now the tariff effects will start coming in. And to your point, if you remove financials and if you remove technology, then the rest of the market is to varying degrees having a tough time. So I would agree with you that even now, even though the headline numbers in aggregate look great, but the discretionary segment, staples, parts of healthcare, parts of industrials, all of them are showing different levels of margin pressure. And I think that is just going to build as we go through this year. Yeah.
Is it also a problem that the hottest part of this economy, i.e. tech, is one that in aggregate is laying off workers, not adding to the workforce?
Yeah, and what's interesting is that, of course, tech industry will give you a different reason for why they're doing that. But our hunch is that software productivity is up 30 to 40%. So if you're a tech native or a tech centric business, then I think that's a logical outcome you can expect, given the fact that AI is actually removing the bottom layers of coding, skills you need. So I think that's where you're seeing right away. To what extent does this translate into the rest of the economy has to be seen. I mean, clearly, based on everything you read, there are elements in the economy, whether it is healthcare, whether it's education, AI can have a massive positive effect, right, in terms of how we consume it and what it does to productivity. So I think it's a mixed bag, but we have argued for over 2 years now that over the next 2.5 years, the single biggest beneficiaries of this AI trend is going to be the tech sector itself, specifically the hyperscalers. And that is exactly how it's playing out. Down the line, we'll need to see who the winners and losers are, what new business models come out of it, how these existing companies adapt to some of these changing business models. I think you can expect a lot of shakeup in the next 3 to 5 years.
Are you concerned that the valuations, though, are just getting too high?
I think you got to break it up, right? If you look at aggregate S&P valuations, it's about 23 times, then you'd argue that it's high. If you peel it back, big tech started the year at 34 times forward earnings. Right now, we're trading at 30 times, right? So it's still one handle less than where we started the year. If you saw the bottom this year, it was close to 21 times. So obviously, it was dirt cheap after Liberation Day. If you look at the rest of S&P outside of tech, that's trading at roughly, I would say, about 20 times. It's a little pretty close to fair value. We think fair value is probably slightly lower. So that also is not egregiously rich. So I think, it's on the face of it, if you just look at the absolute multiples, then, people jump to the conclusion that it's rich. But when you break it down to its components and see what's driving it, like for example, the rest of S&P, we have a fairly decent framework where we look at what we think is a fair value based on change in inflation, change in nominal 10-year rates, expectation for economic growth. And that tells you that we are tad rich, but not excessively so. What matters is for that economy, if margin pressures build, right, and if tariffs start to hurt, then maybe the valuation is a little extended.
If margin pressure builds and the tariffs start to hurt, is it going to be basically companies passing on higher product prices to consumers, or do you think they're going to lay off people?
No, I think what's going to happen is it's a combination. So when they obviously pass on the prices, then they're not taking a hit at all, right? The secondary effect of that on ultimate demand and consumption is going to hurt them. But what companies have been trying to do, if you look at all the transcripts of the earnings season, even this season, last season, is depending on the industry you're in, they're trying to pass some of it on to the supply chain. They're passing on some of them, especially consumer facing, directly in price increases. And in some cases, remember, post-COVID, prices went up a lot. So companies' profitability improved a lot. So you can argue that a lot of companies have a decent amount of cushion to absorb some of the margin pressures by taking the cost themselves. So I think it really depends on the company. The bigger scale they have and the more control they have over the supply chain, their margins will be somewhat protected. The smaller the companies are, the less flexible they are, they will have to eat it in their margins. So I think that's where the bifurcation will come.
So the second half of the year is going to be really important, especially since those rates come into effect this Thursday.
Absolutely, absolutely.
Venu, thank you so much for your time this morning. Venu Krishna of Barclays, thank you so much for joining us. Let's get you an update on stories elsewhere this morning. Your Bloomberg Brief with Yahira. Hey, Yahira.
Hi, Anne-Marie. We start with our top story. President Trump is set to announce a new Federal Reserve governor and Bureau of Labor Statistics head in the coming days. He told reporters he has a couple of people in mind to replace Fed Governor Adriana Kugler. His pick might be in the running to fill Fed Chair Jay Powell's spot when his term ends in May. Meanwhile, Tyson Foods raised its earnings forecast after quarterly profit unexpectedly rose. The company saw a boom in U.S. chicken that offset losses in its beef business, which has been hurt by a severe cattle shortage here in the U.S. The chicken unit posted adjusted operating profit of $345 million in the third quarter, the best result for the period since 2016. Shares are up 4.2%. Meanwhile, Tesla shares are up, also rising 2% after the company announced a massive payout to CEO Elon Musk. Musk awarded 96 million shares of restricted stock worth over $23 billion based on the last closing share price. Tesla's board described the decision as a good faith payment, saying retaining Musk is more important than ever before. That's your Bloomberg Brief. Anne-Marie?
Not a bad welcome back to the C-suite gift for Elon Musk. All right, up next on the program, the morning calls, plus the former New York Fed President Bill Dudley with changes coming to the Federal Reserve. He'll weigh in. That's next. You're watching Bloomberg Surveillance.
Going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
What's key then is about at least some resolution to that story. Where's trade policy uncertainty going forward? We've all been talking about if you want to reshape global trade, you're going to have to risk downside. So I'm not sure that this report materially changed our view on that right now, but I think it's clear that the economy is adjusting to a period of higher tariffs. Either the consumer will eat it or corporates will, and if the latter does, look for a much weaker labor market.
Much weaker labor market potentially as the tariffs start to take bite. But equity markets this morning shrugging off Friday's jobs report, starting to rebound a little bit. They're looking forward and potentially meeting the Fed timeline to cut. Their first interest rate cut potentially is going to be September of this year. S&P 5 futures up 0.5%. NASDAQ futures up 0.7% this morning. Time now for the morning calls. First up, we have Morgan Stanley raising its price target on Disney to $140, setting growth in its experiences and streaming businesses. That stock is up more than 1% in the pre-market. Next up, Bank of America cutting its price target on Colgate to $98, citing multiple compression across the consumer goods sector. And finally, Citi raising its price target on Spotify to $780 after its third quarter guidance exceeded expectations. Spotify jumping in pre-market up 5%. Let's turn now back to the Fed. President Trump says he plans to announce a new Fed governor in the coming days after the resignation of Adriana Kugler. Former New York Fed President Bill Dudley writing this morning, quote, "Don't be fooled by the drama. In terms of how the Fed manages the economy, it's mostly a tempest in a teapot." Bill joins us now. All right, Bill, I won't be distracted by all the drama, but there's a lot of noise right now coming out of Washington, D.C. When it comes to who could potentially take this role, do you think this administration wants to put in a shadow Fed chair?
I don't know if that's their intention or not, but obviously the next governor appointment that seems to be on a faster timeline than we thought will be important because that person could end up being the next Fed chair. And so people will pay particular attention to who that person is and what their views are.
So in that case, and I know as you write, Bill, that you did see Waller's desire to succeed Powell and Bowman's thank you to Trump for appointing her as part of the reason behind their dissents. Bill, if I could just push you on that, because many people have looked at this economy and said there are reasons for a cut, and Friday vindicated that with weaker labor market data. Is there an issue where we look at all these dissents and say they are just political, or is there real evidence that perhaps the Fed should be leaning towards a cut?
Well, the Fed is leaning towards a cut. If you go back and look at the June summary of economic projections, everybody sees the path of rates is going downward. It's just a question of magnitude and timing. So the degree of disagreement in the Fed is actually, I think, dramatically overstated because everybody thinks the next direction it moves is down. Just a question of when to do it and how to manage the inflation risk caused by the higher tariffs.
So, Bill, the direction of dissent or the amount of dissent is overstated. So, too, is the ability for this FOMC to be swayed. What happens, though, if the data becomes less reliable, if a more political figurehead is put in at the BLS? Bill, you've been in the room evaluating this data with colleagues. How does that change in the Fed's evaluation of said data if changes are made at the Bureau of Labor Statistics?
Well, it depends on whether the changes made at the Bureau of Labor Statistics actually result in poor quality data or not. Obviously, if the data, is rigged, then the Federal Reserve is going to have to go to other sources of data. There's a lot more data available now than there was in the past. There's a lot of data that you can scrape off the internet, for example. So I think that obviously we want the BLS data to be excellent quality and trusted. That's very important. And so we have to keep an eye on that. But the idea that the Fed would be sort of unable to conduct monetary policy because the BLS data was corrupt, I don't think that's the case.
Well, going to the BLS data on Friday, now the average 3-month payroll gain went from 150,000 before Friday's release to now just 35,000. Going back to those two dissenters, doesn't Governor Waller have a point? The crack has already emerged. Is the Fed going to be behind the curve?
Well, I think the Fed probably will be behind the curve because the tariffs created so much uncertainty about what's going to dominate, the risk of inflation or the risk of growth. Everyone said the tariffs are going to push up prices and push down economic activity. And the question is, which is going to predominate? So the fact that the Fed might be late is because the tariff policies created this tremendous uncertainty about which force is going to be dominant.
Jay Powell really honed in on the unemployment rate last week, talking about the fact that's the main number he's going to look at. We did see it tick up to 4.2%. What do you think the line is for him where the unemployment rate ticking to what would get him really uncomfortable?
I think, a couple more tenths would definitely get him uncomfortable because then you'd start to think that the whole labor market was starting to give way. And when that happens, it can be a self-fulfilling prophecy because it scares people. They pull back on their spending, and that makes the labor market still weaker. The important point that Powell made, though, is it's not about the payroll employment changes. It's basically how that actually reflects in the unemployment rate. Because what's basically happening this year is the growth rate of labor demand has fallen, but the growth rate of labor supply has also fallen dramatically because of deportations and the crackdown on immigration. So both sides of the labor market are less robust than they were before.
And the jobs that were added, Bill, about 75 of them came from healthcare. The cyclical parts of the economy really were not adding jobs. The lack of breadth in Friday's data, does that concern you at all?
Well, I think, I'm worried that we're going to be in a sort of stagflationary environment where we're going to have both higher prices and a weaker economy. And the question is, which one do you put more weight on? I think the direction of rates is down. I think the question is just, at what meeting does the Fed finally see enough evidence to warrant a cut? As I said in the piece that I published in Bloomberg Opinion, there's not that much disagreement about the Fed. It's all about timing and magnitude. It's not about direction.
Well, what happens if, Bill, we have Adriana Kugler stepping down, so that's certainly a Trump appointment, and then you get Chair Powell, who decides not to stay on as a governor through 2028. In total, you add to that both Bowman and Waller. That means 4 Trump appointees on the FOMC. Does that, in aggregate, just mean, at the very margin, a more dovish shift to this Fed?
Oh, absolutely. I think, when it's a close call in that kind of situation, the ties are going to go to the doves. But at the end of the day, the economy is going to drive the story. I think, the chairman can't take the Fed wherever he or she wants. It depends on how the economy is motivating what's the right thing to do in terms of monetary policy. The chair has to convince the rest of the FOMC to go along. Now, obviously, if you have 4 governors all lined up on one side, that gives the chair quite a bit of momentum to get his or her way. But, I think the Federal Reserve presidents are going to continue to vote their conscience in terms of what's right for the macroeconomy.
The markets this morning are rebounding off of the lows on Friday, following the fact that everyone's starting to bake in this idea of a September rate cut. But, Bill, what if we get a hot CPI print? What's going to happen then?
Well, I think it's too soon to say that we're going to get a September rate cut. We just saw how the market for September has moved dramatically just in the last week. When Powell made his remarks at the press conference, people said, "Oh, they're not going to cut in September." And then we got the week in payroll employment report on Friday, and everyone said, "Oh, they are going to cut in September." So it's a long time between now and September. I think the prospects are pretty good that the Fed's going to cut rates later this year. Whether it turns out to be September or not really is going to turn out to depend on the data.
Bill, to what degree could this just be a post-Liberation Day fallout, the jobs data we've had over the past 3 months, and something that might rebound in August, given more certainty on which tariff levels are being set?
I think you're making a good point that the tariffs have caused people to sort of stand back in terms of business hiring and business investment because they don't really know what the landscape is. And as we get past August 1st and hopefully get more clarity on what the tariff packages are going to be country by country, that presumably will make businesses more willing to move forward in terms of their investment and hiring plans. So it certainly could go that way. Or it could go that the higher tariffs are raising prices, that's crimping real income, and that's affecting consumer spending, and that's leading to weakness in employment. That's going to motivate the Fed to cut rates. We still don't know which direction is going to predominate.
What we do know, though, is we know most of the rates. There's a handful of countries potentially could get better deals and better rates, but for the most part, we do know the rates going forward, and they're going to take effect this Thursday. How much time do you think the Fed needs to see this work through the economy?
Well, I think the Fed would like to see, a lot of time, a lot more than, 6 weeks to the next FOMC meeting. I think they think it's probably going to take, 6 months to get to see the full effects of the tariffs, because it takes quite a bit of time between the good landing on U.S. shores and it actually ending up being sold in a department store or in other retail establishment. So I think the Fed thinks it's going to be a slow process, and Powell basically said that at his press conference last week.
Former New York Fed President Bill Dudley, thank you so much for your time this morning, and you can catch his opinion piece this morning in Bloomberg Opinion. Danny, he says in the media, the Federal Reserve is under siege. I think that's because of the truths we get a lot from the President of the United States. He says, don't be fooled by the drama. In terms of how the Fed manages the economy, it's mostly a tempest in the teapot.
He did, though, say that we could have a more dovish shift. That's not a complete unraveling of the Fed independence, so I think that's a really important thing to signify. But at least at the margin, if you have in total 4 people who have been appointed by Trump, and one of them is the Fed chair, having 4 people in the column of cutting could sway things in that direction. But this is maybe a Fed, to his point, that needs more time, and it gets to this argument. Is the data we're going to get between now and September enough to give them confidence as to whether they should cut?
2 CPI prints, 1 more jobs report, and then the Fed meets. Coming up the program, Robert Sotkin of Citi on bracing for U.S. growth slowdown. Plus, Yahira is back with us with your morning movers and the high expectations in the chip sector. You're watching Bloomberg Surveillance.
Ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
It's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning. Welcome to Bloomberg Surveillance. I'm Anne-Marie Hordern. Danny Berger joining me today. Lisa and John are off well-deserved vacations. It is August. We do have U.S. stocks clawing back some of last week's losses, especially after Friday's weaker-than-expected jobs report. On top of that, the massive revisions we saw then prompted the president to actually fire the BLS commissioner. S&P 500 futures this morning up 0.6%. NASDAQ futures up 0.8%. We are 1 hour away from the cash open. Let's get you some morning movers with Yahira. Hey, Yahira.
Hi, Anne-Marie. We start with the latest company to report results, and that is on semiconductor. Shares are falling nearly 5% here. Earnings matched analyst estimates, but it was the revenue that really underwhelmed, falling 15% from a year ago, a problem since this company is involved in the hot chip space. So this underscores how high the expectations are for the companies in that area. Next up, we have an update on these two companies. A deal has been confirmed between CommScope and Amphenol. CommScope shares are rising 80%. Amphenol is buying its broadband and cable unit for $10.5 billion involving debt. The move underscores booming demand for AI data centers, which rely heavily on fiber optic cables, which are key parts of CommScope's unit that Amphenol is now buying, of course, subject to regulatory approval. And investors are liking the move by Tesla. Take a look at shares. They are up 2.25%. The move by its board approving a massive new award of 96 million shares for Elon Musk as it tries to keep him locked in while his original $50 billion pay package continues to be tied up in courts. The board also saying that retaining Elon Musk is more important than ever before, and they are putting their money where their mouth is. Anne-Marie?
Oh, they certainly are. That is about $30 billion for Elon Musk. I think my attention would focus back to the automaker if I was paid $30 billion, and I'd maybe ignore politics for a bit.
I mean, he did say that he's back to sleeping in the office and working 7 days out of the week. Hey, if that got me that amount of money, I might consider rolling out my mattress underneath my desk.
Yeah, there too. Pretty incredible. All right, investors gearing up for a lighter week of data and awaiting President Trump's picks for both the next Fed governor and the BLS commissioner. Bloomberg's Michael McKee joins us now. All right, so Mike, who's on the short list?
Anne-Marie Hordern and Danny Berger, I think, are leading the list at this point. God, we have no idea at this point what's happening. First, let's get the economic data out of the way. It is August, as you mentioned, and this is an August kind of week for August. We have very little data that's going to influence anybody. Today, we get factory orders. Tuesday, we get the ISM services number, which could give us maybe some bad feelings about the service industry overall, or maybe reassure people. Then you go to Thursday, you get the jobless claims numbers. Now, we do have Cook, Collins, Daly, Musalam, and Bowman speaking this week. We know how Mickey Bowman voted and how she feels. We may get some indication from the others if anybody was leaning towards, if not voting for, a rate cut during July. But I think overall, when you look at these numbers, you're thinking that John and Lisa have a reason to take this week off as far as data.
Yeah, lucky them. Mike, you're stuck with us. The Fed is under siege and it'll be just fine, is what Bill Dudley told Danny and myself just this hour. What do you make of all the drama happening in Washington, D.C.? And let's get back to some of those names. There has to be a short list that's coming up. If the president says this week he plans to announce a nominee and name to fill Kugler's seat.
Well, it's the names that we have heard so far, basically. The Kevins, Hassett and Warsh, and Scott Bessent, to the extent you think he would want to give up Treasury, and then Chris Waller on the Fed already. Now, the thing for the president is, and the chart I have here suggests the first thing that we'll be looking for maybe is a BLS commissioner, and the president has not been telling the truth about what the numbers have shown and what the BLS did. But the president can't make a recess appointment to the Fed. So the gamble he has is, does Powell quit as governor? If Powell stays on, then he only gets to appoint one person, and he better fill the Kugler seat with who he wants to be chair. If Powell is going to quit, which the chairman avoids talking about, then he would have a chance to put somebody else in. But the other thing about waiting for Powell's decision is that if you have to wait to see if he resigns until the end of May, then it's going to be months after that before you get a chairman in place. So I think the odds are he'll probably look towards getting someone named as soon as possible. The question, and you know this as well as anybody, Emery, is how fast the Senate will move. They're out right now for the month. They come back to this big, huge budget problem they have. So maybe best case scenario, they get to confirming somebody in October. Then there's only one meeting in December after that. So the president doesn't get a whole lot of benefit out of moving quickly this time, even if that seems to be the prevailing view.
Right, don't hold your breath. The Senate does not move expeditiously. Michael McKee, thank you so much. We're going to be sticking with the economy. Investors boosting bets on a Fed rate cut after Friday's jobs report showed more weakness than expected. Robert Sotkin of Citi writes, with the second half of the year set to show weakening activity, global growth is likely to fall from around 2.8% last year to 2.5% in 2025. We see global growth at 2.5% in 2026 as tariffs also bite into activity next year. Robert joins us now. Before we get into where growth is, can we have your reaction to Friday's payrolls report, especially since it prompted the President of the United States to fire the BLS commissioner?
Yeah, no, this was a very surprising report, I think, for the entire analyst community, in the sense of the size of the revisions that we saw really changed the trajectory of the labor market, at least where it stood at the moment, relative to what we had been thinking before the report. But that being said, I think it very much aligns with our view, which you outlined there, that we expect the second half to show slower economic activity as the tariffs start to bite more, as they influence business decisions more. And I think maybe that's what we're starting to see reflected in these labor market figures. We're also seeing it in a wider range of data. You're seeing a slowdown in consumer spending. You're seeing a slowdown in manufacturing, construction. So I think if you add it all together, the economy is not falling off a cliff, but this labor market data is more consistent with the picture we've been expecting, which is a slow U.S. economy, not a recessionary one, but a slow one.
Is it a lot of noise, or is there a signal in this potentially that even everyday Americans do not trust data coming out of Washington?
Well, you know, I think there is a issue here which has been percolating for some time, which is, especially after the pandemic, we have seen the response rates of these surveys fall dramatically. And I think that is the major reason that we are seeing these large revisions. And we had a large set of revisions in this Friday's report, but it's not the first time. We've seen very large revisions over the last several years due to these low response rates. And I do think it raises a bigger issue, as you said, for everyday Americans. They're looking at these large number changes in the newspaper and saying, well, why couldn't they get the numbers right the first time? Now, it's a very, very difficult exercise measuring these data. Even this data that we have now are not perfect in terms of their design. There's a lot of debate about how these surveys should be done. But I think it does highlight that there has to be some way to get these response rates higher so we get higher quality economic data for a lot of reasons, including for the Fed having better real-time data to assess the economy.
Does all of this then also change the ability of the Fed to use the short-term and monthly data we get to make a decision? Does it call into question their ability to decide for sure that September should be a cut, if the month's data that we're going to be getting up until then keeps getting revised?
Yeah, it adds to the challenges the Fed already has. I mean, the Fed is already looking at the tariffs that are playing through the economy in a sort of noisier, perhaps slower way than many expected. You know, we've been expecting the tariffs to push up U.S. prices, lower U.S. growth. I think we're starting to see more of that come through, but it's been a slower, harder process. And they have to assess that in real time. And so if you're dealing with data that is getting revised significantly, it creates more challenges. I think what you're going to see, and what we do as well, is you have to lean on a broader set of data. And so we have the official data. We also have all sorts of alternative indicators that we track. We have a range of high-frequency data as well. And you have to paint a picture with all of those series. But ultimately, yes, if you do have data that's constantly revised, it makes it hard to make policy in real time.
It's a real debate to be had right now, but Robert, it does feel like it's very much so being overshadowed by the Trump administration, or Trump himself saying that there's some partisan influence. Kevin Hassett on American media moments ago also saying that there have been revisions that have been in the partisan basis as well. So what happens if the solution is something like giving it more funding, but instead what changes is just who's running the agency?
Yeah, and I think hopefully, if it's just a change in leadership, you're still going to have the data kind of run in the same way in terms of the process that it had before, but maybe again with a look at how do we improve the quality of this data. Because if you look at, for example, how the BLS or any other, the BEA, any other economic organization makes these data, it's not the decision of one person. It's a process that involves statisticians and surveyists and hundreds of staff. And so it's really more of a technical exercise building these things. But underneath it, as I said, there is a deep issue of making these data higher quality, which would serve everyone better.
Let's get back to the trade story. Some news coming out of Bern. Switzerland ready to make more attractive trade offer to the United States. If not, they're facing a 39% tariff rate come Thursday. The administration wants to put the trade wars behind them. They came out and they said these are the rates, they're going to stick. How do you think about the overall tariff rate going forward when potentially some countries still want to negotiate with Washington?
Yeah, this is another area where it's been hard for us and for the Fed and others to assess the ultimate effects on the economy, because one of the most important variables is where does the tariff rate ultimately land? And we estimate with everything that's been announced, we think the effective tariff rate is somewhere in the neighborhood of 20% on U.S. imports. It was about 2.5% before President Trump took office. As you get more sectoral tariffs coming into play on things like pharmaceuticals, electronics, that could go a bit higher. And then it depends on where these deals ultimately land. And I think what we've seen from the administration is, so far from these trade deals, they have largely gotten what they have wanted in terms of what they're asking for. And other countries have mostly been accepting these relatively high tariff rates to avoid much higher penalties going forward. So I do think something like Switzerland, where the rate has been 39%, I do see scope there for negotiations, because that's a very high rate, particularly compared to the rest of Europe. But in terms of, are we going back to a world where countries are able to negotiate significantly below things like 15% baseline tariff rates? I think the administration's signaling that's unlikely.
Right, 10 is the new 15. So last year, 2.5% average tariff rate. You say this year it's about 20%. 17.5%. Who's eating that?
Yeah, and this has been the challenge in terms of measuring the effects on the economy, is there's a lot of margins of adjustments that could happen. How much is going to get absorbed in terms of exporter margins, importer margins in terms of what goes to wholesalers, retailers, and then ultimately how much gets passed on to the consumer. So far, we are still holding to the view that a lot of this is going to get passed on to the consumer, especially with tariffs at these levels. And when we look around the world, we are not seeing a lot of examples of exporters absorbing these tariffs into their margins. You saw a few, Japanese automakers are a good example, but for the most part, it seems that exporters are not absorbing this, and it's going to be shared between companies they're importing and the U.S. consumer. And we think more of that is in the pipeline in terms of how much is going to get passed on to the consumer in coming months.
Robert, thank you so much for your time this morning. Robert Salkin of Citi. Let's get you an update on stories elsewhere this morning and for what's going on in terms of Switzerland and the trade war. Bloomberg Brief with Yahira joins us now. Hey, Yahira.
Hi, Anne-Marie. As you said, officials in Switzerland say they're ready to make a more attractive trade offer to the United States. This coming after Swiss stocks dropped this morning as traders had the first opportunity to react to President Trump unexpectedly slapping a 39% tariff on the country. The number announced last week leaves Switzerland with one of the steepest levies in the world. Meanwhile, U.S. Trade Representative Jamieson Greer shared the U.S. and China are, quote, halfway there on a rare earths deal, a key component of any future trade deals between the two countries. His comments come as the U.S.-China trade truce is set to expire on August 12th, which is next Tuesday. And Indian Prime Minister Modi struck a defiant tone after President Trump imposed a 25% tariff on his country, urging the nation to buy local goods. Modi also insisting the country would continue to buy Russian oil, with the government describing the India-Russia relationship as steady and time-tested. The White House has threatened more action if India continues to purchase that oil. That's your Bloomberg Brief. Anne-Marie.
Thanks so much, Yahira. Up next in the program, we're going to set you up for the day ahead, plus Noel Dixon of State Street on navigating choppiness ahead in the markets. You're watching Bloomberg Surveillance.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive. Getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Clearly, there has been an uncertainty impacting the economy that has mattered for companies when they think about the labor demand numbers. I think for consumers, what that results in is a labor market that is still supportive, right? An unemployment rate of 4.2%, wage growth that is still running above underlying inflation, even with some of the tariff inflation impulses starting to move in. So consumers are managing this, I think, quite remarkably. Oh, the market's managing it quite remarkably as well today. All the drama of Friday, the market seems to be shrugging it off, starting to price in potentially the timeline for the Fed to have that first interest rate cut of this year being brought up to September. You also have treasuries erasing losses. Yields declined to session lows. The 10-year yield just under 4.2% this morning. Now we're counting you down to the opening bell. Here's the trading diary for the week ahead. 10 a.m. Eastern, we'll get durable goods. On Tuesday, the trade balance and PMI data and AMD results. We are still in full swing of earnings. Wednesday, Fed speak from Daly, Cook, and Collins, plus Disney results. And on Thursday, a rate decision from the Bank of England and another round of jobless claims. Plus, President Trump's new global tariffs will take effect. And on that note, let's go to Mike Shepard joining us down in Washington, D.C. Shep, it looks like potentially, even though the president and his advisors say that the tariff rates are set, do you think we can get a deal? Because Switzerland is hoping that they can put something a little bit more attractive in front of this Oval Office.
Oh, they were certainly caught off guard by the very high rate, really that eye-watering level of 39%, which was out of step with many other U.S. trading partners. They would like to see that addressed. And something clearly went wrong in the conversations between U.S. officials and their Swiss counterparts. There was some sort of disconnect, and the Swiss are hoping to get things back on track and try to get that rate lowered so that it's more in step with what other U.S. Trading partners and counterparts have gotten. For example, Japan and South Korea at a 15% level. That's something they can work with. The European Union in that same ballpark. So we will have to see whether the Swiss can come back with something that the U.S. is willing to accept. And certainly that 39% tariff rate sent a shot across the Swiss bow there, Emery.
Well, yeah, and it was up, Mike, of course, from even Liberation Day with 32%. So Switzerland definitely having a tough time. Shep, thank you so much for all your reporting this morning and for joining us. Turning back to markets, Noel Dixon of State Street writing, I think markets should be prepared for continued choppiness in the near term as investors grapple with the juxtaposition of slower growth and increased goods inflation. Noel joins us now. So Noel, when it comes to the labor market, we do know that there is weaker data. We saw that on Friday, but you're also still concerned about what this all could mean, the tariff regime for inflation. How are you thinking about all of this going into the next CPI report?
Well, thanks for having me. Well, I think there's going to be continued volatility as investors try to sort through not only, I think, a weakening labor market, but an increase in goods inflation. And I think what that'll do is it'll make the September meeting more of a 50-50 sort of outcome, and that'll cause some volatility, I think, into markets. So I think the way we look at it is not to panic, but probably use it as an opportunity to buy the dip.
At the start of the year, Noel, the American exceptionalism trade was really challenged. It started to come back as we cared less about tariffs. But if we're in an environment now where tariff rates are going on, in the case of Switzerland, higher than Liberation Day, if the data is starting to weaken, if there's some questions about Fed independence and the data agencies collecting them themselves, the credibility of it, do we start yet again to question American exceptionalism?
I don't think so. I think there was a lot of uncertainty. We didn't really know what the proposal was from the Trump administration from a nuanced perspective. Now I think we have some clarity. We have the one big beautiful bill. We actually know what the tariff rate effective, at least the reciprocal tariff rate, probably closer to 17%. So that'll give businesses that have been on the sidelines some confidence. I think we know, where the Fed stands, regardless of who's at the helm. I think, the board, they have to make a certain decision just based off the data. So we have some more certainty, and I think that presents an opportunity for the U.S. economy to sort of be the cleanest dirty shirt as we get into the second half.
Even so, Noel, you have someone like Amazon in their earnings last week, Andy Jassy, saying, we just don't know what's going to happen moving forward. It's hard to know where the tariffs are going to settle. And this is one of the companies that is moving forward with their spending plans. What happens to those that are more consumer-oriented, that just don't know where things are going to go from here? Noel, can we really have, beyond tech and the capital expenditures that they're doing, a real revival of growth?
Well, I think when we think about the consumer, we have a K-shaped economy. So you have the more affluent, think about, financial conditions year to date have actually been loose. Household net worth has actually picked up. It's the bottom 2 quintile of income earners that are suffering. But on aggregate, consumption is still pretty healthy. So I think those companies will still be able to have pretty decent earnings as consumption resumes, where they'll ultimately have to make a choice between higher prices and growth prospects.
Well, when it comes to that bottom quintile, the tariff rates going to hurt this group the most?
Unfortunately, it will hurt that group the most. They're at a position where they're not going to be able to handle those prices. However, I think on an aggregate perspective, I think, consumers are pretty strong. And I think if we get enough pain, enough suffering, I think the Fed will have no choice but to react regardless of where inflation is.
You say September's a close call, but given all of this we just discussed, do you think there is more of a probability the Fed cuts in September, or do you think they still wait on the sidelines?
I think it's 50-50. I know that's, probably a cop-out, but it truly is 50-50 because if, say, core inflation is CPI is at 3%, it's going to be really difficult for the Fed to make a move. And keep in mind, Powell referenced the unemployment rate, which is still pretty tight based on any historical standard. So I do think it's still 50-50.
Well, we get one more jobs report before the September Fed meeting, and we get 2 CPI reports. What are you looking at as the most important piece of data?
I think it's the labor market. I think if we see a real meaningful deterioration, a big jump in the unemployment rate, I think that'll transcend the inflation data. But that's not our base case. I think, the unemployment rate is likely to remain tight. And I think from our perspective, we think the inflation outlook is going to be the more closest thing to watch because we do think the labor market, at least as it relates to the unemployment rate, will stay tight.
Noel, thanks so much for your time this morning. Noel Dixon of State Street. Anything but a sleepy August or a sleepy summer. These next few data points are going to be incredibly important going into September.
And one of the real questions is, which you were getting with Noel, is the unemployment trend now worrying enough that we set aside what happens in inflation? Just based on the market action yesterday, where, as you say, 90% odds of a cut, a 2-year yield which plunged 27%, the most in about 2 years, it would suggest that the market does believe that this is a Fed that's setting aside inflation for the labor market.
But what happens if we get a hot CPI print? Does it just shift all the other way?
What happens if you have a new BLS chief and you can't trust the data? A lot of unknowns.
True, and potentially more deals coming down the pipe. Switzerland says they're ready to make a more attractive trade offer with the United States. Coming up tomorrow, Jack Caffrey of JP Morgan Asset Management, Rob Casey of Signum Global Advisors, Dana Peterson of the Conference Board, and Amanda Lynham of BlackRock. This was Bloomberg Surveillance. Thank you for watching with Danny Berger and myself. Lisa will join us. She's back tomorrow.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
A cidade estava sitiada.
Isso ao começo eu também não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Tishu talya ko na ahma ta chuara pa ngop ahma pa manjang le nya ko mana nya. Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
In case you missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
We are bouncing back. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, President Trump promises to make 2 key economic hires within days after painful data rocked markets on Friday. A rare setback for Warren Buffett. The billionaire's cash pile drops to just $344 billion, the first decline in 3 years. And Tesla approves a massive payout meant to keep Elon Musk's attention on the EV maker as a legal fight over his pay package drags on. Katie, what are you watching?
Well, let's get into the specifics of that pay package. Tesla approved an interim stock award worth about $30 billion for Elon Musk. The company will drop a longer-term CEO compensation package ahead of its November 6th annual meeting. But the idea that Matt mentioned that this will keep his attention on Tesla shares up about 2.4% pre-market.
All right, and earnings do continue. Palantir reports after the bell today. Shareholders looking for reasons to justify its $364 billion market cap, with the shares up this year more than 100%, and in the pre-market just about 2.33%. Katie?
All right, all that and more coming up, but let's go back to the big news from Friday, because now President Trump is set to make 2 new appointments in the coming days, a new Fed governor and a new head at the Bureau of Labor Statistics. White House economic advisor Kevin Hassett was asked if the president should fire anyone who presents numbers he disagrees with.
No, absolutely not. The president wants his own people there so that when we see the numbers, they're more transparent and more reliable. And if there are big changes and big revisions, we expect more big revisions for the jobs data in September, for example, then we want to know why. We want people to explain it to us.
Joining us with more is Michael McKee, Bloomberg's international economics and policy correspondent. And Mike, this news, that Eric McIntyre was fired on Friday was pretty shocking. There have been significant revisions, and I believe every month this year, to the downside. Why have they been screwing it up so badly?
Well, maybe I can explain to you and Kevin Hassett at the same time. It's not screwing it up so badly, although there are questions about whether the government, not just the BLS, but the BEA and Census Bureau, can get accurate numbers, or can get the numbers as accurate as they used to be, because businesses are not responding like they used to be. We used to get 90% participation by businesses in these surveys, and now for May we had something like 42%.
Wow.
So they have to do some extrapolation. They have to use some other statistical methods to try to come up with the best numbers they can, and then they get some more numbers each month as they come in, which accounts for the revisions. Now, the biggest issue that the economy has is it's slowing slowing down. We grew in the second half of the year of 2024 by 2.75%. In the first half of this year, the first 6 months, we grew by 1.25%. So naturally, hiring is going to slow down if the economy is slowing down. And also you had, on top of that, all of the problems with trying to figure out what tariffs would be and what impact they would have on hiring, companies just sitting on their hands.
Well, the point you make about collection rates going down, really stark when you put it that way, from 90% to 42% in May. That absolutely would have an impact. There's so much more we could say and ask about this topic, but we have to talk about the fact that President Donald Trump will also have the opportunity to announce a new Fed governor in the coming days with the stepping down of Adriana Kugler.
Yes, and this is an interesting dilemma for him because the only two seats that would come up during his term are Kugler and Powell, but Powell not until 2028. His term as chairman expires in May of next year, but he can stay on the board till 2028. So if Powell decides to stay on the board, and he has refused to say he won't, then the president only has the Kugler seat to fill to put a chairman in unless he wants to choose someone like Chris Waller, who's already on the board. So we'll probably get a pretty good indication of who the president is going to think of as the next chair when he makes this nomination. Now, he can't do a recess appointment for the Fed, so he's going to have to nominate somebody. They're going to have to be confirmed, and given that the Senate is out now, comes back to a big budget problem that might lead to a government shutdown, your best case is they probably won't get anybody nominated and into the confirmation process until October. And if you look at the Fed calendar ahead, the only meeting after October is December 10th. And so the president wouldn't get a whole lot out of being able to appoint somebody earlier, especially since they're not likely to vote against the chair at the first meeting. They could do that, but at this point, it matters less than it might appear.
Mike McKee, thanks very much. As you were speaking, President Trump tweeting or putting out on Truth Social that he's going to pick an exceptional replacement for the BLS. He says, and I'll quote here, "Last week's jobs report was rigged, just like the numbers prior to the presidential election were rigged. That's why, in both cases, there was massive record-setting revisions in favor of the radical left Democrats. Those big adjustments were made to cover up and level out the fake political numbers that were concocted in order to make a great Republican success look less stellar. I will pick an exceptional replacement. Thank you for attention to this matter, MAGA."
Can I just point out that the numbers released right before the election, November 1st, and election day was November 5th, showed 12,000 jobs were created in October.
Yeah.
That was
only 12,000
not a major boost to the Democrats.
Well, something I was thinking about, you know, we typically interview someone from the administration on the jobs report day, and I remember us asking the question to Acting Labor Secretary Julie Su many times about the revisions. So this issue, these massive deviations that we're seeing, definitely predate this specific administration started.
Yeah, it has been an issue. It's been an ongoing issue, certainly last year as well as this year. Let's turn right now to Tesla. The stock is rising after the board approved an interim stock award worth about $30 billion for the CEO, Elon Musk. Joining us now with more is Bloomberg Tech co-host Ed Ludlow. And Ed, normally I think if a company said, we're going to pay our CEO $30 billion, the stock might tank. But in this case, shareholders really want Elon Musk's attention on this company.
Yeah. And it's outlined in the letter from the board just how integral Elon Musk is, particularly to retaining talent. What they say in the letter is that, you know, he is a magnet to attract and retain top talent, while they also acknowledge in the letter that he has attentions elsewhere with his other companies and his other interests, but that the board feel this package will keep him focused on Tesla. He has to serve the full 2 years for the full amount, 96 million shares, to vest after a full 2-year term. But what's really interesting about it is that the exercise price, $23.34. So for each share, he would pay $23.34, but the share price is above 300 now, right? $310. You know, that's where the comp is. But we have a vote in November at the annual shareholder meeting for a much fuller, longer-term package.
All right, Bloomberg Tech's Ed Ludlow. I know you'll be all over this on Bloomberg Tech at 11 a.m. Looking forward to your reporting there. But let's zoom out to earnings season in general, because this week, 14% of the S&P 500 report earnings. Here's a look at earnings expectations. What a chart this is. It's been a very strong quarter despite tariff uncertainty, with 82% of S&P 500 companies beating estimates so far. That's the highest rate since 2021. Let's discuss with Bloomberg Markets Live reporter Michael Ball. Great to have you with us. And I know that you're taking a look specifically at the economic data, which seems a little bit out of sync with what we're seeing from corporate America.
Yeah, it's interesting. It's creating sort of a day of reckoning between the two. Last week, as Mike covered, the GDP report came in weaker. The momentum seems to be cooling. Final domestic sales, something we look that kind of excludes sort of the trade noise, was showing that after 6 quarters, almost 3% growth there, we're finally coming off this run rate. And earnings still holding in. Obviously, there's a concentration in sort of the big caps, and tech and IT, AI-related story is definitely ramping. We saw that in GDP as well. Investment outside of AI, IT, came off. But it's just kind of a conundrum that eventually it's going to have to, one side's going to have to win, and we're not sure yet.
So many CEOs are using the word fluid when talking about the tariff situation. We have a big story on the Bloomberg about how the pressure on yields is to the upside, even though right now we're down at 420 on the 10-year. You worked at the New York Fed. How do you see this data and this new policy affecting the earnings picture for stocks?
Yeah. Interesting. I think stocks are being supported by earnings, as we just said. And funny enough, the data cooling is probably supporting treasuries. So you're getting the best of both worlds. And ultimately, what we need to see is when we start to get downgrades again in earnings. But it's a big economy. It's got a lot of moving parts. We had manufacturing last week and ISM kind of showing cooling. Hiring rates were starting to turn into firing talks, which was the first time we picked up on some of that. This week we get ISM services, so we'll be watching that closely. But it's a huge economy, and it just takes a while for these tariffs and all the other uncertainty to hit. And I think that's what we're really getting, the lag there.
All right, Michael Ball, great to get some insight from you. That is Michael Ball. He is one of our Markets Lives reporter. You can find him at MLIV Go on your Bloomberg terminal. Meanwhile, let's take a quick check on futures right now. Boy, we had a wipeout on Friday, but you can see a little bit of green about 20 minutes ago before the opening bell. The S&P 500 up about 0.6%, a little bit better when you take a look at big tech. That was the laggard on Friday. The Russell 2000 also punching above its weight there. Let's get specific, though. Let's talk about chicken.
Let's
Tyson.
dig into it. Yeah. Some of the movers here. Tyson is one that I was looking at this morning, raising its outlook as chicken sales offset losses in its beef business. And I've been paying a lot more attention to the chicken economy ever since that Odd Lots.
Beak capitalism.
That Odd Lots podcast about the chicken stock.
Yeah, interesting to see poultry outperforming cows right now. Let's also talk about Wayfair beating estimates, with analysts seeing strong upside for the e-commerce firm, up almost 13% right now.
All right, I'm going to actually interview the Wayfair
I'm
CFO
excited for you.
on Bloomberg Business
With
Week
Carol
today
Master.
with Carol Master. I'm
What a
looking forward
dream.
to that. You saw Hims and Hers there as well. It reports after the bell. It's had a 250% surge in the past year and continues to rise. And this, I think, is for the most part down to the GLP-1s.
Yeah, there's been a lot of back and forth there. This has been a very volatile stock, so looking forward to those figures. But coming up next,
Berkshire Hathaway's profit drops as it writes down its Kraft Heinz investment, and they only have $344 billion in cash. We'll get more analysis from Kathy Seifert, analyst at CFRA. Next, this is Bloomberg Open Interest.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Warren Buffett's Berkshire Hathaway saw its operating profit dip about 4% as it took a $3.8 billion impairment on its Kraft Heinz stake. CFRA analyst Kathy Seifert says the results temper her firm's enthusiasm for the company. Kathy joins us now. She has a hold recommendation on the stock. Kathy, was this entirely unexpected here, and how serious is it?
Well, I mean, I think there were a couple of factors in these results that were less than stellar, and the Kraft Heinz impairment was not that big of a surprise. I mean, we've seen that there's been some activist action at Kraft. Berkshire's representatives resigned from the board in mid-May. So the write-down was not that much of a surprise, given that they changed the way that they're accounting for the stock. I'd also point out that they account for their Oxy investment on an equity basis and are currently carrying their Oxy position about $5 billion above market value. So, I mean, I think that's something to watch as well. I think there were a number of things in the earnings that were a little tepid, in my view.
Well, let's talk about that. I know that you have a hold rating on the shares. It seems like when you think about this weekend and what we learned there, it doesn't seem like there's a lot of pressure on you to bump up that rating.
I downgraded my recommendation late last year when top line growth was slowing. And, you know, one of the things that sort of made Berkshire stand out from a lot of its peers was their ability to generate pretty healthy organic revenue growth. Well, that seems to be coming to a halt, and revenues actually, operating revenues actually declined this quarter. Insurance results were very mixed. And, you know, I've also talked about how last year the insurance industry had a pretty significant tailwind. And this year, results outperformance is really going to be company by company specific. Geico's results were okay. They grew top line a little over 5%. Loss costs were contained. That's kind of similar to what we've seen from some of the other peers like Allstate and Progressive, although both Allstate and Progressive are growing their top line faster and underwriting more profitably, so there's that. Berkshire's commercial lines businesses were pretty weak. Top line deteriorated. There's some adverse claim trends. So I think the insurance results were pretty mixed. Ironically, the one bright spot was at BNSF. They got some increased operating efficiencies. Lower fuel costs certainly helped. But, you know, BNSF is sort of in the headlines because of the notion of rail consolidation to gain increased efficiencies that they just achieved organically. So I think that's something else to watch, you know, what happens in the rail space.
Right. Well, Kathy, given that, you know, they had to write down that Kraft Heinz stake that they have, do you think that that dampen some of the speculation around BNSF? Does the timing make sense for Berkshire here?
I mean, my sense is that, you know, Berkshire's cash position grew to over, you know, like $344 billion. So they're certainly sitting on a lot of cash. But I think it's also important to note that they didn't buy back any of their shares this year. And I think they're sort of standing pat. And historically, when Berkshire does acquisitions, they like to do them on their terms, not because their hand has sort of been forced because of an industry consolidation. So, you know, I know there are a lot of rail analysts who have made the argument that, you know, a tie-up with another railroad makes sense. What I know about Berkshire is that they historically don't like to do things, which doesn't mean that they're not going to see the writing on the wall, but it doesn't align with how they historically do deals.
Hey, I mean, what deals are there for them to do? You know, aside from railroads, they have $344 billion. Are they going to be able to put that to work? Do you want them to put that to work? Are there other things you'd like to see them do with that cash?
Well, I think, and this is just sort of my sense, you know, there's a management transition going on. That's sort of the understatement. But there may be a cohort of investors once Warren Buffett is no longer sort of at the helm. My sense is that there may be pressure for Berkshire to pay a cash dividend. They're one of the largest financial firms and one of the largest companies in the S&P 500. And, you know, relative to their cohorts, they're one of the few that don't pay a cash dividend. They also don't. They have a capital allocation plan. It's not necessarily articulated, and a lot of their peers have a better articulated share repurchase plan. As it relates to acquisitions, I mean, I understand where they're coming from. Market valuations are not cheap, and we've got an economy, and I would argue Berkshire at an inflection point, and they may be, you know, they've warned about the impact to tariffs. My sense is they believe it's going to impact them, and I can understand that concern. So they may be waiting for equity valuations to contract a little bit.
Kathy, great to get a little time with you. Really appreciate you joining us this morning. Kathy Seifert there of CFRA talking to us about Berkshire Hathaway. Now let's get to some of the other movers on our radar this morning, and one that Katie and I both have been, astounded is too strong a word, but a little bit surprised by is the jump in Joby shares. Yeah. It's an air taxi, I guess, company. I've never taken a Joby.
I haven't had the pleasure, but apparently they're buying all of Blade's passenger businesses in cities around the U.S. and Europe. The CEO joins Bloomberg TV at 12 p.m., I believe, with Ed Ludlow and Caroline Hyde, which makes sense. Ed Ludlow broke the story with Sid Phillip over the weekend. I just am interested in this because Joby is the one doing the buying for a $125 million deal, but shares are actually much higher right now. So
$125 million?
Yeah.
That's it?
That's
to
probably
buy Blade's business?
That probably explains some of the reaction that you're seeing in shares right now.
I would say so as well. Spotify climbing on news. It'll increase subscriptions across Europe, Asia, and the Middle East. That's a big jump for that.
Yeah.
I've never been a Spotify. I know the kids love it.
I've been paying for Spotify since college, pretty much. So you can see that reflected in shares this morning. And Boeing, more than 3,000 Boeing workers in St. Louis are on strike after rejecting the latest contract offer. Boeing shares down 1.2%. Not a huge reaction, but a little bit of a setback for Boeing.
It's a GSE.
Coming up, Morgan Stanley says to buy any stock dips. We'll ask Citi's Stuart Kaiser if he agrees. That conversation next. This is Open Interest.
Welcome to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
To the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Morgan Stanley strategist Mike Wilson says that any stock pullback should be seen as a buying opportunity. He says that the combination of a fading inflation impulse and softness in the labor market should lead to a robust interest rate cutting cycle. Citi head of U.S. equity trading strategy, Stuart Kaiser, is at the desk. So, Stu, does that make sense to you, both the reasoning and the playbook, just buy any pullback?
I mean, I think we're probably a little more conservative than that right now. Our view has generally been rate cuts are great, but they're not enough to bail the market out if this labor market really cracks. So, our view has generally been as long as the labor market is strong, you want to be long equities unless and until that labor market starts to come under pressure. The data on Friday was, concerning enough that we'd probably be a little bit more conservative about buying dips right now than that.
You think maybe the BLS was faking it? Does it seem like it was rigged?
I would say probably it was not rigged, but all of this data is estimated based on statistics. So I guess, different people might have different views on that. But no, I don't think the data was rigged. I think, you're at a period of time when there's a lot of uncertainty for corporate America, and they're probably being a little more conservative. I think not hiring is different than firing, right? So I think what would really get the market into a troubling spot is if you saw layoffs increase in a material way.
All right, Stuart, we're going to keep you with us here because the opening bell is next, and we're looking at a pretty decent rebound, not making up everything that we lost, right,
that's
on Friday.
The thing. I mean, you can't really complain about 0.5% higher, so 0.6% higher, but we were down 2% on the S&P 500 on Friday alone, so trying to crawl out of that hole. We'll bring you through all the opening bell action up next. This is Bloomberg.
break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We are moments away from the start of trading to kick off this week. This is Bloomberg Open Interest. I'm Matt Miller. After a 2% drop on Friday, as Katie pointed out, we're back up, recovering 0.6% on futures here. NASDAQ getting a little bit better, up 1%, and the small caps are rising as well. You see and hear the opening bells at the New York Stock Exchange. Finance of America. The ticker is FOA, which is my fraternity at Antioch, the Fraternal Order of Antioch.
The more you know.
But they're down 80% in the last 5 years. That's not great. The chart looks really ugly. Here on the NASDAQ, Verint, which provides solutions, they're down 26% year to date. Not a great day for bell ringers,
No,
really.
no.
You're looking at Tesla stock, and it's up.
Having a slightly better day. I mean, up 1.5%. This after Tesla approved an interim stock award worth about $30 billion for CEO Elon Musk if he stays in his role for the next 2 years or so. The idea here is that this is going to keep him engaged and motivated to be working specifically on Tesla. We know that he is a CEO with divided attention given his portfolio of companies. That's worth a little bit of a pop in Tesla shares. Matt, I will point out it was up higher pre-market, so we'll see if these gains are sustainable.
What's the name of the political party that he wants to start? It's like the Freedom Party?
I think it's the America Party.
The America Party?
I don't know. You'd have to go check on X.
In any case, that could be a distraction if it happens. Palantir doesn't seem distracted. Reporting after the bell today, shareholders looking for reasons to justify the massive gains, more than 100%. This year, it's got a market cap of $365 billion. All right, we're back with City Head of U.S. Equity Trading Strategy, Stuart Kaiser. And Stuart, we were looking at a chart that shocked me, and I think it's fair to say everybody on our team, of second quarter earnings expectations. You know, there was a while, here it is, there was a while when we thought it wasn't going to be so great, and now we're returning more than 9%. What happened?
Large cap tech reported, I guess, is basically what happened. I mean, if you look at the path of EPS, kind of after financials reported, you had a couple % dip in calendar quarter consensus estimates. Last week, biggest week of earnings, big cap tech reports, and those earnings numbers rebounded, as did the market. It has been the most volatile earnings season we've seen in about 15 years, though. So, you know, under the surface, there's a lot of moving parts at the single stock level. But, you know, by and large, I think the takeaway is going to be a lot of volatility, but, you know, corporate America kind of delivering and at least underwriting the rally to some degree.
I think I saw a Goldman Sachs estimate this morning.
I have it right here. The Magnificent Seven apparently grew earnings by 26% year over year.
That part's not surprising to me. The surprising part is the S&P 493, the rest of the group, only up 4%.
Well, I mean, look, there's always this theme in the market. Right now, that theme is AI and large cap tech, and they're kind of pulling the weight right now. And look, that's a positive, right? Even when the 493 is under a little bit of earnings pressure, that large cap tech is strong enough to kind of right the ship. Once the economy settled down, uncertainty improves, you would expect that 493 to play some catch up. So I would look at that as a positive, i.e. the ballast that you're getting from the Mag 7 is enough to allow those other companies to kind of figure stuff out.
Well, let's meditate a little bit longer on the surprising part of that 4% for the remaining 493. Do you just trust tech here? Do you take a look at that 26% year-over-year earnings growth and say, okay, I'll just load the boat there?
And that's what I think that's what people are doing. You know, whether it's tech or tech adjacent, right? You know, you have the AI stocks, you have Mag 7, you have the power gen, which is sort of, you know, the infrastructure for that AI. All those stocks are doing very, very well. You know, the other 493, as you put it, I think under a little bit more pressure, probably from the uncertainty, you know, that's going through the system and that we saw in the economic data last week. But yeah, I think you have to, you know, cross your fingers and say, at a period of economic uncertainty, those folks are going to get us through it, and then you get the rest to play catch up. Yeah.
Let's talk more about the economic uncertainty over the economic data itself. We were having this conversation before the commercial break, and I wonder if we're entering into a period where you question the quality of the data. Does it create this new playbook where maybe you're not trading the headline number on the first Friday of every month, you're actually just trading the revisions?
Well, I mean, look, the data is the data. It's been sampled and sourced the same way, you know, for 50 plus years. I think what you're getting is because of AI and because of, you know, internet-based and alternative data, people are starting to maybe raise their expectations, you know, for the quality of the data sampling. And, you know, maybe we do need to play a little catch-up in how that's done. But I don't think there's any reason, you know, to question the underlying quality of the data on Friday. The data's the data, and we just kind of accept that and move on. It's not, to me, I don't think there's been an overall decline in the quality of data. I think maybe what's happened is the standards for that data, you know, from the average consumer have probably risen a little bit.
You know, we had a great big take story on the Bloomberg yesterday about the upward pressure on yields. And yes, right now the 10-year is down at 420, but the idea is the Sell America trade, right? The baby boomers aren't saving up anymore. The Chinese aren't buying treasuries with their savings, and if you have the president starting to fire the messenger all the time, and maybe even putting yes men in place, that's even more pressure on yields to rise and people to sell treasuries. What do you think about that?
I mean, look, I think what you're talking about to me is the much longer end of the curve, like 20 to 30-year bond levels. And look, there is a supply-demand issue out there to some degree. There's probably more 20 and 30-year bonds issued than the market would normally consume. And if you do get a pullback in foreign buying, that can kind of exacerbate the problem. But, you know, the 10-year yield, we would view that as just kind of the quick and dirty view on the growth outlook. 2-year point is kind of policy. That 30-year point is inflation and uncertainty. So the stuff you're getting at, if the market starts to worry about that, that's going to be the very, you know,
I'm just saying the real rate of interest is floating higher and higher, and the risk premium, if you fire the BLS head, you know, is going to rise.
Yeah, look, fair enough, but we didn't see much of a move in the long end of the curve on Friday. I think from an equity point of view, we're going to look at the bond market, and if the bond market is not getting too concerned about that long end bond yield, you know, the equity markets are going to kind of compartmentalize this, you know, into a separate category. But look, we saw this kind of late June, early July, where 30-year bond yields in the UK and Germany and Japan and the US were all kind of moving, and equities took note of that when it happened. We did not see that happen last week, and I think equities will be a little bit comforted by the fact that the bond market didn't react too strongly to that news.
And so, Stu, let's just wrap it all together. I mean, you take a look at the trajectory of the rest of the year, recognizing that we're very much in August right now. I mean, where is your highest conviction at this point?
Well, we still like being long U.S. equity risk, and we have been probably for the last 4 to 6 weeks saying stay in your larger cap, higher quality stuff, because there is a real risk from this spillover from global bond yields, and there is concern about what's going to happen to the U.S. economy. Our economists do expect a significant slowdown in the labor market and the unemployment rate to rise. So I think if you took a snapshot of the macro investment environment today, you'd say that's very positive to own equities. Inflation easing, 4.1 unemployment rate, preparing for some Fed cuts, even in that context, that's very positive. The outlook in the third and fourth quarters is we need to keep a really, really close eye on what goes on with that unemployment rate. And for that reason, we would recommend staying in higher quality stocks. And ancillary to that, I think, is the inflation print you're going to get in mid-August. Because if that inflation print is hot at a time when you just had a weak labor market report, that kind of puts pressure on the Fed from both sides of the dual mandate. So again, there's enough uncertainty there where we want to be conservative about it, but we still want to be long U.S. equities given the backdrop.
Absolutely. Sounds like the recipe for some fireworks, at least when it comes to the economic data. Stuart Kaiser, always great to see you. Thanks for kicking the week off with us. That is Head of U.S. Equity Trading Strategy, Stuart Kaiser. Meanwhile, let's get a check on this market. You have the S&P 500 extending its rally just in the first few minutes of this Monday trading session. We're now up 0.9% on really good breath, actually. You have over 400 names in the green right now, and it's big tech that's leading. You can see up at the top, we have NVIDIA, your biggest gainer on a points basis in this market, followed by Microsoft. They're actually trading places right now. Apple, Broadcom, Meta, Tesla, the list goes on. We do have some losers, only about 80 or so. Berkshire Hathaway up at the top there in terms of losses, down about 3.3%. That is your biggest points detractor from this index. On Semiconductor reporting earnings this morning, down 7%. Not something you want to see, but still a lot of good news in this market, and you can see that on the sector level as well. It's a perfect screen behind me. 11 out of 11 in the green right now, Matt. Big tech up at the top, followed by communication services, but you can see its gains all the way down on this Monday.
What a nice way to start the week, you know, just.
It does feel good.
You know what would be better?
Tell me.
If you ran a company and the board approved a $30 billion
one of these days
payout for you as CEO. There's a catch to that, though, and we'll tell you what it is next with our own Max Chafkin. This is Bloomberg Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg. Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Kimberly-Clark is getting upgraded over at JP Morgan after its earnings beat estimates. The firm has confidence in Kimberly-Clark's volume and growth in the second half of the year. Matt, everyone needs to buy toilet paper. Next up, Coinbase is getting downgraded to a sell over at Compass Point. The firm expects a choppy third quarter because of decreasing retail interest in crypto treasury bonds. You can see shares down only about 0.5%. And finally, Spotify is getting raised over at Phillips Securities. The streaming company announced it's raising subscription prices across markets outside the U.S. Not exactly great news for me, but you can see shares up 7.3% right now.
All right, so big gain there for Spotify, which Katie apparently has been paying for since college.
Like 2011.
I don't get it. But Tesla approved an interim stock award. You could afford it if you had this. Worth $30 billion for the CEO, Elon Musk. And the catch is he only has to stay there for 2 years. The board says rewarding Musk is, quote, the right thing to do. Joining us with more is Max Chapkin. He's the co-host of the podcast Elon Inc., which isn't called Tesla Inc. because Elon has a hell of a lot of other stuff that takes up his attention besides the car maker, and that's what they want to change with this package.
I mean, or change, or just maybe keep the status quo, make him not start any more things. The case for this is sort of twofold. One is that Tesla shareholders did try to give him a giant pay package, which was voided by the Delaware courts. So the board is kind of saying, hey, this is a make good on that. In case the courts don't uphold this pay package, here's $30 billion. The other thing is that Elon Musk has been threatening to start a political party. And there are a lot of shareholders, now this may seem a little counterintuitive because these threats to start a political party have not been good for the stock, but a lot of shareholders feel like if only we just give him a little more money, a few more shares, maybe he'll be incentivized to not do that. And that's kind of the case here.
So I don't know if you guys know this, but I host this podcast called the Money Stuff Podcast with Matt Levine. I believe he calls it like the Elon Musk attention auction because that's really what you're doing. You're trying to pay the highest price and get Elon Musk to pay more attention to this venture. Does it help at all that it seems like XAI could become more of a part of Tesla?
I mean, the XAI thing is interesting because XAI is competitive with Tesla. So that, I think, is one of the reasons shareholders want to do this. They're worried that maybe Elon Musk will just turn around from Tesla, walk away. Now, that would be, just to be clear, that would be very bad for him from a financial perspective because almost certainly if he did that, the price would fall, his net worth would fall, but maybe he could get excited about a different company. I think the hope here is that he keeps his attention, I guess, on the two. You know, Musk has been out there sort of threatening, and in fact using XAI as part of that threat. Like, maybe I don't want to do the great AI work that I've been planning to do at Tesla, inside of Tesla, if there's a risk that some activist investor could come along and take it over, push me out. So that's part of what's at play here. I think from a sort of normal company perspective, it's very weird to have a company that has really been underperforming, that has not been doing very well for a couple of years, turn around and write effectively a $30 trillion check to the CEO. The strike price... $30 billion, excuse me. It's probably what Elon wants. But the strike price on these shares is $23 a share or so. So we're talking, and the price today is like $308. Effectively, these are no-lose options. Like, he's going to get this money if he sticks around. There's no sort of performance bonus here or anything like that. This is just about trying to get Elon Musk get his head in the game.
Can I pivot?
Go ahead.
Because you mentioned AI, and Max wrote a story today about, I think it's fair to say, an industry that treats its customers worse than almost any other besides private prisons, right? And I'm talking about airlines, obviously. It It's already the most convoluted and difficult to understand pricing structure that you can imagine. They do this purposely to hurt their consumers, right? And they're going to make it worse with AI. How's this possible?
All right, so the airlines would argue that they're not making things worse for their consumers. They're merely finding the best price, optimizing their business or what have you. But what is happening, what I wrote about today, is there's a startup out there. It's called Fetcher. They're working with Delta. That's their most prominent deal. Delta's actually been talking about this startup quite a lot over the last 6 months or so. Got my hands on a sales document that they use, and it describes kind of what they're doing. And it really gives you a vision for how buying a ticket will work. This kind of confusing feeling where you don't know whether you're getting a good deal today or tomorrow. Maybe if you wait, it'll be a better deal. Maybe if you hold off. They want to make it actually way more complicated. They want to add more fare classes, lots of shifting around. And as Delta has talked about, AI pricing, they've talked about it as this great thing because from an investor point of view, right, it makes sense. Investors love being able to raise incremental revenue, and they also love AI right now. But consumers, those are not necessarily things that they want. And you're seeing a backlash going on right now where you've had a bunch of lawmakers and so on essentially write letters complaining to Delta. Also, American Airlines saying we're never going to price with AI, or we're not going to price now. I think most people who watch the industry assume that everyone will do this because it's going to be a powerful tool essentially to raise additional revenue, see if you'll pay, hey, maybe you'll pay $20 more for that ticket, maybe $40 more. And that was actually the example that Delta gave during an investor day.
Josh Hawley, the senator said, from Missouri, said, it's the worst thing I have heard from the already awful airline industry. And this is something I think no matter what side of the aisle you're on, you can agree with Josh. It's just a horrible industry.
I think you're going to see a lot of stories like this because this isn't only happening in airlines. And that's one of the points one of the people I talked to for the story made. We're seeing AI in pricing in other places. Of course, you see it when you do ride hailing. And there are efforts underway. This company that is working with Delta right now and some other airlines is trying to go to other businesses. The idea is to bring this, most of us think of, oh, we're going to have super intelligence and it's going to cure cancer. Maybe, hopefully. But what it's actually going to do is just, figure out how to wring a couple of extra dollars out of consumers because it's going to be able to hopefully, from the point of view of the companies, price things more aggressively.
All right, Max, great reporting both on Tesla and, of course, on this new AI program, which sounds like actually isn't great for consumers, maybe great for those airlines.
I'm going to tweet this story out.
Good.
I'm going to use my Twitter.
You don't tweet very
I'm going to
much.
use my Twitter account to share this story.
That really tells you how passionate.
It really grinds my gears.
It grinds his gears. Bloomberg's Max Chapkin. Be sure to listen into Max's podcast, Elon Inc., wherever you get your podcasts. But coming up, Hims and Hers reports after the bell. Shares are up more than 250% over the past year alone. That conversation up next. This is Open Interest.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. we go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hardern in Alberta, Canada, and this is Bloomberg.
Hims & Hers shares poised to move 16% in either direction after earnings. That is according to the options markets. Bloomberg Health reporter Madison Mueller covers the company. She joins us now. So this stock is up 250% over the last year, but that comes with a whole heck of a lot of volatility. And we were talking about how this has become sort of a meme stock. I didn't realize it's become a meme stock to the extent that retail participants actually ask questions on the earnings call.
Yeah, the last couple of quarters, it's become a new tradition. Hims CEO Andrew Dudum's really leaning into the fact that they have this growing retail fan base, and he actually starts the earnings calls by taking a few questions from these retail investors and then going to more institutional Wall Street analysts. And there is a really big community. It's called Hims House, and they have a Discord channel, a Substack.
Not Hers House?
Not Hers. There needs to be a Hers House. I mean, that's
Not
the
yet.
next thing.
Not
Yeah,
yet.
exactly.
Matt's going to start it.
So GLP-1s is what is great for Hims and Hers and Noom and Row.com, and you know, famously they were $1,000 a month. Lately, I've been seeing all over socials microdosing for like just $100 a month. So massive decline. That's a 90% decline. But
not 1,400%.
But President Trump has the idea that he's going to lower drug prices to an amount that really just gets you paid. Listen to what he had to say yesterday on the tarmac.
We'll be dropping drug prices. It'll start over the next 2 to 3 months by 1,200, 1,300, and even 1,400% and 500%, but not just 50% or 25%, which normally would be a lot, because the rest of the world pays much less for the identical drug.
So essentially, he's going to make it so drug makers pay you thousands of dollars for your prescriptions.
I mean, that would be ideal. But the mechanism by which President Trump is going to do this is still sort of unclear. I mean, he's been saying for months that there's going to be tariffs on pharmaceuticals. He's been saying that he's going to lower the drug prices. And how that happens is still somewhat unclear. I mean, he's been talking about this idea of most favored nation pricing, which would essentially mean that it would align U.S. drug prices to what other countries pay. And on Friday, I think it was last week, he sent letters to 17 different drug makers, largest pharmaceutical companies in the world, essentially demanding this, but not going so far as to mandate it by any, regulatory requirements. So he said, you have to do this voluntarily, 17 letters to different drug makers, and gave them 60 days to comply. So we'll sort of see what happens there. But drug makers have obviously not been fans of this, and it remains to be seen actually like how he will make this happen outside of just demanding that they voluntarily do it.
All right, yeah, you take a look at Eli Lilly shares dropping 2.6% on Thursday when those letters were sent out. Just still a lot of question marks here. That is Bloomberg's Madison Mueller. Of course, we have Hims and Hers earnings after the bell today. Will certainly be interesting given the backdrop here. Let's talk about futures, though, or rather, the market's open.
Yeah,
let's talk about what the market is actually doing right now, and it's actually moving pretty meaningfully higher. Maybe not relative to what we saw on Friday, but very good breadth today on the S&P 500. 11 of 11 sectors higher right now, and it's going to be interesting to see how those bars change over the course of the week.
Yeah, absolutely.
There it is, 1% on the S&P 500.
In the next hour, we have Lori Calvasina joining us, and she says earnings are not as rosy as the market suggests. Plus, we're going to talk M&A with the master of it from Morgan Stanley. Tom Miles joins us. This is Open Interest.
this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human being, for the world.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Jennifer Kuiper. A showdown among Texas lawmakers. Republicans have redrawn the congressional map in that state that will favor GOP candidates in future elections. In response, Democrats have fled the state, preventing a vote. CBS's Ed O'Keefe in the Chicago area.
Dozens of Texas House Democrats are now in the Chicago suburbs, leaving their state behind and disrupting plans to vote on a new Republican-drawn map to reshape congressional power in the Lone Star State.
We're not here to play political games. We're here to demand an end to this corrupt process.
President Trump has directed Texas Republicans redraw their map.
On Texas, how many more seats do you want the Republicans to draw?
5.
In hopes of avoiding the losses that usually happen to a president's party in midterm elections.
The massive Gifford fire in Central California is only 3% contained and has now grown to about 50,000 acres. CBS's Jason Allen, reporting from nearby Santa Maria, says the Gifford fire is burning through rugged terrain.
This is not an area where there are high population centers, but there are homes, there are ranches. Firefighters, 1,000 that are working on this right now, have been trying to protect more than 400 structures, and there are evacuation orders in place.
Armed and dangerous is how police in Anaconda, Montana described the man they're looking for in Friday's shooting deaths of 4 people in a bar. State Attorney General Austin Knudsen.
By all indications, this is an unstable individual who walked in and murdered 4 people in cold blood for no reason whatsoever. So there absolutely is concern for the public.
A boat carrying migrants has capsized off the coast of Yemen. At least 68 are confirmed dead, with 74 others still missing. CBS's Vicky Barker reports from the Foreign Desk in London.
The UN's International Organization for Migration, or IOM, says 157 people were on board the vessel, most would-be migrants from Ethiopia. Only 32 have been rescued so far. Yemen is a favored destination for people smugglers trafficking African migrants into the wealthy Gulf state. The IOM says there were at least 558 deaths on the so-called Red Sea route last year. Vicky Barker, CBS News, London.
According to Bankrate's Housing Heat Index, the hottest housing market right now is in Connecticut. Analyst Alex Gailey.
So we're seeing a big shift in the U.S. housing market. What were once red-hot housing markets along the Sun Belt are now cooling, and housing markets in the Rust Belt and Northeast are heating up.
The New Haven-Milford area is ranked first overall. U.S. stocks rise following sharp losses last week. The Dow is up almost 400 points. This is CBS News. Pope Leo XIV has wrapped up a weekend jubilee for more than 1 million young Catholics. CBS's Chris Livesay has more.
A rock star welcome at what's been dubbed the Catholic Coachella. With more than 1 million gathered in a Rome suburb, it was the biggest and youngest crowd of Leo's papacy so far. But as a new generation from around the globe celebrated, the Pope was quick to draw attention to their peers who cannot.
We are with the young people of Gaza. We are with the young people of Ukraine.
A group of countries that are part of the oil cartel OPEC Plus have agreed to boost oil production by 547,000 barrels per day in September, a move that some believe could lower oil and gas prices. Countries including Saudi Arabia, Russia, and Iraq cited a steady global economic outlook and low oil inventories. Jennifer Kuiper, CBS News.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience streaming live on YouTube as well. Norma Linda, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. Coming up, Michael McKee, Bloomberg International Economics and Policy Correspondent. He's going to explain to us what's going on at the Federal Reserve. I think somebody stepped down. There's pressure on the Fed chair. What's going on there? Plus, we'll get the breakdown of some of the economic news coming our way. Steve Mann, Bloomberg Intelligence Global Autos analyst. Talk to us about Tesla. I mean, they're locking Elon up even more. $30 billion in stock. That'll do the trick, I think. Don Steinberg will join us, founder and CEO of Agecroft Partners. Talk to us about the private credit market and the extraordinary growth we're seeing there. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. Just when you thought all the trouble was finally behind Boeing, then you get another part of their workforce going on strike. They can't catch a break. So we'll break down what it means for Boeing and the all-important deliveries of 737 MAX. Right now, let's kick it all off with Lisa Mateo and get a Bloomberg Business Flash.
You got it. This Bloomberg Business Flash brought to you by IBKR. Will U.S. initial jobless claims exceed 220,000 for the week ending August 2nd, 2025? At IBKR Forecast Trader, the yes recently at 54%. Start predicting today at ibkr.com/forecast. The last trading day for this contract is August 7th. All right, we've got more economic data coming out. We'll start with factory orders for June. The expectation was for a drop of 4.8%. Well, came in just on target, a drop of 4.8%. Durable goods orders Waters. That was expected a drop of 9.3%, dropped about 9.4%, so a little bit more of a drop there. Stocks started the new trading week higher. We're also on records watch, so let's get right to it. We'll start with the S&P 500 up more than 1%, 72 points at 6,309. We have the Dow up 0.9%, 397 points at 43,985, and the Nasdaq up about 1.5%, 333 points at 20,983. The two-year yield 3.69%. That's up 1 basis point, and we have the yield on the 10-year 4.22%, and that is little change. The Bloomberg Dollar Spot Index, that's down about 0.1%. Stocks in Switzerland, they're falling. Concerns President Trump's punitive 39% export tariff on the country will affect corporate profits. But now you have the Swiss government saying it's ready to make a more attractive offer to the U.S. So we'll take a look at some of those movers like watchmaker Richemont. Its shares down more than 1.5%, and Swatch down nearly 2%. Also, chocolate and coffee companies like Lindt, their shares off up nearly 1%. And we're also keeping an eye on shares of drug makers like Novartis and Roche. Those are lower. Drugs still exempt from those new tariffs for now, but Swiss officials are saying they could still face separate levies. And finally, keeping an eye on Tesla shares. They're up nearly 3%. The company approved interim stock award. Paul mentioned it, worth about $30 billion for Elon Musk. It includes 96 million shares that will vest. Here's the thing, if he continues to serve as a lead for another 2 years. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Paul and Nora.
All right, Lisa Mateo, thank you so much. We appreciate that. As Lisa was saying, we've got green on the screen here, stocks moving higher. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney with Nora Melinda, and we're joined by Bloomberg's Tatiana Darye. Tatiana, what are you looking at today?
Well, looking at three of consumer names here, telling slightly different stories. So we'll start with Spotify. Your ticker is SBOT, higher by about 6% after raising premium subscription prices outside of the U.S. And not because the U.S. has been spared, it's because they've raised them here last year and even twice. Well, this comes after the company posted a second quarter loss last week due to some higher expenses related to employee compensation. So investors and record labels have been encouraging the company to do this for some time. And here's a fun fact. Apparently, Spotify has some of the most loyal listeners out there. They are the least likely to cancel among the major video and streaming audio services in the United States, according to Antenna. So everybody loves their playlist.
Oh, for sure. Spotify? I'm Spotify all day, every day.
You gotta be.
I know. I'm not Spotify.
You're more like an Apple
Where are you?
podcast.
I don't. Sirius XM.
Do people still use Pandora? Is that a thing anymore?
I don't know. I mean, I still. I don't know. I listen to the radio.
But like Spotify has the Hulu Spotify bundle. You can do so many cool bundles that are, at least I feel, to be relatively reasonable.
No? Okay. Just listen to the radio. The next name is Tyson Foods. Your ticker is TSN, up 3% after raising its earnings forecast. Apparently, there's a boom in chicken consumption.
Because beef prices are so high.
Exactly, as consumers are trading down from those record high beef prices, and the company's chicken unit posted its highest adjusted profit since 2016. But the beef segment posted its 7th straight quarter of losses here. So, Paul, are you more of a beef lover or?
I like chicken, definitely.
healthier.
But you know, we do the steaks on the grill a lot. But I mean, you got to make more cows. I mean, I'm calling the ranchers out there. Like when we had the chicken problem, I said just make more chickens, and the price of the eggs will come down.
Okay.
Can't they just make more cows?
We need to get it together. I mean, when I think of Tyson's, I immediately think of their frozen, is it chicken nuggets or some wings that they used to do? I'm always thinking about the chicken side of them.
I'll talk to my rancher friends, see what we can do here. What else?
So the next name is Wayfair. Your ticker is W, up about 7%. The home goods marketplace posted a solid second quarter beat. Adjusted EPS really there above estimates. Bloomberg Intelligence is saying that the retailer may be on an upward trajectory. And I went back to look for tariffs because, you know, that's the main theme in this earnings season. And there was little evidence, executives said, of price increases. They say the suppliers are really hesitant to increase those prices as they see consumers pulling back. So I think that tells, you know, the sort of contrast with what we've seen from other companies who are able to pass along those consumers. But the CEO, they are noting that the higher end market is stronger So that sort of gels with the other macroeconomic data saying that high-end consumers are doing or holding up okay. The lower income ones might be more
I see
under pressure.
Stiefel saying that Wayfair has done an impressive job growing the online portion of its home furnishings category. That's all I've ever used. I didn't even know that people were going in store to Wayfair. I just do a nice little click of a button.
It's
hope for the best.
Omni-channel click, then you can go into the store. Tatiana Derrier, thank you so much for joining us. Tatiana Derrier, she covers the markets for Bloomberg News. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers of the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, Michael McKee, you know him, you love him, international economics and policy correspondent for Bloomberg News. I'm not sure he's prepared to offer any answers to what happened last week. President Donald Trump said he will announce a new Federal Reserve governor, because one stepped down, and a new jobs data statistician, because I think he fired that person, in the coming days. Mike, what's going on down in D.C. in your world of economic statistics, data? Don't we kind of depend upon that stuff?
We kind of depend upon that stuff, and it's a bit of a surprise that the markets have rebounded somewhat today because there was a feeling among some people that maybe statistics matter. But at this point, I think the feeling is the overwhelming view of people in the markets is that firing the head of the commissioner of the Bureau of Labor Statistics is a terrible thing to do because it implies that you want to fix the numbers, but the process of doing so would be almost impossible because there are too many civil servants who've dedicated their lives to this stuff that you would have to replace, and you're not going to be able to find those people. So I think the feeling is generally that the danger is not as great that we get fixed statistics. It's just that the idea that if you don't like the numbers, you can fire somebody is sort of, as Janet Yellen put it, banana republic.
Right.
I mean, when we think about the BLS head, I mean, of course, a lot of the allegation here is that their actions are politically motivated. When we think about the BLS and just all of these entities more broadly, are they typically politically impartial?
Yeah, they're politically impartial, and most of them have been working for decades under both Democrats and Republicans. And every so often something like this comes up. Back in Obama days, Jack Welch, the late Jack Welch, argued that the jobs numbers were politically distorted, and he ended up apologizing for that because it was shown to him that they were not. There are always times when the statistics can be a little funky. It's also a time when they're having a hard time because business response rates are so low that they're having to do some extrapolations. But it doesn't mean that the numbers are politically manipulated at all. And there's no evidence of that. The evidence the president has cited over and over and over again is just wrong. I mean, he either doesn't know or he's lying about the numbers because he keeps talking about the number right before the election last year. Well, the BLS reported 12,000 jobs was all that were created in October on November 1st, and Election Day was November 5th. So that, I mean, if that was politically motivated, it was motivated to hurt Kamala Harris.
What's going on at the Fed? We had a governor step down. Can you explain what that was? Was it unusual? How should we think about that?
Not completely unusual, but because most governors don't make it to the end of their term. Their terms are 14 years, and people don't tend to last that long. They can be longer than that if you're appointed to fill an unexpired term and then reappointed. We don't know exactly why Adriana Kugler decided to resign now. Her term is up at the end of January. She had personal reasons, they said, for missing the last Fed meeting. It's also true that she's going back to the Georgetown School of Business, and perhaps she just didn't want to miss the fall semester. And some schools have tenure rules, so she may have just decided, I'm going to be gone anyway, so might as well leave now.
Is this shaking things up at all? Is it raising any alarm bells right now in Washington, or
that's not? And she was seen as a fairly reliable hawk who would vote with the chair, so replacing her isn't going to make a big difference. And the other thing is that it's not going to be as easy to replace her as some people out there think. whoever is appointed to the Fed has to be confirmed by the Senate. You can't do a recess appointment.
And that could take a minute?
And that could take a minute, especially since the Senate at this point is on vacation. And then they come back in September to a budget mess, which might end up in a government shutdown. And so you probably, in October, get to the replacement's confirmation, if then. Okay. And then at that point, you only have one more meeting left this year. So does it really matter all that much? I don't think so, except that people will assume whoever is appointed will be the chair in waiting to replace Powell.
Interesting. Okay.
Interesting. Okay. All right. We'll stay on that story as well. Michael McKee, international economics and policy correspondent, Bloomberg News, joining us live here in our Bloomberg Interactive Brokers studio. So the Fed needs a new governor, and the BLS needs a new chief.
A new head.
And so there's some moves to be made down there in Washington, D.C. It was certainly a busy end of late last week on that front as well. S&P 500 up 72 points. That's 1.1%. The NASDAQ doing a little bit better, up 340 points. That's 1.7%. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. We've got stocks advancing this morning. This has traders become a little bit more optimistic about Fed rate cuts. We have the NASDAQ up more than 1.5%, 345 points. The S&P 500 up more than 1%, 72 points. And the Dow up 0.9%, 399 points. Let's head to the IMAP feature for a closer look. So if you head to the terminal, 10 of the 11 major industry groups trading higher. The biggest pull coming from information technology. You click through, you go to semiconductors, and at the top of the list is NVIDIA. It shares up about 2.5%, and right below it is Broadcom, ticker AVGO. Those shares up about 2.5%. Going to oil. We have Brent crude falling more than 1.5%, $68 a barrel. As far as gold rising, COMEX gold up 0.8%, $3,429 an ounce. And the Bloomberg Dollar Spot Index down about 0.1%. Quick look at earnings. We go to shares of Tyson Foods. They're up about 3.5% to raise its earning forecast. Quarterly profit unexpectedly rose. Chicken continues to offset those losses in the beef business. And shares of Wayfair, they're up nearly 7%. Top earnings revenue expectations again. This was Wayfair's highest revenue growth since 2021. And on the flip side, you have shares of ON Semiconductor. They're taking a hit, down nearly 9%. It's the maker of power chips and sensors. Reported adjusted earnings per share for the second quarter that matched estimates. Looked like investors, well, they were hoping for a little bit more than that. After the close, we move on to Palantir and Hims & Hers Health. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is your Bloomberg Business Flash. Paul and Nora.
All right, Lisa Mateo, thank you so much. We appreciate that. Norma, Linda, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. How about this? Tesla approved an interim stock award worth about $30 billion for Chief Executive Officer Elon Musk to keep his attention on the automaker. I would think that would do it. Steve Mann joins us. He covers all the autos companies for Bloomberg Intelligence. He's down there in Princeton. Hey, Steve, I mean, I can't think of a company, maybe, I don't know, since maybe Ford Motor Company, where there's a key man risk like Tesla here and Elon Musk. What do you make of this stock award here?
Yeah, I think it's very positive news for Tesla because, you know, they are going through a pivot right now. Not only an automaker, but they're very focused on AI. But if you look at Elon Musk, you know, Tesla is not his only business, right? He's got xAI, his AI company, which owns the former Twitter, and he also has, you know, SpaceX, Neuralink. I think they're all related in some ways to AI, and I think, you know, without Elon Musk and Tesla, I think, you know, there's going to be a lot of risk to that vision for Tesla without him there.
Steve, you mentioned that there are a lot of different things that are vying for Musk's attention. Of course, we do know that he was really politically involved, and then we thought kind of pulled back, and then he mentioned his intention for creating the America Party. So clearly he still remains in these conversations here. But what are investors looking for right now from him? And does it seem as though his attention is devoted as much as it should be to Tesla?
Yeah, I think fortunately for now, his attention is very much devoted to Tesla. And he said that at the second quarter earnings call. I think you know, his presence is important because you know right now the company's going through a changeover in terms of the direction, the strategy, right? You know, cars has been very important, continues to be important to drive that AI theme. But without Musk there, I think the company will have to, you know, won't able to find the next person really to drive the company to the next step in expanding robotaxi, expanding their Optimus robot offering in the future.
Do we care about how many cars they make and whether they make any money in the old car business, Steve?
We do. And you know, a lot of people think that you know it's a full pivot towards AI. But I think making cars and developing that AI software goes hand in hand. It's almost like Apple and its ecosystem. I mean, there are opportunities for Tesla to actually license the FSD, the full self-driving software out. But I think in the meantime, it's not something he's looking to do. I think he wants to build out robotaxi internally and actually drive revenue and profits. He does see huge profits from the robotaxi and from the FSD software. If you look at other software companies, margins are high double digits on the software for any software. But then with his FSD software, the car is an integrated component to it. It's very important that he continues to make cars not only for cash, but for really marketing that software that he has.
Steve, a lot pressuring Tesla over the last few months. I mean, we're looking at a stock that's down about 23% so far this year, and it's the worst performing stock within all the Mag 7 stocks that there are right now. Explain to me right now what the latest overhangs are right now for the company.
Well, I think one big overhang that's been removed is his pay package. There is a lot of fear in terms of him potentially being kicked out of Tesla. But I think the biggest overhang right now, or where the investors are more focused on, is the expansion of robotaxi. Right? He launched it back in June in Austin. He's launching it in the San Francisco Bay Area, and he's also thinking about launching it in Nevada. And it's from the looks of it, it's going quite well. I mean, there are some hiccups here and there with this complex engineering system that he's putting in place for cars. It's normal. It's normal. So, but safety is still his priority, and he's going at it at a measured pace. But it seems like he's expanding it relatively fast. The area of coverage is much bigger than it initially was back in Austin back in June, and we're seeing something similar in San Francisco. So investors are really focused on when robotaxi will start contributing to the bottom line, and we think that probably more likely in 2027.
Steve, thanks so much for joining us. Always appreciate getting a couple minutes of your time. Steve Manning covers all the autos for Bloomberg Intelligence. He's safely ensconced down there in Princeton, New Jersey. Coming to us live in the Bloomberg Interactive Broker Studio, Donald Steinberger, founder, CEO of Agecroft Partners. It's tough to get you out of Richmond, Virginia, my friend. I mean,
Richmond?
Yeah, which is
VA.
Awesome. I went to the University of Richmond. I lived down there, worked down there. My twins were born there. It's a great town.
Special place.
Don, talk to us about this private credit business. I was talking about ETFs, were one of the really coolest innovations in my 35 years on Global Wall Street. But right there with ETFs is in private credit. Talk to us about that business and kind of what your clients are telling you these days.
Well, first of all, it's had amazing growth. It's grown 400% over the past decade. Currently, it's at 1.8 trillion in assets. It's expected to grow another 500 to a trillion over the next 5 years. It's gotten a lot of interest from large institutional investors. They're beginning to get into the retail marketplace. And, I'm an advocate of private credit, but I think a lot of the risks are misunderstood in private credit. And I think you got to be really smart in allocating to it, or you potentially could lose a lot of money.
What are some of those misunderstood risks?
Well, when you think of private credit, a lot of people look at the historical returns and they look phenomenal. I mean, there's no volatility. They're getting 10% a year, and they project that that's what's going to happen going forward. But in reality, there's a lot of potential default risks. And when the economy's doing really well, all these private credit funds look fantastic. But the economy turns, you could see some significantly bad performance from some of these. So you got to be really careful and make sure you understand what the underlying investments look like, because there are huge differences between the quality of loans that these funds are making.
Where's the money going? I mean, I guess when I think about the hedge fund business, even the private credit, I just think it's not a handful, but a relatively small number of firms are just sucking it all up. Is that the same in private credit?
It's even more so. I mean, it's the Blackstone, the BlackRocks, the Apollos, the Neuberger Burnhams, Carlyle's. And what is happening is there's significant competition for loans. They're allocating so much money that you've seen spreads come down. Typically, they're floating rate instruments above risk-free rate. You've seen 100 basis points decline in spreads. Right now, the big players are getting about 4.75% above the risk-free. Much better to go with smaller managers that are focusing on smaller loans. You can pick up about 100 basis points if you do that.
So what sectors right now are most actively targeted by private credit lending right now?
I mean, it's everywhere.
Okay.
You know, when you're talking 1.8 billion, you got to go over every market. Yeah. Excuse me, trillion. You know, the real estate market, a lot of money is going into bridge financing. There's a lot of money going to support middle-sized companies that are competing with banks. There's money going into the private equity market. A lot of them are buying companies on margin. Some of it's going to venture capital. Some of it's going to distressed debt. All of those things have different risk parameters. So one of the big mistakes people make is if you look historically, don't invest just in the highest returning manager historically, because they're probably taking the most risk and might do the worst if the market turns.
Private equity, there hasn't been a lot of monetizations, exits. The IPO market's been pretty fallow over the last several years. I haven't seen a ton of M&A. And if I'm a private equity investor, I'm like, I need to get my money back here with my return. What's going on in the private equity world in terms of kind of getting, you know, returns of capital to the limited partners?
So I just think it's a market that has grown historically or grown massively over time. There's a lot of dry powder. There's too much money going after deals. The expected returns for private equity has come down a lot. The IPO market hasn't been that robust. So yeah, I think if you're investing in private equity, your expected returns going forward have declined. And I do think a lot the flows into private equity have definitely declined. Some of these big institutions are selling their private equity exposure on the secondary market. Still a massive market, still a lot of money in it, but it's not as the demand is significantly less than it was 5 years ago.
You mentioned real estate. How active is private credit in CRE specifically right now compared to maybe like the traditional banks and whatnot? Of course, people had a lot to say about commercial real estate in recent years.
So I think it's, you know, becoming larger and larger. A lot of these real estate organizations are turning to private credit because it's easier to get loans. They're not able to get them from banks. They make quicker decisions. You don't have to have a good credit rating to get private credit. A lot of these private credit managers have pretty good collateral. You know, they're only lending maybe 60 cents on the dollar. So they are moving into the space. But again, I think if you invest in private credit, you should limit it to 10 to 20% of your assets and diversify across a bunch of different managers.
Don, thanks so much for joining us. Appreciate it. As always, Don Steinberger coming to our studios. He's the founder and CEO of Agecroft Partners, located down there in Richmond, Virginia, one of my all-time favorite towns. S&P 500 up 72 points. That's 1.1%. The NASDAQ doing a little better, up 1.6%. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Matei. We've got stocks rebounding from last week's steep losses. The Nasdaq leading the charge up more than 1.5%, 340 points. We have the S&P 500 up more than 1%, 73 points, and the Dow up about 1%, 431 points. The two-year yield 3.71%. That's up 2 basis points. The yield on the 10-year 4.22%, and that is little changed. The Bloomberg Dollar Spot Index down about 0.2%. A few companies making news this morning. CommScope has agreed to sell its connectivity and cable solution segment to Connecticut-based Amphenol. It's for about $10.5 billion in cash. That has shares of CommScope. They're soaring this morning, up about 67%. Amphenol shares, they're up about 3.5%. Warren Buffett's Berkshire Hathaway took a $3.8 billion impairment on its Kraft Heinz stake. Its cash pile fell to $344 billion, the first decline in 3 years. Berkshire shares are down nearly 3%. And Skydance Media announced a future executive team expected to lead that combined company following the close of its pending merger with Paramount. David Ellison will serve as CEO. The company also expected to be structured into 3 business segments: studios, direct-to-consumer, and TV media. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is your Bloomberg Business Flash. Paul and Nora.
All right, Lisa Mateo, thank you so much. We appreciate that. Norma Linda, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. All right. Workers at Boeing's St. Louis area defense factories are striking after union members rejected the company's modified contract offer. When I first read that, I was like, didn't we already do this?
I know.
But that is a further reading. I found out that was the commercial airplane union out in Seattle or whatever. These are the defense people. So just when you think, Boeing's kind of out of the woods, cleaned up everything, and stocks up 25% year to date, and then this comes along. So I don't know how to make it. George Ferguson, this is his job, Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence. George, how important, how big of an issue, how big of a headwind is this for Boeing?
Yeah, not much. So you're right. We did this before. The lion's share of the machinists, there's some 30,000 that were represented up in Washington, struck their deal last year. We calculate, this is about 6,000 machinists, again, compared to 30,000 up in Washington State. We calculate that if this 6,000 machinists get a similar deal as the machinists did in Seattle, which I don't see why not, it probably costs Boeing all in when it's all done in 4 years, when the members get 43-ish% increase, costs them an extra $200 million. For Boeing, look, everybody wants to preserve $200 million, but for Boeing, I think not that material. Plus, it's in the defense business. Some 40-ish%, 42% of that business is cost plus. So there's likely the ability to defray some of those costs through those cost plus contracts. So not that big of an issue, I think.
George, it seems like Boeing is always in the headlines nonetheless, though, whether it's internally what's going on with employees or what's happening with their planes here. Have things seemed to have gotten any better, at least internally? Is this a more, a newer strike, if that makes sense? Or have there been a lot more claims being made?
So I think you broke up a little bit on me, but I think you're asking if things are any better. But I think they are, right? I think we saw 2Q numbers for the company, and they're delivering airplanes. They're at 38 build rate, going to 42. The defense business has got some problems, right, with the fixed cost contracts. They still eked out a bit of a profit this year. They've made about $200 million operating profit so far this year, so it's about the increase in the cost here to the machinists. Now, look, the things should continue to get better at that defense business. They have that big fixed price legacy programs. Though there's some very important programs inside that legacy fixed cost program business that they'll be happy they have over the years. One of them is the Stingray. It's an autonomous refueler that works off Navy aircraft carriers. I think in the future, that'll be pretty important. The KC-46 is the tanker they build. That'll be very important as well. So I do think, this is no sign that things aren't haven't turned around. This is just one of the last stubs of their labor that, once there increases after the pandemic to cover that increased inflation, I think it's going to be a blip, I think.
George, you mentioned that there's still some things to iron out as it pertains to Boeing's defense business in particular, but how are they stacking up? How is their defense unit stacking up against a lot of the other different defense primes, like a Lockheed, for instance?
So, Lockheed just had a bunch of, at least one major charge in their last earnings and just got roiled by that. But I would say that, first, financially, they're just not performing very well compared to their peers, which I think, on the glass half full kind of side, you could say that they ought to have a lot of capacity to improve performance at that business. And they've got some, like I said, some pretty good programs. I just talked you through, that refueler, the two refuelers actually. But they won the F-47 contract where they're going to help develop the next sixth generation fighter. That's going to be some $20 billion, we think, over the next 4 years. That's going to be largely cost plus. That's a great contract. That will improve their fighter business. They build F-15s and F-18s. Those are sort of sunsetting, but they're very, very capable fighter jets. We've seen countries around the world order them and use them very effectively. So the defense business has, again, those glimmers of hope because there's a strong product portfolio there. It's just been eclipsed again by some of these fixed price contracts that they've really, sort of messed up under Muhlenberg, and now need to sort of get reordered, get some of them off of the books and get going. But it's a good business.
Hey Jeff, George, how has the global defense prime business changed just in the last 6 months with President Trump getting agreements from a lot of big European countries to up their defense budget? Presumably, if the Germans are spending more, the French are spending more, they're probably coming to the U.S. defense primes. How has the world changed, if at all?
So we think so. So, I think right now the debate is, can Europe really provide all the defense products they need to be, to create a credible deterrent? Or do they need to go outside the bloc in order to buy capability? We think they need to go outside the bloc to get capability, especially sort of the most important capability, currently. And I think that some of that most important capability is air defense, and U.S. defense companies do very, very well. They've got very advanced products that they've built through a number of generations of those products. That have shown their ability over in the Middle East. And those are going to be like RTX, Raytheon, very strong in interceptors, radars. Lockheed as well is in that business and is going to do well. And we've seen the orders come from Europe for that. I think some other things that Europe needs, they'll probably get largely at home. Things like armored vehicles, tanks. The Europeans build some very capable products there. I think they'll buy them at home. Fighter jets are a little bit different, right? Europe doesn't build a stealth fighter yet. They have 2 programs in the continent that they want to build. They'll take a decade to build. In the interim, they'll buy the Eurofighter out of Airbus, Leonardo, BAE Systems. A consortium builds that, but they're also buying Lockheed F-35s because they don't have any stealth technology in Europe right now. They need that Lockheed stealth technology, so they'll buy some of those in the interim. So I think that's exactly what you're going to see out of Europe as a mixed buy, but I think it's going to be a big improvement for the U.S. primes because Europe was spending nothing on defense, and now they'll spend $800 billion, right? They'll go from $300 to $800 billion over a short number of years. I think it'll give the U.S. primes a lot of opportunity, and European primes will have to ramp up pretty quickly.
I think that means we have to send George over to Europe even more frequently to go to some of those boondoggle
so we can see the lay of the
shows.
land
Exactly.
there.
George Ferguson, Senior Aerospace, Defense, and Airlines Analyst. He covers it all, folks, and he's at Bloomberg Intelligence, one of the best on the street. We appreciate getting some of his times. Markets, hitting the intraday highs here. We got the S&P up 76 points, 1.2%. The NASDAQ up 335 points, up 1.6%. So that sell-off we saw Friday.
Shaking it off.
Shaking it off here. I think people, as Michael McKee said, kind of recognize that, the data is what the data is, and it's tough to kind of manipulate it. And I think that's kind of what people are coming to recognize at this point. We'll have more coming up. This is Bloomberg.
listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, Norma Linda, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. American Eagle shares rally as Trump touts Sweeney ad campaign. Mike, ad campaign? No, not me. Right?
He said, not you.
No, Sydney Sweeney.
Sydney Sweeney. Close, though.
She's an actress.
Yes.
Okay.
Euphoria.
All right. Mary Ross Gilbert. I'm throwing it to Mary Ross Gilbert. It's her problem here.
She'll
Senior
tell us.
equity analyst covering retail for Bloomberg Intelligence. Mary Ross, what's going on with our good friends at American Eagle here? Is this a meme stock now?
You could say that it's partly meme, right? Because the stock today is up 12%, and it started running up over the past couple of weeks when the new Sydney Sweeney ad campaign, and that debuted on July 23rd. But if you look at where the shares are, they're up 14% today, but they're down 34% year to date and down 44% over the past year. So it's not like it's kind of out of that negative territory, you know, based on where the shares are today. And that really had to do with some, you know, execution issues in the first quarter. They got some assortments wrong, and they had to take heavy markdowns to move that out so that they could be in a good position in the second quarter. When we look at the sales for the second quarter, and it's over, right? But in our data, we have a 5-day lag. But when you look at the data, their sales look like they're tracking up about 1.6%. And that compares to consensus for -6% and guidance of down 5%. So they're tracking ahead of that. And when we sort of look at when the campaign debuted, they were tracking at close to up 1%. So they did get a little bit of a lift from the campaign. So I think, it's been controversial, but we think the controversy over the campaign, saying that it's more than just about jeans, we think that's inaccurate and overdone, and we think it's all about jeans.
So talk to us about the controversy. For those who aren't aware, what exactly is going on here, and why is President Trump making a comment here today?
Well, first of all, just to address your question, Nora, on President Trump. President Trump basically said that she's a registered Republican, and that's what he was sort of Xing about, right, or tweeting about, whatever you want to call it. And so that's really where that comes from. With regard to the campaign and the controversy, there's a reference to genes, in that your hereditary genes, when really it's meant to be a pun, and the company does use the word denim jeans, spelled Jeans. And so some of the media has kind of run with it and said, how can this company whose DNA is really based about, think about their brand Aerie, which is about being real and being who you are. But, when and this campaign has got sort of a sexy connotation, but, I think that women like to feel sexy too. So, and these are young women. They're really targeting Gen Z. And so, and look, if you see what's happening with the campaign, it's created billions of media impressions. And on YouTube with their ad campaign, they already garnered in less than 2 weeks 4.6 million views. So that looks pretty strong.
Definitely. When you think about the strength here of the consumer, can you just speak about how much of an impact here retail shoppers, consumers here really have on these companies?
Yeah, so, with the consumer, we're seeing real resilience, right? We had some weaker jobs data that came out on Friday, but we're still at full employment when you think about it. When you have unemployment rate in the low 4s, we're really at full employment, and we're seeing a lot of resilience with the consumer. It really comes down to having good fashion, the right product, and you'll get your sales. And American Eagle is greatly positioned, being in the value segment. You really get good value, and I think they're positioned well for back to school, given their core customer base.
You're out there in Los Angeles. I know the schools go back there early. So back to school, but more importantly, holiday season. What's the early read?
Well, we don't have like an early read, but generally I'm still optimistic about the consumer. I am not seeing anything out there that tells me that they're not resilient. And when we look at the surveys for back to school, apparel is one of the largest categories they plan to spend on, and where they might be lowering their spend in certain categories, it's not apparel. We're actually seeing an increase in what consumers are saying in these surveys for apparel. So I think it's very important when they think about, heading back to school, that they look good.
Yep. All right, Mary, thank you so much. We appreciate that. Some things never change. Mary Ross Gilbert, Senior Equity Analyst, covering all the retailers for Bloomberg Intelligence. She's based out there in our Los Angeles bureau. President Trump is out with a tweet. Quote, Trump to hike India's tariff rate for buying Russian oil. And I go to his tweet that is out there, and this is a quote from President Donald Trump. India is not only buying massive amounts of Russian oil, they are then, for much of the oil purchase, selling it on the open market for big profits. They don't care how many people in Ukraine are being killed by the Russian war machine. Because of this, I will be substantially raising the tariff paid by India to the USA. Thank you for your attention to this matter. Triple exclamation points. Signed, President DJT. So there you go. The latest tweet from President Trump on the ongoing tariff issues and policies coming out of the White House. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now. Good morning. This is Bloomberg.
This is Bloomberg Intelligence with Paul Sweeney.
The semiconductor business is a really cyclical business. The market's telling me, here's another AI play. Just bid it, buy it. Is the market over their skis? Are people just too exuberant out there?
Breaking market headlines and corporate news from across the globe.
This was a big success story for Apple.
We like bonds. We think bonds are attractive.
Private markets have become very diverse.
What we're telling people is be cautious here.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, Norma, Linda, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Coming up in this hour, Nathan Dean, Bloomberg Intelligence Senior Policy Analyst down in Washington, D.C. I just kind of throw it to him and say, Nathan, what's going on down there in D.C.? What do we have to pay attention to? And he sets us straight, so we'll talk to him. Matthew Palazzolo, Bloomberg Intelligence Senior Analyst covering the insurance companies. Talk to us about Warren Buffett. Mr. Buffett and Berkshire Hathaway, they reported numbers. My big question is, will Warren Buffett and Berkshire Hathaway, through their ownership of Burlington Northern Santa Fe Railroad, will they get in on this M&A activity in the railroad business? That's really what I want to talk about. Margaret Patel, Senior Portfolio Manager at Allspring Global Investments, will get her market outlook here. Mike McGlone, Miami Mike, Bloomberg Intelligence Senior Commodity Strategist, talk to us about what's going on in the global oil business. Again, oil's weaker again today. OPEC ramping up production yet again. Why would they do that? I don't know. But we'll talk to Mike and we'll get the latest there. But let's kick everything off here with a Bloomberg Business Flash with Charlie Pellet.
Hi, thank you very much. And here's what's going on. We have got the Dow, the S&P, NASDAQ, all advancing. We are just about best level of the day on this Monday morning. S&P right now up 71. For the S&P, that is a gain of 1.1%. Dow Industrials pushing higher by 466 points, up now by 1.1%. NASDAQ up 302 points for the NASDAQ Composite Index. That is a gain right now of 1.5%. 10-year at 4.21% with the 2-year 3.70%. Gold is advancing $11 the ounce, up 0.3%. And West Texas Intermediate crude 66.76 a barrel. WTI down by 0.9%. And repeating the headline that Paul brought us moments ago, President Trump says he will substantially raise the tariff on India, citing the country's purchases of massive amounts of Russian oil. So it is an update on this Back to Work Monday. As for the market backdrop, Rayanne Mitrione is a partner at Callan Family Office, and she was a guest this morning on Bloomberg Surveillance.
When you see a lot of euphoria, that's usually a good time to be concerned that maybe we're getting close to a top. But there's still, we're still seeing some volatility. We're still seeing some concerns, and it hasn't been a market where everything has been moving up the same.
And again, the S&P at 63.11 right now, up by 1.2% with a 10-year 4.21%. Tesla shares are gaining. Tesla has approved an interim stock award worth about $30 billion for CEO Elon Musk, a massive payout meant to keep the billionaire's attention on the automaker as a legal fight over a 2018 pay package drags on. Again, we've got Tesla up now by 0.7%. Recapping, S&P up 1.2%. And for on-demand news 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much for that. We appreciate it. Norma Linda and Paul Sweeney, we're here in our Bloomberg Interactive Broker Studio live, also streaming live on YouTube. Head over to youtube.com and search Bloomberg Live Radio. That's where you'll find us. As Charlie was just mentioning, we got a risk-on day today for sure. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Norma Linda, and we're joined by the pride of Romania, Bloomberg's Tatiana Darie. Tatiana, what are you looking at today?
Yeah, I'm back with a mix of names here, slightly different stories. So we'll start with American Eagle. Your ticker is AEO, is up about 16% today after President Donald Trump came out in support of the controversial ad from the company, posting on Truth Social that, quote, Sydney Sweeney, a registered Republican, has the, quote, hottest ad out there. And apparently the backstory is that he was on board of Air Force One. A reporter asked if he has any thoughts on Sweeney being a registered Republican, and then he said, surprisingly, he said, I didn't know that, but now I like her ad, basically, which prompted his post. And just a reminder, that's about a controversial ad that plays on the word genes being passed from parents to offsprings, which sparked a backlash online for having racist undertones. Well, Bloomberg data actually showing that that there hasn't been any impact on sales. And now with the president coming in favor of the ad, investors are bidding the stock.
Yeah, definitely seeing a pop here, but when you look on a broader scale, down 38% year to date. So really interesting move that we're seeing here. But you're also looking at a stock that's constantly soaring, Palantir.
Yeah, exactly. The company reports after the bell, and it's an important name, you know, for the market as a whole, because it's the 5th largest contributor to S&P 500 returns this year. Shares up more than 100% this year, so expectations there are really high. Bloomberg Intelligence noting in this preview that continued momentum in sales growth is needed for Palantir to keep its premium valuation among enterprise software peers, saying it's seeing traction in the commercial segment. It needs to continue that, but that may be offset by slowing revenue abroad and a possible competition at the Defense Department, which has been awarding big money contracts to competitors, OpenAI, Anthropic, Google. So we'll see what Palantir has to say about that.
Yeah.
TSLA, Tesla.
Tesla. We have to talk about Tesla. It rallied more than 3% early. It has been losing some steam here, but it's after the board approved an interim stock award worth about $30 billion for CEO Elon Musk. Those shares will vest only if he stays on board for another 2 years. The news is taken positively by investors and analysts, saying that it removes an overhang on this stock, that Musk is Tesla's biggest asset. But of course, the other news hitting the tape today is that China shipments are falling again amid intense competition. So that is taking some of those shares lower. And, you know, that underlines how much work there is to be done for Musk to
I
prop
assume
up
that
those
the
sales
company is
again.
now reincorporated in Texas, whereby so that this pay grant will be okay, whereas when he was incorporated in Delaware, it was subject to legal blockage. I don't know.
They're certainly making an effort here, and they're considering this is part of a larger package, which will be put up for a vote at the company's meeting there in November.
All right, great
Looking
stuff.
for his attention.
All right, Tatiana Dare, strategist for Markets Live at Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen here. Nathan Dean, I don't know. I think he's got the worst job at Bloomberg Intelligence. He's down in D.C. where it's a swamp. Literally, they built the city on top of a swamp.
So hot.
And he has to figure out what's going on in Washington with all the policy changes coming out of the Congress, coming out of the administration.
But he knows it all.
He knows it all somehow. Nathan Dean, senior policy analyst for Bloomberg Intelligence. Nathan, where's your focus these days?
So it was going to be moving away from tariffs, but obviously with President Trump's social media status this morning, there's two things that we're telling investors they should look out for. First is Bloomberg News is reporting that Switzerland is trying to make a deal before these tariffs go in later this week. And then subsequently, you saw President Trump announce that the potentially tariffs on India will go up in terms of price or for purchasing Russian oil. But then after tariffs, then I would say is let's start talking about September, because we have August recess. There's a lot of things that aren't going to be happening in Washington, but we are anticipating a chaotic September because the government runs out of money on September 30th, and Congress will need to agree on a package to extend that. We potentially could have a government shutdown.
So, of course, we did get that headline that came out earlier that you mentioned, Trump hiking India's tariff rate for buying Russian oil. How big of a deal is this right now?
So I think it's a big deal, but also I would just say is that this really is just continuing the playbook of President Trump's usage of IEEPA, the International Economic Emergency Powers Act, which is obviously something that's going through the courts. And our analyst, Holly Frum, is saying, obviously the courts are beginning to look a little bit less certain in terms of authorizing President Trump to use this IEEPA. The other thing I would say is this sort of takes the wind out of Senator Graham's bill on tariffs. Senator Graham had a bill on sanctioning Russia, for example, that would give the president authority to move up to 500% tariffs on any country that buys Russian oil, so India, China, and Turkey. But if President Trump is coming out here and saying, look, I'm going to do this anyway, it sort of just makes the bill moot. So again, I would say is that this is one of those scenarios where we have to follow the process of what President Trump is trying to say here. I don't anticipate this is going to be the end. Any statement that President Trump says in terms of increasing these tariffs, probably in the next day or two, you're going to see a subsequent decline or at least a change of behavior as these negotiations take place. But again, it's just something that the markets are used to, and this uncertain time continues.
Government shutdown here. You got my attention when you talk government shutdown. What percentage odds, because I know you like to do this, what percentage odds do you think that would occur?
Yeah, so I'm at a 40% chance, which is probably a little bit higher than what some other folks are saying out there right now. But look, we have a lot of angry Democrats in Washington at the moment. And let's play out how September works. There's a fight over timing of confirmation of candidates. And we anticipate the Senate Republicans are going to try and change Senate rules to speed that up. That's going to happen probably first thing when the senators get back in September. That's going to make the Democrats upset. Secondly, you're going to probably see statements from the OMB director, Russ Vought, trying to make, he's already come out and said he wants the bipartisan aspect of appropriations to be less bipartisan. So I would anticipate additional rescissions packages being announced in September. This is going to make both parties somewhat very angry with the opposition here. But the reason why I don't think you're going to get a government shutdown come September is if I'm the Democrats, I don't see where the exit strategy here is. If the shutdown does occur, there's a lot of people in the White House that say, look, if 85% of the government is now deemed non-essential, then why do we even need to have 85% of the government? And also, I think that this is one of those situations where come we get close to September 30th, neither party is going to be in position to really articulate what they want. And as a result, the most likely thing happens, they kick the can again, most likely to December or March.
All right, there you go. Nathan Dean breaks it down for us. We ask him to say, hey, treat us like we're 5-year-olds. Break down what's going on, and that's how we kind of understand it. Nathan Dean, he covers all the policy coming out of Washington, D.C. for Bloomberg Intelligence. Literally nobody better than we talk to on that kind of stuff. All right, they had a little earnings from Berkshire Hathaway over the weekend. Why did they do it over the weekend when nobody else does it? Because it's Warren Buffett. He can do whatever he wants, basically. Matthew Palazzolo, that ruins his summer weekend. He's a senior analyst covering all the insurance guys for Bloomberg Intelligence. We'll get to the earnings, or maybe we won't, because all I want to talk about is what is Burlington Northern Santa Fe, which Berkshire Hathaway controls, what are they going to do in a world where it looks like we may have some consolidation and get cross-border rail service? What's the company saying about what they might do at BNS?
So they're saying characteristically nothing. Okay. But what we think and what the market's thinking is, I would say this, Buffett is, I would put almost a 0 probability of Buffett getting involved in a bidding war over Norfolk Southern, right?
Norfolk Southern.
Yeah,
Norfolk.
so he... Yeah.
Pronounce it correctly, Norfolk.
So I don't think he's going to try to outbid UP on that one, right? Like, that's just not what Berkshire does. But then the speculation is CSX is the other thing out there. And I'm not a railroad analyst, but we've done some work on it, only on the weekends. Our rail analyst thinks that Burlington Northern will be at a big disadvantage should this deal go through with UP, and that they would have to do something. That would leave CSX out there, which is the other East Coast Railroad, and then Berkshire's got the West Coast Railroad, so they could maybe merge those two. The stock of the market believes this too, because the stock of CSX is up like 25% since this initial bid. Again, like as a Buffett watcher and studier, I kind of feel like I feel like he would want to sit this one out. But if I could exactly predict what he would do, then I wouldn't be taking the Metro North into work. So
tell me about it. So if this were to happen, though, how big would it be for Berkshire?
Yeah, so the enterprise value of CSX is about $85 billion. So that would assume no takeout premium right now. Berkshire has $344 billion of cash. So they could theoretically do it in cash if they wanted to. It would take a big chunk out of their cash. Buffett's got only a few months left as CEO. He will step down at the end of the year. And he still remains as chairman, so I can't imagine that he would be, completely uninvolved. But, I would assume heir apparent Greg Abel would have a lot to say about any potential deal.
All right, I'm speaking as a former railroad analyst, which my tenure there covering the industry ended in 1989 when I went to business school. He has to do the deal. He has to do it with CSX.
Yeah, I mean,
I mean,
they have the money. I mean, they buy it in cash. I was just running some back of the envelope. It's going to be accretive to earnings versus just holding it. And if interest rates are going down, that makes it probably perhaps more attractive for them to do something. It'll be interesting. He wants that one last elephant, and that this would certainly be it.
Boy, and now to me, the whole thing is most important person in this whole discussion is Jennifer Rhee at Bloomberg Intelligence. She does the antitrust ruling, and I don't know how this stuff gets approved other than Trump says, I want it done, and then the Surface Transportation Board just follows suit.
I think they have some game theory there, right? Because, I talked to Lee, our railroad analyst, BI, and he was saying it seems like an uphill battle. He's not the antitrust like Jennifer. But, does Berkshire sit back and say, well, maybe this just doesn't even get approved, so why are we going to launch a bid for CSX that might also not get approved? I don't know. I mean, they have a lot to think about in Omaha.
I mean, who's left in the landscape, right? You've got Berkshire. I mean, we've got these other names. Who are the major players outside of that?
Are we talking about for railroads?
No.
Not exactly my expertise, but I don't think there's anyone else that would
just a bunch of short
be able
lines.
to
That
do
has
it.
to
So,
all right, let's get to the earnings. Any takeaway here? Hey, what's the cash position, and what are the earnings trends for this company?
So cash position $344 billion. It was down a couple billion from last quarter. So they took a write down on their Kraft Heinz investment. It's getting a lot of press. People are, I think, attributing the stock decline in the quarter to that. I mean, the net after-tax write-down is 0.6% of Berkshire shareholders' equity. So the stock's down 3% on that. It doesn't really make a ton of sense. They account for the Kraft Heinz investment in the equity method, which meant they were holding it for much more than the stock was worth. Because of those rules, they have to write it down eventually. So I'm not shocked. I don't necessarily think this is a vote of no confidence in the stock holding. It's kind of the accounting. The earnings were like 11 billion, that's stripping out a lot of the noise. That's pretty much exactly what we thought they were going to be. But there were some moving parts. Insurance was weaker than I thought. The railroads were better, and even retailing was better.
All right. You stay close to the phone because I want to talk to you about this railroad thing here, and we'll get Lee Klaskow on. We'll get Jennifer Rhee on because you can argue transcontinental railroad. Why don't we have one in this country? I mean, come on, let's be honest.
It's 2025.
Yeah, exactly. I'll come out of retirement and get this deal done if you need be. Matthew Palazzolo, Senior Analyst, Property and Casualty Insurance for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio. Again, Berkshire Hathaway reported some numbers over the weekend, and the focus is what do they do with their cash? That's kind of always been the story. Well, maybe they can double down on the railroad business. Why not? S&P up 72 points, 1.1%. The Nasdaq's up, call it 300 points, 1.45%. Looking at the VIX, the Tom Keene VIX, we're now sitting at an 18.24, below the 20 where we were yesterday, Friday. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks higher. We're trading close to session highs. And this Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitments, see if your company qualifies at oracle.com/Bloomberg. A renewed wave of dip buying lifting stocks after a slide fueled by weak jobs data. Traders wading through solid earnings reports amid bets that the Fed will soon be cutting rates. The S&P right now is advancing by 69 points at 6307, a gain now of 1.1%. The Dow up 442. That's an advance of 1%. NASDAQ, the outperformer, up 1.4%, higher now by 297 points on the NASDAQ Composite Index. Our Mag 7 Index pushing higher by 1.5%. The 10-year right now at 4.21%. The 2-year, 3.71%. Gold is up 0.3%, 33.74 the ounce. And West Texas Intermediate crude down 0.9%, 66.70 for a barrel of WTI. Joby Aviation shares now up by 20%. Joby planning to buy helicopter rideshare operator Blade Air Mobility for as much as $125 million in stock or cash as the electric aviation pioneer seeks to expand its battery-powered air taxis into a ready-made market for its aircraft. Again, Joby trading higher by 20.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Norma Linden, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Looking at the EA function for the S&P 500, we've had about 335 of the 500 companies report earnings. Earnings growth, it's kind of like 8-9%. It seems pretty solid, and at least for today's market. It's good enough for today's market, but is it good enough for the pros out there as we think about valuations across the board here? Margaret Patel joins us, Senior Portfolio Manager, Allspring Global Investments. She's up there in Boston. Margaret, what do you make of this earnings season so far? Is it enough to kind of propel this market forward, or are you concerned here?
No, I think the market will continue to chug along. And really, as you pointed out, corporate earnings have been very good, say 9-ish% so far. And that's with economic growth. If you average the first 2 quarters, say modestly positive. So that says in a 1 to 2% economic growth, corporations can produce earnings of say 9 to 10% even. So I think that says the equity market continues to move higher over the balance of the year.
What are you thinking just more broadly right now in terms of the strength of the equities market?
Well, I think it's going to continue to be the trend we've seen certainly over the last year or so, which is not all sectors will participate. So that's why you'll continue to see the tech sector very, very strong, communications, industrials, which has really come up a long way, and also some parts of even the energy sector related to gas, and those centers, of course, related to the data centers, expanding the electrical grid. So I think those companies will all do really well, companies that benefit from the much lower CapEx treatment in the new tax bill. So that says there's plenty of room for the equities to move higher, especially with treasuries at this really pretty low rate.
You mentioned treasuries here. How are you thinking about the fixed income market here as the treasury market versus maybe taking some credit risk?
I don't think there's much risk in the fixed income market pretty much across the board. If you look at high yield bonds, default rates are only about 2%. So that's really about as low as you've had historically, period. And if you look at, say, investment grade bonds, actually, you could say the market's starved for supply. Year to date, the investment grade part of the market has actually shrunk because new issue supply is less than coupon payments, calls, and bond maturities. So you might say there's a little drought there. Same thing in the high yield market. And when you look at the treasury curve, you know, you don't have to be a treasury wizard to say there's something askew when you have the 10-year bond trading slightly below the lower band of the overnight Fed funds rate. And when you look at the short term, 2, 3, 5, 7 years, they're all well below that 4.25%, 4.5% of the funds rate. So I think the market is crying out and saying lower rates in Fed funds is really appropriate, just looking at the treasury curve.
Speaking of rates, how are you thinking about the health, the resilience of corporate America right now as we're through earnings season, as we're in the middle of it? What are your main takeaways?
I think the economy looks in great shape. Corporations, U.S. corporations, thanks to restructuring their balance sheets over the last year, have a lot of flexibility. And also, we've seen that there's a lot of concern every quarter about, oh, well, this quarter there'll be pressure on corporate margins with a slower economic growth. That has not come to pass. And most companies, if you look at, are maintaining those historically high profit margins. Why? Because they've restructured the way of operating over the last, say, decade of intense competition from China and emerging markets. And also the mild inflation we have isn't necessarily bad for corporations, because that says to me corporations are able to pass on price increases, not have to absorb them and hurt their margins. So that says much of the surprise of the worries in the market. I think we're going to continue to see earnings expand, corporate profit margins stay high where they are, and with the qualification that only some sectors are really going to participate in the high growth. Other sectors will be left behind because they don't have the pricing power, they don't have the intrinsic growth, they don't have the new product innovation that the tech and the industrial sectors have.
Margie, as always, thank you so much for your time. We appreciate getting some thoughts from you. Margie Patel, Senior Portfolio Manager, Allspring Global Investment. She's based up there in Boston, Mass. I'm looking at WTI crude oil. We got a $66 print. We were below $66 earlier this morning. President Trump is out with a tweet here. We've been covering it about raising the tariff paid by India. And he kind of weaves in this oil issue. Quote from Donald Trump's tweet: India is not only buying massive amounts of Russian oil, they are then, for much of the oil purchase, selling it on the open market for big profits. I don't know how that even happens, but I'm going to check in with our next guest because I'm guessing he has an idea. Mike McGlone, he covers all the commodity space for Bloomberg Intelligence. He's been doing that, covering that market for decades here. Hey, Mike, I guess that raises a good question. I guess I never really thought about Russian oil sanctioned by the West, so we're not buying it, and a lot of our Western allies are not buying it. But I guess India was buying it and then reselling it. Is that how that works?
Yes, well, the number one source of where that Russian oil is going is China, but India has been opportunistic. They were able to get it cheaper than normal. They're bringing in some of that crude, refining it, and then exporting it either as crude or higher prices or as a refined product. Can't blame them. They're capitalists. I mean, that's what happens in the macro world. But now they're running into this new world where the world's largest demand pull economy and a country where they like to sell a lot of goods to, where they have a lot of protection against us selling to them, is pushing back on that. And that, to me, is the new world order that Mr. Trump has kicked in. There's a book about it called Choke Points. And it just points out how the new world order is about economic, maybe warfare, and the U.S. is just pushing back and proving that this world's largest goods importer has a lot of power.
So where do we fit in right now in the U.S. in terms of our access to oil?
Well, hello, Nora. The thing is about U.S. is we have a pretty significant glut growing. The biggest incremental supply of crude oil on the global stage for the last 10 years has been from the U.S. Canada's in there, but now the rest of the world's adopting our technologies and bringing that shale in different forms. So the supply estimate revisions for crude oil on a global scale has remained up, and the demand estimate revisions for crude oil on a global scale have remained downward, particularly from China. They've been importing around 10, maybe 11 million barrels a day for, 4 or 5 years now, and it's starting to head lower. Why? 50% of their vehicles now are EVs. BYDs are coming around the whole world. So that trend for crude oil is very bad, but I look at it in the shorter term. So that's the macro. In the shorter term, what happened Friday is what the biggest risk is. We're running into the peak summer doldrums. Volatility in the stock market just dropped from very low levels, and if it rolls over, crude oil will do what I think I've been waiting for it to do for 2-3 years now, is get cheap, get below $55 a barrel, get below that break-even cost to offset these excesses of supply and demand.
What's OPEC doing here, OPEC Plus?
More supply. So they curtailed their supply for a while, we know a couple of years ago. Now they're bringing that back on, and it's part of profit. The good news is crude oils have been somewhat stable, but they're just bringing on that more supply. And the key thing is their suppressed capacity is increasing. The demand is somewhat declining. And the macro big picture is you better hope China picks up and the rest of the world picks up, but it's those demand estimate revisions, not just crude oil demand, but also GDP estimate revisions on a global scale remain downward. So I think it's just a normal cycle in crude oil. It got way too expensive in 2022, and it's just on this track to get too cheap. What stops it from getting too cheap? And I think it's still that downward trajectory. I don't know what stops that except lower prices.
Mike, what signals are you watching more closely to gauge turning points in the oil market?
Yes, well, key thing is what happened on Friday is what I'm really worried about. You can't really watch crude oil and copper anymore, those economic sensitive metals, without watching the stock market. Now, we've had stock market on a record here is keeping them somewhat stable, particularly copper. But now that we just dropped to the lowest 30-day volatility in almost 4 or 5 years in the stock market, and it's heading to the doldrums, if we head lower with the U.S. economy potentially heading lower, all these commodities are going to do what they normally didn't, head lower. The key thing is crude oil's heading down, corn's heading down, which means grains. And if copper drops, which I'm afraid it's going to, that's the 3 C's kicking in. And there's only one key commodity going up, and that's gold. And I'm afraid that's going to continue.
All right, I've been dying to talk to you about this. Tyson Food, they reported chicken business good, beef business not good. Apparently there's a cattle shortage. What's going on here?
Yes, the key thing about cattle, Paul, is I've found in my history is it's one of the major correlated commodities I've never been able to get robust data on to really figure it out. And there's been some issues with parasites and things, but the key thing to remember is when you make new highs, which we're doing now in prices and everything, is typically that'll just lead to the others. Well, you saw what happened in butter recently. We saw what happened in cocoa. And particularly in copper and crude oil and corn. It's just a matter of time. It's just one of those things that in terms of, the key thing I like to point out about all the cattle and grain and livestock is they're well fed. There's a glut of U.S. corn and soybeans coming out this harvest.
How long does it take, like if I say my cattle herd is too small or at historic lows, how long does it take me to build it back up again?
Well, it typically takes a year or two in cattle, but the lesson I learned from my uncle about pigs is the lessons of threes. 3 months, 3 weeks, 3 days, and you have a mature pig, which is part of the reason pork has always been one of the most significant meats, because you can bring on that pork rather rapidly, the mature pork.
See, there you go. All right, I mean, what's the best commodity trade right now, Mike? When we pick up the phone and talk to clients.
Gold, and maybe even looking at, I'm still sticking with gold. I don't know what stops that rally, and I'm thinking the next big trade, Paul, might be copper dropping below $4. Right now it's about $4.44.
You're right. All right, very good. Mike McGlone, Miami Mike, he's down there in Miami Beach, Senior Commodity Strategies. You can talk to him from grains to, you know, the metals to energy.
Pigs,
pork bellies. Pork bellies is big for me, all the way to Bitcoin now. So he does it all. So we appreciate it. And he was a farmer back in his former life. Now he's just swinging with the elite down in South Florida, kicking it with those folks down there like all the players do. Market's still holding on to these gains pretty solidly here. The S&P's up about 1.2%. The NASDAQ doing a little bit better, up 1.5%. Calling out WTI crude oil since we had Mike on, just below $67 per barrel for WTI crude. Did hit an intraday low of $65.45 here. So keep an eye on the volatile energy space as well. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got equities trading close to session highs. The Dow, the S&P, NASDAQ, all very much in the green. Stocks holding a 4-day decline with the S&P 500 index now advancing by 1.2%. Dow Jones Industrial Average climbing by 1% now, up 450 points. S&P, as we mentioned, up by 72. That's a gain of 1.2 on NASDAQ. The composite index up 1.6%. NASDAQ 100 index up 1.5%. Tech stocks rallying here. The Bloomberg Mag 7 index up 1.7%. And we've got the Russell 2000 index of small cap shares taking part in the rally as well, up 1.3%. Your 10-year, 4.21%. The 2-year, 3.70%. Gold is up $11 the ounce, up 0.3%. And West Texas Intermediate Crude WTI down 0.7%, 66.83 a barrel. As for the overall market backdrop on this Monday, Lori Calvasina is head of U.S. equity strategy at RBC Capital Markets.
It feels like we're ahead of 2025 fundamentals, and it feels like we've already priced in a lot of good news from 2026. And my concern is that maybe 2026, while not terrible, ends up not being quite as rosy as everybody thinks. So that could create some volatility.
Lori Calvasina of RBC Capital Markets. Workers at Boeing St. Louis area defense factories are striking for the first time in almost 3 decades after union members rejected the company's modified contract offer. Boeing shares on an update for the rest of the market. Boeing now lower by 0.2%. Again, recapping, S&P up 1.1%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Norma Linda and Paul Sweeney, we're here with you in the Bloomberg Interactive Broker Studio, streaming live on YouTube as well. The S&P 500 year-to-date is up 7.2%, but that doesn't begin to tell half of the story, given all the volatility between where we are today and where we kind of started the year. But again, the S&P up 7%. A lot to parse out in the first, call it 7 months of the year as it relates to tariffs, as it relates to new tax policy, maybe pro-business, some policies coming out of this administration. What are investors to do here as they think about the crosswinds in the markets out there? Jason Brown, he thinks about this stuff. He's the founder of the brownreport.com and author of a book, The 5-Year Millionaire. So you can talk about that. Jason, how do you think, or what's the conversation you have with investors who say, boy, every day I kind of look at the news and there's so much volatility out there and so many new policies, whether it's tariffs or trade legislation and so on. How do you suggest they kind of navigate through all that noise?
Yeah, Paul. So it's funny. The word you used was traders and investors are looking at the news every day, and that's what I tell them is don't listen to it every day, or should I say, don't let it control your decisions every day, because most people are not day traders and trying to take advantage of the market day in and day out. But when you zoom out and you look long term, the market goes higher. And when you look at everything that's going on with tariffs and geopolitical tensions, typically we get over it in 3 to 6 months. And if you look at some of the biggest things that have happened in our economy, like COVID-19, or you look at the 2008 real estate market crash, it took about a year, and then we started to reach either the same levels that we were at or the market was higher. So if you can have about a 6 to 12 month view, that allows you to not so much focus on the day-to-day headlines and panic and do something that wouldn't be beneficial for your portfolio.
Jason, there's been a lot of adjustments in the political sphere over the past few months. Are investors at all rattled by the uncertainty? I mean, I'm looking at the VIX index hovering around the 18 handle, which is a lot lower than what we saw that high spike up to 52 back in April. But how are investors really thinking right now?
I think there's 2 types of people in the market. You have investors and you have traders. I think the traders are the ones who make the VIX spike and panic, and I got to get out and I don't know what's going on. And I think what you're seeing with the low VIX is that investors are saying long term, the market goes higher. We believe that President Trump and his policies, he wants a good report card when it comes to the stock market. I don't believe any president wants to leave their presidency and have the market lower than when they came in, but especially this president. And I think the market is saying we kind of get the game that he's playing with tariffs, and they get paused and kicked down the road. And so you're seeing less of a volatility spike because to some degree, nothing really happens bad as it seems that it's going to be in the headlines. And so that gives investors a little bit of confidence to say, let's start to take positions here, which I think is why volatility is super low.
Jason, we saw back in the sell-off back in April with Liberation Day that it was, in fact, retail investors that were buying on the margin here. And does that surprise you?
If you've been waiting to get in some of these positions, you've been on the sidelines, as you've been watching the market go higher, I don't think it surprises me because everyone's been chomping at the bit to get involved in the market and waiting for that big pullback, that opportunity to get stocks at a discount, if you will. So it doesn't surprise me, especially with the rise of social media, Instagram, Reddit, all these platforms. I think if you've been watching people make money on the Microsofts, the Googles, the Amazons, the Nvidias, you were waiting for that pullback. And once it happened, investors and traders were ready to pounce. And I think it's similar to the pullback we just had over the last 2 days. You're starting to see some support come in. Tech is up today. If you've been waiting to get in on some of these uptrending stocks, I think that's why you're seeing retail traders pounce on the opportunity.
Jason, are we seeing a bit of an evolution here when we think about the market makeup? I mean, when we talk about retail traders, of course, it's a bit different what we're seeing now versus, maybe the pandemic when it comes to these meme stock rallies. But I cover real estate stocks, and Open Door Technologies and the surge that we've seen from that and a lot of these other meme stocks really just begs the question about, are retail traders just kind of getting in and jumping in more than maybe before?
I don't know that they're jumping in more than they have before, but it's really an exciting time to be in the market. And I think what's happening is that retail traders now have more tools available. I mean, just think about when Robinhood came out. Before Robinhood, everyone was worried about how much commission are you going to pay on a trade, especially if you had a smaller account. You're worried about the small trade that you can make is going to get ate up by commission. Then you had Robinhood come in and commission-free trading kind of swept through all the major brokerage platforms, which lowered the barrier. Then you have better research tools now. Now you also have AI that can go and read earnings reports and give you a recap. So I think the retail trader is able to compete from a knowledge standpoint and from a technology standpoint with some of the big boys and some of the big houses that they normally wouldn't have had access to from an information standpoint or a technology standpoint, or even from a commission standpoint. They have more money to put to work and not be worried about how much is eaten into their account. So I think that's attracting a lot more retail traders, and they're feeling a little bit more confident with the flow of information that's out there.
And Jason, also, I think about ETFs, and that's I've been in this business 35 years. It's one of the greatest developments I've ever seen in the investment market. How are you seeing the development and evolution of ETFs, maybe broadening out, democratizing investing for a lot of folks?
Well, ETFs are a very powerful tool. And if someone's watching and don't know what those are exchange traded funds. And what I tell my traders and my people on my platform is the power of ETFs is if you want to be involved in technology, but you don't necessarily want to be a stock picker, you don't know if Apple's going to go up, Microsoft's going to go up, Amazon's going to go down, you can just buy the exchange traded fund like the XLK. You can get a basket of stocks like the Nvidias, like the Broadcoms, ticker symbol AVGO, and it gives you diversity in a market where you don't have to diversify by saying, I'm going to get bonds, I'm going to get some stocks, I'm going to get some insurance from real estate, but you can diversify within a sector and not be a stock picker, but participate in the entire sector rising up. So I think ETFs are changing the game and creating that diversity for everyday traders who don't want to pick stocks, but they know that AI is booming. They know that chips are booming. They want to be involved in that sector. They don't necessarily have to worry about, did I pick the specific right stock, because they might not also have enough money if that one stock goes against them.
Jason, great stuff. Thanks for taking the time to chat with us. Jason Brown, he's a founder of thebrownreport.com. He's author of the book, 5-Year Millionaire Roadmap for Investing in the Stock Market, Wealth Accumulation, and Financial Independence. Appreciate getting some of his times. We've got a move higher in the markets here today, holding on to that. The S&P's up 1.1%. The NASDAQ's up about 1.5%. So some good solid moves to the upside here. Yields holding steady. The 10-year Treasury is sitting at 4.20%. Pretty interesting. The 2 years at 3.69%, so about 50 basis points steepening of the curve. Coming up, Jamie Rush, Director of Global Economics for Bloomberg Economics, on the big take story about interest rates, why they might be higher for longer. This is Bloomberg.
This is Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, Norma, Linda, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well, so check us out there. Well, President Trump, he wants lower interest rates, that's for sure, but achieving that will require overcoming structural forces that drive the cost of borrowing, which are currently pointing up. Let's get the latest on this big take story. One of the writers of this story, Jamie Rush, Director of Global Economics for Bloomberg Economics. He's based in London. Jamie, talk to us about this story here. I mean, the president wants rates to go down. I think he'd even entertain putting a new Fed chair in there if he could get that done. But talk to us about the market, the interest rate market these days. What are the dynamics?
Well, Paul, I mean, you're quite right. Trump wants lower policy rates, right? But you've got to be careful what you wish for. If you remove Powell, you could end up in a much worse situation. But let's take it back a bit. Let's take it back to what the determinants of interest rates are, right? So everyone knows Powell can, when it comes to short-term interest rates, it's Powell and co. with their fingers on the trigger. They're in charge of setting policy, but they don't get to choose any interest rate they like. There's only one interest rate which will stabilize inflation in the medium term, and that's not determined by Powell. It's determined by the fundamental balance between demand and supply in the global economy. And so that's what our work has been looking at.
Jamie, you're in London. I'm going to take advantage of that. What is the global view here when you think about the U.S. right now and our rate environment?
Well, I think the fear that there are a number of forces which are going to be pushing interest rates northward relative to what we've experienced in the past, and a lot of that is global factors, right? So one of those things, if you think about why interest rates fell over the past 30 to 50 years, it was partly because of demographics, a slow-moving trend, but an important one that changed the balance of saving in the global economy. Demographics is now changing. It's likely that the baby boomers are going to be retiring and spending down savings, pushing up interest rates. When you think about the other causes of interest rates and why they were moving down, China, crucial in that. Over the period where China was acceding to the world economy, it was recycling savings into the US Treasury market. That was pushing down on interest rates everywhere, but particularly in the US. And this dynamic's now flipping into reverse. So China hasn't bought any US Treasuries since 2015. The portfolio is dwindling relative to the size of the global economy, and that's now pushing up on rates. And of course, if you start to interfere with the institutions, if you start to threaten the Fed chair or other institutions, you'll find that global investors will pull their savings out of the US. And again, it was the flow of savings in push rates down. If you take savings out, it's going to push rates up. So I think that's another key dynamic.
I mean, there was, Jamie, a feeling, well, not more than a feeling, there was evidence that, earlier this year when right around Liberation Day, that that was in fact what was happening. We saw people taking assets, fund flows out of the U.S., including the U.S. stock market. They've arguably returned to some degree as the stock market's making new highs. But how about the Treasury market? What was the flow of funds in that market so far this year?
Yeah, I mean, I imagine that we've seen some pullback from international investors, not as big as perhaps you'd imagine. I think the evidence on that is it's a bit mixed at this stage. But I think that there's a broader point, which is that the kind of global geopolitical strategic rivalries that we've seen between China and the US and other countries as well, is creating an environment where people are going to be, or countries are going to be pulling their savings out. So China is one such example. Think about what happened to Russia during its invasion of Ukraine. Well, the Fed, European institutions seized assets, making it appear to these countries that they are not a safe place to leave their assets. So again, because of geopolitical reasons, you've got an impetus to pull savings out of US markets and in fact in European markets as well. So when you think about the long view, you have to take geopolitics into account, and these strategic rivalries are not going away. And so the big long-term picture is of some assets leaving US markets as that happens.
All right, Jamie, thank you so much for joining us. Jamie Rush, Director of Global Economics at Bloomberg Economics. He's in London. You can read more of this story, the big take story, on the Bloomberg terminal. You can also do it at bloomberg.com/bigtake. So, Nora, thank you for joining us here today. What are you working on these days with your equities team and the markets team?
I've got my eyes on pretty much everything at this point. I'm watching real estate stocks. I mean, of course, commercial real estate, all those REITs that you love to point out the FFO.
Sure, love it.
metric on. I'm also covering aerospace and defense firms. Lots of activity, especially as we were discussing earlier with George Ferguson about what's going on with Europe really wanting to boost up its production there of a lot of those defense arms. So lots to really cover here.
And then you've got that strike in their military.
Absolutely.
Their defense side of the business, which George explained, isn't that big of a deal relative to their commercial aviation business. And again, if you look at the Boeing stock today, really unchanged, so no real impact. And that stock is up 25% this year. So feels like that stock is out of the woods and is kind of got some brighter future going for it.
A different story being painted here.
Yep, absolutely. All right, just looking at these markets here. Tom from the Upper East Side demanded a Bitcoin quote, I'll call it right around 115,000 there. We got it on at risk on a day in the marketplace, with the S&P up 1.3% and the NASDAQ up 1.6%. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Stay with us. Your top stories and global business headlines are coming up right now with green on the screen. The Bloomberg Dollar Index is the only thing showing a little bit of redness. Again, a little bit more weakness in the U.S. dollar. We'll have more coming up. This is Bloomberg. Good morning.
CBS News on the Hour, sponsored by ZipRecruiter.
I'm Cammie McCormick. Dozens of Texas Democratic lawmakers have fled the state to deny a quorum to Republicans, hoping to push through a redistricting plan. New York Governor Kathy Hochul is hosting several in her state.
I hosted them at the governor's residence early this morning to make sure they're well fed with New York food.
A legal analyst Jessica Levinson says the Republican redistricting plan likely would survive court challenges.
Drawing district lines so that a party either keeps or increases power, those particular claims are not something called justiciable by federal courts, meaning the Supreme Court has said don't come to a federal judge with a legal claim that a line or a number of lines are a political gerrymander.
Texas Governor Greg Abbott has ordered the Democratic lawmakers back to the state by 3 p.m. today. President Trump said today he will substantially raise tariffs on India if it continues to buy Russian oil. He posted on Truth Social, India doesn't care how many people in Ukraine are being killed by what he called the Russian war machine. He'd already imposed a 25% tariff on India and said it would face an unspecified penalty for buying Russian oil. Switzerland said today it's ready to make an offer to the U.S. to avoid steep tariffs of 39%. In Gaza, more Palestinians died trying to get food aid. Reporter Robert Berger has more on the outrage that followed videos of 2 hostages struggling with hunger.
Hamas says it is willing to allow the Red Cross to visit these hostages if Israel opens a humanitarian corridor to all of Gaza and doesn't conduct airstrikes during the visits by the Red Cross.
Israeli Prime Minister Netanyahu said today he will convene a cabinet meeting later this week to decide how to proceed in Gaza. Vicki Barker reports a boat carrying migrants has capsized off the coast of Yemen. At least 68 people are confirmed dead.
The UN's International Organization for Migration, or IOM, says 157 people were on board the vessel. Most would be migrants from Ethiopia. Only 32 have been rescued so far.
The extreme weather in Europe continues, from brutal heat in Spain and Portugal to an unusually fierce storm in the UK, which has disrupted travel.
What can we do? The weather, there's nothing we can do about that, is there?
A bit stuck in no man's land.
High winds disrupted train services and toppled trees in Scotland and northern England. The storm is called Florence. On Wall Street, stocks are bouncing back after last week's losses because of the jobs report. This is CBS News. New street drug is raising concerns. CBS News correspondent Michael Wallace has that.
It's called Fly Sky. It's heroin laced with medetomidine, a tranquilizer used in veterinary medicine.
Medetomidine is a drug that is not affected by Narcan. So if you overdose on medetomidine, Narcan is not going to save you.
Michael Abell is the district attorney in Fayette County, Pennsylvania, where there have been at least 2 Fly Sky overdose deaths. The drug has also popped up in Philadelphia and Chicago.
You just don't know what you're getting anymore on the street.
Michael Wallace, CBS CBS News.
Outside the UN headquarters in New York, a replica of Rodin's famous sculpture, The Thinker, is being slowly submerged in plastic rubbish and will disappear under layer upon layer of bottles, toys, and fishing nets during 10 days of talks that start tomorrow on tackling plastic pollution around the globe. The artwork is being called The Thinker's Burden. I'm Cammie McCormick, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
The Help Wanted sign is up at the White House. Welcome to the Monday edition of Balance of Power. As President Trump says he'll announce a new Fed governor and a new BLS commissioner in the next couple of days here after one resigned and he fired the other. We're going to talk about the big job search here, whether it's possible to rig jobs data. When we spend time with Stuart Paul at Bloomberg Economics, we'll have analysis from our political panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano back together today. And Democrats are fleeing Texas to prevent Republicans from redrawing congressional maps. It's actually come to this, and we're going to get the latest from Bloomberg Texas Bureau Chief Julie Fine as we keep our eyes on the Lone Star State. It's all after a look at Wall Street. Let's get up to tabs here on the markets with Charlie Pellet at World Headquarters in New York. How's the Monday trade, Charlie?
Right now, a lot of green on the screen. Back to work Monday with the Dow, the S&P, NASDAQ, just about the best level of the day right now. I got the S&P up 80 at 63.18. That's a gain of 1.3%. Dow Industrials up 476 now, up 1.1%. And NASDAQ up 359. The NASDAQ Composite Index up 1.7%. 10-year at 4.19% with a 2-year 3.69%. Gold up $11 the ounce, up 0.3%, 33.74. And West Texas Intermediate crude retreating by 90 cents a barrel, 66.21. Bitcoin, meanwhile, at 115,041, up by about 0.5%. Certainly, trade tariffs and the potential impact on the U.S. economy a major concern for investors. Robert Socken is director of Citi Research at Citigroup Global Markets.
One of the most important variables is where does the tariff rate ultimately land? And we estimate with everything that's been announced, we think the effective tariff rate is somewhere in the neighborhood of 20% on U.S. imports. It was about 2.5% before President Trump took office.
Robert Socken of Citigroup Global Markets interviewed this morning on Bloomberg Surveillance. American Eagle Outfitters shares are surging after President Trump touted the retailer's ad campaign featuring actress Sydney Sweeney. The post, which misspelled Sweeney's first name, was subsequently removed from Trump's Truth social feed. But right now, we've got American Eagle shares. They're up by 17.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
He deleted the post, Charlie?
He deleted the
Sweeney.
post.
I thought, wow, I figured we'd be talking about this all day. He had a big weekend of golf at Bedminster. The president is back at the White House now, but gosh, it's just incredible. You couldn't have seen it coming, but at the men's senior club championship at the president's own Bedminster Golf Club, let's just say he's winning on and off the course, to use the words of the White House. 2025 Men's Senior Club Championship. I'm looking at the card right now, 69. President Trump, nobody even close. Welcome to the Monday edition of Balance of Power. Great to have you with us here on Bloomberg Radio, every day live from Washington. But you know, Mondays are special around here. And because it is high noon, you know anything could happen, which is why so many of you tune in every day on Bloomberg Radio, satellite radio, channel 121. And of course, you can watch the radio on TV by going to Bloomberg Originals or YouTube, search Bloomberg Business News Live. And we'll meet you in the studio. We'll, of course, welcome our global television audience in our second hour. Kaylee is with us. We got the band back together again. Rick and Jeannie will be here in the second half of the hour. So he trusts the numbers, he trusts the data at Bedminster, but not at the Bureau of Labor Statistics. Of course, President Trump here has got some hiring to do after we spent some time on Friday. We need to go back here. It'll sort of happen over the course of the day, including the firing of the commissioner of the Bureau of Labor Statistics, because that jobs report we talked to Molly Smith about at 8:30, remember, was much weaker than expected. They had multiple months of downward revisions. President Trump says it was rigged, not just made in error, but intentionally rigged by a commissioner with political motivation. He talked about it on his way back into town last night. Listen.
We'll be announcing a new statistician sometime over the next 3 or 4 days. We had no confidence. I mean, the numbers were ridiculous, what she announced, but that was just one negative number. All of the numbers seem to be great. We'll see what happens. But we just found out that I have a open spot on the Federal Reserve Board. I'm very happy about that.
He is very happy about that and still writing about this on Truth Social. Head of the Bureau of Labor Statistics, he writes, did the same thing just before the presidential election when she lifted the numbers for jobs to an all-time high. That was not true, in fact. As we discussed here with Peter Navarro on Friday, those revisions happened on August 21st, 2024. That was actually the week of the Chicago Convention. He's been talking about this repeatedly here on Truth Social, suggesting again that the numbers are rigged, and that's the idea that we want to explore with Stuart Paul. He is the U.S. economist for Bloomberg Economics. So forget your brother-in-law or the guy you sat next to on the train, your friend who called you this morning. Let's talk to somebody who actually covers this stuff for a living. He's with us from World Headquarters in New York. Stuart, great to see you. As always, welcome back. The idea that the numbers were rigged, and I think we need to separate these two stories because there is a real concern among smart people that BLS might be underfunded or might have to take a new look at the way these numbers are distributed. But we heard from Kevin Hassett over the weekend. He did Sunday Morning TV, and he reiterated the point this morning that the revisions themselves are the evidence of this being rigged. And I just would love to hear from you on the way this is done, because in many cases, respondents don't get back to BLS in time for the jobs report. And as they continue to gather more information, numbers are often revised. Am I on the right track, Stuart?
You are. So that's definitely one element. As time goes by, additional data are collected, and as those additional data are collected, they're incorporated into estimates of past months' data. That's the first thing. Mm-hmm. The second thing, which President Trump has alluded to, are annual re-benchmarkings of the payrolls data, and that comes from a very complicated process about how we represent the broader nationwide payrolls and how we make any sort of inferences from rather narrow surveys of just a few 100,000 businesses each month. And that's a larger, more complicated statistical inference problem. And that is another prong here that we need to wrestle with. Neither of those two issues, either the collection problem or the inference problem, have anything really to do with political bias or politicization of the data themselves. While the president might benefit from any sort of a gimme within, let's say, a 4-foot radius around the cup when he's playing at Bedminster, there are no gimmies in economic data, and so it is difficult, and people are really held to account. And so, in a sense, the folks who run the statistical agencies do have to be held accountable for the quality of the data that they're collecting and for the inferences that they're making about the data. But to say that there are political motivations here looks to me like it's unfounded.
Is it true that additional resources, more money, would help BLS create a more accurate data point?
It's possible. Look, in Washington, it seems to be the case that any time there are internal failings at an agency or any sort of controversy about the quality of work being done at an agency, those who are within the bureaucracy make an appeal for more funding. And it's not necessarily the case that more money necessarily fixes, let's say, response rates to the questionnaires and the surveys that are distributed. It's not necessarily the case that more funding will result in better models or more innovative models for making inferences about the broader population from the data that are collected. So I'd hesitate to say that a bigger budget will fix things, but it is obviously a relevant point in the context of an administration that's been looking to cut budgets where they can find additional fat to trim.
Okay. I was fascinated to learn that about a third of the sampled businesses in the report each month do not return their survey responses in time. So as those come in, yeah, you get in many cases, recast numbers. The New York Times took a really interesting dive on this today, Stuart, looking at the periods of time in history where other countries tried this. This is not a new idea, and it has never worked. You look at Greece, where the government faked deficit numbers for years, they write, contributing to a debilitating debt crisis. Country then criminally prosecuted the head of its statistical agency, easy for me to say, when he insisted on reporting the true numbers. There's China. Earlier this century, the local authorities manipulated data to hit growth targets mandated by Beijing, and people stopped trusting their numbers. Then there was the big one in Argentina, understating inflation figures for so many years and to such a degree that the international community stopped relying on the government's data. When people are worried about this, Stuart, I heard a lot of folks in financial news media today say, hey, the markets don't care, all right? We care about earnings and making money. Nobody cares about what's happening in Washington. But if you lose faith in the data, the whole house of cards can come down, right?
I think that's right. I think that, look, when you lose faith in the data, you start to question the institutions, including the political institution, and that's never a good thing. For example, as you mentioned, it's not just Chinese growth data that's brought into question, but there's an academic researcher, Yi Fuxian, who's even brought into question the population data in China, asserting that the total population has been in decline for well over a decade. And when you don't even know how many people there are in your country, it's very difficult to, let's say, make earnings forecasts for consumer staples companies, right? And so, in a sense, these data points are critically important for making forecasts about the future. When there is politicization of the agency by elected officials, it's obviously bad for data quality. I don't think that's a problem at the institution right now, but you can bet that in the firing of the BLS commissioner and her replacement with a new appointee whose credentials and whose unbiased take on the world will undoubtedly be in question just by the very virtue of the timing of their appointment, it's certainly something that's going to lead folks to doubt the veracity of the data.
Well, it's a concern here, Stuart. You also wonder who would take the job after this whole event and the conversation surrounding it. Let's stay close on this one. We could have a name, it looks like, the next 2 or 3 days, Stuart. We'd love to talk to you when it happens. His job is interpreting the data that is now being called rigged by the president. Stuart Paul, Bloomberg Economics U.S. economist, the president on Truth Social a short time ago. Last week's jobs report was rigged, all caps, just like the numbers prior to the presidential election were rigged. Looking to tie these two together. That's why he says in both cases there was a massive record-setting revision in favor of the radical left Democrats. Fake political numbers concocted in order to make a great Republican success look less stellar. That's where we are in sports. We're just starting the week here. The president has no public event scheduled, just a lunch with Vice President J.D. Vance. We'll have a lot more ahead. Stay with us on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ, all advancing. Stock buyers stepping in to drive the Wall Street rebound. We are seeing a wave of renewed dip buying. S&P right now currently trading at just about the best level of the day, up 80. That is a gain of 1.3%. The Dow up 476, up 1.1%. NASDAQ Composite Index now up 365 points. That's a gain of 1.8%. Our Mag 7 Index up 1.9%. The 10-year at 4.20%. The 2-year 3.69%. Gold is up $13 the ounce. Spot gold up 0.4%. At a retreat now for West Texas. Intermediate crude 66.52 a barrel. WTI down by about 1.2%. Tesla has approved an interim stock award worth about $30 billion for CEO Elon Musk, a massive payout meant to keep the billionaire's attention on the automaker as a legal fight over a 2018 pay package drags on. Tesla shares, they're up today by 1.5%. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, many thanks. Charlie Pellet back on the case on a Monday in August. You can always trust the numbers from Charlie Pellet. Here in Washington, you never know who's going to be trusting what at any given moment. Democrats certainly do not trust Republicans in the state of Texas. And if you've been with us for the past week, you saw this coming. It was a week ago today. We spoke with James Tallarico, and I can't remember the last time we heard as much about an interview here on Bloomberg. This is the Democratic lawmaker in the state of Texas who did Joe Rogan and then really blew up when he did BOP here, Bloomberg. A pastor, the former teacher, now lawmaker, who many see as a future star, a rising star in the Democratic Party. That's why his face is on all these stories about Texas redistricting. But he's far from the only lawmaker who has decided to leave town. Remembering, this is about quorum. Texas House can conduct business only when 2/3 of its 150 members are present. So as Republicans move to redraw the map and create new Republican seats in the state, to help Republicans keep their majority in the House, Democrats say, let's get out of Dodge. Because if you don't have the right number of people, you can't move forward with the redistricting. Now, this is going to end probably at some point, because as Julie Fine's going to tell us in a couple of minutes, the governor, Greg Abbott, could just keep doing special sessions as long as he wants. And at some point, you need to come home. We talked to James Tallarico about the prospect, because this is very controversial, the prospect of them leaving the state in the face of this action. Here's what he told us on Bloomberg.
We've had to figure out how to use every tool in our toolbox, whether that's the rules, whether it's our platforms, or whether it is denying quorum. That's obviously a dramatic step, and it's one that shouldn't be taken lightly. My Democratic colleagues and I are willing to do whatever it takes to stop this power grab and to protect the democratic process here in Texas and around the country, because if President Trump succeeds with this power grab in Texas, I worry that he will do the same thing in every red state across the country.
Well, hold your horses. Again, that was a week ago today. They have pulled the trigger, heading for 3 different locations: New York, Boston, and in the case of Mr. Tallarico, Chicago, where, by the way, the governor is standing by here not to miss an opportunity. Pretty interesting how this is going, because everybody's got something to gain here, potentially. The governor of Illinois, J.B. Pritzker, is providing logistical support and is reportedly considering giving them some cash to pay for fines that they're now facing in Texas. If you're with us here on YouTube, look at the backdrop behind Governor Pritzker as he's speaking. Let's watch and listen.
Trump came up with a new scheme, rig the system, by ramming through a corrupt mid-decade redistricting plan that would steal 5 congressional seats, silencing millions of voices, especially Black and Latino voters. Let's be clear, this is not just rigging the system in Texas. It's about rigging the system against the rights of all Americans.
Noting the campaign logo on the backdrop behind him. We've got to bring in Julie Fine, our Texas bureau chief, has been awfully busy on this for the last week, and she joins us now from our Dallas bureau. Julie, what's the thought here? These lawmakers are all going to be fined $500 a day, is what we're learning. What else can you tell us?
Well, they're going to be fined $500 a day, but you just talked about this, Joe. It appears there will be money. I mean, clearly donors have some interest in this. This goes well beyond Texas. However, a quorum break means everybody has to stay together. You have to stay and continue on with this to deny the amount for a vote. Last time in 2021, when lawmakers walked out over a voting bill, they were out, I believe, 38 days. This session only has 2 weeks left. But, Joe, as you pointed out very astutely, Governor Abbott can just continue to do these over and over and over again. So he did that 2 years ago. That was regarding school choice. I think they had 3 to 4 sessions, and eventually it passed this session. So it'll be very interesting. I do like how you pointed out, though, everybody has something here. You talk about Governor Pritzker. He's talked about that in his own state. Governors in New York and California discussing it in their own. These lawmakers are going to be busy visiting different places. But at the end of the day, the bottom line here is Republicans are in charge of both the House and the Senate, and they have the numbers.
Well, you know, you can add Kathy Hochul here. Look at the governor of New York, Julie, because a good chunk of these lawmakers went to New York as well. And she, of course, not to miss an opportunity, was out early in front of cameras and microphones. Here's Kathy Hochul.
To refuse to stand up and fight for our democracy as we are joining in solidarity with our friends from Texas means one thing. You won't fight for democracy, you're doomed to lose it. If Republicans are willing to rewrite these rules to give themselves an advantage, then they're leaving us no choice. We must do the same. There's a phrase, you have to fight fire with fire. That is a true statement of how we're feeling right now.
All right. Didn't Gavin Newsom use the fight fire with fire? The fact of the matter is California is considered a more likely candidate here to follow in the steps of Texas if, in fact, they redraw the lines. New York would be a little bit more difficult. But how long can they stay away here, Julie? I think we've established that it's impossible for them to run out the clock. Are they just raising money?
Well, they can stay away for as long as they remain a unit. But you're talking about the middle of the summer. Joe, somebody might have a child getting married. Somebody may have something going on in Texas. It's interesting, as you see, and we saw it really in 2021. The longer it goes on, the question becomes who breaks the quorum break. So you have to really work to keep this group together. But I do also want to point out the difference between 2021 and now is that in 2021, Democrats actually had 5 more seats. So now they have fewer to lose in order to get those numbers. So it really holds for as long as they can hold it together. However, I will say this, there's much more national attention on it this time around.
Yeah, okay.
Due to the fact of the other states in redistricting.
Sure, this could be a massive story. We're talking about the rest of the year if other states get involved. But I'm just curious quickly, Julie, locally, are people talking about this at the diner? Is this like office talk or is this for political wonks?
You know, Joe, you and I often talk about this when it comes to inflation or people talking about what's going on in Washington. Yeah. People are talking about this here locally. Reason being, there is a lot of other issues. There are a lot of other issues on the call for the agenda in the Texas special session. That includes flooding. So, yes, this is one that's actually getting a lot of local attention for that reason.
Boy. Can't wait to hear what happens next. Julie will be with us in the late edition of Balance of Power as well, because we're reaching out to a lot of these lawmakers. We'd love to talk to them as they hunker down. You see, they're at an undisclosed hotel in Chicago. You can't even tell them, because I'm pretty sure Texas lawmakers or law enforcement cannot come arrest them until they come back to Texas. They're threatening their arrest. Julie Fine in Texas. Thank you, Julie. There's another big story that we're following here by way of Boeing. Shares are barely lower despite this story today. It's kind of amazing, and maybe it was already priced in. Maybe that's what I'm about to hear from Mr. Ferguson. But workers at Boeing's St. Louis area defense factories are on strike here after union members rejected the company's modified contract offer This is IAM District 837. Members, quote, deserve a contract that reflects their skill, dedication, and the critical role they play in our nation's defense. Yeah, to all of those. These are the guys who build fighter jets and stuff. These are specialized jobs, and we wanted to talk about what it means for the company and for the defense industrial base with George Ferguson, who, of course, covers Boeing, along with the rest of the sector at Bloomberg Intelligence, the senior aerospace defense and airline analyst. George, it's great to see you. I'm sure you're in high demand today, and I'm wondering how destructive this could be for the company to make good on orders and what's going to happen in the weeks ahead.
Yeah, so I think this is not that difficult for Boeing to manage around. I mean, there's 36,000 members that are represented by the Machinists Union. This is the remaining 6,000. So the other 30,000 went on strike last year. They really served the commercial business, the ones that went on strike last year. This 6,000 is very much defense focused. So there's sort of the remaining contract that I think needs to be adjusted for inflation. We've put like a $200 million cost on Boeing per year. Once, if they get a similar contract to the machinists up in the Puget Sound region, we think it's $200 million at the end of 4 years. So Boeing needs to conserve all the money it can, but this isn't a lot of money in the grand scheme of things.
These are the workers who make or assemble F-15s, F-18s. How difficult is it to hire talent like this in terms of their specialty dealing with these complex platforms?
I mean, all around the aerospace supply chain, I still hear big concerns about the ability to hire talented labor. So I think this isn't an easy replace. The business has been slowing a bit, right? So F-18s are largely not being made. F-15s are, they're being bought by foreign customers. U.S. Air Force just ordered more. A very capable airplane, twin-engine fighter, not stealth, but very, very capable. That's why the U.S. Air Force is buying more. It's a little bit of a lull, but Boeing, I think, doesn't want to lose this skill set. They just got the contract for the F-47, the next generation stealth fighter. That'll probably be built in St. Louis. These would be the workers that would do that. Probably some $20 billion in contracts that going to be spent in St. Louis over the next 4 years. Cost plus contracts, so they probably can pass on some of the costs of increased labor through that contract. So they don't want to lose the talent, I think. They'll come to an agreement.
Yeah. Stock's been on a tear lately, certainly since Liberation Day. It's been almost straight up with a couple of interruptions, looking a lot better than it was last year. George, we only have about 30 seconds. Does the Pentagon shrug this off, too, the way Wall Street is?
I think so, because I think you're going to see in short order an agreement. I think they're about 20% away over those 4 years, 5% a year. My guess is Boeing management's going to give more, and you'll see an agreement.
Always there to pull us in off the ledge. George Ferguson knows what he's talking about. Great to see you, George. Bloomberg Intelligence Senior Aerospace Defense Airline Analyst, and indeed, Boeing, I should say, shares are barely lower, down about 0.25% right now, holding above 221, with a lot of analysts saying this is going to 250. We'll assemble our panel next. Rick Davis and Jeannie Shanzano on the help wanted signs at the White House. We'll have much more straight ahead on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We have got stocks jumping after the latest employment data last week showed a sharp slowdown in job growth, lifting expectations that the Fed will cut rates to support the economy. So here's where we stand. We've got the S&P just about the best level of the day, up 80 points now at 63.17, a gain of 1.2%. Dow Industrials up 488 for the Dow, an advance right now of 1.1%. NASDAQ up 356 for the NASDAQ Composite Index, up 1.7%, and just above 21,000 at 21,006. The 10-year 4.200%, with the 2-year 3.68%. Gold is up $7 the ounce, almost 8 right now, up 0.2%, 33.71 a barrel. And West Texas Intermediate crude, we're seeing a retreat there, down 1.4%, 66.41 for a barrel of WTI. The Swiss government says it is determined to win over the U.S. on trade after the announcement of 39% tariffs on exports to America. Switzerland's trade surplus in goods with the U.S., partly due to its gold exports, is seen as a factor in the U.S. decision to impose tariffs. And certainly tariffs has economists expressing concerns about the health of the American consumer. Michelle Meyer is chief economist at MasterCard International.
If you look at the last inflation report, it's starting to show in certain categories. A lot of the durable goods, discretionary goods, whether you're looking at appliances or auto tires or even into apparel, it's starting to show up. So I would argue that consumers are already starting to face some of those higher prices. It's happening gradually and it's happening uneven.
Michelle Meyer of MasterCard interviewed this morning on surveillance. Workers at Boeing's St. Louis area defense factories are striking for the first time in almost 3 decades after union members rejected the company's modified contract offer, a stock we were just talking about with our George Ferguson. Shares lower now, little changed, down by about 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts, and Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Many thanks to you, Charlie. We'll get back to Charlie at the top of the hour for another look at Wall Street, a market that just wants to go higher. The news be damned. We're keying off of earnings here and paying very little attention, it seems, to the concerns that are being expressed by some in Washington when it comes to a Fed governor stepping down, when it comes to the firing of the BLS commissioner. But we've got some time to think about it to ourselves. Everyone has left town. The president is back from Bedminster after winning the club championship yesterday. I just don't know how he continues to do it. But everybody else is out of here. The House and Senate are now on recess, both until September 2nd. There was a bit of a meltdown in the Senate on Saturday night as John Thune and Chuck Schumer failed to reach a deal on nominations in exchange for dropping the idea of another rescissions package and, in fact, unlocking money that's already been allocated for a couple of matters. Chuck Schumer and Hakeem Jeffries are now asking for a Big Four meeting with Thune and Mike Johnson to talk about funding, because there's a great worry that the failure to reach a deal on nominations over the weekend might ensure a shutdown with nobody getting along when we get back. We will get to all of that with our panel, as well as the big job search that is underway here. I already mentioned the 2 holes that we need to fill. One, we need a statistician who, maybe hasn't been reading the news recently and thinks this would be a fun job to run the BLS, which might be about as fun as being the Fed chair from here on out. And the president, it seems, now has a mechanism to drop the next Fed chair in, because after the Kugler resignation on Friday, we've got an open seat, and that could, in fact, be the next chair who's going to be sitting right next to Jay Powell, and the whole idea of a shadow Fed chair becomes reality before the first year of this administration is out. There's something reassuring on a Monday about having Jeannie Shanzano and Rick Davis back together again. It reminds us that, yes, the sun will come up, and some things we can count on, like our signature panel. Bloomberg Politics contributors Jeannie Shanzano, our senior democracy fellow at the Center for the Study of the Presidency and Congress. Rick is back, Republican strategist and partner at Stone Court Capital. Missed having you two together for a couple of days here, and I'm just deeply curious to know what you're thinking about all of this. Rick, presidents hating on the Fed chair, wanting lower interest rates, and questioning the veracity of economic data is nothing new. But to suggest the data are rigged is something a lot of people are having trouble with. How is President Trump going to navigate this scenario that he has now created?
Well, first, thank you so much for that warm welcome back, Joe. I mean, Jeannie and I have never been compared to sunshine, so that's great. Look, you know, as you said, I mean, it's not unusual for a president to, quote, work the ref, right? And try to push some of these independent authorities to open up the valve a little bit to accommodate their worldview. What's interesting about this one is the irony of it is that the bad jobs report actually helps facilitate a lower interest rate at the Fed level. I mean, they're supposed to protect the employment security of America, and this would have actually been interesting news for them to have had before the last open market meeting. And so, you know, I don't think he's putting one and one together to get three here for a win, but you're right. He has an enormous potential right now to affect all that. Either we're going to get more confidence in the ability for the government to produce these numbers that we'll have confidence in, and at the same time a potential view of the next Fed chairman by appointing Google's replacement. So again, I mean, I think it's advantage Donald Trump here. He'll take criticism on both fronts, but he's getting what he's gonna get what he wants.
Are we being babies about this BLS story? Jeannie, is this a case of pearl clutching? Because the market clearly doesn't care. It's rally time. Just hire a new commissioner. What's the big deal? The president, though, says the report was rigged, which would involve dozens, if not hundreds of people to be in conspiracy at BLS before, by the way, those numbers ever got to the commissioner. Those are put into the computer system days before the release. And at that point, the commissioner sees the data that's already been compiled by an army of economists. You picture the room full of green visors. Jeannie, is it just as simple as hiring a new one?
It is not just as simple as that. And I'm going to be sunny today, Joe, for you.
Thank you.
I'll try my best. You know, the two things that really struck me about this, number one, is it is such a reflection of how nervous Donald Trump is about the economy, which is why I think it's surprising to me that the market is responding the way that they are. Because if anything, this just shows how freaked out, if I could use that word, the president was by what happened on Friday to go to this extent. The other thing that strikes me is that when we've seen this done historically, and I just heard you talking about some of the historical examples, it has seldom, if ever, worked. You know, Rick and I and you, we talked for so long about the Biden administration ignoring the reality of how people felt on the ground about the economy, coming out and saying, I know you're not feeling it, but the numbers are really good. Just look, look, look. This is like the reverse of that. You know, Donald Trump can say what he wants. He can put in people he wants, manipulate data. But the reality is people know how they feel about the economy when they go to the grocery store, when they can't find a job. And that's why this doesn't work long term. And so just like Rick made a great point about the fact that the president doesn't seem to be able to see how this could help him with his interest rate crusade, he doesn't see long term the fact that the numbers are what they are, but people know how they feel about the economy and about jobs and everything else. And nothing he says or does is going to change that.
Rick, do you worry about a longer term corrosion in the credibility of not only the data, but the future Fed chair, where a year or two down the road, they're both handpicked by President Trump and the market doesn't always know what to believe or whether something was in fact politically motivated or done to, you know, quote unquote, make the boss happy?
Yeah, for sure. And I worry, as you say, in a macro sense, institutions have been under siege for a long time. Our government institutions, our religious institutions, our economic institutions, and we're not going to see an improvement in that, right? I mean, this is a classic declaration of war against an embedded institution of government that has provided credible and stable information for both the public and the private sector to make policy decisions that relate to business. And the reality is, without these kinds of institutions, it is melee. It is, the private sector creating their own options to be able to make proper investment decisions, and the public sector playing by guesswork. And neither one of those serve the public in a positive way. So yes, I would worry more from a macro sense. There are plenty of good statisticians and economists working at the Bureau of Labor Statistics to ensure that numbers get out in a fashion that should be credible. But this attack on this institution, like many others, is just eroding public confidence in government. And that is something we hope to be able to reverse at some point in the future.
Well, that's true. Look no further, Jeannie, than Kevin Hassett, the president's National Economic Council director. I mention him because a lot of folks think that he is not only in the running, but might be in the lead to be the next Fed chair. It's part of his job to go defend what the president did. He was on Sunday morning television. He was back on the cable nets this morning. Quote, on Meet the Press, the revisions are the hard evidence, unquote. When asked, where's the evidence of this being rigged? The revisions are the hard evidence. But Jeannie, the revisions are literally part of the process. This is part of the process of making the data more reliable when more responses from the survey come in. So if that's what Kevin Hassett thinks, and this tape will be out there forever, what happens if he does become the next Fed chair?
Yeah, I mean, it's deeply troubling, and we've seen this throughout the administration in this second Trump term, is that their loyalty is above all else. And so Kevin Hassett certainly knows better. There have been examples about the labor secretary. Early morning Friday, she's on Bloomberg talking about the numbers as positive. Hours later, she goes out and talks about them as rigged. They know, I suppose, the reality, the writing on the wall. If they don't go along with Donald Trump, they won't have their jobs. But at some point, people need to put in the administration their expertise and their professionalism and what's best for the country above trying to do the work of Donald Trump and trying to appease Donald Trump. And we just haven't seen that. And that goes for Congress, too. A lot of people since this firing have been calling on Congress to act. And, don't hold your breath. They're simply not going to act. And how do you make public policy decisions without agreed upon numbers that we can trust? The decline of expertise in this country under this administration, quite frankly, around the world, has been deeply troubling because none of us are experts in everything. We have to rely on experts. And the commissioner of the Bureau of Labor Statistics is an expert. She was an expert. She'll still be. And she didn't have to be and shouldn't have been fired because there's no evidence of politicking that they have pointed to.
I still come back to the markets, though, Rick. And you do tend to think, as a forecasting mechanism, if something was truly at risk here, when it comes to the credibility of our data, when it comes to the trajectory of interest rates, the independence of the Fed, would we be up 500 points on the Dow right now? The VIX is falling. Stocks are rallying. Should we pay attention to this?
Yeah, there's obviously a Trump swoon going on, for the first 6 months of this year since he took office. And sometimes it has betrayed what you would have thought would be rocky economic news. We're not even talking about the significant tariffs that are going into effect this week and what the market reaction was to that on Friday when they were announced. It was a bad day, then turned into a good day. I don't know. Maybe the market isn't the best judge of where we're headed as a country. It never has been in the past. But remember, too, in the 1920s, everyone thought the markets were the indicator of U.S. wealth, as Donald Trump likes to say, make America wealthy again. And that turned out to be a disaster for the financial markets. So I'm not painting a drab picture that, we're in some kind of a bubble and it's all going to burst at some point. But it is confounding how the markets have reacted to these, political decisions by the White House.
God knows it. Rick Davis and Jeannie Shanzano with us on the Monday edition of Balance of Power. Great to see you both, and they'll be back in our second hour here as we welcome our global television audience to the conversation. We'll be deeply curious to hear from Rick and Jeannie on redistricting that is now underway in Texas and Democrats' decision to flee the state to avoid a quorum. They are on ice, but only for now. We'll have much more on that ahead as long as you're with us. We'll also be joined by Congressman Brian Stile following his wild town hall last week.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
President Trump is hiring. Welcome to the Monday edition of Balance of Power, as the president says he will announce a new Fed governor and a new BLS commissioner in the next couple of days. We'll talk over the next hour about the job search and whether it's possible to actually rig economic data. I'm Joe Matthew alongside Kaylee Lines in Washington. Kaylee, the president, as recently as this morning, again contending that the jobs report was rigged by someone with political motivation.
And yet no evidence has provided to actually been supportive of that claim at this point, but obviously McIntyre, the former BLS chief, is now out. He says he will nominate someone exceptional to replace her in the coming days. We don't know exactly who that will be, but he also, of course, has the opportunity to nominate a new Fed governor after the earlier than expected departure of Adriana Kugler, which will happen later on this week. Keeping in mind, though, that both of these roles are going to require Senate confirmation. So it's no guarantee that President Trump can install exactly who he wants in both positions.
Absolutely right, and no guarantee that credibility will follow them. Following these accusations, there could be questions about the motivations of the Fed chair that he picks as well, knowing that the next person to sit on the board could, in fact, be the next chair.
Yeah, this is something we're going to speak about with a member of the House Financial Services Committee coming up in just a few moments. Republican Congressman Brian Stile of Wisconsin will be joining us, not just on that, but of course the perhaps difficult, shall we say, town hall he has back home in his district, where he heard from constituents that they're not too thrilled with everything that Congress or this administration is doing.
Pretty rambunctious session, as we learned last week, to the extent that some protesters even walked a cardboard coffin to his home, Kaylee, which brings up a whole boatload of questions about security, and we'll get into all of that with Congressman Stile ahead.
Indeed we will, but we begin, as always, with a check on financial markets, and to do so, we turn to Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much, Joe and Kaylee, and here's what's going on. The Dow, the S&P, NASDAQ, they're all pushing higher. S&P right now holding very close to session highs, looking at an 83-point gain right now, with the S&P at 63.21, up by almost 1.4%. The Dow's up 542 now, up 1.2%, while NASDAQ is surging 369 points, up 1.8%. The Bloomberg Mag 7 index up by 1.9%. All of this with the 10-year at 4.20%, the 2-year 3.69%. We've got spot gold up $8 the ounce, $33.71. That's a gain of just about 0.2%. And West Texas Intermediate crude seeing a retreat there, down 1.5%, $66.29 a barrel on WTI. Earlier today, President Trump said he would hike India's tariff rate for buying Russian oil. Moments ago, India responded, saying that the targeting of the country is unjustified and unreasonable. India also says it will take necessary measures to safeguard its interests. We're keeping an eye on American Eagle shares. The outfitter company, the clothing retailer, up 19.6% right now. Shares surged after President Trump touted the retailer's ad campaign featuring actress Sydney Sweeney. The initial post, which misspelled Sweeney's first name, was subsequently removed from President Trump's Truth Social feed. Again, the stock trading higher by 19.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. Pretty incredible to see that move on American Eagle on the back of True Social posts from President Trump. Of course, that is not all he's mused about on True Social today. We've heard from him on a number of issues, including, as Charlie mentioned, the threat to raise tariffs on India over purchases of Russian oil, but also a doubling down of allegations that began last Friday, shortly after the jobs report, that somehow the data put out by the Bureau of Labor Statistics was rigged. This is something the president said on social media earlier today, that these were numbers, fake political numbers that were concocted, to quote him, in order to make a great Republican success look less stellar. We would reiterate that neither the president nor anyone else of the administration has actually provided hard evidence to support these claims. But of course, President Trump has not just talked about it online. He's spoken with reporters about it as well, and what's going to come next for the BLS. Listen to a few of his comments from over the weekend.
We'll be announcing a new statistician sometime over the next 3-4 days. We had no confidence. I mean, the numbers were ridiculous, what she announced, but that was just one negative number. All of the numbers seem to be great. We'll see what happens. But we just found out that I have a open spot on the Federal Reserve Board. I'm very happy about that.
And with 2 jobs to fill, we turn to Michael McKee for help. Bloomberg's international economics and policy correspondent, who, of course, covers the Fed, travels to Washington, where Kaylee and I sit now to cover this very complex that the president is talking about. And he's with us now from World Headquarters in New York. Mike, we've got 2 different things here. There's wrong and there's rigged. As far as wrong, the revisions are part of the process, as we've been discussing. In many cases, respondents are slow to get back to the government survey. But when you hear Kevin Hassett on Sunday morning television saying the revisions are the hard evidence. How do we go forward from there?
Well, it's an interesting question because I'm sure that Kevin knows better, and he's just saying it because he works for Donald Trump. The revisions are revisions, and there's a reason for the revisions, and that is that statistics is imperfect. One of the problems that the BLS has, along with the other statistical agencies, is that since the pandemic, response rates from businesses have been falling a lot. So they don't get as much information into the first release as they do into the later releases, and they also have to do some statistical abstraction, but that doesn't mean that the numbers are false. It's the best statistically that one could do. They also have a problem in that there are fewer people working at these agencies because Congress for years has starved the statistical agencies of cash. And so it all comes together in this situation where we had a couple of months that were revised significantly downward. But when I looked at the data, the response rate for the first May survey, which was revised down significantly by the third one in July, was 42%. So less than half of the businesses that are supposed to respond. So the Labor Department probably did some extrapolation and came up with a larger number that then, when they got more data, was pushed back down. I think the final data number was 89% response rate. The president also is, I don't know whether he's lying deliberately or whether he doesn't even know what he's talking about. But when he said that the BLS released data to make the Harris campaign look good right before the election, the BLS actually on November 1st, 4 days before the election, announced that in October there had been only 12,000 jobs created. So if anybody was favored by that, it would have been the Trump campaign. So it's kind of hard to know where you go from that when they're living at the White House in such a fantasy world.
Well, and of course, that more than 800,000 revision number we talked about from 2024 actually happened during the Democratic National Convention. Joe and I were in Chicago. It was well before the election. So, Mike, that's on the BLS side. Of course, President Trump is talking about not just filling that role, but a new role on the Federal Reserve Board of Governors as well. How should we be reading into who ultimately he names potentially as soon as this week, and what it will mean to who ultimately is going to succeed Jerome Powell as Fed chair?
Yeah, he said he'd be naming somebody in a few days. I tend to doubt that based on his history and also based on the thinking that has to go into this. Scott Bessent has started a process. I'm not sure how far along he is in vetting somebody to replace Jay Powell as chair and in theory at the same time replace Adriana Kugler in her governor's spot. And the Kugler vacancy may be the only one that the president gets, because Jay Powell, in theory, could stay on as governor until 2028. His term as chair is over in 2026, but he could stay on as governor even if he were not chair. So if there's no opening, he can't appoint anyone else, which sets up a kind of a musical chairs game. Does he want to put in somebody to Kugler's seat who's going to be seen as the chair in waiting and create that shadow chair situation that we have talked about? The markets would probably assume whoever is chosen would be that. Or does he put somebody in and then say, I'll decide later who's going to be chair? Even if Powell stays around, I'll pick somebody like, I could pick somebody like Chris Waller or Mickey Bowman or this person I'm just naming now, and set up, as somebody put it today, an apprentice-like situation where you have three people for 6 months competing with each other to not be fired. So it is kind of an unusual situation that will be interesting to watch, and it might be a little painful for the markets.
All right, Michael McKee, Bloomberg International Economics and Policy Correspondent, here with us on Balance of Power. Thank you so much. And we want to add the voice now as we consider both of these vacancies that will have to be filled. Of a member of the House Financial Services Committee, also chair of the House Administration Committee, Republican Congressman Brian Stile of Wisconsin is back with us on Bloomberg TV and radio. Congressman, welcome back to the show. It's good to have you. If we could just begin with the Bureau of Labor Statistics chief being fired over the jobs data. Have you, as a member of the Financial Services Committee, seen evidence to support the president's claims? And in the absence of that evidence, do you think this firing was justified?
I don't have evidence of those claims, but I do believe that the president has a right to make sure that he has a man or woman in that position that he has full faith and confidence in. The job market has been very difficult to analyze at a period of time as the gig economy has dramatically ticked up, as we have seen a shift in jobs as it relates to foreign-born or natural-born citizens. And so making sure the president has someone in that position that he has full faith and confidence in is his prerogative.
Do you think that when he goes to fill the vacancy on the Fed board here following Governor Kugler's resignation on Friday, Congressman, that person, in fact, will be the Fed chair, the new Fed chair in waiting?
I don't have information one way or the other, but I do think it's important to recognize that the decisions made by the Federal Reserve are not made by any one individual. Often we see the Federal Reserve Board act with unanimity, but that may or may not be the case. And so we may see more divisions and votes, and I don't think that's an inherently bad thing for the Federal Reserve. And so it's a group of people. The key is that they are making these decisions based on the data in front of them, not based on any other ulterior motive.
Well, so when the president suggests that the person he wants to chair the Fed ultimately, and very well the person he'd like to select is the governor that replaces Kugler, that he wants them to have a low interest rate bias, Congressman, do you see that as a problem if lower interest rates may or may not be justified by the data?
Well, again, what we want is these decisions made by the Fed based on the data in front of them. Again, having disagreement or different points of view brought to the Federal Reserve Board, I don't think is an inherently negative thing. And the Federal Reserve has been criticized for decades by different administrations. President Trump just doing it more publicly than maybe President Nixon, where we found out later when the tapes were revealed. And so putting pressure on the Fed is nothing new. I think what we're seeing is just to play out in a little bit more of a public manner. Although the Federal Reserve is independent of the executive, that does not mean it's immune to criticism from the administration.
Congressman, we had a look at the town hall meeting that you held last week that got pretty chippy. There were a number of folks who were booing, and we've been talking about the potential for some confrontational town halls this August recess following the passage of the president's big, beautiful bill and, of course, the rescissions package that followed. I just want to give our listeners and viewers a taste of what you ran into the other night. Let's watch and listen.
Tell me the dire circumstances that triggered his tariff wars. Thank you.
Very good.
Tom, you got a veteran's hat, so out of the gates, I just want to say thank you for your service to our country. As we look at the broader tariff back and forth that's going on with the administration, this really, at its core, needs to be an opportunity to make sure that other countries are treating the United States fairly.
So a big round of booing there, and as we read in the local media, Congressman, protesters actually walked to your home with a cardboard coffin to represent the people they say would die from cuts to Medicaid. I'm just curious what your thoughts are coming out of a session like that and how you respond to these constituents.
I've done dozens and dozens of town halls across Wisconsin over the years. Media reports said that probably out of a room of roughly 400 people, there may be 30 to 50 protesters inside. Rest assured, they were loud. I don't think that group of protesters, the small group that was inside the room, were really representative of the views of most people in southeast Wisconsin. This was a group that tried to obstruct the Pledge of Allegiance, booed when we said, let's have a productive conversation. And so at the end of the day, I think what's really challenging right now across the board in the United States is a willingness to really engage in productive conversation about what needs to be done to move our country forward. And so far too often, individuals resort to disruptive tactics rather than engaging in what's really needed of a substantive conversation, a period of time where we're massively driving debt further and further up, where we have global challenges from a national security perspective, and where we've made, I think, great progress on securing the U.S.-Mexico border. And so maybe it's a point in time of reflection for the whole country to reflect and analyze how we can have a much more productive dialogue, which is going to be really essential based on the challenges that are in front of us.
Well, have you had any productive engagement around issues constituents may have around the way in which this one big beautiful bill threatens to affect them, or they're worried will affect them? Does it give you pause about any elements of the piece of legislation that you voted for?
Well, there's a lot of misinformation that's circulating on key provisions of the bill, which is why I was hoping to use this forum as an opportunity to provide folks and residents across Wisconsin better information about what's actually in the legislation that's become law. We use a number of different venues to do this, through email, telephone calls, in-person town halls just being one of the ways in which I try to communicate with folks. But there's a lot of misinformation, in particular as it relates to Medicaid. And in regards to Medicaid, what we're seeing in Wisconsin is mostly a shift towards work requirements for able-bodied childless adults in the state of Wisconsin. That's an 80-20 issue because it's common sense that we know that we can help lift people up out of poverty as long as a job is a core component of that.
Yeah, well, look, I think that everyone deserves a lot of credit for being at that town hall on both sides of this, including you, Congressman, as a lawmaker. Making a decision to interact with constituents has not been terribly popular from what we've seen lately. And I wonder if you actually can hear from the voters who are upset about debt and deficits, seeing some $4 trillion added to ours in the so-called big, beautiful bill. There has been, I know, a conversation about coming back around to lower the debt impact of this legislation. Is that what the next move should be?
We had questions on that exact topic, and I think it's important to know that as the Washington, D.C. accountants analyze that cost, large chunks of that, or the overwhelming majority of that, is actually just simply making the 2017 tax cuts permanent. We simply built on that by providing tax relief to seniors on Social Security, those individuals working overtime or earning tips. And so the bulk of the cost is really shown up by simply doubling down and making sure that we're making permanent the 2017 tax cuts that had a real substantive positive impact on real wages for families across the state. And so it's reasonable that people can have different views on any given policy, but this is where making sure individuals have the information they need to be able to make their decisions is so absolutely essential, and why a small group of individuals who protested the town hall was a bit disappointing for the countless individuals that wanted to hear what I was trying to provide.
Congressman, we just have 30 seconds left, but when you return to Washington come September, what odds do you put around a government shutdown?
We can't allow a government shutdown to occur. I know there's a lot of my Democratic colleagues that are actually hoping that we do shut down. I don't view that as productive. I'd rather make sure that we come together, address the spending challenges we face, and do what we need to do to avoid a shutdown at the end of September.
Appreciate you joining us here from what looks like a beautiful day in Wisconsin, by the way, Congressman. We'll do this again soon, I'm sure, and certainly when you're back in the Capitol. It's Brian Stile, Republican Congressman from Wisconsin's 1st District. I'm Joe Matthew, alongside Kaylee Lyons in Washington. We'll assemble our panel next as Democrats in the state of Texas flee the Lone Star State to avoid reaching a quorum that could prompt a redrawing of congressional maps. We'll have the story next on Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. Best level of the day right now on the S&P 500 index, up another 84 points to 6322, gaining 1.4% in the back-to-work Monday session. The Dow up 558 right now for the Dow, up 1.3%. The NASDAQ Composite Index up 371 for NASDAQ. That is a gain of 1.8%. Our Mag 7 Index up 1.9%. Equities halting a 4-day slide. S&P again up by 1.4%. The 10-year currently yielding 4.20%. The 2-year 3.69%. Gold little changed, up $8 the ounce, $33.72 right now, while West Texas Intermediate crude is down 1.5%, $66.31 on WTI. Bitcoin right now up 0.9%. Bitcoin at 115,483. Tesla has approved an interim stock award worth about $30 billion for CEO Elon Musk. It is a massive payout that is designed to keep the billionaire's attention on the automaker as a legal fight over a 2018 pay package drags on. Tesla shares, they're climbing by 1.9%. Again, recapping, S&P up 84, up 1.4% for on-demand news 24 hours a day. Subscribe to Bloomberg News now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet in New York, thank you so much. I'm Kaylee Lyons alongside Joe Matthew here in Washington, where the town has been abuzz for weeks now about the potential of redistricting wars heading into the 2026 midterm. The talk, of course, of which began a few weeks ago when President Trump openly suggested that Texas should redraw its congressional map in order to carve out 5 more Republican seats to give the Republicans a better chance of retaining the majority in the House of Representatives. Texas, of course, began a special legislative session a few weeks ago to undertake that effort, as well as others, including the relief for the devastating floods that hit the state last month. But to take forward action on any of them, you need a quorum. 2/3 of the Texas legislature needs to actually be present in order to vote on these matters, redistricting included. And Democratic lawmakers in the state have decided not to provide that quorum as they attempt to block this Republican effort on gerrymandering, have fled to blue states like New York or even Illinois to outside of Chicago, including a Texas legislature member, James Tallarico, who we spoke with on this program 1 week ago today when we asked him about this possibility. And this is what he told us.
We've had to figure out how to use every tool in our toolbox, whether that's the rules, whether it's our platforms, or whether it is denying quorum. That's obviously a dramatic step, and it's one that shouldn't be taken lightly. My Democratic colleagues and I are willing to do whatever it takes to stop this power grab and to protect the democratic process here in Texas and around the country, because if President Trump succeeds with this power grab in Texas, I worry that he will do the same thing in every red state across the country.
That was 1 week ago here on Balance of Power. Fast forward to today, and James Tallarico is now one of 57 Democrats who's chosen to leave the state, preventing Republicans from, I should say, reaching a quorum, and therefore at least temporarily blocking this redrawing from happening. We want to get into this with Julie Fine, Bloomberg's Texas bureau chief, who has been very busy on this story now for a couple of weeks, with us from Dallas. Julie, it's an interesting move here, but it can only go so far, right? Governor Greg Abbott can call as many special sessions as he wants. So is the effort here to simply publicize what's happening?
Well, I think the effort here is to draw attention to it, certainly. However, they are working very hard to make sure that this doesn't happen very soon. I mean, when you look at the redistricting bill, this is the first bill that has come up for the House to vote on. I think that infuriated many, knowing that it would be put on the clock so that they would have to stay there, because you leave and you have flooding on as well. So obviously this is a choice that they decided to make, and they know that Republicans will discuss that. This, Joe, you've discussed this before, is temporary, because at the end of the day, when you talk about the tools in the toolbox, one of them is not the majority. And that's what you really need to get something through here, so they can stay out. They'll draw attention to it, certainly. But I think what they're also trying to do is make sure that other states that can redistrict pay attention to what's happening.
Mm-hmm.
Well, Julie, when we talk about tools in the toolbox, what about the tools available to opponents of what Democrats are doing here, like for Governor Abbott or the Attorney General Ken Paxton, who has floated the idea of arresting these lawmakers who have left the state? What real consequence could these individuals face?
Well, that certainly depends, and that would explain why they are in Illinois. That is a Democratic state, and you heard Governor Pritzker at the news conference say last night he will do everything he can to protect them. The question is when they go back to Texas. So clearly they understand that this is a risk that they are taking, but certainly the Attorney General has made it very clear that he thinks that they can be arrested. Governor Abbott now threatening their seats, talking about vacating them. So in the next few days, I think you're going to really see what direction this is headed in. This session lasts 2 more weeks.
All right, Bloomberg's Texas Bureau Chief Julie Fine, appreciate your reporting on this. Thank you so much. And as Julie mentioned, we did see the governor of Illinois, J.B. Pritzker, greeting members yesterday outside of Chicago. Let's get a taste of what he said.
Trump came up with a new scheme, rig the system, by ramming through a corrupt mid-decade redistricting plan that would steal 5 congressional seats, silencing millions of voices, especially Black and Latino voters. Let's be clear, this is not just rigging the system in Texas. It's about rigging the system against the rights of all Americans.
And for those with us on radio and not YouTube or TV, it's worth noting that jbpritzker.com was pasted multiple times as the backdrop for these remarks. So let's get into this now with our political panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Rick Davis, of course, Stone Court Capital partner and Republican strategist. Jeannie, our Democratic analyst and senior democracy fellow at the Center for the Study of the Presidency and Congress. Jeannie, we've talked about, or we were just talking about with Julie, how all of this is a chance for Democrats to publicize what's going on in Texas. But is it also a chance for the likes of J.B. Pritzker, a potential 2028 candidate?
It absolutely is. And I'm so glad you mentioned what was behind him, because Kayleigh, you can save democracy and raise money apparently at the same time for your run for 28. But this is really a precursor, not just to the midterms, but to 28. And you're giving a lot of state and local Democrats the chance to show Americans that they are willing to fight for them. And that is what many Democrats on the ground want. I think one of the ironies of this entire story is the fact that this is allowed because the Supreme Court said it is constitutional to politically gerrymander. And that has gotten us into this position where you now have Texas and sure to follow other states, whether California, New York, Illinois, they will try to gerrymander. And the losers here are the American public, Republican and Democrat, because what you're doing is denying people a choice at the ballot box, making our House districts less competitive. And that is anti-democratic with a small d.
I know we've seen this move before, Rick, but what kind of strategy is this here? You go to hang out with Pritzker in Chicago, Kathy Hochul in Albany. I guess some of the others are in Boston right now, but you have to come home eventually. Might have to pay fines when you do it, and then the governor simply schedules another special session. This doesn't keep anything from happening, does it?
Yeah, it's not a winning formula from what I can tell, and I don't know, but most Texans, I would think, hanging out with those Democratic leaders in Yankee states is probably not exactly a positive for them coming back to their home district. So, I mean, I can't believe that's going to work. And then on the top of it, you've got another liberal Democratic governor, Gavin Newsom, saying he's going to do the same thing they're doing in Texas. So, like, I'm sorry, sounds like you've adopted the same strategy. So why are these people hiding? I honestly don't think it's a winning issue for Democrats. Nobody's ever won an election that I can recall, you know, decrying the negative state of redistricting. I mean, even the Supreme Court says, you know what? Districts are set by political means, and that's exactly what they're talking about doing. So the likelihood that any of this is going to result in a successful lawsuit, devil's in the details, but that's been tried before, and very rarely does it succeed. So I don't know. I mean, I think this takes Democrats off their game, puts them in an awkward spot where some of the leaders are claiming to want to do the same thing, and others are harboring people who are trying to avoid it. So where are you, Democrats? Are you for this or are you against it?
Well, so let's add the voice of another Democratic governor. Rick, of course, mentioned that California Governor Gavin Newsom has floated the idea of pursuing something similar, but so too earlier today did the governor of New York, Kathy Hochul.
To refuse to stand up and fight for our democracy as we are joining in solidarity with our friends from Texas means one thing. You won't fight for democracy, you're doomed to lose it. If Republicans are willing to rewrite these rules to give themselves an advantage, then they're leaving us no choice. We must do the same. There's a phrase, you have to fight fire with fire. That is a true statement of how we're feeling right now.
Jeannie, is the more fire strategy the right one here?
Yeah, and we're hearing that strategy. You mentioned Newsom, Hochul, Pritzker, also people like Holder, who famously has been against this strategy until he is for it now. You know, the party has no choice as they see it. Once one party goes down this direction, the other one is going to follow, whether you like it or not. But I'm not sure this makes the Republicans seem strong. We've seen two examples in the last few days, to me, of Donald Trump feeling very nervous. Number one, he gets bad job numbers. He's so concerned, he fires the messenger. Number two, it doesn't seem like they feel they can win the midterm unless they rig the districts in Texas and potentially other states. So to me, I think it screams that the GOP has a bigger issue here than redistricting, which is why can't they run fairly on their message? And you were just talking to Representative Stile about the difficult town calls he and I'm sure other Republicans are having as they go out to sell this wildly unpopular bill. So I think this screams concern about holding the House because the public isn't seeing what they've done so far in a positive light.
Well, it's, of course, I mean, it would potentially be an issue either way with a majority of 3 or whatever the speaker is dealing with right now. Rick, you mentioned nobody's ever won elected office beating the drum on gerrymandering. But what do you make of the potential math at hand here? Donald Trump is convinced if they redraw these maps, add 5 seats, they go red, Republicans keep the House. Is that a dangerous bet?
Yeah, it's a dangerous bet. I mean, look, historically, the party in power loses, 25, 35 seats. I mean, like 5 seats in Texas in that average is not going to make a dent. And so you're spending all this political capital to maybe win 4 or 5 of those, right? I mean, like, I've seen so many redistricting battles where you think you're going to pick up seats and you don't. And so at the end of the day, it's a high leverage situation. But look, he's sitting on government. He's got $200 million in his super PAC, and he's got all these options. And so why not trigger a few of these options? It's not the first out-of-cycle redistricting Texas has done, and arguably they picked up Republican seats.
Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors, many thanks to both of you for a great conversation here on the Monday edition of Balance of Power. We have breaking news coming from NATO. In fact, the U.S. ambassador to NATO is going to join us ahead on providing weapons to Ukraine. It's next on Bloomberg.
140 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all advancing. Stocks holding very close to session highs. S&P right now up 84, 63.22 where we stand. That is a gain of 1.3%. The Dow's up 542 points for the Dow Industrials, an advance of 1.2%, while the NASDAQ Composite Index is up 376 for NASDAQ, a gain of 1.8%. The Mag 7 Index is up right now by 1.9%, the 10-year 4.20%, with a 2-year currently yielding 3.69%. Spot gold is up $9 the ounce, higher by 0.3%. The spot gold at $33.73 the ounce. West Texas Intermediate crude down 1.5% right now. WTI 66.32 a barrel. Workers at Boeing St. Louis area defense factories are striking for the first time in almost 3 decades after the union rejected the company's modified contract offer. Boeing shares little changed on the day, up less than 0.1%. Joby Aviation is planning to buy helicopter rideshare operator Blade Mobility for as much as $125 million in stock or cash as the electric aviation pioneer seeks to expand its battery-powered air taxis into a ready-made market for its aircraft. Joby Aviation shares up 20.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. Back we go to Washington. Balance of Power continues. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet in New York, thank you so much. I'm Kaylee Lyons alongside Joe Matthew here in Washington. Thanks for being with us on the Monday edition of Balance of Power, where we've covered some of the domestic issues that are abuzz in Washington and the greater political universe today. One being, of course, the president's ability now to appoint not just a new head of the Bureau of Labor Statistics, but also a new Federal Reserve governor, potentially impacting our economic path forward, but also, of course, the redistricting effort that the president himself is pushing in Texas. President Trump also weighed in on American Eagle and the Sydney Sweeney ad earlier today. We don't need to get into that, though. President Trump, though, not stopping there, as he threatens today to raise tariffs on India for purchases they continue to make of Russian oil. Of course, the threat to impose things like higher tariffs or secondary sanctions on countries that purchase Russian energy, part of what has been a bit of a tone shift from President Trump when it comes to Russia's ongoing war with Ukraine. That, of course, was further evidenced last month as well by an announcement that was made that the U.S. would be providing more weaponry to Ukraine, but that distribution would actually be handled by NATO, and that NATO countries, Joe, would pay for it. And today we got the announcement of the first country that is making such a purchase. It's the Netherlands.
That's right. We had a lot of questions at the time about how exactly this would work, but it's being laid out before our eyes. They're calling it PEARL, I believe is the acronym, Priority Ukraine Requirements List, a financing mechanism worth about 500 million euros, about $578 million. Indeed, the Dutch are stepping up first here, and we're lucky to have the U.S. ambassador to NATO to help us understand a little bit more about this. Matthew Whitaker is with us live from Brussels. And Ambassador, it's great to have you back on Bloomberg TV and radio. There was a reference here to Patriot missiles. Will these be essentially defensive weapons in this first tranche for Ukraine?
Yeah, well, it's good to be with you. This is obviously exciting news, something we've been working on since the announcement last month in the Oval Office, where I was there with President Trump and Secretary General Rutte. And the announcement of $578 million worth of American weapons and munitions sold to the Netherlands and then provided to Ukraine is a big step forward. And this is probably the first announcement of many that are going to be following on. But, I think should expect that, weapons and munitions obviously are defensive, especially when you're talking about Patriot missile and radar and those types of things. But you can also, see that most expectedly there will be things like artillery shells and bullets and ammunition.
And how quickly will all of that, Ambassador, be in the hands of Ukraine now that this purchase has been announced?
Well, obviously, we're moving out very fast, in expectation of this. And, And after the announcement, the folks that are doing the logistics have already had some of this material in process. And so it's moving in the typical channels that you would expect. I just want to say that, while this announcement of the Netherlands purchasing American equipment is important, remember why they're doing this. It's because Ukraine wants American equipment. Ukraine wants our weapons and our ammunition because it's the best in the world. And, a lot of it is manufactured in the United States. And that's why, one of the things that I'm working on here in NATO is to make sure that American manufacturing continues to thrive and grow and expand. And, those are really hand in glove as to what we're doing and the work we're doing here to make sure that Europe can ultimately defend itself long term.
Well, let's talk more about that, because there was a concern about our own stockpiles here, which is why at one point, at least that was the justification by the Pentagon for halting temporarily weapons shipments to Ukraine, because we were getting down to concerning levels. At this point here, if we're in fact providing more weaponry to Ukraine, realizing that others are paying for it, is there a limit to what we can send?
Well, yes, there is, and we want to make sure that the United States is never at a strategic disadvantage or puts ourselves in a vulnerable position. And so what we're providing is what would be considered excess in addition to what we need to defend ourselves strategically. But at the same time, we're still manufacturing, whether it's missiles that go with the Patriot system, or whether it's artillery shells or everything in between. All of these armaments are continued to be manufactured in the United States and, quite frankly, all across the NATO alliance. And so we see the need in Ukraine. We've then, the people at the Pentagon, especially the generals that manage a lot of these important programs, looked and determined what we could sell to our NATO allies, and then they could provide them to Ukraine.
As you see it, Ambassador, when we consider the situation in Ukraine and a war that Russia has signaled no desire to stop at this time, despite the president's consistent push for a ceasefire, are sanctions needed to supplement this further weaponry, even secondary sanctions perhaps, which the president has suggested could go into place as soon as the end of this week with the 10-day deadline he announced last week?
Yeah, well, President Trump's been clear that this war needs to end, that the death and carnage and slaughter we're seeing on the battlefield every single day, where thousands of soldiers are dying, and, of course, the attacks into some cities inside Ukraine as well, where civilians are ending up being casualties. It needs to end. There's no resolution on the battlefield. A diplomatic solution is the only way. And President Trump is creating the environment that Russia will come to the table and negotiate a ceasefire, because that's what's necessary to end the killing. And I think secondary sanctions and tariffs against those that are paying for this war, like China, India, and Brazil, by buying the oil that Russia is producing, is an obvious next step to try to bring this war to an end. And we'll see. President Trump said just the other day that Russia is very good at avoiding sanctions and evading these things. But I think this is going to really hit them where it counts, and that is in their main revenue source, which is the sale of oil to these countries. And so President Trump, is playing this card, if Russia can't negotiate a ceasefire. But at the same time, Russia just needs to end this war. They're not going to win it on the battlefield. They're making marginal, if any, gains. And they've really been struggling because of the situation on the front line. And so we just need to end this war. And I think these sanctions are the next step. But again, President Trump's going to continue to work on creating the environment that's necessary to bring Russia to the table and to get a ceasefire.
Is there anything, when we consider the weapon shipments, that we will not send to Ukraine, Ambassador? I remember the big debates that were had over the shipping of F-16s, providing M1 Abrams tanks, ATACMS missiles, and so forth. If somebody else is placing the order and doing the buying, do we care what they get?
Well, obviously, I'd say the rule number one is the United States will not make ourselves strategically vulnerable in any way. So we're not going to, cut too deep or give amounts or sell amounts that are going to put us at a strategic disadvantage. But we're going to make sure that Ukraine has everything they need to defend themselves. They have, like the way the U.S. Air defense systems especially have performed as they're every night attacked by drones and missiles and all the things that Russia is sending their way. And so, I mean, they obviously want more of those systems because they know they work and they know that they're very successful in eliminating those threats. But at the same time, you know, they need to be able to defend themselves on the front line where they're encountering the Russians and the waves of poorly trained Russian soldiers that are, you know, being paid a significant amount of money in expectation that most likely they're going to die. It's really a sad situation on the front line, and we just need to end it. President Trump sees that for what it is, and, you know, let's just hope that as we take steps into August here, we can get this war to a ceasefire.
Ambassador, just quickly before we let you go, President Trump announced on Friday that he would be deploying 2 nuclear subs into an appropriate region in order to counteract what he saw as escalatory rhetoric coming from Russia. Can you confirm whether or not those subs actually have been deployed? And do NATO allies worry about that kind of escalatory move?
No, I'm not going to confirm our strategic movement of any submarines. Obviously, that's one of the many systems we have available that make us very strong as a country and provide the necessary strategic ambiguity that we can move things around. And submarines obviously are very important to what's in our arsenal. But, you know, there's no reason for me to talk about any of those things right now.
Had to ask it. Matthew Whitaker, thank you so much. U.S. Ambassador to NATO. It's great to have you with us, sir, and appreciate the update here on weapons for Ukraine as we add the voice of Michelle Jamrisko, Bloomberg's White House national security editor, with us back at the table in Washington. Michelle, it's great to see you. We just kind of covered the bases with the ambassador here, but this is a pretty significant update. Having had so many questions about the way this program would work or whether it would work at all, what does it tell us that the Netherlands are first, and are there any limits to this program?
Well, that remains to be seen as so many developments in this space. I mean, I think you heard from the ambassador that it's such a sense of urgency right now. They're underscoring in terms of trying to end the war, and you see all these kind of crosshairs getting involved in this, from, you know, the trade tariffs as well, and we were talking about India earlier, and also the urgency of resources, and of course, notwithstanding the ambassador and others' hesitance to give away too much in terms of the strategy and military details. We do know that, you know, they're trying to figure out how to move these assets and to maintain, you know, support for Ukraine while also not escalating, as Kaylee mentioned.
Well, on India, the threat of higher tariffs of an amount that he did not specify, is that likely to change India's behavior, Michelle? Are they signaling they're going to stop purchasing Russian oil?
I think we're seeing the very high bar that successive U.S. presidents have dealt with in trying to persuade India on a moralistic line in terms of purchases. I mean, I can remember even 2 years ago now when we were having this conversation with Indian energy minister at the time about the Russian oil purchases and the U.S.'s disdain for it, and he had something to say about how it wasn't altruism, it's not philanthropy. They're making these purchases for their domestic population, the most populous nation in the world, on the basis of pragmatism, and they're just not going to budge right now on that.
Well, that's important because the president says they don't care how many people in Ukraine are being killed by the Russian war machine. First of all, remarkable to hear him use the phrase Russian war machine. I'm not sure we would have heard that even weeks ago. But to the point that India is being framed this way by the president would suggest that they've talked about this. Did this come up with Modi?
Well, we can't get inside, his head on the conversations he's personally had with Modi, but we do know, of course, he's had warm relations with the Indian leader for some time. I mean, dating back to campaign trail, meetings and events and that sort of thing. So it really just does, again, underscore, the toughness which India is using, their leverage and saying, no, we're not going to sway on this. And by the way, we don't appreciate, they said in a statement last hour, that that, the EU and the US are being somewhat hypocritical in this, and they're pointing to, purchases of different goods by those two entities too, so from Russia. So there's a lot of, war of words going on right now, and it's, the India tariff deal is just one thing that's being caught in this sense of urgency that Trump has renewed over ending the war in Ukraine, that he, by the way, campaigned on finishing on day one. So we'll see.
Yep, 24 hours was a promise at one point. Michelle Jamrisco, Bloomberg White House and National Security Editor, thank you so much for joining us. We'll, of course, have more on this story coming up at 5 p.m., but get back to our other top stories as well when it comes to vacancies at the Fed, at the BLS, and, of course, redistricting efforts across the country.
That's right. Democrats fleeing Texas. We'll have a lot to cover, along with a stock market that just keeps reaching higher through this earnings season. So meet us back here at 5 p.m. Eastern on the late edition of Balance of Power, only on Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser. and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, live on TV, radio, YouTube, Bloomberg Originals. Carol Master, Tim Stenivek is off this weekend. In the house is none other than Matt Miller.
So happy to be here.
Are you?
Yes,
You
I
have a
really
long
am.
It's a long day for you.
Well, I mean, I spend this part of my day typically listening to you and Tim.
You do.
And so
You
I'm always
message-
happy to be here.
You message in a lot, so it's really fun to have you here. We're going to talk a little bit about the trade today because we've got equity investors back, Matt. It looks like some fairly broad-based buying, although we're just turning off our best levels of the session. I don't know whether it's just people expect that Fed rate cut sooner rather than later. What are you looking at?
Well, I was looking at the gains. So we're up 1.3%, and we were off 2% on Friday. So we still haven't made back what we lost on that day.
No, it's a really good point. All right, so we're going to talk a little bit about technology. We've got Apple's pep talk on AI. We're going to check in with Mark Gurman in just a moment. Palantir coming in with their earnings results after the closing bell. The stock has been on a tear. It's minting billionaires, so we're going to get into that a little bit later on. And then I mentioned we have a couple of C-suite execs.
Yeah, we're going to talk about how much they're using AI, their clients using AI, and we also have an interview with we'll replay an interview that Ed Ludlow did with the CEO of Joby after their acquisition of Blade.
Copter ride sharing. Generac CEO is going to be with us too as well. First up, though, let's get a check on that trading day. Let's turn things over to Charlie Bell.
Hi, thank you very much indeed. We are seeing stock surge. We are holding, as you mentioned, very close to session highs right now. With the Dow, the S&P, NASDAQ, they are all advancing back to work Monday. Right to the numbers here. We have got the Dow Jones Industrial Average up 485 points. That is a gain there of just about 1.1%. S&P 500 index climbing now by 1.3%, while the NASDAQ Composite Index also pushing higher. Your 10-year right now, 4.20%, with a 2-year, 3.68%. So bottom line here, the Dow, the S&P, NASDAQ all advancing. Spot gold up 0.3%. We've got West Texas Intermediate crude down 1.6%. And Bitcoin right now is advancing by about 0.7%. American Eagle Outfitters shares are surging after President Trump touted the retailer's advertising campaign featuring actress Sydney Sweeney. It was the topic everybody talking about over the weekend. Shares of American Eagle right now up by 22.4%. The Post, which initially misspelled Sweeney's first name, was subsequently removed from Trump's Truth Social feed. Again, though, American Eagle right now up by 22.4%. So the Dow, the S&P, and NASDAQ all surging. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
And there will definitely be some Sweeney talk later.
She has really good genes.
And what's wrong with saying that?
No.
I don't know.
Nothing wrong with that.
I don't know. We're going to talk about it with our TV colleagues. Here right now, we want to talk about Apple. Shares bouncing around today, up as much as 2.7%. Right now, near their lows of the session, down about, still up about 0.7%. This is as analysts have been raising their price targets on the company, some 17 changing price targets, 15 raising them by an average of 4.5% following their recent earnings. We also heard about Tim Cook's AI pep talk, and there are also some concerns, which may be what's weighing on the stock a little bit today, about U.S. tariffs on India and what that may mean for Apple products. So let's get to it. Let's lay it all out. Our in-house expert is none other than Mark Gurman. He's Bloomberg News managing editor for Global Consumer Tech, and he's out there in our L.A. bureau. Hey, Mark, good to have you here with Matt and me. Lots to talk about. First of all, what do we need to know? Is there real concerns about these U.S. tariffs in India and the impact it could have on Apple? What do we need to know here?
I think long-term, yes, to a certain extent. For the time being, Apple's still in a phase right now where smartphones and other types of consumer gadgets are getting an exemption, no matter where those products are being imported into the U.S. from. So Apple at this point is not going to have to pay those additional tariffs. No matter how high they go, we're still in exemption territory. But at some point, that smartphone exemption is going to run out. I believe it's in a couple months from now. And at that point, Apple will need to begin paying tariffs. That's not going to have an impact in all likelihood on the September quarter, but more likely on the December holiday quarter. And they have some padding in there anyways, given that's typically their most revenue-rich quarter of the year because all the new products really come out during that period. What I will note is we're in for basically a yo-yo game here. Apple's going to have to be moving things around dependent on where the tariffs are going to hit. they were very quickly able to move the majority of US iPhone production out of China into India. They'll again probably have to shift it around depending on where they're going to get the biggest savings. But at the same time, I do believe that behind the scenes discussions between Tim Cook, the CEO of Apple, and President Trump will continue to try to get as many exemptions for as long as possible on the company's products.
Well, and President Trump has been pretty open in stating that he wants smartphones to be made in America. How much production of the iPhone do you expect to be moved to the States?
None. I mean, they'll certainly make more components. They'll certainly claim they're doing some sort of manufacturing here, maybe small items, maybe things like packaging, maybe the final component manufacturing here. But in terms of the large-scale mass manufacturing that you see happening in China and India, at this point, that's simply not replicable in the United States. Even if Apple were to claim that they can do it in the United States on a logical level, I wouldn't anticipate that being able to happen at any mainstream quantity as long as Trump is president, if his term runs out in the beginning of 2029.
All right, I want to switch gears because you've got some great stuff, Mark, on the Bloomberg and out at Bloomberg.com, your Power On newsletter. You talk about Tim Cook talking to his staff and really giving them an AI pep talk. What did you learn? What are you hearing?
So Tim Cook held a rare company-wide meeting. This is for all employees in Cupertino. The fact is earnings was a huge beat. Tim Cook wanted to come out and celebrate. Hardly anyone was anticipating 10% annual growth. I don't think that's a long-term thing. I think it's a short-lived thing because of people wanting to buy the phones before anticipated price increases. You saw a lot of people coming on TV and lying that the phones are going to go up to $3,000 or $25,000. People got scared. They ran to the stores and they bought them. Who wants to pay $3,000 for a phone anyways? That's why you saw that 10% hike. He focused on a lot of things, but my big takeaway was artificial intelligence, talking about how this is something Apple needs to be a major player in. They need to grab it. They need to own it. They need to innovate. They need to invest in. My big take from that is this was a pep talk that Tim Cook should have given 3 years ago, right? We're at the end of 2025 here. The ship has sailed on AI, and Apple is not going to be able to make a meaningful impact at this point unless they make a major acquisition or a significant partnership.
Well, don't you expect them to do one of those two things? I mean, there's so much talk about, well, I guess I read Dan Ives' notes all the time. So at least he talks about Perplexity a lot and the fact that he thinks they should buy them. And they have made partnerships, most notably with OpenAI, right?
Mm-hmm. I think what Dan Ives is writing about was my story from 2 months ago saying that Apple's having serious internal discussions about buying Perplexity. And then he put his note out multiple months after that, agreeing with my take on there. So that's what you're seeing there. But Apple is contemplating Perplexity, dependent on what you see with the Google search deal. Also, serious contemplation around Mistral, which is a pretty popular and famous maker of large language models and other underlying AI tech out of France. There's all sorts of complication there with the European Union and the difficulties of an American company buying a French company, especially with the Digital Markets Act and all the policies happening in that region of the world right now. But I do anticipate Apple to make a series of AI-related acquisitions. I wouldn't believe there would be anything north of 10, 15 billion. There's no Anthropic here for 60, 80 billion or anything like that. Certainly OpenAI is a pipe dream of the Apple faithful, but I anticipate them to make some maneuvers there. In that meeting, Tim Cook indicated that 40% of the new 12,000 hires that Apple has done over the past year were R&D. They're shifting around some teams within the software engineering organization to focus more predominantly on AI. So they are making the maneuvers. It's just too little too late, if you ask me.
Well, and let me just ask you, the AKI team, what do we need to know about that? And are they now in on a chatbot or a ChatGPT-like, vehicle for Apple? Because it sounds like they've gone back and forth here.
Yeah, so AKI is this new Answers, Knowledge, and Information group. The person, Robbie Walker, who was in charge of Siri was removed from him because of all the delays and multiple issues. I don't have to go through unless you have an hour, I don't have to go through the laundry list of problems with Siri, but that was taken away from him. Now he's building a new answer engine, and this is designed to be an AI-ification of search. Again, this is all prep work for the anticipated breakup of the Apple and Google search deal. Apple's going to lose billions a year on this. They need a replacement. This is a good time for a reset.
All right, good stuff. Are you okay? Are you hoarse? Were you at a concert or something? Did I miss?
I lost my voice. Okay. I'm all good.
At Lollapalooza. Were you at the Dead show? No, he's in L.A., not in San Francisco.
As long as you're okay. All right, Mark Gurman, thank you so much. Bloomberg News Managing Editor for Global Consumer Tech out there on the West Coast. Hey, we're going to stay with big tech, and we're going to talk a little bit about Palantir. Stock's up about 4%, Matt, here, ahead of earnings. I don't know if you've looked
And it's
lately.
been on a tear.
Unbelievable.
Over 100%. It's more than doubled this year,
Yeah,
I'd say.
it's pretty amazing. All right, and we're going to get an update on the business after the close. Let's see what two members of our team have to say about it. Bloomberg Intelligence Global Head of Technology, Mandeep Singh, is here in our Bloomberg New York studio. And then we should remind that run-up in the share price has created a lot of wealth creation for folks. So we're going to get to that aspect of the story with our Dylan Sloan. He's Bloomberg News Wealth reporter. Mandeep, I want to start with you. I mean, it does just seem like this one, every time we talk about it, it's often in a positive way. What are you watching out for when this company reports?
I mean, the U.S. commercial segment revenue, that is the one which has seen the most traction, given they've launched this product called AIP, which is tied to AI and use of large language models. And that segment has grown almost 70% so far this year. Everyone is expecting growth to accelerate sequentially. So anything below 75% growth would certainly be considered a miss. The whisper number is probably higher.
Below 70%.
Yes, but that's, again, a pocket of their revenues. They have a high exposure to government revenue. And look, when a company trades at 90 to 100 times sales, 9 out of 10 times, no matter what the company does, a year from now or 2 years from now, the stock will be flat. And we have numerous examples of that, Snowflake being the most notable one, which is a comparable company to Palantir. It IPO'd exactly at 100 to 120 times sales. The stock has been flat since the IPO. The company has done very well. It's grown 30, 40%. But again, the expectations get so high. And look, to my mind, OpenAI is the fastest growing company, OpenAI, Anthropic. Even those companies don't trade at 90 to 100 times sales. So what makes you think of Palantir at 40% growth, even if it's 45% going forward, should command a 90 to 100 times sales multiple?
And that's why it's created so many billionaires, right? Dylan, there are now 5, I think, billionaires who are mostly co-founders of Palantir, but one, Shyam Shankar, is the chief technology officer. So it's making a lot of people a lot of money.
Exactly, yes. So we've been tracking this at the Bloomberg Billionaires Index for about a year now. And you mentioned up 100%, I think, in the past few months. But yeah, the stock's up, almost sixfold or so over the past 12 months. And in particular, Shyam Shankar, Chief Technology Officer, valued his net worth for the first time. He's at $1.3 billion. And he's another example of a non-founding team member at one of these companies who has achieved $1 billion net worth, which is something that we are seeing more and more recently. In the past few months, we've looked at Sundar Pichai over at Alphabet. We've looked at a number of board members and executives at NVIDIA who have joined that club too. So certainly a ton of wealth creation at Palantir up in the C-suite.
Well, and you also, it's not just, billionaires being created, but just investors in general. And you guys include that. It's the third highest volume of net retail purchases for any stock, Palantir. So you see retail investors also buying in.
Exactly. Yeah, really top to bottom. And in particular, it's interesting, looking at the senior leadership. Shankar himself is at, just over $1 billion, but some of the founders are significantly more wealthy as well. We're looking at Alex Karp, who's the CEO of the company, who, he joined the Bloomberg Billionaires Index a few months ago and is now, in the top 200 in the world. So it's really creating some serious.
Makes me want to watch and see if insiders are selling. I mean, Mandeep, when you see such, the enthusiasm, as you put out, you look at the fundamentals, you talk about price to sales, and it just kind of doesn't make sense. So any disappointment, would you anticipate? It's not like short interest is high on this one either. Investors seem to be all in.
Well, the investor base is quite interesting. In the case of Palantir, there is a big retail investor base that really loves this company. And look, software businesses are very sticky. So all their companies that are using the product, the U.S. Army, $10 billion contract with Palantir. Now, there is no finite contract duration. It's not as if the 10 billion will show up in revenue over the next 5 years. It could go beyond, but still it's a very sticky business. So that's why software business models are so good. At the same time, it is a very expensive product. So if you're an enterprise spending $40 to $50 million on Palantir, your other option is to go on Microsoft Azure, use OpenAI and Anthropic and build it yourself for maybe less than 20 billion. So a company that is technical enough to do it on their own probably won't go for the expensive Palantir option. But still, you know, if you're a non-tech company, Palantir gives you a very good choice in terms of a product that kind of hits the ground running out of the box. It gives you the functionality you're looking for. It makes sense of the data. So you may be willing to pay a premium price for it.
You might also be willing to pay a premium price if you've got connections to this company through the government, through the military, through the Department of Defense, right? Shankar joined the U.S. Army Reserve's Innovation Corps. So they're getting pretty cozy with the U.S. military.
Yeah, and that's a big endorsement, right? So if the U.S. military is endorsing your product, I mean, it helps you sell to large enterprises because everyone knows their product is good enough to be used by the U.S. military. So look, there are positives and negatives. My only kind of focus right now is the valuation. And I know historically when things trade at this multiple, it doesn't end well no matter how good the fundamentals are.
I want to come back to the CTO in just a moment, but we did see the stock take a bit of a hit last week. The information reported that the U.S. Department of Defense has been testing AI models from Microsoft and OpenAI. So there is exposure where some of the enthusiasm, the guarantee of government contracts may not always be there.
Well, and also, you know, you have to look at the competition. Now that everything is being reimagined in the world of large language models, Palantir is not a company that is native AI. They found a good pivot with AIP and they've been able to sell better, but there are a lot of native companies that are building on AI-based frameworks. And that's why I compare to OpenAI and Anthropic. I mean, these are some of the fastest growing companies. Even they're not trading at that valuation. So I go back to valuation because to me, there's nothing wrong with how good Palantir is doing. It's just the expectations are so high that they may not be able to satisfy them all.
Did you ever type GPTR on a given security?
I don't know that I did. Why?
You've done it, right, Dylan?
Absolutely.
Because you said you want to see if there's insider buying or selling. And I thought, well, the Bloomberg could show you that. If you do it with Palantir, you can see maximum shares sold or bought in a single transaction. They include Shyam Shankar, Peter Thiel, and $4 billion of stock was sold last year.
Yes, just last year alone, which was a really big year for insider selling. As we were covering that, it's interesting, you know, the timing wasn't really great, to be honest. We were looking at doing some math on if these executives and board members had held on, they would be they're worth a lot more these days. But Sankar himself, personally, last year, he had been a long-term holder. He joined the company way back in 2006. They're just their 13th employee, so he's really been there a long time and held on to most of his equity. But last year, he sold, I think, around $370 million in one transaction in December. So he started unloading some of his holdings. And
we know execs do this. Sometimes it's just part of managing their portfolio.
Yeah.
I know.
Well, sometimes you need a Rolls Royce.
Sometimes you need a Rolls Royce.
Yachts can get expensive.
Matt's here, everybody. Mandeep Singh, thank you so much, along with Bloomberg's Dylan Sloan. When we come back, we're talking with the CEO of Insight Enterprises.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They're holding close to session highs, off session highs, but still gains on this back-to-work Monday. A renewed wave of dip buying lifting stocks. Right now, the S&P 500 index up 81. That is a gain for the S&P of 1.3%. The S&P at 63.19. We've got the Dow up 493 points, now up by 1.1%. NASDAQ up 1.8%. The 10-year, 4.20%. The 2-year, 3.68%. Spot gold up 0.4% right now, up $13 the ounce, 33.76. And West Texas Intermediate crude oil slumping 1.2%, 68.80 for a barrel of WTI. Bitcoin up 0.8%. Bitcoin just above $115,000. Spotify shares surging after the company announced it is raising premium subscription prices across many markets outside of the United States. Spotify up right now by 6.1%. And Amazon says it is closing its Wondery podcast studio and will break up the audio services operations as part of a broad reorganization of its business. Amazon down by 0.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Matt, I know you like to read in over the weekend, and there was a Bloomberg News story that broke over the weekend. Did you know about this?
The Joby story that Ed Ludlow put out?
Yes.
Yeah, I saw that.
Okay.
For one thing, because I'm kind of into these air taxi companies. So Joby is a plane taxi, right? Yeah. But Blade, which has really cool marketing, is a helicopter taxi. So I thought it was kind of cool that they did a
Have you done this yet?
I have not ridden on either one of them. It's very expensive, so I drive cars and take ferry boats, but someday.
TBD. Well, as we mentioned, we did get the confirmation, something that Bloomberg News did report over the weekend. Joby Aviation planning to buy the helicopter rideshare business of Blade Air Mobility for as much as $125 million in stock or cash as the electric aviation pioneer seeks to expand its battery-powered air taxis into a ready-made market for its aircraft. Shares of Joby soaring on the news. Bloomberg Tech co-host Ed Ludlow and Caroline Hyde, the two hosts of that broadcast, caught up with JoBen Bevert. He is Joby's CEO, earlier on Bloomberg TV.
The first piece is that we're seeing unprecedented levels of regulatory support from the White House, from the DOT, from the FAA, really leaning in. You also have regulators around the world so excited about this new age of aviation. Second is where the Joby team is. We've been knocking out of the park on certification and really delivering on manufacturing, where we're doubling our manufacturing rate. And all of this sets the stage for commercialization.
Of eVTOL.
Exactly. And the key piece is the work that Blade has done, where they've built out an incredible network of takeoff and landing locations, exclusive lounges, and an attention to detail and attention to customer service that are really unparalleled in vertical aviation. And so this is the right moment for us to partner, and both by acquiring the passenger business, but also partnering on the medical business.
JoBen, when we broke this story over the weekend, and thank you for your time and coming on the show, the question I kept asking myself was, does this accelerate the eVTOL bit to market in the United States?
Absolutely, and one of the things that's so exciting, as I mentioned, on the regulatory support that we're seeing from the administration with the recent executive order, we really see the potential where that pulls forward the timeline, and that's one of the big catalysts for why we decided to pull the trigger here on the Blade acquisition.
In the interim, will you continue operating the helicopter rideshare bit? Does that business continue, or you just buy the assets and start planning from there?
Absolutely. We're looking to not only operate it, but to grow it and turn it into a much bigger business. And then we think that with the quiet aircraft that we're building, that we're going to see an explosion in the number of takeoff and landing locations that we can operate from. We're seeing real estate developers both here in the U.S. and around the world who are so excited about our technology and are clamoring for takeoff and landing locations at their developments. And so we just see unprecedented momentum in the market today.
All right, that again is JoeBen Bevert, Joby CEO, talking earlier with the co-hosts of Bloomberg Technology on Bloomberg TV, Ed Ludlow and Caroline Hyde. Check out the full conversation on the Bloomberg and at Bloomberg.com. We're going to stay with technology, Matt and myself. The tech solutions provider, we're talking about Insight Enterprises, reported earnings last week. Shares did come under pressure, down as much as 18% intraday, the largest intraday drop since 2009 after second quarter sales missed analyst estimates. The stock is down more than 20% year to date. We wanted to hear more about the business, the outlook, and what is going on with IT spending more broadly. Here with us is Insight Enterprises President and CEO Joyce Mullen, joining us from Chicago. Joyce, welcome to Business Week Daily. Before we get into the results, the outlook, just remind our audience about what your company does specifically and who your customer base is.
Yeah, sure. And thanks very much for having us today. Thanks for having me. You know, Insight Enterprises has been serving enterprise customers, small and medium business customers, public sector customers for 35 years or so. And we have evolved many, many different times. We announced a couple of years ago that we were creating a new category in our industry. We're calling it Solutions Integrator because we have invested not only in our hardware, in our software capabilities and skills with our partners from around the world, but also our services expertise. And what we know is that buying patterns are changing. Enterprises really are looking for results. And the way you deliver results with technology, now more than ever with AI, is by combining hardware, software, and services. So that's what we do, and we're proud to do it. And yeah, we delivered a pretty resilient quarter in a Q2, considering all the headwinds. We met our expectations and expanded profit, but yep, the market dropped our stock dropped for sure. And we're proud of the quarter we delivered. We just got to keep doing it, and it'll come back.
So why do you think the stock dropped so drastically?
Yeah, we're trying to figure that out, but you know, I think what we got to do is stay focused on delivering really strong results, expanding our margins like we've been doing, and then also making sure we take really good care of our customers. And our clients today are really focused on how do I put technology to work to deliver results fast, pragmatically, and simply. And this is what we've been focused on for a long time. We're pretty proud of the margin expansion that we saw in the quarter. We're really excited that Gartner named us as an emerging visionary in terms of all things AI. It's really the first time they've published that particular grid, and we're pretty excited about that designation, but we got to do it over and over again, and you know, we're ready to do that.
I mean, you have, Joyce, the execution down. You have amazing experience at sales and supply chain orgs, massive businesses with Dell and with Cummins before that. But you've got to be able to deal with the capital side of the business too, right? So you need to know what shareholders are thinking and what they want. Or is that not, do you think it just comes if you continue to do your work?
No, of course. I mean, we are working really, really hard to build out our capabilities organically and inorganically as this market changes. You know, I mean, I think AI presents enormous opportunities and frankly challenges. I think the traditional channel model doesn't survive an AI world where there's automated procurement and automated selling and all sorts of agents doing all kinds of work. And we are ready for that. We have been investing heavily in our own internal AI because if we're client zero for a bunch of our solutions that we've developed internally, we can also help our clients get those same results when we take them to them. And we've our number of AI assessments has quadrupled, more than quadrupled in Q2 from Q1. So we think this is really the catalyst that we've been excited about and preparing for many years. And now I think we're in a great position to deliver against those opportunities. But you know, you gotta demonstrate results every single quarter, and I think that's what we're prepared to do.
How much of it, though, is, you know, that customers, and I think this came out in the reporting following your results, that customers are just putting off new projects and they're saving for what they think they might need in AI. How much of that is going on, I guess, and impacting your business?
Yeah, we have definitely seen that, specifically, Carol, in our enterprise infrastructure business. So our infrastructure business around enterprise, our largest customers. And there's a lot of excitement around AI. There's also a whole lot of uncertainty about how to proceed. So I think our customers are looking for those no regrets moves that they can make. How do they shore up their infrastructure, but maybe don't do the data migration work quite yet because they're not sure which workloads go where. We're definitely seeing that type of hesitancy, and that's a reflection of, I don't think we're an outlier on this, but that's a reflection a little bit of just changing spending patterns in those enterprise IT budgets and making sure that people are prepared and ready to spend on the things that are going to matter most in terms of their own AI implementations.
Is it because
the good news is,
yeah, oh no, please finish. Please, of course.
I was just going to say, the good news is whether they decide they need a much more robust network or they decide they want to run a whole bunch of these large language models and smaller language models at the edge, we can help them, or they're multi-cloud, we can help them. And that's the idea. How do we turn their concerns into shorter term pragmatic projects, deliver results fast, and earn the right to do more?
How much of this I wanted to ask you, Joyce, is because they're smaller businesses or medium-sized business, and so I know that there's been this expectation that when it comes to AI of having on-premise facilities versus, processing when it comes to AI up in the cloud. So how much of it is it that those smaller and medium-sized businesses maybe want to have it on-premise, but they want to hold off?
Our commercial business has grown 5 years in a row. So that's that small and medium business space. We are really pleased with those results. And normally, after we come out of a downturn, the commercial business grows first, and then we see that follow in the rest of the segments. And that follow-on work is just starting to take hold in our corporate segment, but the large enterprises are usually the last to grow as we come out of a down cycle. I do feel like there's a lot more discussion about which workloads should run on-prem, which workloads should run in public clouds, and we're ready for those discussions. And we help our clients optimize multi-cloud implementations every single day. So that's a huge opportunity for us.
I just noticed the statement that the enterprise tech buying model is broken, and I wonder how you think the new model looks.
Well, I think the new model is really around those pragmatic projects that are simplified and deliver results fast is sort of the norm. That's how we buy. We don't want a big engagement that spans 7 years. We don't want $100 million contracts around our technology services and solutions. We want smaller, bite-sized chunks so we understand what the ROI is, and then we use the returns on that investment to pay for the next one and the next one and the next one. And that's how our customers are buying today. That is a pretty significant departure from kind of how customers bought technology support and services maybe 5 years ago.
All right, can I just ask you 10, 15 seconds, the pullback in spending, was it across industries or certain industries, just quickly?
Yeah, really, I would say it was more pronounced for large enterprise customers, more pronounced in those customers who serve consumers.
All right, gonna leave it there. Good to check in with you. Joyce Mullen, she's Inside Enterprises President and CEO. When we come back, our view from the C-suite continues this with a company whose share price was the best performing stock in the S&P last week. That's next.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got equities pushing higher, equities halting a 4-day slide. S&P 500 index right now up by 1.3%. Tech mega caps, which have borne the brunt of recent selling, leading today's bounce. Case in point, we do have NASDAQ up 1.8%. The Bloomberg Mag 7 index up 2%. The Dow up 520 right now. That is a gain of just about 1.2%. 10-year 4.20% with a 2-year 3.68%. Spot gold is up $12 the ounce, up 0.4%, 33.75. And West Texas Intermediate crude down 1.9%, 66.08 a barrel on WTI. Tesla has approved an interim stock award worth about $30 billion for CEO Elon Musk, a massive payout meant to keep the billionaire's attention on the automaker as a legal fight over a 2018 pay package drags on. Tesla shares right now, they're gaining by 2.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Really looking forward to this next guest. Generac, I don't know if you noticed, Matt, was the top performing stock in the S&P last week. It was up 25%.
And it makes a product that I think a lot of homeowners, if you don't have one already, you want your own generator. And I guess with these climate issues that we have, more and more people are pushed to buy one. Let's bring in the chairman, president, and CEO of Generac, Aaron Yachtfeld. He joins us after second quarter earnings. And I guess, you know, power gen has never been as exciting. You must be the most popular person at a cocktail party now, because it's not just a generator that people want at home, but because of the data centers and AI, everyone is talking about generating power. How's it working on your company?
Yeah, thanks for having me on today, guys. Yeah, it's like you said, it's never a dull moment when you talk about backup power. You know, every time I travel, I get on a plane, you sit down next to somebody, you do okay, what do you do? What's your job? Where do you work? I talk about Generac, and all of a sudden, you know, people are like, well, that's a product we have to have. You know, I think what we've come to find just as Americans, you know, we struggle with power quality in this country, and we have for many decades. This is not a new issue. I think, you know, what's worrisome is just the number of outages that are happening and how long they're lasting. And this is a growing problem, both for homeowners as well as businesses.
Yeah. So how much, Aaron, of your business is, me and Carol out in the suburbs, and how much of it is a company, you know, mid-size or even larger, looking to back up its data?
Yeah, about 60% of what we do is in the residential market. So that would be, you know, out in the suburbs, for homeowners who are looking for a solution for their family, for their property, protect those things. Businesses, you know, this is a business decision, right? With homeowners, it's a little bit different. It's a little bit more emotional, right? Just the loss of power and what can happen in your home. Certainly there's things that can go wrong. There's damage that can happen to your house. But largely, you know, that's an emotional decision. Whereas a business, the loss of revenue, spoilage of inventory, you know, some kind of interruption of a critical process, especially as things get more critical with in business with power, the need for that. We see about 40% of our business leaning that way, but that is a very large opportunity for us. And in particular, in some of the bigger applications where we play up in the data center market, it's an incredibly hot space.
Well, dig into that for us, Aaron. Like, how much growth are you seeing in that space? How many calls are you getting about that? Give us an idea of some of the demand and what that kind of gives you an indication of how much more that market could be for you guys.
Yeah, the market for data centers, I mean, obviously you guys cover this,
massive.
Very broadly. Yeah, it's massive, right? Like, I mean, the capital spending that is going into these facilities and all the equipment that goes alongside of them is enormous. And of course, the power needs themselves are enormous. But you can imagine the backup power, right? These are critical installations. If the facilities go down, we don't have access to the cloud. We don't have access to some of these critical things that are happening in data centers. So every single data center that goes in has emergency backup power. And so we're a relatively new entrant to this market. Our product lines have been smaller. We've served small business business and smaller data centers for many, many years. The telecommunications space, and an example is we provide backup power to a lot of the major wireless carriers out there. So this is a bit of a new space for us. We just entered it in April. We opened up our order book, and we've already booked $150 million worth of new business. We talked about that last week on our call. I think that was part of the reaction that you saw in the stock. But we're seeing just an incredible amount of demand for these types of products.
I'm always interested in where you're building these things. And I guess you have a new facility in Beaver Dam, Wisconsin, that's supposed to open up space to build those big diesel generators, more of the big diesel generators in Oshkosh. Tell us about your manufacturing footprint, because tariffs are obviously a huge issue these days.
Absolutely. And, we've been a longstanding U.S. manufacturer. We just opened our 6th facility in the state of Wisconsin. We have 7 here stateside. Those 6 facilities in Wisconsin, a good chunk of those facilities are focused on these larger units and on the commercial and industrial products, so those products for backing up businesses. But we're also a global company. We have facilities worldwide. We have a facility in China, a facility in India, Brazil. We have 3 facilities in Europe, and 2 in Italy, 1 in Spain. Have another facility down in Mexico. So, we're a global company, but we see, the demand for backup power growing, really across the globe. But we see what's going on here in the U.S. The addition of the Beaver Dam facility was a critical part of expanding additional capacity for these systems because the growth is it's enormous right now.
How much? So I look at cars all the time. Ford builds more cars in America for sale in America than any other producer. You'd think that would help them avoid tariffs, but in the end, they get absolutely crushed with tariffs on steel, tariffs on aluminum, tariffs on foreign-made parts, tariffs on magnets out of China. And it really makes up then more of a tariff hit than somebody building a car in Japan or somebody building a car in South Korea for export. Do you get hit with those kind of nickel and dime tariffs too?
We do. We use a lot of steel. We use a lot of aluminum. We use a lot of copper in every single gen set. So, in fact, it's interesting you brought up the automotive industry, Matt, because it's a real good proxy for, a lot of our input costs, in terms of the components, in terms of the commodities, the things that we're exposed to. So, we have a lot of those similar exposures. And I think just like Ford and others, we're trying to do what we can to minimize the impact of tariffs, but it's difficult. I mean, we've all developed over the last, 40, 50, 60 years, global supply chains, right? I mean, there are areas of the world where, certain components, certain commodities are only available, right? They're just not widely available in other parts of the world. So it's going to take time to recalibrate those supply chains and to try and create a more domestic manufacturing base. And I get it. I understand the need to do that, in particular around things that are, associated with defense, maybe pharmaceuticals, things that are truly critical. I'm not sure, when you look at the broader base of things that we're putting tariffs on, that, like tennis shoes and Barbie dolls, if that's, maybe the right place to do it. I think we've got to be selective and we've got to be strategic in how we use tariffs. But I know the administration's, working through all of that with all these different trade partners.
Well, some things, like magnets or rare earths out of China, we're never producing those here. It's like not an option, not in decades. So
it's challenging.
And you must use those. Are you getting enough?
We are. We're fortunate that we have the ability to kind of substitute for some of those super rare earth elements that I think are really critical in aerospace and defense. Not as critical maybe in the automotive, and in smaller quantities they are. But we have access to them today. But of course, that's a concern because, as you noted, there are only a few areas of the world where you can get those types of materials and those types of components. So it presents a really, this is a very complicated situation, a very complicated conversation. I understand what we're trying to do, but again, I think we've got to be super strategic about how we implement these trade agreements and these tariffs.
We are talking with Aaron Yachtfield. He is Chairman, President, and CEO of Generac. Hey, a couple of things that you said, and I want to follow up on. You are mostly selling here in the United States, but you did talk about what you guys are doing around the world, Aaron. Does it make sense to pivot even more so international with the energy storage solutions to places like Europe and China, given that the U.S. policies are now less friendly to something like solar?
Well, those are big markets to begin with, right? So, obviously we want to be successful with our energy products, the storage products in particular, battery products. Europe is a very well-established market. The U.S., is a good market as well. But obviously the policy changes that we've now codified here recently are going to have an impact on the U.S. market for solar and for storage. Now, a lot of the things we're looking at, though, even with the loss of those incentives and the loss of support here in the U.S., the economics of putting a solar system on your rooftop, depending on where you live, as the cost of energy continues to rise, this is one of the things we've talked about. We started out talking today about the quality of power. The cost of power is another element here that needs to be talked about, because as power costs go up and the cost of these technologies around solar and storage continue to come down, the economics, the payback, the raw economics of investing in your own power production on your rooftop or a geothermal loop or however you want to produce your own power and store some of that power continue to improve. And the loss of support, it may impact the industry for a year or two, but it will get back on track because, again, power prices are going up.
Yeah, it does feel like we're headed towards a power war, certainly here in the United States, considering the amount of power needed to really support all the AI that's going on. Having said that, you talk about these loss of these residential tax credits. You've got some new home standby generators, my understanding, is coming to market. Is that going to help offset, though, some of the loss that you are seeing from those residential tax credits, especially when it comes to your energy storage business?
Yeah, absolutely. So on the energy storage side, the loss of the credits, that's going to impact that business here short term. Our home standby business, that business it's never benefited from tax credits to begin with. So, it's the kind of thing that again, if you and Matt out in the suburbs, you want one of these products to back up your home so that, you protect your property, protect your family. There unfortunately were no tax credits available, even though the administration